Good morning, fools. It is indeed the beginning of another week. It is 8 a.m. here on the East Coast. I'm Jason Hall, joined by Rick Munarriz. Welcome to Fool24. Hey, Rick.
Hey, top of the morning to you on St. Patrick's Day, Jason. Good morning.
Top of the morning, indeed. I have got
literally top of the morning. So yes.
Yeah, it is. It really is. All right, so we're going to do what we're watching this week to kick off our programming here at the beginning of the work week. Fools, if you have questions for us, we want to answer those questions. Get them to us at slido.com. The event code is Fool24. Just always remember, this is for educational purposes only. We answer your question. We're not telling you what to do. This is not a forum for us to provide anyone with individual or personalized financial advice. We're happy to share our insights and our expertise and ideas, but remember, you have to own your decisions, and we're not here to tell you exactly what to do. All right, Rick, it's kind of, earnings is this is one of those weird periods for earnings where we're either at the very end of earnings or at the very beginning of earnings, depending on the company.
Yeah, and usually like this kind of usually March, definitely early March, is a lot of retailers, a lot of companies that have their fiscal years or fiscal quarters ending in January. But
right,
I was surprised. We have a lot of non-retailers also reporting this week, so there's never a dull moment. I don't think there is a slowdown now in earnings season because everyone's chosen to go with different calendars. But yeah, I think to me obviously last week was rough, and Friday's rally was welcome, but it's do we trust it? And I think especially I'm just looked at this morning. The futures show slight decline in the markets at the open, but it's small. It's nothing problematic.
It's more like a normal level of decline that we would see, like down a small fraction of a percent. So it's just the market doing something more normal.
Yeah, normal is good. And again, I don't mind the volatility. I think if you're an investor, you like the ups and downs because it gives you opportunities to get in and to sort of assess, hey, is this stock outrun my bullish thesis on the stock if it goes too high? But also on the way down, the same thing. You have an opportunity. Hey, these are some stocks that I really liked before, and I thought they were too expensive. Maybe now they are right in my price range. So volatility could be your friend, but it doesn't feel good while it's happening. If anyone that is long the market, of course. So
yeah, no, that's exactly right. And I think the hardest part, and we talk about this a lot, like we'll slow, and I'll do it at some point during this hour, is we'll put up the charts like showing the long term and how it makes even massive market sell-offs, like for those that were around in 1987, where the market fell by a quarter, in days. Really, it was mostly one session that knocked 25% off of the market. And of course, the .com crash, the pandemic that we went through, the financial crisis. You stretch the chart out long enough, and those things just look like little tiny little dips, right? But the reality, when you're in them, they're a lot. They feel really, really big. So having the mindset, and then having the framework for your investing, the structure of your portfolio, all of those things around based on your short-term and long-term goals, so your long-term wealth is exposed to stocks, your short-term needs are not. And that's how you unlock the power of the volatility on both sides, right? Because volatility is up and down. We say the market's volatile when it's falling, but it's just volatile when it's moving a lot. And over the long term, that volatility is our friend. And in the short term, we can make it either benign or our friend by building a portfolio based around our goals, having good asset allocation, and then being able to be opportunistic in the short term, but still thinking long term with those moves that we're making.
Yeah, I agree completely. I mean, again, we tend to be long-term investors. That's the goal. That's the ideal. But you watch the short-term moves. Basically, a long-term, just like a month is a combination of how the 30, 28, or 31 days play out. Same thing with investing. It's okay to watch the market on a daily basis. It's okay to react if you find an opportunity to buy, or if your bullish thesis falls apart and you want to sell. But it's just a much longer time frame that you have to be looking at, not just this crazy week we just had, or even what this new week will bring us.
Let's do this. I'm gonna start off here I'm just gonna name a list of companies that are reporting this week, and after I name them, these are just some of the notable ones. Of course, we're in a market of thousands of companies just trading on US markets, which means that any week, every week of the year, somebody's going to be announcing some financial period. But there's a few notable ones this week. So today we have StoneCo reporting after the market close. Tomorrow morning, I believe we have Ollie's and Five Below reporting. Thursday, we have Nike, Academy Sports reporting. We also have Micron. So we're getting, still the tech semiconductor, one of the biggest memory makers in the world. Lennar reports on Thursday as well. So one of the home builders recently made a big move to like further like make their business even more asset light. And then Friday we've got NIO, the Chinese EV manufacturer, and Carnival Cruises. So kind of an interesting mix. And like you said, a lot that are exposed to retail or to the discretionary consumer spend. What of those are companies that you follow or interested in, and what are you thinking?
Yeah, so Five Below is a very interesting company that I follow over on the rule breakers side of the world. And again, this is a company that when they came out, they were disruptive. They broke the mold. It's true to their name, Five Below. That's what they sell. You go in there, and it's every product is priced $5 or less. But again, but the initial appeal, pretty much most of the appeal, isn't like basically like a Dollar Tree or Dollar General where you get a wide range of customers. Five Below, they tend to have like sort of a trendier merchandise, and that tends to bring out a lot of young shoppers. So it's basically a lot of teens and preteens would go to Five Below, and their parents or on their own. Either way, it was this very specific clientele. And for years, the company was delivering great growth, and they were popping up everywhere. It's like expansion was just, hey, this works. Even though it's technically a big box, it's sort of a large space for a store. They could fill up with a wide variety of merchandise, and then things they started to sway away from the model. So this was originally started by the two guys that if you remember, if you're old like me and you remember like old toy stores, a toy store called Zany Brainy, which had sort of like they were like toys, and it was like a toy store, but it was more like a not learning toy store, but like sort of creative toys. It wasn't just a matter of just board games and dolls. It had a lot of thought went into their merchandising. So this team started the Five Below, with the same kind of concept, just make it a fun, festive environment, where hands-on kind of environment for shopping experience. Despite it's technically, not a dollar store, but a $5 store. A lot of things are even less than $5. So the company struggled. And recently went through a CEO change last year, and everything was going rough for them. And the stock took a big hit last year. The stock's down about 2/3 of its value over the past year, so not a good stock. But their last report was promising. Their last report was a beat. It was a beat on earnings, beat on revenue. Again, not the great comps growth that we had from before. This is a company that was struggling with negative comps and had to slow expansion. But this is a very important report because that last report was very, while the stock didn't respond necessarily positively, definitely not over the past year. Here it is now. It gave us a glimmer of hope 3 months ago. Now, can it deliver on that? And I think that's the important thing, especially with a lot of these with earnings season, is a stock that's been hit hard. And a lot of stocks, this stock was hit hard before being hit hard was fashionable the past couple of weeks. This stock was just slammed last year when a lot of stocks went up. But will it be able to live up to the expectations? And expectations, because expectations are low, but will it be able to continue, at least take that second step? And again, when there's a shuffle in management, and one of the founders was on to help everything, so a lot of things are happening that seem to be like, hey, maybe this is it. And again, we'll find out in 2 days. We'll find out whether it's real or not, if the turnaround is actually happening. So a lot is riding on Five Below. And I love these situations where a company's starting to turn around, at least not, again, and I don't mean back to the glory days of Five Below of double-digit growth and all that, but the point where they are starting to turn the corner. And will they continue to turn the corner here in its next report, or is this just going to be that was just a fluke? The last report back in January, I believe, or will it be the real thing? So definitely a company to watch this week when they do report. One of the retailers that I'm really keeping an eye on. It's for most retailers that are reporting, you went through the holiday season. Five Below isn't necessarily like a holiday shopping store. They're pretty much all year round business. It's not that heavy seasonality you find in some stores. But yeah, there's a lot riding on this report. I think especially because everything the company's been through.
Well, a couple things just to hit there. So very much on the discretionary edge. There's nothing in those stores that you could really qualify as a staple thing that people are buying. But because of the fact that it's right there in the name, it is a store that could potentially have a little bit of counter-cyclical resilience because kids still have birthdays. People still want to get rewarded and treat their kids, and very much focused on, a young end user, whether the customer is the kid or the parent. So it'll be interesting to see how that plays out based on, the health of the economy as we continue to learn more about that. But just, I wanted to put some context on the results it was its third quarter that it reported, that goes through November 2nd. So again, right before the holiday season. The big number is that comps were up almost 1%, about 0.5%, right? Revenue was up about 15%. So they continue to expand and open new stores. But context for that, so that was the third quarter, comps up just a little bit about. Through the second quarter, comps for the full year were down 4%. And in the second quarter, they were down almost 6%, like 5.7%. So again, moving from bad results to, okay, this is signs of positive, a turn, signs that maybe something that management is doing to refocus the business is starting to deliver results. Yeah. Okay. I'm most interested of all the companies that are reporting this week. I'm most interested in hearing from Lennar. I follow the housing industry and home builders really closely. Lennar is a home builder that I own, largely because the stability of the business is great. It's one of the largest home builders, and they made a move in last quarter to spin out their development business, the part of the business that would actually develop land assets, put in the infrastructure, and get it prepped and ready to actually start building a community on. They've spun that out to shareholders. I believe they retained a small portion of it, but it's mostly been spun out to shareholders. And I think the long-term intent is to not own any of that business. And the move was made again to further deleverage Lennar as a home builder, because the challenge with home building is, number one, it's very cyclical. The ups and downs of housing demand are, can be brutal at times. Demand can shift, based on interest rates, or, we have to have a house. We have to have somewhere to live. We don't have to buy a house. And it's a decision that people can pivot away from very quickly based on the economic conditions, and makes it for, like banks, their earnings can be very, very cyclical based on what's going on with the economy and demand. But building homes costs a lot of money. You have to have land. If you're a successful large home builder at scale, you need a pipeline of land to build on, right? You can't just finish a community and then send out your land people to go find a new one to buy, and then spend a year negotiating and buying and then developing it, and then you start over. You have to keep that cadence going all of the time. And because of that, you're spending a lot of money on assets that can take years to generate any return. You buy land, you own land for, 2 or 3 years sometimes before you actually start building on the land, sometimes longer. That's unproductive money. The debt that sits on your balance sheet, again, it's already a cyclical industry. So you're adding a lot of leverage and unproductive assets to a cyclical business. So the idea is to have less and less of those things internal, and be able to buy developed land or acquire land through a option contract. So you pay a premium. So you've got a little bit of capital at risk, but you're not taking on debt, and then have the ability to have an expiration date, just like with options that we use for acquiring stocks. Have a price agreed to and a date, and have that as your capital at risk is the premium that you paid. And then you acquire the land when it comes time to actually start developing it. And now, instead of having that development assets and the payroll and all those things on your business, you've got a third party that you work with. And this is becoming a little more normal for the industry to do this. They already do it some before they spun out the business. So now they're doing it entirely. So you get all of those assets and the leverage off of your own balance sheet. And I'm going to be interested to see how that transition is going for Lennar, in addition to what their guidance is for the rest of the year. We've heard from most of the top 10 home builders we've already heard from. I can't think of a single one we haven't yet, that have given their guidance and told us, what their outlook is for 2025. And I'm curious to hear what Lennar, again, one of the biggest, has to say, because we do know that labor is starting to become a bigger and bigger challenge, as we're seeing more and more deportations. I've talked about it before, Rick. The housing, home building industry has massive exposure to immigrant labor, particularly in the hottest markets, the Sun Belt, the Southeast, Texas, carrying even further over into Colorado. You move into Southern California. It's in a lot of markets, it's more than 1 out of every 5 home building laborers, and a lot of them are undocumented. The industry doesn't employ most of its home builders. It's a lot of day labor and contract labor. So there's a lot of risk there. So hearing more about what management says about that kind of potentially, because what's going to happen, Rick, is the smaller the labor pool is, there's still a lot of demand. There's a lot of pent up demand for housing. Labor costs are going to go up. We saw this happen back in 2016 when a lot of home builders started to try to reaccelerate building. A lot of builders had retired following the financial crisis, and the industry was really, really chasing labor, and labor prices went up and margins went down writ large. Now you put in potential tariffs on lumber, and 2 of the 3 L's of home building are getting potentially really constrained and expensive in land, labor, and lumber. Land supply broadly looks pretty good for most of the industry, but I'm interested to hear more about those near-term headwinds. I think, again, thinking as a long-term investor, I still think we have a decade of really, really strong demand for home builders just to try to meet the missed build from 2010 through 2016, 2017, before we started to see an acceleration in permits and building activity.
Yeah. So Lennar, you mentioned Florida, Texas. So Florida, I live in Miami. Lennar is basically maybe about 8 miles away from where I am right now, their headquarters. It doesn't mean that they build all over the Sun Belt, all over the Southeast and beyond at this point. But it is the kind of thing, what you mentioned, labor. Yeah, it's obviously very critical to them, especially when construction is hard work. And roofing is hard work, especially in the Southeast. When we get to summer, you need to have a certain kind of temperament, and that often is the immigrants that came in and just said, "Hey, I'm willing to do anything to make money, to send back home to my relatives who are still back in my home country, or do anything to work." So it is the kind of thing where obviously it will get more expensive to build new homes, and I think Lennar and the home builders in general, they sort of feasted a couple years ago, the initially post-pandemic, when no one wanted to leave their homes, but there was this whole call where, hey, you don't have to work in the office anymore, and everyone was just moving to the suburbs. And Lennar has some beautiful communities, usually not in the heart of a city, but in the suburbs where they can buy the land and develop it. So they had double-digit growth in fiscal 2021 and fiscal 2022, but fiscal 2023 revenue grew 2%. It doubled to less than 4% in this fiscal 2024. So now we're getting the first quarter of fiscal 2025, and I think, it's interesting. And I know it's always, it already went in waves, so we already know general demand. We know what's happening with, and the general what's happening, and especially with home builders and Lennar in particular, the quarters are lumpy. They're going to be lumpy. So don't panic when there's a decline, or panic or get overexcited when there's a big jump, because maybe it's just one quarter where everything was delivered on time or ahead of time. Right. It's just, you got to look at the backlog of homes and all these things. But yeah, I think I'm really interested right now, especially since interest rates, while it's a really weird environment, mortgage rates actually sort of started to dip. And I don't think it's at the point where if you have a home, it's not going to stir enough activity to get the pre-sale, the resale market, homes that people are ready to move down. But it's still a good climate for new construction, because we need new construction, regardless of everything that's happening. We're still underbuilt, and I think that's a long-term bullish thesis for Lennar. But yeah, the report will be interesting, as it will be, especially since it's the latest read we have on housing. This is a market that's been changing in a very volatile market with consumer sentiment, do people want to make a big ticket purchase and buy a new home, or young couples or young families, or just people, do they want to make that big move at this point? And so Lennar is going to be a very important report this week.
Yeah, I think so. It's interesting. It's worth mentioning too that the home builders too, that one of the arrows they have in their quiver is they do, because they're building the house and they have some ability to work. They work with a lot of lenders. They can buy down rates as promotions to bring the interest rate down to help, from a marketing perspective. If you can show a 25 or 50 basis point lower mortgage than if you're buying an existing home, those things can increase traffic. And like you said, Rick, it can be incredibly lumpy. A perfect example was, last year compared to the couple of years prior, where coming through and out of the pandemic, home builders writ large blew through their inventory. There was so much demand in the low interest rate environment, plus the shift to more work from home and hybrid work. So many more people immediately became a buyer, and blew through the inventory, and they've largely rebuilt the land pipelines. And this is the first year that I think in the past 3 years that Lennar is going into the year with what they want to have in terms of active communities. So like you said, it's going to be really interesting. Let's talk just really quickly. We've got some questions that are coming in. And now, Rick, this is the first Monday where we're going to be on YouTube streaming for the full day of programming too. So those of you that are watching on the YouTube stream, welcome. It is awesome to have you on here with Motley Fool members, paying members, to be able to access Fool24. So just to mention it again, to make sure everybody that knows, since we're streaming behind the paywall for Motley Fool members and on YouTube, we use Slido for getting question submissions. There's no comments on the YouTube. So go to slido.com. The event code is Fool24. Get your questions into us. And just remember too, this is not a forum where we're providing anybody with individual or personalized financial advice. We're happy to answer questions, but just remember, this is not individual or personalized financial advice. So Rick, we've gotten some questions come in, but I want to say one thing before we start taking questions. We mentioned retail. We mentioned home builders. Academy Sports is another company that's reporting. We're starting to get some of those macro reports as well. This morning, we're going to get the retail sales report at 8:30. That's always interesting to see. I think it's for February. The Home Builder Confidence Index comes out at 10. That's from the North American Association of Home Builders. I can never remember which the exact name is, but it's the survey, the industry survey that's done. And then tomorrow we get the housing report. So housing starts and new permits. And we're going to hear from the Fed chair on Wednesday. So some things people are going to be wanting to hear. Let's move into the questions. What do you say?
Yeah, sure. Let's do that.
Right.
Well, I have and again, this was actually from yesterday, and I know there's some great questions today, but I came in, the last question asked last night, it was not answered. No Noise has thoughts on Reddit, and do you consider it a rule breaker? And Reddit is not reporting this week, but it's been very volatile lately. Reddit obviously is the popular online discussion forum that went public last year, basically almost 52 weeks ago. Went public like March 20th or so, 21st or so. So almost a year since its debut. And it went public at 34, and it was a 5-bagger. It was one of the, if not the best, it was one of the best IPOs of last year. Closed out the year about 166, I believe. So definitely a 5-fold increase in the stock. And it went as high as like 230 as recently as last month. And now it's given back nearly almost half of its value. So, and it's not that the company's had bad reports. It's not that the company's doing anything wrong. But it is the case where it's just an overextension of what's happening with a lot of these stocks. And in the case of Reddit, when they hit the market, it was the kind of thing. The one thing that was holding Reddit back was will it be able to monetize this platform? Because as you know, anyone that knows Reddit, especially some of the more vocal communities in there, it's a community of communities. It's basically, in many ways, it's very old school, like the old bulletin board systems of the early internet days, but sort of extrapolated. And so, if you have a specialty, if you're a fan of a specific show or an industry or you have a hobby, odds are there's a specific community already with hundreds, if not thousands, if not tens of thousands of members in it. So it's a very interesting place. But it's always whenever advertising tries to get in there, it's like, oh no, it's invading our space. But again, something has to pay the bills, and this is a free service to use, so this has to happen. And I think the most exciting thing about Reddit is how it has delivered since it went public. So the year it went public in 2023, it was up 21. Revenue was up about 21%. Over the course of the year, in the low 20s. I don't have the number in front of me, but this is how it's done since it went public. It was 48% back in March for the March quarter, which is the first month that they were partially publicly traded, then 54%, then 68%, then 71%. So this is a company that has dramatically accelerated its top line growth in the last 4 quarters. And in doing so, has sort of just, silenced a lot of the bear theses on the company. But here we are now on this end where the stock has corrected sharply because maybe it did overrun its initial hype. And where are we now? So I think Reddit is an interesting company, and I'm encouraged by the growth momentum the company has. I'm encouraged the fact that there's a lot of things to be worried about, like, this community or the CEO may have done this back, and he may have had a fake account back in the early days of Reddit. All these things that that are sort of like not ideal in a growth company. That it's sort of like so Reddit is not a rule breaker right now, but it is the kind of stock that has a lot of the traits: great growth, accelerating growth, and disruptive, even despite this being a throwback forum. So it's a stock that I watch and I'm excited to watch. But I'm very interested in how far the stock pulls back and to see if it gets back to how low. I will get back to double digits. I don't know. Again, this stock went public at 34 and now at 130. If you bought at the IPO, you're still almost quadrupled your money. But it is the kind of thing that it's definitely bears watching as far as Reddit goes. A lot of interesting characteristics. I don't think growth can keep accelerating from here. That's the rub. You're at 71% for an established platform. It's going to take a lot of monetization, a lot of growth and community to make it happen. But that's my take on Reddit. Sorry, Jayson. I mean, if you want to tackle a little bit of Reddit or just tackle a more current question, I'll look at them now. So yeah.
No, Reddit. I'll just add on the thing about Reddit that's most impressive to me is the engagement continues to remain very strong. And if you're going to be a successful social media platform, your monetization is going to be advertising, and you have to maintain an engaged base of users. And it seems like as they have increased ads and increased those ad placements, there's been grumbling, but it doesn't seem like it's upending the model and affecting engagement by users. And that's the most important thing, is finding the tension between maximizing your revenue generating opportunity with ads without upending the thing that brings people to your platform. And I think so far they've done a pretty good job of managing that. It's probably helped too. Just, I'm sure they've been able to increase the monetization because we've been through a pretty healthy part of the ad cycle. And I want to mention that anybody that's following this business is that because it is an advertising based business, if we go through a period, eventually we're going to go through a recession, whether it's this year or 5 years from now, we don't know. But when that happens, ad spend gets pulled back really quickly. We've seen it happen with Meta plenty of times. That it's the reality of these platforms is that when ad spend gets pulled back, they do get hit and the revenue gets affected. That's why focusing on those engagement metrics really tells you a lot about the health of the business through those cycles. And sometimes we get the better opportunities to buy when that happens. But it's an interesting one. And it's one that I kick myself on, that I really was considering buying close to the IPO, but I generally don't. But it's put itself back on my watch list because the business has done well and the stock has come down. So that's where we are. All right. So let's see here. I'm going to take Ed's question from 17 minutes ago. Do you think Home Depot will get a pop in its stock price since we're traditionally going into the busier season? Would you consider selling Home Depot and buying Trex? So this is an interesting question. So Home Depot, of course, the largest of the building retailers out there, the home improvement retailers, a giant. Their opportunity for expansion in North America still exists, but it's small. The business is actually, I believe, at a point now where comp sales is the larger portion of its revenue growth, which tells you how large and mature the business is. They made an acquisition last year to start getting into distribution. So there could be like another leg of growth there, because that is a very, very fragmented space, just the distribution. So if they could start acquiring and build something in that distribution space, there's a lot of opportunity for consolidation there. But the risk of that is moving into a business it's proven at. I know they know logistics really well. You can't get as big as they are without knowing how to move goods around effectively to get them where they're going to sell, minimize your transportation costs, and be able to continue to turn your inventory quickly. That's one of the things they've done better than Lowe's that's resulted in their better economic returns is they turn their inventory a little bit faster. And there's a lot of value to that when you are dealing with low margin stuff like lumber. If you can just turn your lumber 10 or 15% faster than your competitor at the same margins, you're going to be a lot more profitable. So things like that they're able to do that matters. I don't necessarily know that, and I think it's a little bit of a lower F fool's game to try to look for a pop just based on seasonality. And yeah, we're moving into the spring. It's warmer. People are going to start going to the garden department and buying plants and flowers and that sort of thing, and start working on some of those outdoor projects and that kind of thing. But this business has been around so long, I don't know that there's necessarily a lot of momentum that can be created around that. If there's momentum in this stock around the spring, it's going to be because we're hearing like macro reports that are positive about consumer spending, and traders are going to see it as a stock that there could be an opportunity to try to get into, right? So again, those are all kind of near-term things. I think the real catalysts for Home Depot are the aging housing stock. We talked about that opportunity for home builders to meet demand. Home Depot is not selling lumber to home builders. They're going to the big distributors and they have long-term contracts and they're buying massive amounts of lumber. They're not going to the DIY guys to do that. So what you're going to see is the opportunity for just improving the existing stock of housing. And it's approaching 40 years old on average in the US. It's very different from one market to the next. I know down in Miami, there's some older housing, but a lot of Florida's housing was built in the past 30 years. A lot of it was. You move up to where I am in the Northeast, and my house is 31 years old and it's new, right? So it's very different. It can be different regionally, but that aging housing stock is a real opportunity, particularly as we see one of the headwinds for companies like Redfin that's really struggled selling existing homes is that the existing inventory for sale is like half of what it historically has been in a healthy market. So we're seeing a lot more people staying in the house that they have. And that includes a lot of baby boomers as they're retiring or retiring in place. And they're going to need to do improvements to those homes, better lighting, safety things, accessibility things as their health needs and mobility needs are challenged. I think that's probably the biggest catalyst for Home Depot going forward, to leverage its scale, to continue to do the omni-channel things that they do really well. I'm not looking at any really near-term catalyst for it. I think the stock is interesting at this price and valuation. If you're looking for a stock that can grow sales, if they can grow sales 5 to 7% a year, use their operating leverage and turn that revenue growth into 8 to 10% a year earnings growth, earnings per share growth, because they buy back shares too, and then put their dividend yield on top of that, all of a sudden you're getting, depending on the year across the cycle, 9 to 12% earnings per share growth if they're really executing on their business well. They've kind of lapped some of those really tough comps period coming out of the pandemic, where so much money was being spent on people that they had to do something with the house they were in to improve it, to make it usable, functional. They weren't going on vacations, weren't going out to movies. A lot of pin-up discretionary capital went into people's homes. So we're starting to lap those results. And like when interest rates shot up, that really kind of put the brakes on their business. So going forward, it's going to be interesting to see, kind of getting through some of those tough periods, how they're able to capitalize. And again, over the long term, I think there's an interesting opportunity here, but it's just not built to be a world beater stock. I do prefer Trex right now. And I know this is a company you can talk about, because I'm looking more for a business that is able to leverage its ability to grow. They've deployed some capital and got plans in place to expand their manufacturing footprint. And 2 or 3 years from now, I think we're going to look back and their margins are going to be really good. Their capacity, they're going to start leveraging that capacity really, really well. They're going to have manufacturing closer to some of their markets. So thinking about logistics and driving out distribution costs is going to be beneficial for them. It's the dominant brand in the business. And I think you have a whole generation of home buyers right now that are prioritizing a product that's recycled, that doesn't require the maintenance, that lasts multiple decades, versus, cutting down forests and wood, and then the chemicals and things to go to treat it. How much of that is perception versus like the reality of the impact, is another conversation. But Trex is the best operator and still has substantial amount of growth ahead of it over the next 10 or 15 years. So I think Trex, but again, I think there's maybe a rough period for the business, where it's kind of lumpy and it's maybe not the same 15% revenue growth a year that we've seen over a lot of its history, over the past 15 years. But I do like Trex. I like Trex a lot at these prices. Rick?
Yeah. I like Trex too. And again, well, Jason was talking about like the seasonality of Home Depot. Trex is really all about seasonality. This is the time of year, like right now in the next couple months, this is when people are going to say, the weather's getting nice. I want to extend my outdoor living space. Now's the time you build. You're not going to build in the middle of winter. You may not even build in the fall, knowing that, hey, why build when I'm not going to be able to spend a lot of time out there? Now is the time. Springtime is that one peak period for Trex. It's a do or die time for them. But as Jason mentioned, I mean, it has been hit a lot harder. Home Depot has plenty of things. I have a plumbing issue. I lost a shingle. All these. I want to build something out. Trex has only do one. I mean, they do other outdoor things. Railing and gazebos and stuff like that. They've expanded what they do and they offer. But it's pretty much live and die by the outdoor decking, wood alternative outdoor decking. And as Jason mentioned, there's obviously the eco implications. But even without that, a lot of people, regardless of whether you think, oh, this is really going to have an impact, even if you don't, they're saying, hey, if anyone's owned a wood deck, and I can say I have, it was terrible. Every year or two, at least 2 or 3 years, it'd be kind of thing where it gets splintered, it gets messy. So you got to basically, grind it down, restain it, and finish it, and all these things. It's a process. That's the beauty of Trex. You're paying a lot up front, but very little maintenance for years. That's what makes them stand out. This wood alternative platform that's made, I think, about 95% or so, 95% of recyclable material. Right. Yeah. Yep. So it's a product that appeals to people, but again, it will be volatile, a lot more volatile than Home Depot. The revenue was declined in the last 2 years, negative growth, not a lot, but negative. And it's the kind of thing where, hey, it needs it needs the market, it needs especially the resale market to catch up. So they need people to start trading. They need inventory turnover because when you go into a new house, you look around the inside and you go, I want to do this, I want to do that, and mentions there's a lot of grass out there. I would love to make this a deck, and so all this needs to go right for them. We'll see. No. I'm excited about it. So one question I saw here, Jason. Matt had asked, will either of you be watching Sportradar earnings on Wednesday? So, Matt, I know I've spoken to you about Sportradar, Genius Sports, these two companies that sort of work with the data of sports, and it's cool from a perspective that obviously the betting market needs to have this fresh data, but you also have media companies that need it. There's so many different demand to make sure that they're getting the right sports information. So you have these companies that are dedicated to this. This is, I believe, they're based out of Switzerland. So it's an international company, which is not a problem because sports are international, of course. And this is a company that is reporting earnings on Wednesday. And again, 4 years of better than 20% growth, revenue growth in the last 4 years. That is good. Obviously, the pandemic year was a slight decline, but still positive, but now really growing at a nice, healthy clip. And what you're seeing now, especially expectations into what do I expect into Wednesday's report? And so this company that's basically had double-digit beats on the bottom line for the last 3 quarters. That's good momentum, but revenue is slowing down. And again, after we've seen this, 20% revenue growth in 2023 accelerate through 2024, now we're seeing that the forecast for this is revenue is up to 17% and less than 15% growth for all of 2025. So it is a thing where the business is slowing, but I wouldn't be upset at double-digit growth. Obviously, investors will want to see acceleration and anything that sort of leads to that. But I think momentum tells us that we may get a bottom line surprise, but maybe the top line may not be that impressive. At least that's the way momentum from the analysts community that follow it a lot closer than I do is going. But yeah, it's definitely an interesting market and one that you thought, there should be more competition out there. But the companies that are doing it, the two publicly traded companies, tackling different aspects of data, sports data for the gambling and the entertainment community, media. I do think that it's Sportradar technically is under the radar, so to speak, just to bring the second half of its compound name there. That it is kind of like an obscure stock, maybe because it's based out of Europe and people just may not have the same kind of affinity to it. But I think it's a very interesting company, and it's a market that I think will only grow because even even at a time when people are not really watching as much traditional legacy TV as they were, live sports still gets people to watch stuff, and live sports has managed a way. The companies like the DraftKings and the Flutter of the world with FanDuel have gotten a lot of people excited about just casual betting, not having to go out to call a bookie or go out to Atlantic City or Vegas or Reno, wherever you are, to find a legal way to gamble. But it is a way that it is getting to the point where I think this is a market that will continue to grow. But again, obviously, at least as far as what the analysts see, and I am not taking that deep a dive in Sportradar, the report that's coming this week, they do see revenue continuing to slow down from here.
I'm going to take Cena's question about Millrose Properties. That's ticker is MRP. This is the development business that was spun out of Lennar. So his question, have I dug into it yet? Pros and cons as a business. So I haven't yet. I haven't fully dug in. So again, I own Lennar. So I actually was awarded a very small number of Millrose shares as part of the spinoff. And it is on my list of, let's get out of earnings season, focusing on, the companies that I cover, a lot of it for the work that I do for the Fool, and then start kind of peeling back the hood and look at it. So the thing that's interesting about it is there aren't a lot of these businesses that we can invest in that do exactly what it does, because the key is that its business, again, is acquiring and developing land assets and then selling those land assets to a home builder on an option. Like that's their business, is doing the options with home builders and not just selling off the land. So I think the goal is, because we've seen more and more home builders, in NVR, Rick, they kind of set the standard as building this asset light home building industry with the land options model. What a lot of people don't realize is that they did that innovation not to disrupt the industry, but because they went through bankruptcy, and coming out of bankruptcy, they had to figure out a way to acquire a pipeline of land. Not a lot of creditors want to issue credit to companies that emerge from bankruptcy. So they decided to pursue this option as entirely this path is their entire land acquisition strategy, and built what has become the best investment story in the history of home builders. It's a wonderful business. I believe they were profitable every quarter through the financial crisis. One of the biggest real estate crashes in modern global history, and the business came through it okay. I think the Japan real estate market's the only one that's ever been worse. Some of that real estate's still cheaper than it was 25 years ago. But the reality is that for home builders, it was a brutal period. And so the two things, the innovation with the land options strategy, but also having an integrated business where they do some financing and they make good money, originated mortgages for a lot of their home buyers. So they built a good, integrated, strong business doing that. But we've seen more and more home builders realize, hey, this is a really good way to build out a land pipeline and build out that portfolio of land. So Millrose's strategy is going to be to do that, not just to sell land, but to sell the options on the land and work with the home builders to prep and get the land ready to build. So they did a deal right after they spun out of Lennar, like a few days later. So the deal was already ready to go, where they acquired 24,000 home sites from Roush Coleman, which is a home builder, and immediately signed an options contract with Lennar. So, that's had to be already in place for them to be able to move that quickly. And the reason why is Lennar bought Roush Coleman. So they wanted the home building assets, but they didn't want the land on the books. So what I do think is important to watch is as Milrose stands up more and more and becomes more independent and starts to diversify itself away from Lennar, seeing fewer and fewer of these transactions between those two businesses. Because, you don't want it to be like a tugboat that's got a line and it's being drugged behind the battleship Lennar. You want to be able to see it function on its own as a standalone business. So I had initially thought that I would just sell it off. But again, I've decided that I want to dig in a little bit more and see what's under the hood and learn more about their strategy over the long term. There's a management company that's running it. Like, what are they really trying to do over the long term as an independent business? But right now, I think it's just too close to Lennar to really fully evaluate what it's going to look like maybe in 5 years' time. Rick?
Yeah. So Kim said, I just love my Trex deck, built over 10 years ago, and I just wash it once a year. Yeah, that's the beauty of Trex, especially for the first 10, 15 years of ownership. And so another earnings report that's happening this week is Carnival. They're reporting on Friday morning. Carnival is the largest cruise line, not by market cap, because Royal Caribbean has a larger market cap. But again, the great thing about this report, Carnival gives us a report like sort of a month and a half after Royal Caribbean and NCL do. Viking, which is River Cruises, a very different market, reported last week. But generally, the trend has been that they're all putting out really exciting growth numbers as far as demand has never been stronger, which is something you're not seeing in a lot of travel sectors. With Viking's case, the revenue was up 13%, which may not have been that impressive, but it basically was an increase, 6% increase in capacity, and 7% increase in people spending more on the boats. But the most important thing from Carnival's perspective, from Viking's perspective, is that they announced that they already have 88% of their sailings for the rest of this year already booked. And as far as the advanced booking, so the money that they're holding, that people made advanced bookings, is 26% higher than it was for the 2024 season at this point a year ago. So clearly doing really well on that front. But one of the analyst notes that followed the report was saying that they're just a little concerned because they just saw the market sort of generally weaken after the quarter ended, specifically in February and maybe early March. And here comes Carnival, the leader as far as a fleet of ships and passengers that it takes. But it's been historically growing slower than a Royal Caribbean or an NCL or Viking. And it was the last one of the three major cruise lines to actually turn a profit coming out of the pandemic. And it's going to report. And the most important thing when you hear this again, this is wave season for the cruise industry. This is the time when they try to book. They have the best promotions right now. If you wanted to go on a cruise this year or even next year, now's the time you either call directly to them or call a travel agent, get it done. This is when you get the best rates. But for Carnival's case, revenue is expected to grow in the low to mid-single digits. Earnings per share has been what stands out for Carnival. They basically trounced expectations all the last 4 quarters, and hopefully we'll have more of that. But again, Carnival is going to be a very big report, at least on my radar, when they report Friday morning. But again, it's still a laggard in many ways in my eyes. But then again, it's also valid as such. The cruise lines, at least the 3 major cruise lines, Royal Caribbean, NCL, and Carnival, you can still get them at a fraction. At an earnings multiple somewhere in the mid-teens, if not lower. In NCL's case, lower because it's the third. Bronze medals has its lack of perks. But yeah, it's a very interesting time for the industry, especially when there's some sort of a lot of headwinds happening with international travel that have held them back, and obviously. Not just the tariff stuff, the fact that even the Commerce Secretary last month said, hey, we don't like that these, all these cruise lines have, they're flagged with Panamanian or Liberian boats, not the U.S. made boats, and they're not paying taxes because of that. They're making their money in international waters, and they want to do something about that. But that happens. Everybody wants to change that, and they haven't been able to because, again, these companies are literally making most of their business in international waters and in overseas ports. But, it's going to be a very interesting report to see if Carnival shows any kind of weakness, which would really hurt all the cruise line stocks at this point. We'll find out on Friday morning.
Yeah, the market is ever looking forward. There's no doubt about that. And as we saw last week, and really the past few weeks with such a sell-off that's happening, the market hates uncertainty, right? And even the big great day that we had on Friday, that sharp increase, when we see that sort of upside volatility, the market is also swinging the pendulum the other direction too, because there's obviously optimism, but when the moves are that big, there's still a lot of kind of not knowing exactly what to expect going forward. Sticking with our theme of home builders, we've got a question here. Who asked the question? Now I can't find it. Somebody was asking. Oh, Kim. Kim was asking about NVR. I mentioned NVR. I probably saw that, and that was the subliminal thing that put in my head about talking about the story of NVR. So how do you feel about NVR at this current price? So NVR, it's easy. You look at the stock; it's almost $510 a share, and you're like, "Holy cow, that's expensive." But then if you look at the earnings multiple of about 14 times, and you're like, "Wow, that's crazy cheap." The truth is kind of somewhere in the middle. So it's very, very discounted compared to the market's multiple. Home builders always are, Rick. They trade, again, all the things we talked about, the seasonality of the business, the cyclicality, the leverage that most home builders do have to use to fund their operations and to have a pipeline of buildable land. The thing about NVR is that it actually trades for a premium multiple to every other home builder, and it consistently has, because it has been such a wonderful compounder and creator of value. Again, earning money through all kinds of economic environments because they've built that business model to really be super efficient. They're also really good originators. When they acquire land, they're able to develop and build on it and then sell at really profitable prices, making some money on originations of mortgages, and that as well. So they make money in a multitude of ways, and then they have a long history. The board has prioritized share buybacks, for example, and have bought back a massive percentage of the business's shares outstanding over the years. That's further juiced earnings per share. It trades for, like I said, a big premium to a lot of the other home builders. I want to send over a screen share to take a look at, just to share with everybody, that highlights some really important things. So I'm just going to start with the company's earnings per share. And this is over the past decade. Has just steadily grown in earnings per share. We saw that massive run up here. And we've seen it come down a little bit. Again, this wasn't because the business weakened. It was because, like everybody else, the industry sprinted for 2 years, just full out sprint, building and selling and building and selling. And it got to the point, it's like, all right, we got to spend some time prepping land. We've got to work with our developers to get infrastructure put in and rebuild up our community count. And that happened really kind of at the beginning of last year. Like a lot of other things, they tend to be a little bit ahead of a lot of the large competitors, the big guys, and they were bringing more inventory online. They've largely in a good position with active communities. So you look at the earnings multiples, again, the trailing 12 months, 14 times. That's actually below the long-term average where it's been. It collapsed here because their earnings ramped up so fast. Even though the stock did well, their earnings growth was so quick. So I do think, and on a forward basis, it's roughly about the same kind of multiple. I do think that is an appealing valuation, but I want to caution any investor out there that's looking at home builders right now. We could look back in 6 months and these prices look like just the dumbest investment you ever made, because we don't know what the implications are with the Trump administration's economic plans and immigration plans. They're just really, 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 I don't know of any other industry except maybe like meatpacking or something like that has such high concentration to things the administration is doing that could upend the business. I think the price looks really good. 5 years from now, I think we're all going to look back at this as a good price. I really believe that. 10 years from now, we're going to look back and see this as a good price. I can't say the same thing for 5 weeks or 5 months from now. So we have to invest in the environment that we're in for whatever it's worth. Rick, last Wednesday, I bought shares of 3 of my favorite home builder stocks. I didn't buy any NVR, not for any particular reason about not liking the business. I think it's a wonderful business and it's a buy at this price. I just chose to invest in 3 different ones that I already own that I wanted to add to my existing positions in.
Yeah, I've not bought a home builder in a while, but yeah, it's definitely an interesting time right now. They're all trading such low multiples, but clearly a cyclical industry in many ways. I wanted to tackle a question that's also earnings related. Curly Q asks, "Good morning, fools. Do either of you follow Nike or Academy Sports? Ticker symbol ASO. and Nike, obviously, NKE. I'm curious to know what you think of either ahead of earnings. So I'll tackle the Academy Sports question. To me, it's a company, obviously, heading into this expectation report. It's sort of struggled lately. Very profitable. You look at it, wow, what a low earnings multiple. But then you start saying, well, wait a minute, earnings are declining right now. Even this quarter that we're looking at here that we're going to be hearing about this week, the analysts expect sales to dip a little bit and earnings to take an even bigger hit. But the stock is still, if you look beyond the noise, look at, back to, not this year, but the year ahead, the following year, it's trading for 6 times, earnings, 2026 earnings. Clearly an attractive company in that sense, but I don't like when sales are declining. Compare that to like Dick's Sports, Sporting Goods, DKS.
It's one thing if everybody in the category is on the same trajectory, but if you're the outlier, there's reasons to be concerned, right?
Yeah, Dick's Sports, they're expanding, they're building out. They just opened a brand new store, basically within like less than a mile of another store here in Miami. And they opened a Dayland Mall. They're at Target Dayland South Station. I'm not sure if they're going to close the other one, but it's just really weird. That's how quickly they're expanding their space. I don't think cannibalization will happen that way. But Dick's Sporting Goods trades, 12, 13 times earnings, very reasonable for a company that is actually expected to grow this quarter. So again, it's hard to really get excited about Academy Sports. It's a value play at this point, but I don't know. And Nike, I'll be honest with you, you'll find much more bullish opinions on Nike. To me, I've always avoided it as an investment as much as I own several Nikes. I'm a fan of Nike, the footwear. But this is 1 year of double-digit growth in the last 8 or 9 years. That does not excite me as a growth investor. And again, not that you need heady growth from Nike, but it's the kind of thing where, hey, footwear, they've stood the test of time. That's one thing. Nike is timeless in that sense. But I just don't see the excitement to pay a premium, market premium for a company that is growing a lot slower than what I like to look for in stocks. So, Jayson, thoughts on any of those? Or if you want to go on
one of the things I like that Dick's is doing is some things with their store models that they're opening some. They're growing their square footage. Last year, they're actually, I think there was a net reduction in the total number of stores, but they increased their square footage because in some markets they consolidated to some of their. My brain's doing this thing because I'm looking at the clock and I don't want to take up too much time, so I'm taking up more time trying to remember the words. But some of these special formats that they're opening that are actually larger, that are I think really compelling, and creating some destination opportunities that are filling this void because over the past 10 years or so, Rick, we've seen a lot of washouts in this retail space. And as we've seen from the Nikes and the Under Armours of the world that have tried to be omni-channel and it hasn't necessarily delivered well, they're filling that void better than anybody. They've really seized that opportunity. I just really quickly, before we hand it over to the morning show, we're the morning show. They're the morning show. I just want to make that clear. Matt asked about Redfin. As a Redfin shareholder, is there any chance you'll vote against the deal with Rocket Mortgage, or do you find yourself warming up to it? I have zero interest in owning Rocket Mortgage whatsoever. I think the deal I'm going to predict, and maybe I should go on the prediction show that we do at 7 p.m. and make the prediction that it's going to destroy value for Rocket investors. It's going to de-worsify that business. And as much as I was concerned about Redfin's near-term concerns with their working capital and balance sheet in this really tough environment to be selling existing home inventory, I think it's going to destroy value for Rocket. I think they're paying too much and they're hurting their own business as a result of this. So that's where I stand. I will sell my shares there. I have options, covered calls. I've got to find an exit point on those covered calls before I can sell my Redfin shares. I think the deal is going to get done, but it's a bad deal.
Yeah, and I know the morning show team is about to come on, but Jim apparently did not like what we were saying about Academy Sports. So I'm looking forward to hearing. I'm definitely tuning in to hear what Jim has to say on ticker symbol ASO for Academy Sports, obviously reporting this week. So, yeah.
Well, with that, let's bring them on. We got Jim Gillies, Nick Sciple, and Emily Flippen. It is the crew.
Yes.
Good morning, folks. How we doing? Happy St. Patrick's Day.
Happy top of the
morning. Yes.
That's right. That's right.
Almost top of the morning for you guys. Yes.
All right. Have a great hour, guys. We'll see you next time.
Yep.
Thanks, Jayson. Thanks, Rick. Cheers. Good morning, fools, and welcome to the Monday, March 17th, St. Patrick's Day 2025 edition of the morning show on Motley Fool 24. I'm Nick Sciple here with my foolish friends, Emily Flippen and Jim Gillies. How we doing this morning, folks?
Hey, doing all right. I keep forgetting that it's St. Patty's Day. I'm not wearing any green. I feel like I need to go change now.
I was going to say, you got the green socks.
I don't own any green. I think I did for Christmas this year. I did get a package of, now you can get socks printed with everything. Like if you need Rick and Morty socks, you can get like a 6 pack of them like tomorrow. I did get a pack of whiskey socks. So I'm not going to show you because that would be strange, but I am wearing socks with drams of whiskey on them. So
there you go. Canadian whiskey only these days, Jim. Let's let's have a little St. Patrick's Day fun. Not a ton of non-macro news this morning.
Well, if we get to it, I'll give you my best foolish St. Patrick's Day story. Don't worry, it's good for air, but it was kind of like sometimes you make things up as you go along, and as long as everyone's laughing about it, good things can happen.
Sure. Yeah. Well, let's kick it off. We're talking about a few Irish companies this morning. Some companies might not know are domiciled in Ireland. One of those is going to be reporting earnings this week on Thursday. That's Motley Fool recommendation. Accenture, probably the least Irish of the Irish companies that we're going to talk about this morning. Moved over there in 2009. Very popular to do. A very favorable tax regime there in Ireland. But why is Accenture a great company to add some green to your portfolio here today on St. Patrick's Day?
Yeah, I love this company. And as you mentioned, this was a business that moved their headquarters, I believe, from Bermuda to Ireland. And as you mentioned, in the mid-2000s, because of the changes in tax laws, I think, during the Obama administration. Yeah, yep. So they're seeking out those tax harbors. And Ireland obviously has access to both the U.S. and the EU and has some of the lowest corporate tax rates in the entire, Europe, all of Europe, I guess.
Yep.
It counts as Europe, right?
It does.
Okay, good. And all of Europe. So obviously Accenture benefiting from their headquarters there. Otherwise, I would not say that they are a traditionally Irish company, but it counts for our purposes of St. Paddy's Day. And as you mentioned, Nick, this is a business that we're going to get second quarter earnings for here on Wednesday, I believe, or Thursday, just in a few days. So a lot of these numbers are going to be updated here for Accenture. But Jim, I think you are going to make the point, which I think is right, that Accenture doesn't really matter what they say in our next quarter earnings report. This is
it does not.
Yeah, it's an incredibly well-performing, steady business. Now, they're always going to have a little bit of lumpiness. This is a consulting business, after all. So depending on what's happening in the enterprise environment, there can be some element of lumpiness to Accenture's business. But one of my favorite things about this company, and part of the reason why I think it could be such a great investment for many different types of investors, is because their operations are still pretty well diversified, even amongst the consulting space. So if you're going through a period of economic decline, let's say companies are pursuing layoffs, while that may hurt consulting demand in other areas, right? They do see an uptick for things like business reorganization consulting. Whereas when times are good, like right now, when we have businesses that are investing a lot into, say, like AI, they see Accenture as a partner that can help them reform their tech stack. I mean, Accenture can always kind of find that little niche that enterprise are looking for, regardless of the environment around it, even though that lumpiness does exist. So it's absolutely an incredible business, incredibly profitable, has made a history of returning value to shareholders via dividends and share repurchases, a lot of share repurchases. So it closely tracks a lot of key metrics, including things like return on assets, return on equity, and return on invested capital.
Yeah. And these consulting businesses, I mean, incredibly cash flow generative, right? Your costs are your people, right? Once you pay your people, you're generating profit, right? I mean, that's
you pay your people pretty well, though, I will point out.
That's true.
Well, one of the two key metrics, and they have been de-emphasized by Accenture in recent quarters because so much of the narrative has been around artificial intelligence, and I can understand that, but they still continue to report what I think are probably the two most important KPIs, one of which is the utilization rate. This is basically, okay, if our number one asset here are the consultants that we hire and we pay for, what percentage of them are actually being utilized on active projects as opposed to theoretically sitting behind their desks just twiddling their thumbs. And Accenture has consistently kept that above 90%, which is exceptional for this industry, as well as churn in those employees. They invest a lot of money up front to acquire those employees, pay them a lot to train them up. If they churn out really quickly, then obviously that destroys their return on capital or on that investment whenever they made that, I guess, acquisition of that employee. So they also track things like the retention rates and how active churn is. And churn has been consistently around 10 to 15% for this company, even through the kind of economic craziness that we've experienced over the course of the past decade.
Yeah, Jim, you've been a long-term owner of Accenture. Things to add?
Well, yeah, and everything Emily has said, 2 votes the whole way along. It is trading closer, as much as I give a rat's behind about trading. It is significantly closer to its 52-week low than to its 52-week high. Why that matters is because of what Emily has said. But this is a fundamentally great company. I have owned this company, I think, since 2012. Might have been a little bit earlier. I look at it. Emily has forced, because by introducing this in our pre-show to me, it's like, oh, that's an Irish company. Hey, yeah, you're right, it is. She's forced me to move up my once a year looking at the share price of Accenture. I usually do it towards the end of the year as I'm planning, for tax, sales and whatever. So I've looked at it today. It's like, oh yeah, it is closer to the 52-week low. Again, I've owned it. I've never sold a share. And everything about predicting where they're going to be consulting, because I also used to I had a position back when I was running Motley Fool options. We had I think a diagonal call on this one. It's a good strategy for this type of a company, which is kind of slow and upwards and to the right as it goes through time. The Accenture, they will always find something to do. So predicting, I kind of found early in my, I think it was the public position with it. It's now long closed. The public position in the options service, we could try to make predictions of where the consulting dollars are going to go this quarter or that. It was a waste of time. This is very much a step back from a 30,000 foot view. Don't you hate when people use that cliche? And looking at a fundamentally good company that does have a niche. And if I may share a slightly personal story, back in my MBA days, so 20 plus years ago, we went to a hiring thing for MBAs at one of the local universities put on by Accenture. They put on a big spread, and literally halfway through, because as you say, Nick, their assets are their people, and their people are not poorly paid. And so we wanted to, or we're still in school looking around for a job. We thought, hey, wouldn't it be nice to be one of their people? So off we go. They put a big giant spread on, and we have to sit and talk. And literally 5 minutes into the presentation, they said, we only hire MBAs from these two schools. And spoiler, I didn't come from one of those two schools. But I'm sitting eating at your table, essentially, for lack of a better term. So what did we do? Well, every MBA student in that room at the time, because there was other people there from University of Waterloo and a couple other places, we got up and walked over to the buffet table and started eating and broke up the meeting. So we were kind of jerky about that, I suppose. But no, they're very particular about the people they go for some reason. And Buffett had something to say about this fairly recently. We don't care what school you go to. Clearly, the Accenture of 22 years ago did, which is their right, but you missed out on this, guys. But no, it is a company where it's more you guys are familiar with the cliche of Fidelity Investments, where their best performing accounts were either held by people they forgot their password or died,
right?
And that and that's I mean, it's probably apocryphal, but let's run with it. That's more of saying, trading is hazardous to your wealth. Take a long-term view. I mean, you can't get much longer term than if you're dead and you keep your investments. I've always kind of slotted Accenture into kind of that space. It's kind of along with a Berkshire Hathaway, with a Brookfield Asset Management, just companies where I own them, a MasterCard, if you will. It's a fundamentally great business, producing a lot of cash, intelligently allocating it, making all of Emily's points again. And in those types of companies, if I read one quarterly report from Accenture a year, that's an active year for me. It's just, I just have it running.
Yeah. And these companies, you could argue Accenture is a potential beneficiary from all these AI headlines we've heard, as more and more companies are seeking to implement that in their own kind of workflow processes. A lot of those folks are calling up a consultant to help them do that. And Accenture is on the short list of folks that are on the list to call. So a great company in the consulting world, and a great Irish company maybe to have in your portfolio. While we're on that topic, Jim, probably the total opposite of Accenture, where Accenture, all their assets are employees. AerCap, all their assets are airplanes, but it's another great Irish business, up more than 5x over the past 5 years. Why should it be on investors' radar?
Yeah, I mean, you've just stepped into one of my favorite companies. I'm going to assume that most people have heard my AirCap pitch before, but let's try to keep it a little more higher level, no pun intended. So AirCap is the world's largest owner of commercial airlines. They are the world's largest lessor of commercial airlines. They are run by the best management team in the business who take this capital allocation. I would argue a leasing business, which makes use of an extensive amount of debt because, you're not buying your planes. Airliners are expensive. And B, you probably don't want to tie up all your capital in them on day one. So they are often debt financed, and then of course they are leased out to your airliner clients at greater rates. So this is basically a spread business. But AirCap has shown really. Gus Kelly is the CEO, and he has shown a really good acumen for the capital allocation side of the business. So the spreads all work beautifully. At times of market, we'll say discomfort. Think post credit crisis, circa 2014, when AIG was still circling the bowl after 3 or 4 years following the crisis. Think GE in 2021, kind of going through COVID, plus all the 2 decades of problems since Jack Welch had given them, finally breaking up. AirCap went in and bought, arguably the 2 largest portfolios of leased aircraft that weren't theirs at distressed prices. And they got the sellers to partially finance it because it was they would tend to issue a bunch of shares as well as take over all of the leases. And so you got shares instead of cash. You got a little bit of cash, but you got shares instead of cash, newly issued AirCap shares. And then as AirCap used their cash flows from their now combined portfolio to buy back or to pay down debt till they get a target leverage ratio, then they started buying back shares. And what they would do is they would often come to you. If Nick, you sold me your portfolio of planes, I would come to you and I would say, well, we're going to arrange for a secondary offering so you can sell some shares on the open market. Oh, and we'd like to buy, say, a quarter of those shares at a 5% discount to the market or whatever. They would get favorable terms. And it was all about getting the company they had acquired the portfolio from, getting them off the books as quickly as possible. And once they did that with AIG back in 2014. They've now done that with GE as of 2022. Then you take your giant cash flows and you start buying back your own shares, and you aggressively attack your share base. And I think they took out 18% of their shares last year. GE is completely gone. AIG is completely gone. They also and all you would talk about utilization rates for consultants. Yeah, same deal with planes, and I think they're north of 98, 99% on lease. Everything looks great. Because the other thing is coming out of the industry or coming out of the pandemic, the industry airlines were tough. I mean, a lot of them had to take government money. A lot of them had to essentially, struggle with debt. They don't want to own planes. I know airlines who don't want to own planes. What do? They choose to lease them. The cost of leasing, even though it's a total net cost higher over time, it's actually better in the interim, and it's a small part of their cost structure. Okay, that's a good deal for AirCap. But the last piece of the puzzle, I've talked way too long. The last piece of the puzzle is AirCap uses about, let's say, between 1 and 2/3 of an aircraft. Like you get a new airplane, they're going to sell it 1 to 2/3 into its natural life of about 30 years. And they have been selling in recent quarters. This is a company that barely trades at 1x book value. They have been selling these assets into the open market at 2.5x book value. Now that should infer to you that the assets that remain on their balance sheet might be a little underpriced. It should infer to you that the PE, which I think the PE ratio, the earnings, I think PE is about 9x earnings right now. That should infer to you that the earnings are understated because they've been overly taking depreciation expense. And they're not going to change. This is going to exist for a while. But not only is this a company in the right space that on top of their industry right now, trading with a great value, run by the best people in the business, with a really good head for allocation, but it's also probably arguably cheaper than it even looks today. Other than that, I don't know what you would like about this company.
There you go, Jim. Yeah, I'd say AerCap and Accenture, two high quality business based in Ireland. AerCap probably a little bit more Irish. It dates back to the Guinness Peat Aviation in the 1980s. So certainly a company that still remains rooted in its Irish heritage. Last company I'll talk about today. Maybe not. I would say I would be quicker to buy the first two on this list, but I think there's a decent chance our listeners are going to be interacting with this company at some time over the next couple weeks. And that company is Flutter Entertainment, the parent company of FanDuel, as well as in Europe, Paddy Power and Betfair. Company really originated that Paddy Power angle. Yeah, that really started in Ireland, still has its international headquarters in Ireland, based in Dublin. And if you look at the online gambling market in the USA, really is consolidated down to FanDuel and DraftKings. So if you look at some data from H2 Gambling Capital, says FanDuel and DraftKings respectively command 44% and 34% of the U.S. online gambling market. Nearly 1/5 of American adults have bet on games since legalization back in 2017, 2018. And we've seen the total number of handle, amount wagered, up 10x since 2019. $13 billion bet in 2019, up to about $135 billion last year. So it's really been a rapid growth industry that's consolidated in really a couple of companies here today. So the U.S. business today for Flutter still not quite the majority, although long term heading towards a significant chunk of the business today. Flutter gets about 41% of its revenue and 20% of its EBITDA from the U.S. operation. So that's primarily going to be from FanDuel, that sort of thing. The rest of its earnings comes from its international business in the UK, Australia, other international markets. And I think that kind of diversification is really, if you're looking at the gambling market, I think FanDuel is a more attractive business than DraftKings, partially for that reason. If you look at the cash flow generation today, Flutter substantially cash flow generative, while DraftKings still burning cash. If you look at advertising as a percentage of revenue, obviously a really important driver for these businesses. I mean, customer acquisition cost is insanely high for these gambling businesses, and it's a fee you have to keep paying constantly to keep folks on your platform. But DraftKings spending close to like 50% of its net revenue on advertising. If you look at FanDuel, closer to like the 30% range. So it's a business that is more profitable. As you know, their model has at least shown across the whole of the business that have been able to spend less on advertising to generate a better market share than DraftKings enjoys. And if you look at where we're at today, both these businesses about to flip over into EBITDA positivity. We've reached kind of maturity in the online gambling space here in the U.S. We've seen folks exit the industry and really consolidate down to these kind of two big players. So we're getting to the point where there's potential for mature economics of these businesses can generate cash flow and shareholder returns. So if you're interested in online sports gambling, I think Flutter is probably should be at the top of your list. However, there's real maybe concerns around this business. That customer acquisition cost unlikely to come down meaningfully over time. This is an industry where there's going to be lots of spend on advertising as far out as you can go. So there's not going to be a point where all of a sudden operating margins or operating leverage runs off to the races, I don't think. Also, these are businesses where as they become more successful, puts a target on them. We've already seen legislators just in the past few months talk about, hey, we maybe need to curtail the growth in online gambling. So certainly it's an area in the market where there's lots of growth. I'd imagine some people watching here today will interact with FanDuel over the next couple of weeks with the NCAA tournament going on. More than $3 billion expected to be bet on the tournament this year. And again, Irish company is really the leader in the space, if you ask me, both from market share point of view and an operational efficiency perspective. And I don't think gambling is going to go away if you can kind of overcome some of the concerns around regulatory and just I guess morality. I think Flutter is a potentially interesting business. It's been recommended in the Motley Fool a couple times, but not in the past several years. I think today's maybe an interesting time to start looking at those companies again. As I said, we're approaching EBITDA positivity, and I don't think the days of new entrants coming into the space, I think those are behind us. Online.
I just like your line there. You know, you don't think gambling's going away. It's like, what, the last 10,000 years of human history? You think that's going to persist?
Well, yeah,
Like,
that
I
is
think we were-
true.
Like, you know, human behavior is, you and I like to talk quite often offline. Human behavior is human behavior. And whether it's gambling or games of chance, whether it's, shall we say, substances of a tobacco nature, people are going to continue doing things that, you know, other people think they shouldn't. And you know, that's there was a really great, I don't know if it still exists, but it was a fund. I don't think it was an ETF, but it was the SIN, I think it was a SIN ETF or a SIN mutual fund, where it was you know, alcohol, tobacco, I think adult nightclubs, and like anything that that people could perceive as kind of a vice or something. So back in the day, online gambling wasn't legal, so they weren't in there, but it include all these vice and Microsoft. And I'm just like, okay, that's pretty funny, actually. You know, are you calling Microsoft evil or just a good business? Because I know where I would land on that slide.
Indeed. Okay. Do we want to go to some questions? Other stories that we're kicking around here? Let's go to.
Feel free.
Let's go to some questions. Let's
Yeah.
go to some questions. Happy to talk more about Ireland, NCAA tournament, macro, whatever you want to do. But let's go to this question from Rita S. I think me and Jim can talk about it. Is Nelnet a growth or a bulwark stock? If you had to put Nelnet in one of those two buckets, which would it be for you?
I love a false dichotomy in the morning.
Yeah.
I would say, why can't it be both? But you know, if you're gonna make me pick, I own it for its bulwarkness, but I think the growth, I don't, that's a word, but I think the growth there will surprise you. Aside from the slowly melting or more moderately melting iceberg, which is what I call the giant pool of student loans that they own, that they're of a type they're not making anymore. I think that's down to about, I think when we first started looking at this about 5 years ago, that portfolio was $20 billion, offset by about 19 billion in securitizations. I think today, Nick, it's around 10 billion, if I'm not mistaken. And I think the securitizations are about 8.5, 9 billion. So, you know, again, it much like AirCap, this is one that can look strange if you start looking at the the financial statements without kind of the context. Like I said, AirCap uses a lot of debt. People see a $18 billion company with $50 billion in debt and they freak out. It's like, oh, they're tied to planes. It's very similar here. There's a lot of debt on the books, but those are owned loans that are A, guaranteed by the US government, and B, the value of the loans on the asset side is actually larger than the value of the securitizations financing the loans on the liability side. So the point is, don't be terribly scared. That is acting as a bit of a weight on the results of the business as those roll off, but they've got other irons in the fire, if you will, not the least of which is their payments and financing business for both private and for-profit schools, or private and public schools, I suppose. You know, they call that Nelnet Business Services. There's the Allo investment, which is fiber to the home. There's the student loan servicing business, which is independent of that big giant iceberg I talked about, where they are the largest servicer for the most loans in the U.S. They've got a new deal going on there. Of course, that's been kind of a fraud area the last few years. They've got, I think it's a 22% stake in Huddle.
Yes, that sounds right. I can get you the exact number.
Huddle, which is this, like, basically Huddle's growing like a weed within Nelnet, and again, they own like we'll say a fifth.
Yeah,
of it.
22%.
Hey, look at me. That's muscle memory right there. You know, like this is a, you know, if you've got a kid in any kind of high school or college sports, I promise you they are interacting with Huddle. When I've mentioned in the past, both on shows like this or just privately to other Fool analysts, like Brian Stoffel. I haven't seen him around recently, but Brian Stoffel has been a coach at a high school level. And the second I mentioned that Nelnet, because we were talking Nelnet a little bit, second I mentioned Nelnet owned a bit of Huddle, he lost his mind. he's like, wait, what? I can own a piece of this? And because he's interacting, like, it's a very Lynchian, buy what you know, right? He was very excited about that. So I think in answer to the question, there are some growth avenues in here. And it's a bulwark position, or as I call it, a bedrock position. I don't know. Nick, any comments?
Yeah. I would, if I had to put it in the two categories, I would say bulwark in the sense that you are backstopped by large amounts of assets that have a established value, right? So you can use
a government backstop.
Yes, exactly. So the book value gives you a reliable estimate of what the company is worth if you had to liquidate it. So in that sense, it's a bulwark because your downside is I think limited by the value of the assets. Now I think it also has the potential for the stock to go up. Now, just you don't have to be a growth stock for kind of the stock to move up. And in this context, it's because the book value that is of the assets listed on the balance sheet that kind of gives you that backstop. Just like with AirCap, you can point to reasons why that is understated meaningfully. Whether that's, hey, they invested in their Allo stake, a number of years back, and it's held on the balance sheet at the price that they acquired it for, and the company has grown quite a bit. So if you were to IPO that company or have another kind of measurable transaction out there in the market, the book value would be meaningfully higher than what it's carried on the balance sheet. You can also look at they have a stake in Allo, which is a fiber to the home business that has taken, I think it's in its first 300,000 crossings. They took like 50% of the market in those areas. So it's a substantial business that has some value. They've depreciated that on their balance sheet down to zero. So no matter how you look at it, it's going to be worth more than zero out there. So it's a bulwark in the sense that your downside is limited, but also I would argue that the stated book value is meaningfully lower than what it would be if you actually sold these assets out there in the market. So there's growth potential to hold the stock. Does that make sense? Heads, you win, you would win, and then tails, you don't lose that much. That's the Dando investor kind of idea, and I think Nelnet certainly checks that box. And in an environment where the economy goes nuts, right? Those student loans are still going to hold their value in a negative way. I mean, so it's the type of company that can provide some ballast to your portfolio during downturns, perhaps. So it's the type of company you like to have in your portfolio: upside and downside protection.
And one little more thing. English did not work on me apparently. Is Huddle. Huddle they've actually had to write up the value of Huddle, which if you know any accountants, and I've got one 30-year CA in the house and one proto CA in the house. So if you know anything about accountants, they hate writing things up. Okay. They've had to write up their stake, their value. Like you only write up, accountants will be real fast to write something down. Like, oh no, impairment, got to take, and there's even rule, we got to do this. But you got a good accountant, you got to drag them kicking and screaming to write something up because they're concerned about the conservative principle of accounting. And Nelnet has had to write up the value of Huddle at least once that I know of, and I think a second time, because as Nick says, they've just been growing internally so well and getting such traction that their auditors are saying, you've got it on the books worth, $3 in a raspberry, and it's really worth, this many million. You've got to write it up. And so they take it up as far as they're comfortable with, and then it grows beyond that. So anyway, and I think they do it every time there's a refinancing. So, or are they raising extra capital for Huddle? Anyway, move along to something more interesting than Nelnet.
Okay. All right. Well, we've got questions from both Zach Fool and Rita S. Asking us to compare Accenture to Kyndryl. Ticker for Kyndryl is KD. It's a spin out from IBM. Emily, what can you tell us about those businesses?
Yeah, I love these. There's two questions, kind of doing the comparison between Accenture and Kyndryl, and also is one potentially better than the other? And I would say trying to compare these two companies is still a bit like comparing apples and oranges. I think it's an easy thing to fall into because both kind of fall into that industry classification of IT consulting, IT services. Kyndryl is a little bit more infrastructure based, whereas Accenture has built up this entire, they are one of the largest consulting companies in the world. So comparing Accenture and Kyndryl, again, kind of like comparing apples and oranges. For context, Accenture, I think their market cap is north of $200 billion. Kyndryl's like $8 billion. But to your point, Nick, this is an interesting question and one that I think is worthy of kind of discussing, especially if somebody were to hold both of them in their portfolios, right? And because they are in two different positions, I think while I wouldn't view them as a trade-off for one another, there's definitely a world where it could make sense for somebody to own both of these businesses. And in the case of Kyndryl, as you mentioned, Nick, this is a spinoff from IBM. I believe they spun out in 2021. And they've been in a little bit of a turnaround mode since then. The valuation on this company is interesting. They're profitable now in the bottom line, which is great, though they're not free cash flow positive because they're still reinvesting so much, especially in the AI of it all, right? Again, in slightly competing a bit more with Accenture there, but also revenue is declining. This is a management team that is focused on high margin, high service segments, trying to get away from some of that IBM past. And so they're almost in like a turnaround mode, if you can call it that. Turnaround, sometimes people associate with like the GameStops of the world or all these other kind of crazy companies. Kyndryl, again, IT services, it's a fine business, but it is one that's still trying to figure out what its place is in the world. And I think we're going to see revenue continue to decline here for a little bit before it picks up, hopefully in the second half of this year. And at which point you want to see that margin profile stabilize. If you compare that to Accenture, has none of those issues, which does beg the question of, okay, well, what do you miss with Accenture versus Kyndryl? You can invest in Kyndryl and buy into the turnaround story, right? And that could drive market beating value because that's a different opinion than what the market has potentially, versus something like Accenture, where the thesis is Accenture just continues to do what it's been doing. And that's fine. And I do think the reason why Accenture has beaten the market for so many years now is in part because of the fact that they're able to grow at a consistently higher than expected speed. And that consistent performance has always just a little bit more than what the more short-term focused market has focused on. But both these businesses, incredible companies. I like them both, although I would say I would not compare them directly to each other. And to actually answer the question, after all of that, I actually prefer Accenture. Again, they're cash flow positive. They generate so much cash. We're talking double-digit net income margin, double-digit free cash flow margins that they return to shareholders with a lot of shareholder-friendly activities, like tons of repurchases that helps their bottom line grow fast, even if their top line is slowing. And over the last couple of years coming out of the pandemic, we have seen some of that lumpiness to their top line, whereas Kyndryl has declining revenue growth and more of a turnaround story behind it. That being said, I think if the investment in Kyndryl were to work out, probably works out to the upside a bit more than Accenture does.
Yep, that makes sense. Ed has a question we can tackle quickly. Ed says, are dividend payouts the same for all investors payable on the ex-dividend date? Or is that when you first invest, or is it when you first invest into the stock, whatever the dividend is paying at that time? So yeah, if you buy before the ex-dividend date, you're going to get the same dividend that a shareholder who has owned the stock for, whatever,
Forever.
5 years, right? That it's the people who own the stock as of that record date. And for companies where the dividend is a substantial portion of the expected return, you will likely see some volatility around the ex-dividend date, right? So, say a company pays an 8% dividend yield on an annual basis. That day after the ex-dividend date, all of a sudden you lost your rights to that little 2% quarterly payout, and so often you'll see the stock move meaningfully down right before the dividend date, and you also will typically see those stocks move up a little bit in advance of the dividend date, just as people kind of play games to try to snag the dividend. But those are not fundamental to the kind of underlying business, but it is something that you will see, and you will see a little bit of volatility around that time. But to quickly answer the question, the dividend does not change based on when you bought the stock.
Just a little commentary on what you just said, basically people chasing dividends. I think my favorite thing is when people, a company will announce a special dividend. So it's not, say, the regular quarterly $1 per share or whatever payout we're talking about. But like a company will announce, oh, we're doing a $10 special dividend as of such and such a date. And traders immediately rush in like, white blood cells going to fight an infection, and they bid the stock up $15. And I'm like, but the dividend's 10. Like on the ex-dividend date, you can expect the share price, all else equal, and all else is never equal, but at least finance theory will tell you all else equal. When the stock goes ex-dividend, if it's a $10 dividend, the stock price will fall by $10 because there's $10 of value per share in that company that is no longer yours because we passed the ex-dividend date. So it's, when you've seen companies, before this will chase the stock price higher in order to grab a dividend that you could probably expect the stock price will fall by a amount greater than the dividend, or greater than the run up, because once the dividend goes by. And one example, I won't name the company, but we've had this a couple of times. It's, I've been writing recommendations, stock recommendations for the Motley Fool for going on 2 decades now. So it's nice to eventually see something you've never seen before. And one company in the service I run, Hidden Gems Canada, which is a small cap companies, half Canada, half US. One of the US facing ones, the company announced a special dividend, and they have a history of doing special dividends about once a year, assuming that their valuation isn't super low, at which point they choose to buy back stock. And so they announced their latest special dividend. I think it was like $10 again. Maybe it might have been $9.50, $10. Stock went up like $40. And it just so happened that I was recommending it that week. And I just flat out said, don't buy this ahead of this. Really think hard about whether you want to buy this ahead of the special dividend. I know that might sound weird to say, hey, they're paying $10 a share on this $250 share price or whatever it was. It might sound silly it might sound strange, right? It's like, hey, don't buy it now before it goes ex-dividend so you get the dividend. Wait until after. But this is the first, and I believe only time I've kind of ever said, really like the company, really like it for the long term. Maybe skip the special dividend, because we'll get on the other side of the ex-dividend. The $10 value will come off. The stock will probably fall by $20 or $30, and then you'll get a better price. And if that isn't exactly what happened, so I was kind of like, hey, we're recommending this, but maybe in about 2 weeks. But publishing schedules are a thing. Anyway. Hopefully that answered the question for about the dividends.
Sure. Yeah. Okay, Jim, we had a question from Kim that gives us a chance to talk about Academy Sports and Outdoors, which is what we wanted to talk about when we led into this show. So Kim asked, would you comment on Academy Sports Outdoors and PRG? I believe that's Prague Holdings. Is that right? That is
Prague Holdings. 2 companies that are... Well, Prague Holdings had an interesting one on their most recent quarter. They got shellacked. I think they were down 30% about an hour into the market. They are basically they're. I'm gonna try to thread a needle without being political here. Prague Holdings allows people to. It's basically financing for consumer goods. You need a new sofa or a couch. I don't know what the Canadian versus American pronunciation is, but Chesterfield is a couch. Or you're buying a new computer, you're buying something, and you do like, the buy now, pay later financing at the cashier. That's Prague Holdings.
Yeah. Layaway.
Advanced layaway. And in a world where the economy might be going in a not up and to the right direction, I think you can probably expect more people to have need of this type of financing. And so paradoxically, this could actually be good. If you've been following Prague as long as I have, the last couple quarters have actually been, they went through a couple of years of kind of the credit cycles working against them. I would argue the last 2 quarters now, they've returned to growth. Credit cycles actually looks like it's tipping back in their favor. If you do get the situation that I've just described there, where more people may be looking for exotic financing because they don't, they'd rather finance something rather than defer consumption. This could be a good time for the business that Prague Holdings is, and they got 30% cheaper on the day, mainly because their outlook was deemed disappointing. And this is just a personal thing for me, my own theory, but Prague Holdings, they generate a lot of cash. Like, they're very good at generating cash. But the dynamics of when that cash lands in their account versus not is Q1 through 3 for the company, they make a lot of cash. Q4, they're cash consumptive. And this disappointing guidance, along with market uncertainty, along with people just didn't like the quarter, I guess, hit during the quarter when they are cash consumptive, which I will argue is another reason the stock falls. That's fine. What does Prague Holdings do with most of their cash in the other 3 quarters? they're buying back about 2% of the company per quarter, and they pay a nice dividend. So I full disclosure, this is just what I did. On the day they fell 30%, I added more shares personally, because I think that I think I'm right, and the market is smart, and the market being smart will recognize that I'm right with time. The second one, you asked about Academy Sports and Outdoor. This is a tricky one. I really like Academy Sports and Outdoor. I like it more. Emily is just waiting to roast me. Fools, I love it when Emily comes for blood. I love it. Let's go.
Give me 3 minutes to figure out some stats to back up my unwarranted opinion.
Oh, don't shoot your own opinion before you've even made it. Come on. Anyway, no. Academy Sports and Outdoor. It is a growth retail story. It is probably been knocked down. What?
Growth? Sorry, growth?
They will get growth. They're growing store count. They're growing store count.
Yeah, it's too bad they're not growing revenue.
Oh, getting spicy, Emily. Okay. Yeah, they're not growing revenue yet. Yet being the operative thing. A lot of it will be consumer, nervous consumers, given waves hands at what's going on in the world. Nervous consumers as well. They source a not small amount of their inventory from countries like China, which of course has been the subject of a tariff war among a few other countries we could name. I am not blind to what arguments I believe Emily is going to mention, since she's already given away part of her hand to start with. Not blind to that. However, I'm sitting here going, this is a company that had a 5-year plan, executed the 5-year plan. I think the last item in their 5-year plan. This was a company. I'm gonna try to M&M this and steal all of Emily's thunder before she can talk. We're gonna go 8 Mile here, which will be the first and last time I've ever compared to M&M, of course. But no, I think they were voted retailer most likely to go bankrupt in 2019. Right. And Emily's shaking her head or nodding. Yeah. So, yeah. They did something good about it. I think they were owned by KKR at the time, before the IPO. They cleaned out the management suite, cleaned them out, brought in a new professional management team. That professional management team came in and said, here's our 5-year goal plan, laid it all out. And wouldn't you know it, they hit every item in their 5-year growth plan. At least, I think the last one fell 9 months before the 5 years were up. So they took out everything. They then, nicely, said, well, we've done it before. Let's do it again. They brought out a second 5-year plan. And I'm just going to see if I can pull up that really quickly. So we'll distract. $10 billion in sales is the goal by 2027. The goal from 2022 through 2027 is 10% annual revenue growth. Spoiler fools, they're not going to get it. I'm just going to say that flat out before Emily gets a shot at it. Net income margin 10%, adjusted EBITDA margin 13.5%, return on invested capital 30%, 3.7 times turning their inventory, upping their sales per square foot from 315, I believe, in the previous plan to 365. And 15% e-commerce. So they've set some ambitious goals. I've already said I don't think they're going to hit at least one of them. They're probably not going to hit 2 of them. But I will argue it doesn't matter, because this is a company that's already been beaten into submission. This is a company where there is, even in my own model, again, the sales goal from the 5-year plan by 2027, the sales goal is $10 billion. In my model, which I have on my other screen here, which of course you can't see, I've got them at about 7.5 billion by 2027. So I'm undercutting their expectations by 25%. I've got margins reasonably well with historical norms. Cash generation reasonably well with historical norms. In other words, I'm not giving them credit in their 5-year plan. I have what I believe is reasonable growth expectations. I think it does top out at about 10% in 5 years. However, it's not 10% this year. I think I got it at 2% this year. Even that might be a little much. With all of these and the amount of cash, and what do they do with the cash they generate? Because they make a lot of cash. What do they do with it? They aggressively buy back their own shares. And so all of my financial modeling, which again, all discounted cash flow models are wrong, all of them, even mine. My financial modeling with weak sauce growth, everything underplayed from what I think underplayed from what the 5-year plan is, which I guess is me just saying they're not going to hit their 5-year plan, even though they have a history of doing so. Discounted everything back to the present, add all the debt on the balance sheet, subtract all the cash to get firm value, make an adjustment for outstanding options. So really hit them hard on what their equity cookies have been to. I struggle. The fair value. I want to do the air quotes. The fair value I have in my model is 5 cents, is a nickel below $80 a share. The stock's trading at 45. Now, I'm going to be wrong. But if this company, let's just say I'm horribly wrong and I can gut my growth thing and we can only get the value to 60. By buying back all the shares with what they're doing with all of their cash flow, not aimed at new store growth, which by the way, Emily, they are growing stores. I know they're not growing revenue yet, but they are growing stores. We're going to wake up in 2-3 years with they've just fallen below 70 million shares outstanding. They were at about 95 million, I think, when they IPO'd in 2020. They're now below 70. They're going to be buying back a ton of shares at lower prices. And I believe what is going to happen. I'm going to go in a strange direction, and then I'm going to let Emily eviscerate everything I've said. I would encourage people to go look at Sprouts Farmers Markets. What does Sprouts Farmers Markets have to do with anything, right? It's a grocery store. Sprouts Farmers Markets 3 years ago was a $25 stock. And I will argue it was a best-in-class grocery store trading for worst-in-class multiples. And what were they doing? They were making a lot of cash. They were growing their store base as well, just like they're regional, looking to become national, just like Academy Sports. And I know sporting goods aren't groceries. I get it. But the behavior of the management team is the same. This is a $25 stock in September of 2021. So it's 3.5 years, I guess. $25 stock. Management aggressively paying off. Well, they didn't have much debt. So they paid off what little debt they have, aggressively buying back their shares. And everyone woke up one morning and said, hey, this is a really good business. And they started producing results that were better than expected. And the stock has gone from $25 to $140 in 3.5 years, a grocery store. Right now, the economy might look crummy. People might be going, tariffs and scared and everything like that. And I think management here is very quietly going to hoover their own shares. And when the industry turns, and I don't know when that's going to be, but it'll be a Tuesday. When the industry turns, when this company reports a quarter that's better than everyone else's and everyone is expecting, I think it could spur a Sprouts Farmers Market like type growth arc. Over to Emily.
Let me be very clear here. My hatred for Academy Sports Outdoors, which it is a hatred, does not stem from deep financial analysis. Although I will maybe make that a priority just to have legs for this argument long term, but rather stemmed from the fact that I grew up in Texas. I have been to more Academy Sports and Outdoors growing up as a soccer player than I'd ever wished to. And there is absolutely no reason in the world why this company needs to exist. It does not need to. Now, granted, Jim, I will caveat this by saying my feeling were exactly the same on Boot Barn. And I was like, there is no need in the world for this company to exist, and it has done incredibly well. So I hear your argument that
Fools, that's a recommendation there. I'd never heard of Boot Barn until Emily mentioned it on a show like this. I don't know, 2.5 years ago. And I went and looked at it. I was utterly delighted. So, where she saw only pain and not a necessity to live. My tongue's not working this morning properly. I much like this. I like, this is amazing. I love this idea. It sounds absurd. This is Lynchian behavior. So I actually take Emily hating this company, your words. I take that as I'm going to take that as a positive for me because I'm strange.
Totally fair. I will say I still, further understanding that I will likely be wrong in this, and I hope I am wrong in this. I see no world where 10 years from now, we have 500 Academy Sports and Outdoors across the United States. They don't need to exist. And for the small demand that there is for outdoor sporting equipment, in-person retail, there's a lot of better positioned retailers out there that fill that need. In terms of better position, I mean literally their footprint in terms of where the stores are located. Academy Sports and Outdoors has some of the worst locations. Now, I think they have been trying to improve that, to your point, Jim.
Yes.
Part of the building out stores in slightly more economically viable areas, as opposed to literally shopping centers that are strip malls that have all these closed businesses around them than one Academy Sports and Outdoors sitting there, right? And that's the reason why I think part of their, in 2019, they were so close to bankruptcy was because of their bad store positioning. So they have a really high hill to climb here. And also, again, and I have not spent as much time looking at this company as Jim has, I will note that they did go public during the pandemic, and I viewed that very much as, well-timed cash grab on management's part at that point, but terrible for investors because they were pointing to all of these crazy metrics. Obviously, when people were spending money on things like outdoor equipment, other stuff, because they were locked inside, they're like, look how fast we're growing, when in reality, it just wasn't going to maintain. So I didn't appreciate the timing of their IPO, of course, and things have gotten better very recently. But I will note, even most recently, we're looking at a business that has negative 5% same-store sales growth. And normally I would give them credit for, okay, well, they're going to grow stores. But when your stores are underperforming, when your stores are losing money year over year, building out more stores is just kind of delaying the inevitable, which is begging the question of, well, why aren't people shopping at Academy Sports and Outdoors, at least at the rate that they were previously? Now, this can turn around, but their best performing segment this year, which is their outdoor segment, which is outside of their core competencies, okay, like grills and stuff, not sporting equipment, that grew 4%. That was their best category. Their second best category declined 2%, and that was footwear, mainly driven by Crocs. This is a business that does not understand what its niche is, what it is selling, or who it is serving. And I think there is some element of a rebound in footprint that is likely to keep this business alive, but sales are half of what they were just a few years ago. Free cash flow is half of what it was just a few years ago.
Nope.
Well, in 2021, yeah.
Okay, I'll give you 2021. Yeah, but if, as you say, that's the anomaly. But okay, I'll give you as the anomaly. Yeah,
sure. But it is all to say that whatever growth they experience hasn't maintained, and it's fine. Their new stores may perform well, and I could see a value play here. To Jim's point, especially if they're able to keep up the cash generation, improve margins, which, by the way, margins are still down. It's not just that sales are declining, margins have been declining too. So this is a turnaround story, which if you buy into that turnaround, that's great. The reason why I can't buy into this turnaround story, though, is because I do not understand who needs to shop at Academy Sports and Outdoors, or why the person who is shopping there is going to 5 years from now be more people than it is today to warrant nearly double-digit store growth.
That's fair. Right. I will say that
we can move on now.
No. I would just say it's about $400 million free cash flow that they've done in the last 4 quarters.
And it is up a little bit from where it was last year, to your point.
Yeah, and that's my metric. The 2020, 2021, the pandemic year, they were flirting with $1 billion in free cash flow. But as Emily points out, I don't think anyone really expected that to be sustainable, or if it was sustainable, boy, the world looks very different today. But this is a company that's a $3.1 billion market cap against $400 million free cash flow. And that free cash flow includes all those stores that Emily doesn't want them to be building.
Which they're continuing to invest in, which
they're continuing to invest in.
Sales growth, negative revenue growth. So this is planning on their stores being better than they are right now, which maybe they will be. But I will say management underperforming, to your own internal judgment here, you expect management to underperform what they have communicated to the market. That is typically not rewarded by investors, even if on a DCF it makes sense.
Yeah, no, I get it. My take on it is that and I generally apply this to restaurants, it's easy for Nick and I to cut out and go buy Chipotle at lunch, right? Whereas we're probably going to think a little longer and a little harder about, upgrading our lacrosse sticks. Do you guys even play lacrosse in the US? I don't even know. Canadians like lacrosse. It means hockey's an easier play. But you're not going to go buy, stuff daily from Academy Sports, I presume, and at that level. But I've always looked at negative same-store sales for a company that I have decided I like, and for the various reasons I like. And in full disclosure, I like this one, and I think I like to think I've added a few reasons why. And none of that what Emily has said is overly surprising to me. No, I mean, like, you as analysts,
Well,
you
I
should.
would just note it's less informed than your opinion.
But we should know. We should know the negatives of our own companies, right, Emily? I mean, if we don't, that's just cheerleading, frankly. But this is with restaurants I've liked in the past. I kind of like to buy when same store sales is negative, because I'm of the opinion, maybe a well-informed opinion, maybe not. Most people, most analysts, the market is a puddle deep. It reads the first couple headlines, decides what it thinks, buys or sells based on that. And so usually if I liked a Chipotle, for example, or a McDonald's, I've never liked McDonald's, or a Restaurant Brands International, which is the parent company of Tim Hortons and Burger King, among others, I actually like to add in quarters when they post negative same-store sales. Why? Because it's beaten the optimism out. I want to be buying the Sprouts Farmers Markets that I mentioned earlier. I want to be buying that at $25 when analysts think there's nothing coming and same-store sales have been negative, rather than today, which I still like the company, but it's $140 with same-store sales at 9%. You're paying up for positive same-store sales. I prefer to pay down for negative same-store sales, especially when I think I've got a whole card in that management here is going to aggressively shrink the share count. And by the time we get back to positive same-store sales in a year or two, there could be 10 to 15, 20% less shares outstanding.
All right, I have nothing to add on
Thank you, Charlie.
We've got about 3 minutes left. I think maybe we've got time maybe to hit this one question.
Hit one more
quickly.
that I'm
Rita
not involved with.
asks us, what are some stocks that you would consider adding or buying as bulwark stocks today? I think that's top of mind for lots of folks, given the market environment we're in. We've entered correction territory, or if not, we're very close to it. So probably folks thinking about, hey, what are some ways I can prepare my portfolio for more potential fireworks? You all have any companies that come to mind for you? I can give a few. There was a questioner in the queue asking about Murphy USA. I think that's the type of company that can fit into that category. Gas station and convenience stores. People aren't going to change their gas and those types of purchase habits. It's a company that historically has just taken the cash that generates and buys back stock. And in an environment where the stock is cheaper, that's going to work that much better for them. So the convenience category, I think is one. Maybe it doesn't fit in the same bulwark category that you would traditionally think of, but I'm not worried at all about where TKO Group sits today. It's a company where the vast majority of revenue comes from its media and TV rights agreements, and we're gonna have those coming down the pike this year, and these are long-term, decade agreements. So we're going to be baking in demand for the asset over the entire duration of the contract. It's not going to be as influenced by what's going on here today. So it's a company that I think is kind of uncorrelated to a lot of what the market is concerned about right now. So those are a couple. Any that come to mind for you guys? We mentioned Nelnet earlier, Jim. That's probably in your bulwark category. Emily?
Sure is.
I'll just quickly note, to Jim's earlier point, I don't like the idea of rotating into defensive companies on the expectation that things are going to get worse in the economy, because by the time you have that expectation, or anybody has that expectation, chances are the valuation on so-called defensive companies has already risen to the point where it doesn't really make sense. So I don't like to be reactive with my investments. And as a result, regardless of what my conviction is in the economy over the short term, I don't make changes to my portfolio. With that being said, I still think there are companies that I would consider kind of defensive in nature, while also have reasonable valuations today and offer capital gains opportunities, which is much more where my focus is. So some of the ones that come to mind immediately, a business like Quest Diagnostics, to the point that you're making, Nick, this is a business that sees a pretty steady demand cycle. The biggest threat against this company has been regulatory changes, but here in the United States, the regulations have been, I think, focused elsewhere. Right now, there was a period where it's like, okay, what does this really look like, especially with hospitals rolling up all of these different labs? But a lot of the regulatory concerns, I think, with the new administration have largely passed us. So Quest Diagnostics is a pretty steady demand curve. A business like TJX Companies, right? A pretty reasonably valued for what it is, discount retailer. It's maybe not as reasonably valued today as it has been in the past, of course. Again, part of that rotation into defensive companies. But whenever people look to trade down, TJX and other businesses like that, these discount retailers can tend to benefit. And I do think with some of the tariffs that we're seeing against places like China, their access to low cost, easy inventory is going to be an asset for them.
All right, folks, we'll leave it there. Thanks so much, everybody, for joining us for this St. Patrick's Day edition of the morning show. Hopefully we were roughly good. We'll try to do even better next time. We're now going to pass the ball to Will and Rachel for a deep dive on DoorDash. Folks, take it away.
Cheers.
Thanks so much, guys. All right, Fools, welcome to another hour of Fool24. This next hour, Will and myself are going to be doing a deep dive on DoorDash. We're back to our former 1 hour format, taking a really nice long look at companies on our portfolio. A lot of times we'll talk about recent recs or long-term recs or just companies that we find interesting or that are widely intriguing to the Fool universe. Will, how's it going?
I'm doing well. How are you?
Doing good. This is an interesting business. It's not one that I currently own, but it is one that I have been really interested in more recently. I'm sharing my screen here, so if we can get that up, perfect. Let me just make that a bit bigger here. There we go. This is a business that's really interesting to me, particularly, I think, as we're looking at the current environment. We talk a lot about consumer-facing companies on this show. I happen to talk a lot about restaurant and food-centric stocks. So DoorDash is an interesting one. I'm going to be starting off today with looking deeply into the background of this business, its business model, essentially how it makes money, what its profitability structure is looking like at this point. Then Will is going to take a deep dive into the financials. I'm going to take it back looking at the potential for the business, their growth trajectory, as well as a deeper look into management. Then Will's going to also take a look at the risks, competition, and valuation of DoorDash. And then we'll close out with our final thoughts. Guys, if you have any questions about DoorDash, go ahead and get those in the Slido. That event code for that is Fool24. We will do our best to get to those before the end of the hour. So feel free to drop those in throughout the next hour, and we will address those later on. For now, I'm going to start off looking into DoorDash and its business model. DoorDash obviously is a technology company at its core, known for its online food ordering and delivery platform that connects consumers with local businesses. And this includes restaurants, convenience stores, and grocery stores for on-demand delivery and pickup. DoorDash, I think, is thought of by a lot of people in terms of connecting consumers to restaurants, but they've been increasingly expanding their partnerships with convenience stores, really growing their share within that category. They obviously are known for facilitating online food ordering and delivery, and so they act as this dual-sided platform where businesses can list their stores and consumers can place orders for pickup and delivery. As a customer, you can browse the app or the website to find restaurants, convenience stores, and other businesses and place orders. It's been a great way for restaurants and businesses to list their stores on DoorDash and be able to expand their potential customer outreach and grow their business through third-party delivery and pickup options. DoorDash drivers are widely known as dashers, and these are independent contractors, members of the gig economy who use their own vehicles to accept and make deliveries. So there's a lot of different options on DoorDash. You've got food delivery, grocery delivery, convenience store delivery. DoorDash actually also offers other services. They have pet supply stores that are listed on there. Alcohol, even package returns is something that is facilitated by DoorDash in certain markets. And then DoorDash earns revenue through delivery fees, service fees, and commissions from merchants. The story of DoorDash is pretty interesting. So this company is actually, still pretty young. They were founded in 2013 by 3 Stanford University students, Tony Zhu, Stanley Tang, and Andy Fang. And initially, the company was known as PaloAltoDelivery.com. Now, it was later obviously rebranded as DoorDash. But the idea for the company came about because these students, they wanted to address the challenges of local restaurant deliveries. And the idea emerged as they were testing a mobile app targeting specifically the needs of small business owners. And as we often see with businesses that grow, that starts from identifying a gap in the market and then trying to serve that gap. And what they noted was that there were a lot of restaurants that were struggling with fulfilling online deliveries. And they saw an opportunity to bridge that gap between technology and service. So in 2013, they launched PaloAltoDelivery.com, later rebranded as DoorDash. And initially, they focused specifically on local deliveries in the Bay Area. They, famously received $120,000 in early seed money from Y Combinator, which is a well-known startup accelerator that's been involved in the launch of many of the companies that we now talk about today that are publicly traded and within the Fool universe. And they received that seed money in summer 2013 in exchange for Y Combinator's 7% stake in the business. DoorDash initially focused on delivering food from local restaurants in the Bay Area. They wanted to become the local on-demand FedEx. And interestingly enough, the founders actually performed the first 100 restaurant deliveries themselves. And that really enabled them to learn a lot about the pickup process, parking, other very practical issues that would come up for their Dashers. And at the time, they envisioned a business that would deliver merchandise and food from local restaurants and retailers. And they expanded rapidly. Before long, they were partnering with some of these large fast food brands like Wendy's, Taco Bell, Buffalo Wild Wings. And by the end of 2015, DoorDash had expanded to 22 markets in the US, including San Francisco, Los Angeles, and a handful of other major cities. In the years that followed, they continued to grow. They became the largest US food delivery platform by 2019, just 6 years into their history as a business, surpassing the likes of Uber Eats and Grubhub. And they currently operate in the US, Canada, Australia, New Zealand, and Japan, with plans to expand further into Europe. And I will admit, I did not know until I started really digging into DoorDash's business how much of a global footprint they already have. And a huge part of that has also been through acquisitive efforts that they've made, which I'll talk about here in a moment. A lot of people might remember DoorDash's IPO in 2020. I'm sure you remember that, Will, as we were heading into the year of the IPO.
Yes, that one was memorable for sure.
So that was in December 2020 on the New York Stock Exchange. It was a significant event. So shares at the time soared about 86% above the initial price of $102. The company reached a valuation of $72 billion at the time. They raised $3.37 billion in their initial public offering, closing at $189.51 a share. And they were valued at over $60 billion on a fully diluted basis. It was unsurprisingly one of the largest of the year. And at the time, that exceeded the combined market cap of companies like Domino's and Chipotle. Now, of course, shares have come down significantly since that time. Meanwhile, though, DoorDash's market share surged to nearly 50% during the pandemic. With more people relying on food delivery services, this was an area where DoorDash was well poised to fill that gap, despite the existence of other well-known competitors. And it's also worth noting that the company's valuation, when they became publicly traded, and some might reasonably argue that it was a very steep valuation compared to the actual true intrinsic worth of the business, their valuation in their previous private market valuation was more like $15 billion. So a pretty wide gap there, but interesting to note. We all know. Go ahead, Will.
I also might add that I just look at the share price. It's about 185 as of this morning, a couple of minutes ago. So you showed that it closed at 189, above 189. So
right,
it's had a wild ride, and mostly not in the right direction. But I guess maybe it's making a bit of a comeback now.
Yeah, sort of just now getting to their IPO share price again. What is that? 4.5 years on, 4+ years on. Now, we know the pandemic obviously led to a surge in demand for food delivery services. This really boosted DoorDash's growth. And despite the success of their initial public offering at the time, there were a lot of analysts, and I would say this was fair critiques, that were critiquing DoorDash's lack of profitability. Also, just the competitive nature of the food delivery market. Some argue that the company's valuation was unsustainable, that the IPO was an example of pandemic pull forward in demand. I do think that has been a reasonable assertion that we've seen play out in the stock over the last several years. In 2023, DoorDash actually moved to the NASDAQ, which further solidified its position in the public market. One of the things that's really interesting is DoorDash has actually been quite acquisitive, and more so than I was aware of before I started really digging into this business. So in 2019, DoorDash acquired Caviar, a food delivery service that specializes in upscale urban area restaurants. And they bought that from Square or Block for $410 million. That same year, they acquired a teleoperation startup called Scotty Labs that focuses on self-driving and remote controlled vehicle technology. So sort of interesting to ponder what kind of a role that could play in the business over the long term. And then in 2021, DoorDash acquired Chowbotics, a robotics company known for its salad-making robot, Sally. I had no idea about some of these acquisitions. Walt is one I was familiar with. So in 2021, DoorDash announced that it was acquiring the Finnish technology company Walt. It helps customers discover and get local shops, restaurants, and grocery stores delivered to them. That was a more than $8 billion acquisition, and it was notable because it expanded DoorDash's global footprint at the time to 27 countries. And it's worth noting that Walt continues to operate independently with its own team, brand, and products in Europe and Asia. And then DoorDash operates under its own brand in North America and Australasia. I personally have used Walt quite a few times in the part of the world I'm in. And I had forgotten that this was an acquisition of DoorDash. That is also a really great app. I use DoorDash a lot. This is anecdotal. When I'm back in the States, I use Walt a lot when I'm over here in Europe. And it's easy to see how these businesses have integrated well, despite maintaining their separate brand identities. They also made an acquisition of a company called Bebot to bolster in-store digital ordering capabilities. DoorDash's business model, I would say, is pretty straightforward. One of their key revenue sources is money on commissions from orders from restaurants, delivery fees they charge to customers. They also have subscription services, Dash Pass. They even make money from advertising and a very small amount of revenue from corporate catering. So commissions from restaurants is sort of the lifeblood of their business model. They can earn a commission ranging anywhere from 15% to 30%, depending on the plan that the restaurant has chosen. And then they also charge customers a delivery fee for each order. And that will vary based on distance, demand, other similar factors. Their subscription service Dash Pass provides subscribers with reduced service fees on orders above a certain amount. And that's also a nice recurring revenue source for the business. Now, something else that's interesting is restaurants can pay to have their listings promoted on the DoorDash app, increasing their visibility, attracting more customers. DoorDash also offers a corporate catering service for businesses looking to order food for their employees. And they have a classic, software as a service revenue model in the form of a DoorDash storefront for restaurants, where they can help restaurants set up their own online ordering system. One thing I think that's interesting to note, we've obviously seen a lot of changes in the gig economy over the last few years. And I think it's helpful to have a little insight into how Dashers are paid as it relates to DoorDash's overall business model. So Dashers are paid weekly for deliveries that are completed between Monday and Sunday of the prior week. And then payments typically appear in their bank accounts within 2 to 3 days. There's something that DoorDash offers called DoorDash Crimson. It's a personal banking account. And this enables Dashers to receive earnings instantly through instant pay. They can enjoy cashback and perks and also manage their money within the Dasher app. There's also a Fast Pay, which allows for daily withdrawals for a fee. And Dashers can choose to earn by completing individual offers or by utilizing a guaranteed active hourly rate while they're engaged in delivery. So DoorDash provides a base pay for each offer, but that can vary depending on the estimated time, distance, and desirability of the offer. And then if a customer pays in cash, Dashers keep 100% of the cash received, and the order amount is automatically deducted from their next direct deposit. So kind of an interesting process there. I wanted to also look a bit into the company's most recent annual report as I sort of get to the tail end of this section. Something they say is that their mission is to grow and empower local economies. Their marketplaces now operate in over 30 countries, including the US. In the US, despite the fact they have a global presence, still accounts for the vast majority of the company's revenue today. And the way they look at it, they say our marketplaces serve three primary constituents: merchants, consumers, and the independent contractors who use our platform to generate earnings, or dashers. And as I mentioned before, these marketplaces provide a really integrated suite of services that helps merchants establish an online presence, helps them connect with consumers in their communities and solve challenges like acquiring customers, order fulfillment, merchandising, payment processing, and customer support. As of the end of 2024, DoorDash's family of marketplaces that are owned under the DoorDash umbrella served over 42 million monthly active users, and they had over 22 million Dash Pass and Walt Plus members also at the end of last year. They say also, in addition to our marketplaces, we offer our commerce platform. That is that suite of services I mentioned that helps merchants grow, run, and operate their businesses on their own channels. They have their white label delivery fulfillment services that generate the majority of the revenue within their commerce platform. And then they also provide services that help merchants establish online ordering, build their own branded mobile apps, enable tableside order and pay, and improve customer support. There's so much more, looking into this to DoorDash's model than might appear at first glance. Obviously, delivery fees, taking a commission cuts from transactions, but also the way in which they directly support and facilitate growth for their merchant partners is really key and a core element of their business that I think is important to note. And in terms of their dasher base, they say we really seek to attract dashers primarily based on the accessibility, flexibility, and earnings opportunities that we provide. Now, in terms of employees, and again, dashers are not direct employees of the business. They had about 24,000 employees worldwide at the end of the year. They also engaged contractors and consultants. It's worth noting that in 2024 alone, 8 million people dashed for DoorDash, and they earned a combined total of over 18 billion in earnings. And they also said, part of our business model is we think that the barriers to entry in dashing are pretty low. Where permitted by applicable law, dashers obviously have to pass a background check, and in most geographies, they have access to a bike, scooter, or car. And if you qualify to become a dasher, you're often eligible to begin generating income within a day of signing up. And they said, in their opinion, they know of no other earnings opportunity that provides superior accessibility to dashing. Once dashers qualify, they choose whether to dash, where to dash, when to dash, how long for. They can essentially, make their own schedule, which I think is something that is notable and also a very flexible part of how their model works. And they said we provide dashers with opportunities to earn that are competitive. We provide tools that provide immediacy and accessibility of earnings, which is something I outlined a few moments ago. And then they have a whole range of support options to help their dashers and to provide those high levels of service through app, website, email, chat, and phone. Now, this is a look at the company's performance in terms of orders, marketplace GOV, which refers to the total value of orders transacted through DoorDash's marketplace in a given period of time. And this is kind of interesting to look at because this tracks these metrics over the last few years in 2022, 2023, and 2024. And as you can see, there has been a steady pattern of growth, although there was actually some slowdown in terms of year-over-year orders growth in 2024. So total orders grew year-over-year 25% in 2022, 24% in 2023, 20% in 2024. Marketplace GOV, which again, total value of orders on their platform in a given period, grew 27% in 2022, 25% in 2023, 20% in 2024. Now, some of that might be attributable to some of the changes we're seeing in terms of consumer spending patterns. I think these are numbers to pay attention to, but also you're seeing a business that is has more of a global footprint than it did a few years ago, but is also a more mature business. Something else that I think has played into the growth trajectory of the stock, and of course, Will's going to dive further into financials here in a minute, is they've also seen some deceleration in their revenue growth. Now, again, I do want to underscore that this is a much more mature business than it was 5 years ago, and like a lot of other of these tech-centric, pandemic-driven businesses, I think there were a lot of companies that accelerated their growth rate in a very brief period of time, which if not for the pandemic would probably have been spread out over a much longer growth trajectory. But I do think that that is worth noting. Last year was the first full year the company reported a GAAP profit. Prior to that, they had been reducing, but still reporting, pretty significant net losses. Now, again, looking at their revenue model, which I mentioned earlier, but this is the excerpt from their most recent annual report. They say we generate a substantial majority of our revenue from orders completed through our marketplaces and related commissions charged to partner merchants, as well as fees charged to consumers. How does that work, though? Well, commissions from partner merchants are based on an agreed upon rate that is applied to the total dollar value of goods that are ordered in exchange for using the DoorDash marketplace. And then fees from consumers are from the use of their marketplace and to arrange for delivery services. They also, of course, generate some secondary revenue from membership fees paid by consumers for their Dash Pass and Walt Plus subscriptions, advertising products. That is all reported as part of their marketplace's revenue for anyone that is going to be, looking into this business further, maybe after the show today. And then, of course, there's their commerce platform that I mentioned. Their Drive business generates the majority of revenue within their commerce platform, which involves per order fees for merchants to arrange for deliveries that fulfill demand. They said we generate a substantial majority of our revenue from orders completed through our marketplaces and related commissions. Revenue from their marketplace is recognized at the point in time in which the consumer obtains control of the merchant's products. So, for example, let's say I order from a restaurant. When I receive that order, the revenue through the marketplace is recognized at that point by DoorDash. In terms of revenue recognition for their memberships, Dash Pass and Walt Plus, that is recognized on a ratable basis over the contractual period. So that could be anywhere from 1 month to 1 year, depending on the type of membership that the consumer purchases. And then their per order fees through their Drive offering is recognized at the point in time, again, when I, as the consumer, obtain control of the merchant's products, say a meal that I order from my local restaurant, which I think is notable. And then one kind of final thing here as well, this is obviously a much smaller part of their business, but they do sell gift cards to consumers that can be redeemed through their marketplaces. They say the majority of our gift cards have no expiration date. Administrative fees are not charged on unused gift cards. And then when those gift cards are redeemed, our revenue is recognized on a net basis as the difference between the amounts collected from consumers, less amounts remitted to merchants and dashers. This is a small part of the business, right? You look at 2022, 2023, and 2024, they had 47 million, 41 million, and 46 million, respectively, of gift card revenue. And then my final slide here for this section, looking at how the stock's performed since IPO, it's been quite the trajectory, as you mentioned, Will.
Yes.
I mean, it's, there's a time at which it was sort of close to the market's performance, but this is, broadly speaking, underperformed the market since IPO. Obviously, over the last year, shares have seen a nice bump. I think shares are up about 40% in the last 6 to 12 months. But this has certainly been a volatile stock to hold.
And I think it's worth noting too that DoorDash was not the only company that went through that.
Correct.
I think companies tend to IPO when the market's booming, and so the market's already high when these IPOs come out. The problem is soon after you often see a substantial pullback, and that tends to hurt its returns for the first few years. And Warren Buffett doesn't like to invest in IPOs. I think that's probably the primary reason why. Because you not always, but you tend to see that pullback. So
Yeah.
Anyway, thank you, Rachel, for that extensive explanation. Quite an interesting business. Going to questions, Sadaf had an interesting one. He asked, please let us know more about your thoughts on potential impact of inflation and immigration restrictions on DoorDash, symbol DASH. First of all, I don't think we really have any data for either, certainly not on the immigration part. Inflation kind of peaked in 2022, and there was a lot going on then. First, you had, I think that's when the pandemic slowed. These businesses started to slow down from the pandemic boom. In DoorDash's case, you also had a lot of acquisitions, and it was still a growing business throughout this. So it's kind of hard to to measure the impact of inflation, but you have to think it's going to be negative because higher costs, people are going to buy less for one, and even if they do buy, they're going to think twice about paying that fee to DoorDash to have somebody get it. They might just decide to pick up the items or food themselves, and that's going to affect things. So I have to think it's a negative, but unfortunately, we don't have the data to really show the exact impact of it.
Yeah, no, I think that's right. I think it's, inflationary pressures or further inflationary pressures, which have already had an impact on the business, could inevitably have a further one. We obviously don't have a lot of information in terms of, the composition of the Dasher workforce for DoorDash. There's obviously the reality that some of these restrictions that are being discussed or have been implemented could impact the driver base for DoorDash over the long run. And that's something to be aware of, but we don't have real data on that, as Will mentioned. And there's also been a lot of fluctuations in terms of what that landscape looks like. So I think it's something to be aware of for sure. And I think it's a really good question. It's something that we just don't have a lot of clarity on right now.
Yes. So going into financials, mostly I liked what I saw with the financials. I don't often say that with some of these companies, but I was really quite impressed actually. So looking at their liquidity, their current assets, about $4 billion in cash and equivalents, 1.3 billion. So around 5.3 billion, maybe 5.5 billion if you add that restricted cash and liquidity. DoorDash didn't list any debt on its balance sheet. I had to look. Some of the short-term marketable securities come from debt, so there is a little bit of debt, but it is pretty minimal, and that is pretty notable for a growth company such as DoorDash. Again, you don't really see that often. Also current assets about 7.4 billion. Current liabilities 4.4 billion. So obviously, it can pay its bills pretty easily. So that's always a good sign. And I'm always concerned by first of all, property and equipment. So about almost 780 million. This is a fairly asset light business. So you're just looking at offices, software, computer hardware. It's mostly an IT business. So there's not going to be a whole lot of assets for that reason. With intangibles and goodwill, I actually thought this was pretty low. As Rachel mentioned, DoorDash has been fairly acquisitive, so it has about 2.3 billion in goodwill. For those of you who don't know what goodwill is, it's what a company pays over and above the real value of the company to make the acquisition. So I mean, they might have to write that down at some points, and 2.3 billion would be a significant write down in this business, or even say half that or a third of that. But that is fairly low. I see a lot of companies with much higher goodwill, so I wasn't too worried. Intangible assets, those are assets that you can't really define, but they think they could turn into something valuable, about $500 million there. So not significant, but not high as companies go. As I mentioned, the current liabilities, they've been going up a bit, but the company's been growing at a significant clip too. So in terms of revenue, so that's not really a surprise that it would increase. Again, it's well below the current assets, so there's no real issues there. And then stockholders' equity also, which is the book value. It's the value if you took the assets minus the liabilities, you liquidated the company and sold everything off. That would be about 7.8 billion. I think it's the market cap's in this, 70 billion. So maybe it's trading at 10, 11 times book value, but that's not unusually high for a company like this. So again, no real concerns there. Moving forward to the revenue, as I mentioned, we've had some inflation, but despite that, revenue's been growing at a significant clip. But as Rachel mentioned, it is slowing a bit, but it's still fairly rapid. 8.6 billion in 23, and then 10.7 billion in 2024. I mean, if you look at the total cost expenses, the total cost expenses slightly exceeded revenue in 2024. However, if you look at the stock-based compensation, that's about 1.1 billion. So that's all that they always distribute that within the the various expenses, sales and marketing, research and development, et cetera. So operationally, I think this has been making a profit. And if you look at the fourth quarter numbers, the cost and expenses was below revenue. So this is a profitable company right now, and not just because they bring in a little bit of interest income. But yes, they were barely profitable in 2024 for that reason, despite the rather high stock-based compensation costs. And moving forward to the cash flows from operating activities, net income takes out depreciation and amortization as well as the stock-based compensation. You add those are probably the biggest numbers that really stand out in this operating cash flow statement. So you had about 2.1 billion in net cash provided by operating activities. As you can see, free cash flow significantly increased. So 1.35 billion in 23 to 1.8 billion in 2024. So I'm like I said, I'm mostly liking what I see with these financials. It's not often you see financials that are this good for a company like this. So and now that it's profitable, that's, I think, even going to be even better for the company.
Yeah, I think that's the case. And, as you mentioned, it is also an asset light model, broadly speaking. And that's something that I think, bodes well for the company's growth over the long run, even if you see some deceleration there on the top line. Just waiting for my screen to share there. And then I want to take a look at the potential for the business. This is a company with a massive market share, right? So they, according to the most recent estimates we have, they hold a market share of about 67% in the U.S. online food delivery market. And then Uber Eats follows in second place with 23%. And this was according to stats I found by Bloomberg, second measure. And, DoorDash, obviously, they operate in a massive total addressable market for food and convenience delivery globally, right? They have the dominant market share in the US. Currently, that is where they generate the majority of their revenue and now profits. But they really are in the very early stages of their ability to grow internationally. And the international food delivery market, convenience delivery market, it's a very fragmented space. And the acquisitive efforts they've made through the years, I think, are really key because it's expanded their international footprint, giving them a lot more optionality to expand within some core target markets over the next 5, 10, 15 years. It's estimated by some analysts that their total addressable market for food and delivery could be as much as about 300 billion globally. And that is a market that's expected to grow anywhere from 10 to 15% annually through 2032. Food delivery, convenience delivery is something that has taken broad adoption in most markets across the world, in both developed as well as underdeveloped economies. And that's something that I think presents a real opportunity for this business. They obviously have a lot of competition internationally as well, that I think is also something to note. But they're working to expand into other verticals beyond just food delivery, areas like retail, alcohol delivery. I actually saw an announcement they had in their press release section as I was preparing this presentation, that they recently announced a partnership with Home Depot. And they're going to be allowing a lot of Home Depot's, products and offerings on their platform, making it easy, to connect with customers. And I thought that was something that was really interesting. It's not exactly the merchant that one would think of at first when, pondering what options are available on DoorDash's platform. So they're really working to capture a broader share of the delivery services market, which is estimated by some to be, as much as more than 1 trillion. We've obviously seen strong growth from the business. Total orders just in the final 3 months of 2024 alone increased 19% year over year to 685 million. In Q4, their marketplace gross order value increased 21% year over year to 21.3 billion. Revenue grew 25% year over year to 2.9 billion in Q4. They now have more than 40 million monthly active users. And they also have a 60% market share in the convenience delivery category. I believe that's domestically. And so they really have expanded their footprint into food delivery and convenience. And I think the real key for the business is going to be their international expansion as well as retaining their significant market share as there's new competitive entrants to the market. There's some analysts that are expecting that DoorDash will achieve revenue growth and more than 36% EPS growth per year over the next several years. Obviously, they're still working towards consistent profitability at this point. DoorDash has previously said they expect their marketplace gross order value to grow between 17% and 20% in Q1 2025. That would reach a midpoint of about $22.8 billion. DoorDash is obviously still working to be consistently profitable, but analysts, as well as I believe management, expect it broadly to be GAAP profitable in 2025, again, following their first full year of proper GAAP profitability in 2024. They are targeting their operating margin to potentially improve to as much as 12.5% by 2028. And something as well about their website, their platform, their app is it really leverages robust network effects. The value of its platform increases as more users, both consumers and merchants, join. And this is a pattern we've been seeing over the years. Even as there are changes in consumer spending, more consumers and merchants and dashers are joining the platform. And as they expand beyond traditional food delivery into new verticals like grocery, alcohol, other retail items like Home Depot, diversifying their revenue streams, I think this trajectory, broadly speaking, can continue. Now, in terms of a look at management, this is one of those companies we talk about how much we love, founder-led companies. Tony Zhu, one of the co-founders of DoorDash, longtime CEO, and has also served obviously as one of the company's directors since May 2013. He is also on the board of directors at Meta Platforms, graduate from Stanford as well as UC Berkeley. The company's COO and president has been in that position since March 2023. Prior to that, he actually served as DoorDash's chief financial officer. And then before that, he was vice president of finance at Uber Technologies, which is obviously a major competitor to the business. He also worked at Goldman Sachs and holds a BE in electronic engineering from the University of Mumbai, as well as an MS in electrical engineering from Columbia University and MBA from New York University. Another element of management I wanted to highlight as well is the company's vice president of finance and strategy, who's also served as their chief financial officer since March 2023. He also used to work at Uber. He served as head of finance for Uber Eats from November 2015 to November 2018, and also worked at Goldman Sachs in their investment banking division. So really, really robust management team, very experienced in this space as well. And they've been with the company for a long time. And again, a founder-led business, which is something that you always like to see. There's plenty of great examples of wonderful companies that you don't still see the founding management in charge. But that's something that really stuck out to me as well when I was kind of digging a bit deeper into this company's leadership team.
Yeah, and going through your presentation on potential, you mentioned international. International, well, the United States was about 88% of revenue in 2024, so leaving only 12% for international. So that kind of tells you how I barely scratched the surface. And you always have to worry about international because there's differing rules, differing cultures. A lot of companies fail at international expansion. There's even some very surprising failures if you look at companies across the board. However, DoorDash grew its international revenue by 54% last year, so that is a good sign. So I think maybe this could point to a bright future, assuming that continues. So
yeah. I think that's right. I do think it is a significant opportunity for them. I think that they have more competition internationally. They were such an early mover in the US food delivery, convenience delivery space, and they've been able to maintain a really solid footprint there, but that's also a much more mature market for them. So I do think these acquisitions they've made could be really key to their growth over the long run, if they're really able to execute on that ability to expand internationally, with the presence of so many other smaller, more regional players. Whereas, there are some of these smaller companies that you see in the US, but that market is essentially dominated by Uber and DoorDash and Grubhub, and not so outside of the US. So that's something that I think about that I think could be interesting for the business over the long run.
Yes, and a lot of their competitors are more niche markets. So I will get to that as soon as I get into this presentation. So yes, I'm doing risk, competition, and valuation here. Looking at the risk, there are I don't think very few of these are come as a surprise, but they are still worth going over anyway. Looking at the business, there's a fairly limited operating history. Like Rachel said, it was founded in 2013, so it's not exactly new, but it's not it's far from being established. This is still very much a growth industry. So the company is still learning a lot and having to work through things that they may not have expected when they started the company. And of course, there is intense competition. I'll go into some of the competitors in a minute, but Uber is obviously the most well-known one. But you also, in terms of delivery, you also have like pizza places. A lot of them have always done their own delivery. You have foreign competitors as well, and and also niche businesses like groceries. There's a lot of self-delivery in the grocery business. So there's not really any company that does exactly what DoorDash does, but there are a lot of related companies where they are partial competitors. So and obviously it has to retain its merchants and consumers. Like I said, a lot of choices when it comes to deliveries, or there's the choice to not do delivery at all and just pick things up yourself. So there's always that concern. So it has to be attractive enough for the merchant to do business with DoorDash, and for the customer to say, nah, I'm not going to pick it up. I'll let DoorDash pick it up for me. So that's always a concern. Retaining dashers. They have to come up with a decent enough compensation package that the drivers will continue to do the company's deliveries. So that's always a concern. They can always go to Uber, go to another competing delivery service to work for. So always a concern there. International expansion. It already is adding to cost, but that's always a risk because, like you said, you're dealing with a new market. You have to set up new infrastructure, deal with new rules. So that's kind of standard when you expand outside your native country. The business may not grow at a consistent pace. We just had the question recently about inflation. So there's lots of things that could affect growth both positively and negatively. And this is going to be probably a cyclical business because, like I said, if there's a recession or something like that, obviously people are going to turn to a DoorDash or an Uber Eats less. So that's always something one has to watch out for. Financial risk. Like I said, I didn't really find too much that was negative in the financials, but there's still a few things. Like I said, the numbers can fluctuate on either a quarterly or an annual basis, so you always have to watch out for that. Must make appropriate acquisitions and integrate them. I think DoorDash has been unusually good at this. They acquired Caviar to get the higher end market. They've acquired others to go internationally. So I think they've been good at that, and that's huge actually, because so many companies fail at acquisition. So I think DoorDash has been successful. Of course, there are a few competitors they can acquire, which is not the case in every business. But I think they've been good at growing their customer base through acquisitions. One thing that's not mentioned a lot, the co-founders hold a disproportionate. They have disproportionate voting power. So I think that just the top three people, the founder, Tony Zhu, and the other founders, they control the majority of the voting power. So if they don't want something to happen, or if they want something to happen, it's going to go their way, regardless of how all the other shareholders vote. So that can be a little bit of a concern. So it's not. So as a shareholder, you don't really have much power. I mean, not that you do anyway, but for the average shareholder. But even if you were to take a huge position in the company, that particular shareholder wouldn't have that much influence. So that's always a concern, I think, if for people who might want to buy shares, especially those larger institutional investors. Moving on to execution, the merchants have to maintain the service levels, and that's a little scary for DoorDash because DoorDash has no control over what merchants do. If the merchant lets its business go, there's obviously going to be fewer orders, especially if it's a major merchant. So there's always that concern. One big one is the potential for systems failures and interruptions. So if the DoorDash app goes down, the business is basically dead in the water. And you might remember from the big outage with CrowdStrike last summer. If something like that were to affect DoorDash, DoorDash would, like I say, would be dead in the water, would not be bringing in any revenue. That's going to affect the financials, the overall business, the stock price. So that's always something both investors and customers have to watch out for. And you have to adapt the model, of course, to different countries. So, a lot of things will be the same, but there's always these different cultural nuances or ways of doing business and such that DoorDash has to be aware of when they go into specific markets. So that's always something to watch out for. There's always the potential for lawsuit liability. You might remember that Uber Eats, I guess the Uber Eats part of Uber, sued DoorDash for some of its exclusivity contracts it had with some merchants. Honestly, I think that kind of reflects more negatively on Uber than DoorDash. Usually you don't turn to lawsuits when you're winning in the competitive battle. So that I mean, in a way, that bodes well for DoorDash because they're the victims of that. But yeah, at the same time, you don't want to be dealing with a lawsuit or the potential liability that could come with that. So that's something investors need to watch out for. You're subject to a variety of laws and regulations because it operates in 32 countries. So obviously you have to deal with differing rules for differing places. Another issue that's been big in this industry is a lot of governments, particularly in California and other places, were pressuring DoorDash to make its contract employees, its dashers, full-time employees. That was rather controversial. Now, in fairness, there are probably some dashers that would like to be DoorDash employees. However, there are others that actually would like to be contractors, like the freedom and flexibility that comes with being a contractor. And so they rather have slightly higher pay and the freedom than they would, the benefits and the drawbacks of being an employee. So that was always controversial. I think that's been limited to certain areas, but it is still a concern if more governments decide that it's not a good thing to be an independent contractor and try to force them to become employees. That's going to add to the cost of DoorDash, certainly, and may affect its business and may affect its growth. So that could potentially be a huge negative, depending on how that plays out. I'm going to competition. Well, obviously, probably Uber Eats is the most notable competitor. Now, Uber Eats is a relatively smaller part of Uber. Uber, as you know, is the rideshare company. They dominate in that space. They have tried to go into other areas like food delivery. As Rachel pointed out, they haven't been quite so successful as DoorDash pretty much has a dominant market share in this area. But it is a competitor to watch out for nonetheless, and probably the overall closest competitor that DoorDash has, certainly in the U.S. And you have the pizza places, Domino's and Papa John's. They've been doing their own deliveries for decades, and they're still largely sticking to their own system. They haven't at least not yet, have they outsourced to DoorDash or Uber Eats or a like company. So they're in a way they are still technically competitors. You have the grocery delivery, so your Instacart, Amazon Fresh, GoPuff, Owner.com, Fresh Direct. A lot of these companies do their own delivery, so they're not going to be turning to DoorDash if they want to expand into that, unless they change their business strategy anyway. Dumpling is more of a personal shopper app, so that's a little bit different. I guess it is a competitor. A lot of times, I guess you could probably look at DoorDash as a personal shopper app in the way, because you tell it what you want to buy and it picks it up. But Dumpling has a more personal shopper focus than, at least more directly than DoorDash does. Eat Street, Chow Now, Delivery.com. Those are oriented toward the restaurant industry, which is, of course, a major customer of DoorDash. So, but I think those are more limited to that part of the delivery industry. And I should mention that most of these are also private companies. You have a few: Uber, Domino's, Papa John's. Amazon isn't private, but Amazon Fresh is such a small part of the business that it's not, the delivery part's really not going to register on its financials. Grab Holdings, I guess maybe it's becoming more of a competitor now, but it's mostly a peer. For those of you who don't know Grab Holdings, it does deliveries and apps and financial services primarily in Southeast Asia, but more in developing countries. I don't think DoorDash is in a lot of those markets, at least not yet. So it's probably more pure than competitor, but that could easily change in the future. So it is something to watch. Moving on to valuations. So like I said, most of these companies weren't public, so I had to expand the definition a little bit of a competitor to find other stocks, but Uber being the obvious one, and Grab Holdings, which does the same thing in a different region. And I included Domino's because they deliver pizzas, and then Maple Bear. Maple Bear is the parent company of Instacart, and they do obviously grocery deliveries. DoorDash I think fared fairly well here for the most part anyway. Gross margins, it beats most of its competitors. It does not meet Maple Bear because if you go on the Instacart app, you do have to pay a fee to use it. So that fee adds to the gross margin. So I don't think any of these other companies have that advantage per se. So that does boost Maple Bear's gross margin in comparison to these other companies. But that is something to note. But revenue growth, it actually outperformed all of them. As a positive operating cash flow. Market cap of about $77 billion. That's about half of Uber's size, but you have to remember that Uber's in the rideshare business. And then Grab Holdings, like I said, they're mostly in the developing world. There might be more potential there, but I don't think they're serving as much of their markets as DoorDash is in say the U.S. So that's something to keep in mind. Like I said, Domino's just does pizza, so other than the delivery part, there's not too much relation. And then I just mentioned that about mentioned this Instacart situation. Price to sales ratio, it is a little bit more of an expensive stock. 7.4, that's more than twice what Uber is. I guess Grab Holdings kind of comes close to that, but this is a relatively expensive stock. In fairness, the price earnings of 651 probably is not a fair measurement. Like I was mentioning earlier, as Rachel mentioned also, 2024 was its first year of profitability, and relatively speaking, it was not a huge profit. So, price earnings, that is just that, the price versus the earnings. Of course, because it's newly profitable, the earnings are going to go up pretty hugely, or at least they probably will over the next few years. That's going to come down. You look at the forward earnings. I think it was they were looking at like $213 a share, if my memory serves me correctly. They're at 180 something now, so you're looking at a forward PE ratio probably in the 80s, which I do think is a little bit expensive, especially when you compare to some of these other PE ratios, especially Uber at just 16. So, this is a prosperous company, but it is a bit on the expensive side. You are going to pay a premium for some of that added growth. Oh, so looking at the bottom line, I'll just keep my slides up and let Rachel explain why she decided that DoorDash is a cautious buy.
Yeah, this is a cautious buy for me, definitely. I mean, obviously, this is a major player in the food delivery space. They're expanding really well into convenience categories. And I do like all the different kind of competitive players you pointed out, especially in the valuation section. I mean, you think about this as a company that is trading at more of a premium. They are reporting much, by orders of magnitude smaller profitability compared to the likes of Uber, but they could significantly outpace Uber's market share in the US. Even though their revenue is smaller, their revenue growth rate is higher. There's, a lot of factors at play there. I think that they have done a really good job of growing successfully through M&A activity. I think that's something that's been really key to their growth over the long run. And I think that that's something that could be a real competitive advantage for them long term. I think obviously one of the most notable things to be aware of is, how spending could slow in an economic downturn. Now, there's sort of an interesting kind of correlation between some of those factors and how a business like this would fare. You could definitely foresee a situation where if economic conditions worsen, people might be looking more to the gig economy for ways of earning extra money. You could see more dashers that could go to the platform as a means of, a secondary supplemental income. And as we talked about, DoorDash does have really a wide range of sources of revenue as well as profitability. I mean, a huge part of that is fees attached to transactions, delivery fees, and commissions. But they are expanding into these other areas like advertising. And I think the other thing that makes me consider where the company could really have some additional resilience over the long term is the fact that they are expanding more heavily into areas like grocery and convenience, which are really these essential spending categories. So you could see a situation where even if spending were to slow on areas like restaurants in the short term, and again, short-term factors don't indicate long-term or shouldn't indicate long-term investing decisions, but kind of factoring these risks in mind, you could definitely see a situation where it's increased focus and market share in the convenience category and some of these other areas like grocery delivery could offer some resilience to the business if consumers continue to focus even more on essential items and, prioritize less of those, discretionary purchases. The biggest thing I'm also really watching for with this business is obviously, are they able to grow out that track record of profitability? They're newly profitable. This is a company that has been investing really heavily in their growth story over the last few years. We've seen that from their rapid expansion into new markets, the different services and offerings they're providing to attract merchants, to attract consumers, to attract dashers, and this stream of acquisitions they've made in recent years. They reported their first full year of proper GAAP profits of 123 million last year, and I think that was notable and something that could portend more consistent profits over the long term. I think another thing to note here is this is probably not a growth trajectory that you're going to see return to pandemic levels, right? This is a very different market in which the company is operating in now than it was a few years ago. I think they experienced above average growth compared to probably the growth they would have experienced if the pandemic had not happened. I still find this to be an intriguing business, but I think that's something to be aware of. This is a much more mature business than it was at the onset of the pandemic. And that does translate into some of the more moderated, but still healthy growth numbers we've seen. And then the other thing I would say is, this could be more of a cyclical business, but expansion into more non-discretionary categories can offer resilience over the long term. I mean, I alluded as well to them working to expand into new areas and new types of customers. They're partnering with Home Depot, as I mentioned earlier, to offer on-demand delivery of home improvement products through the DoorDash app. So they are really looking beyond these initial cohorts of merchants that they are so known for. And I do think that gives them more optionality to grow over the long run. One other thing, Will noted is some of these different competitors like Grab Holdings, which is, primarily based in Southeast Asia. They have a whole fintech wing to their business. It would be interesting to see how DoorDash could also expand into other areas like that. So for me, this is a cautious buy, not one I currently hold, one I'm watching, one I wouldn't take a large position in, but one I think has a lot of potential over the long run.
Yeah, and I actually agree with Rachel more than this slide indicates. I agonized over whether to call this a cautious buy like you did or a hold. I ultimately decided on hold because of the slowing growth, and I think the valuation is still relatively high. Like it or not, or whether it's fair or not, the market tends to punish stocks when their growth slows, even if it slows from like 40% to 30%, even though 30% is a fairly high growth rate still, the market tends to punish the stock. So I kind of said hold for that reason. I'd probably go to cautious buy if it fell another 10%, but I think I'm stuck. Yeah, I'm stuck in a hold for now. But I like the market dominance. I said I like that very much like the financials, the balance sheet, and the income statement and such. They are successful in acquiring competitors, which is a definite asset when you see so many acquisitions that fail in so many companies. It is profitable now. I think it trades at a fair price. Like I said, it's definitely not a sell. It's very far from that, but I think it's kind of on the cusp of hold to buy just because of the slowing revenue growth, which I think could bode poorly in the near term.
Yeah, I think that's right. Well, we've come to the end of our hour. Fools, that was DoorDash. Hope you enjoyed that deep dive. This was certainly a fun one to look into with you, Will. Up next, we've got Asit and Tim for Mindset Hour. Hi, guys.
Hi, Rachel.
Hey,
Hi,
guys.
Will.
Good morning.
Thanks very much for another fine hour. We'll see you soon.
Thanks so
And
much.
Fools, welcome to the Mindset Hour. I'm Tim Beyers. With me, Asit Sharma. Happy St. Patrick's Day for those who celebrate. I'm wearing my green. Still got the ginger hasn't entirely gone from my beard yet, Asit. There's still some of it there. So
Nice.
I'll give you a good morning. Slancha. That is little coffee cheers, Slancha. Happy St. Patrick's Day. Get your sleep numbers in. So for me, Asit, I think like 6 hours, 10 minutes. I was up a little too late, but but I did all right. But how are you feeling?
Pretty good, Tim. I got around 7 hours yesterday. Sort of like on the edge of coming down with something. Felt yesterday like I was really lagging, but luckily woke up today, still able to, hop out of bed and get to work. So I'll keep my fingers crossed. There's a lot of stuff going around, a lot of viral stuff. So hoping I'm not getting ready to slide down.
Yeah, I hope not either. Let's hope it improves. All right, let's get to it. While folks get their sleep numbers in, we are going to talk about the third leg in the stool of the acronym we've been building towards. We talked about fear. We talked about uncertainty. Now we're going to talk about doubt. FUD is the acronym. And FUD used to be, it's often used for, in different disciplines, sometimes in sales. If you want to deposition a competitor, you sow fear, uncertainty, and doubt. It's certainly something that comes up in things like politics. But in general, we all face fear, we all face uncertainty, and we all face doubt. And if you are investing, doubt is something that feels like an enemy, but really isn't. But it feels like it, Asit. This is one where if you're feeling a bunch of doubts as an investor when you're putting capital to work, that can feel like a signal like, whoop, I don't know, I'm not sure. And so it ends up leading to what we've talked about in previous weeks. But here's something I want to start out with. This is the bold statement that our producer, Matt Greer, often likes us to start with. So here's my strongest statement when it comes to doubt. You can't have doubt if you don't have a point of view. In other words, if you are an investor and you have a point of view about a business, the odds of doubt creeping in are almost 100%. So why is that bad? So let me kick it to you here, Asit, for an initial reaction.
Well, initial reaction, Tim, is that doubt in and of itself is probably healthy first, more than anything else, and we should recognize that.
Yep.
We have sort of laid out here that doubt can be a signal. It can be information, and it's telling you something. But I totally agree with you. If you don't have a position or if you haven't formed a perspective on something, there's no place for doubt to come in. And working backwards, what does it mean? Maybe to have the best use of doubt, we should rationally build a perspective. If it's on a stock or the markets long term or on our own portfolios outside of investing anything. We should rationally build up positions so that we can then embrace doubt, so that it can help us maybe reframe how we're looking at something or question the conclusions we've come to. There's a second cousin to doubt called second guessing. We could get into that a little bit. I'm prone to doubt, and I'm prone to second guessing too, but I like the presupposition that you have to get to a certain point before doubt can creep in. And Tim, I want to flip this back to you with something that you said to me when we were prepping for this, which I thought was so valuable, which is that doubt offers us permission to pause. And I was curious if you could explain what you meant by that and why it's so important.
Yeah. Okay. We'll go into this a little bit deeper in a bit, but let me give you the short definition.
Sure.
When you are in doubt, you can freeze, or you could say, okay, there's something here, and I need to know what it is that's causing me doubt, that's causing me some amount of anxiety. And it can be very good. Like, one of the things that I think is terrible for us as people in general, but also as investors, is when you go in fully sure of everything, but you're not going to double check, you're not going to do anything. They're like, nope, my mind is made up, and this is it. This is the only way it can possibly be. That can be very dangerous. Overconfidence is a real problem in a lot of areas. And it's especially true in investing. There's a big difference between confidence and overconfidence. Confidence is, I'm nervous, or I've done everything I can. There's nothing else I can do to prepare for this.
I feel prepared. Yeah.
I am prepared. I've done what I needed to do. I still may fail. I'm nervous, a little bit scared, but I'm ready to do this. Overconfidence is, nothing can stop me. I'm the best. There's nobody, nothing could get in my way. And failing to address the real things that could get in your way. You just believe that nothing could get in your way. So you are unprepared, but you believe that you didn't need to prepare in the first place, because nothing can, defeat your idea or your athletic prowess or whatever it may be. It's just different. So doubt giving you permission to pause is recognizing, am I fully prepared? Because if I'm not, maybe I need to look at something else. That can get into a doom loop, and we don't want that. But it is important to be able to recognize, am I prepared or am I not fully prepared?
I've met some overconfident people in my life, but few serially overconfident people. I mean, they exist, but for me personally, periods of overconfidence have been met with some predictable consequences, and that turned me, by like cosmic design, into a more confident person after preparation in any kind of endeavor. Because if you're overconfident all the time, it's going to be hard to make any kind of progress. But some of us take some time to learn that lesson.
Yeah, let's talk about the types of doubt.
Sure, let's do it.
There are three types of doubt. There is evidentiary doubt. Evidentiary meaning, like, I see some things in the world. I see some things in the numbers. I see some things in what management is saying, and it doubt is starting to creep in. So the evidence makes you doubt what you see. There is self-doubt. There is internal self-doubt. And internal self-doubt is in some ways it's the inner critic we've talked about. And this is the harmful stuff. We're like, yeah, you're not good enough to do this. That can be really crippling. There's also the social pressure, external doubt, social pressure, like, I don't know why you would do this. This is so stupid. You're stupid for even thinking you could do this, or so let's say you wanted to buy a stock of a company that is widely reviled at that particular moment, and you feel like, no, you think you're right. You think this is an interesting opportunity. And on social media, you look around, you're taking a look, you look at the FinTwit channels, and you see this stock getting just consistently hit double barrel. It's getting absolutely destroyed online. That's social pressure. That's externally sourced doubt. So of these three, I would say the only one that's healthy is evidentiary doubt. That's really the only one that's very healthy. The other two, that doesn't mean that somebody who is absolutely hammering a stock is not making a great point. But then that ends up falling into the realm of evidentiary doubt. It's making you think. So it's important to remember, and then I'll kick it to you here, Asit. It's important to remember, what kind of doubt are you actually dealing with here? There's some amount of self-awareness that's required when you're dealing with doubt here, because it can be healthy, but it can also be really unhealthy. And how do you know which one you're dealing with?
Very true, Tim. Evidentiary doubt is the one that I've learned to embrace and to expect. When we make an investment decision, we are sort of taking, it's like a Polaroid snapshot. So once you decide you've got enough information and you feel very positively about a business, you feel okay about the valuation in a stock, and you hit buy in your brokerage account. That's the Polaroid snapshot. And it's going to fade a little bit over time. The colors will sharpen as it develops. But you have all the information up to a point, the decision point that's in front of you. That's the body of work that you've done in gathering up enough of data to make a decision. What happens after that is you're going to be exposed to new data, a new stream of data from that point on. And that's evidence. That's why we're calling this evidentiary doubt. You're going to have evidence that either supports the decision you came to or challenges it. Doesn't mean that you were wrong. It just means that you have to evaluate that information in the stream. And so for me, Tim, when I am sort of monitoring that flow of information and I get that first little ripple of, uh-oh, what is this? There's a disturbance in the force. I didn't expect this. I have to deal with it. The first emotional reaction tied to that for me is often doubt, but it's not a deep emotion. It's just a memory type emotion, a muscle memory. Okay, this may contradict the thesis that I have, so let me start to dig in here and let me use this to my advantage. That is to say, I'll take, one of a few courses of action. I'll decide which pieces of information I need to seek next, what part of my analysis I need to go back and revisit. In extreme cases, it could be to put that mental hold. I'm not buying any more shares on this until I understand this better. Once or twice it's been a direct, I was just wrong. I'm doubting it. And now that I've done some additional homework, that doubt is telling me something. What were you thinking, Asit? Go ahead and sell. I haven't done that in a long time. So treating that feeling as part of this evidentiary process, part of an information flow, is, I think, one way we can get better as investors to get use out of what's inevitable, that you're going to have signal that challenges the decision you came to. And it doesn't have to be a U-turn in your thinking, but it does persist, and it does stick out as something you've got to deal with. And some of us actually procrastinate because the feelings of doubt aren't pleasant. And so we just put it to the side. We see things that we probably should deal with and think through, or maybe research. Maybe someone who's listening today who has this, very same pattern, but we just don't want to deal with it because it doesn't feel comfortable. We did so much work. We made a decision. And sometimes right after that decision, you could purchase a stock. Tim, it could be the next quarter. It could be a few weeks later. You see an earnings report and something comes out of the blue that you didn't expect. But for me, this type of doubt is something that I almost look forward to because I almost want the exercise, that little bit of pleasant boxing in the ring. I don't want to get knocked out, Tim. I want to get out and I don't want to get punched in the head too many times. But I like a little sparring with the thesis, right? That's part of the fun of investing.
Yeah. Yeah. So that evidentiary doubt is good. It's good for that. What you're just talking about there. Self-doubt can be crippling when you just don't. Self-doubt is failing to believe in your ability to do something. In this case, we're talking about investing. If you are constantly under pressure inside your own head and like, I'm not good enough to do this, it can and will cripple you. And if that is something you are feeling, please come back here as often as you need to so we can reassure you that you can do this. We know that you can. We've been where you are. It is entirely, you absolutely can. If you need that reassurance, come back here and we will give it to you. And then, of course, social pressure is, I am a believer in looking out into the world and seeing what others think. I am not a believer in taking what others say as absolute gospel. And if there's just a wave of criticism, my question is, and I think it's a useful question, is this criticism warranted? Or is it just outrageous? Because sometimes it is outrageous. But let's talk about, there are 4 points that we have about doubt that we want to go through, and then we're going to get to some more questions. So the first is, as you deal with it, and especially as you're a new investor, you're going to deal with it all the time. The first mindset shift you can make for yourself that will make things easier is recognizing doubt is healthy. It's healthy. So if you can give yourself this little hack when you are in doubt, celebrate it. Celebrate that, okay, this is good. There are maybe questions here, but this is good. What you don't want to do is treat it as a definitive black and white signal. If you treat it as a black and white signal, then what you'll end up doing is saying like, oh, I got to stop. And then you're stuck in a paralysis doom loop. Not good. But if you can recognize it as healthy, okay, this is, I'm feeling this. The next thing you can do is say, all right, there's information here, and I've got some data gathering to do. So that is interesting. You can use that. And then I'm going to come to point 2 here, which is what Asit was talking about earlier, which is you get permission to pause. And I'm going to come to you on this, Asit, for a second here. This is it's time to take a break, but this is now practical. If doubt is information or an opportunity to seek information, then this is what I mean by it being, it gives you permission to pause. It's essentially saying, if, the evidence is looking you in the eye and now you have some doubt, then the next logical step, as long as you're not having an emotional reaction, as long as you're having a logical step, it's like, okay, what else do I need to do to prepare here? I'm feeling like I might not be fully prepared. What else do I need to do to prepare here? It's time for questions. So, Asit, let me kick it back to you here.
Well, Tim, I just love how you formalize this, and it struck me last week when you verbalized it, because I think the circuitry of my brain for so long has been prescriptive in situations like this. So some doubt creeps in, and from reading something years ago to talking with good friends, like, how do you deal with doubt? You got to stop that behavior, Asit. You have to make sure you're not letting the doubt become this or the other. But sometimes just reframing something into, this is cliche, into an opportunity, or flipping that on its head as permissioning, the way you've put it, it just makes it so much easier to say, okay, now I have permission to take a breath here. There's nothing forcing me into a decision or into a doom loop or into a not positive emotional state. This is my permission to take a little interval here and think about things. It's so much easier than the way I've sort of trained my brain to do things in many instances. And it occurs to me, I mean, I can extrapolate beyond this. So many guidelines that I put up in my own little emotional maze, so many signposts are about the prescribing to myself. In this situation, you got to do this. Otherwise, Asit, it's going to be like it was when you were in your 30s and you weren't any good to anybody. But no, it could be something else, that this is an opportunity to really spend the rest of the day in the calm state you were before you got this information, and just seek to understand first. That's always positive and healthy. And I just really appreciate the framing. I think others listening today, I've seen at least one comment, probably do as well.
Yeah. I mean, doubt is a state that, it doesn't need to be permanent, and it can exist along, a spectrum of severity. It can be crippling. It can be, less doubt and more curiosity. There's no such thing as just, a very clear, and doubt always feels the same. It doesn't always feel the same. It can be, very severe. It can be very modest, but I would caution against it seeming like it is irrefutable information. I think you put it well there. It's a permissioning structure. Should I decide to do more because I may not be prepared here, or I may not like the consequences of what I'm about to do? Like, that is, it's worth paying attention, and pausing can really help there. The third is, so we have to park on this for a little bit. There's a big difference between taking a pause and absolute paralysis. There's a huge difference between those two. When you pause for the purpose of, so let's say you are doing some digging and you are deciding on, we're going to keep it in the investing realm here. You're deciding on moves you're going to make in your portfolio. And maybe those moves could be big, and you have some doubts about whether or not these are the right moves. Let's say, I'm going to put this in the context, Asit, of our members here, because we have a lot of members who are, I think, roughly in our age category or slightly older, might be nearing retirement, might be in retirement. And so I think this is a super important discussion, because the closer you get to things like fixed income, or later stage where your responsibilities are different, every decision starts to feel like it has more weight.
Yeah.
So doubt feels like it's more dangerous. And so in those instances, paralysis is pretty natural, because you're like, I don't know if I should do this, because what if I'm wrong? Because what you're feeling in the back of your mind is like, the consequences of being wrong are really high. And so doubt just feels way more crippling, way more dangerous. It takes on different context. But when we're in our 20s, like, yeah, YOLO, like,
Yeah, the
right?
stakes are low. The
The stakes are
consequences
lower. The stakes
are low. Yes,
you
and
have time to recover from this. So let me finish this one
Please,
point,
go
and
ahead.
then I'll hand it to you here. So it's important to understand the context here of what it is that is paralyzing you. When you're in a pause, you are thinking of when you're in a pause, you're thinking about the steps that you're going to take to get to a decision. And when you're pausing, you are plotting moving forward. You're moving with steps towards a decision. When you are in paralysis, you're like, I don't know if I should make a decision. Decision is that you are worried when you're in paralysis, you're worried about outcomes. When you're in a pause, you're focused on process. That's why they're so different.
Mm.
All right, Asit, go ahead.
I was going to say maybe there's a correlation between the overconfidence factor when you're young and the fact that the consequences are far out and the stakes are lower. As you get older, it does feel like every decision is more consequential, and hence there's less room for overconfidence. In fact, it can be the other way. You feel a little underconfident because the decisions feel bigger. It's going to matter. The outcomes are more consequential. The timeframes are smaller. And I think this is sort of magical if, as we get older, we could just, lean back a little bit into our younger selves and have less of an emotional load and remember what that was like. And I think for younger people too, who are in their 20s, just to visualize, what if you were like in your 30s or your 40s? Boy, when I was 20, we had some friends, Tim, they were 35 years old and they were so ancient. My gosh, that seems so old. Like, they're 35. Should we even be going out, with these guys? Yeah, but it's funny how some age plays with your mind and your perception of time. But I think for younger people, again, just to think, okay, if I could have a little bit less of that super confidence and think in terms of good decisions here, listening to doubt and trying to analyze it, maybe that means I'm going to build a little more steadily in an investing career. So you don't want to be so much on the spectrum of risk and overconfidence that you learn lesson upon lesson upon lesson, which was my case in my 20s. And I know we've got all age groups here in our members. I think we do. Many of us, I think, tend to be closer to you and me in age. But doubt is something itself that's on a spectrum as you age. There's no way around that. What we do is we learn to incorporate it into our experience and treat it as a friend. I think at the end of the day, if you can move past those second two types of doubt that we talked about, so this sort of self-doubt, which is past baggage, and the doubt that comes from external sources, which can be very loud, if you can deal with those and sort of live within the evidentiary doubt, it is something that becomes one of those tools in the kit that gives us some superpowers. And we have some superpowers as we get older, Tim, that younger folks don't. I'm not going to disclose them here because I'd be giving it all away.
We have some earned wisdom. Let's put it that
maybe
way.
That's it. That's what I'm obliquely referring to, I guess.
Earned wisdom is often with pain. So just recognize. I think it's super important when you are investing. It's important to recognize when you're paralyzed and when you're just pausing to make a better decision. If you aren't focused on the process, if you're focused on the outcome and not the process, you're not pausing, you're paralyzed. And that can be a dangerous place to be, because then you are thinking of doubt. And this is number 4. You're thinking about doubt in terms of binary conclusions. If I'm wrong, X. If I'm right, Y. you're dealing in the binary here. We probably want to avoid that because you are thinking in terms of paralysis or rejection or things of that nature. And that's usually not good. When you're investing and putting capital to work, if you are getting lost in binary ideas, short-termism, it can mess with you because then you are under a huge amount of stress constantly. Doubt can be a real source of stress if you're treating it that way. Like if doubt is binary, if it is serious, then what you end up with, I mean, you can see how this unwinds real fast, Asit.
Yeah.
If you treat doubt as not something that's giving you some information, but is something that like you start stressing out about, it's like, uh-oh, there's, a binary event upcoming, then you start worrying about being wrong. And then doubt makes you feel like I always have to be right. And you will never always be right, which means you will always be paralyzed, which means you will not make decisions, which means you will not put capital to work that can benefit you over a long period of time. So you just don't want to get trapped in that doom loop. So you want to unleash a process instead. So let's talk about just briefly what that is, and then we're going to get to some sleep numbers and some other questions, put them out there. A process means if you start feeling some doubt, well, then what do? I mean, honestly, it is that simple. When you start feeling doubt, and you're thinking about investing decisions, like you build yourself a checklist, put it in your investing journal if you need to, but like, so here's a simple one, Asit, like your checklist. If you're feeling some doubt and you're wondering whether or not you've prepared properly, then your checklist could be, have I checked the financials? If your answer is yes, move on to the next one. Do I believe management when they talk to me? Like, have I just gone and listened to like the last earnings call, or did, I listened to a Motley Fool deep dive and they talked about this and I feel okay about it? If yes, move on to the next one. Is this a stock that I feel like I could hold for like 10 years? Because I'm eager to try and hold this one for a really long time. If the answer is yes, keep moving. There's a bunch of simple questions you could put into a checklist for no other purpose of just allowing you to double check whether or not you have prepared according to what you need as an investor. Not what I need, not what Asit needs, what you need as an investor. It really can be that simple. Doubt can be crippling. It can cause a lot of, it can really be dangerous if you get lost in the realm of binary outcomes. Boy, if I'm wrong, I'm screwed. This sort of thing, it just really can mess with you. But if you feel some doubt, you treat it as if it's some information. It's a question about whether or not you are fully prepared. Then you can go to the process to say, all right, I'm not sure I'm fully prepared. Let's see if I'm fully prepared. You run through the process quickly. You either are or you aren't. And if you aren't, well, then a pause is quite useful. And if you are, well, let's move on. All right, Asit, thoughts on that? Then we'll get to some sleep numbers.
Sure. And I want to add in something for maybe newer investors, but maybe some seasoned investors as well. Sometimes if you suffer from just regular doubt after you've purchased stocks, it can help to be the person who writes down what he or she was thinking when they were thinking when they bought the stock. So documenting your reasons for buying that stock, what you like about the business, in essence, putting your thesis onto paper can be helpful, because then you can just use that to sift your doubt through. So as you get new information, again, we're talking about evidentiary doubt here. you can decide, is this even actually relevant to my thesis? This piece of information seems scary, but it's not going to affect the business in a big way, maybe a little bit around the margins, or maybe it does. And for some of this might simply mean like printing out a rec if you want, and highlighting the parts that really appeal to you, why you think the thesis is strong. So you take one of Tim's recommendations, highlight it, maybe write a few points in the margins. If you're not a paper person, you can do this with a PDF of the document. Just make a PDF, annotate it, and save it. And you can return to that as you get information you start to doubt, to remember why in the first place you went with this business, what you liked about it, how this might impact that. So I think that can be a powerful method for us who serially suffer from doubts after we purchase businesses. All right, and with that, we can hit some sleep numbers and questions.
Yeah. I just want to quickly say I posted into Slido, and it should come up here any second, for Vando, best place to go verify lockup period dates for IPOs. I don't have a best place. I gave you one that I found. There's usually a bunch of them. So I don't think there's any special sauce there, Vando. But yeah, if that helps you, great. I hope that's good. We're going to focus on mindset questions. I see some that are non-mindset, and maybe we'll get to that before the end of the show if we have something to add. But I'll just mention this one from Rebel and kick it to you for some sleep numbers. Confidence anticipates the probability to adjust, not necessarily failure, but realities. Life, finances are never static. So, in other words, the way I read that from Rebel, the more you feel like you know what you're dealing with, your ability to understand the probable outcomes and what you need to do, and your ability to engineer an outcome that is more favorable other than less favorable, the more confident you're going to be, the more prepared you are. And I think this is right. It's not about failure, but like nothing is really static. I can be, whatever I'm trying to do, the more I feel like, okay, I could live with X outcome, and I've done enough work to get myself to, Y place, and I can be relatively confident about that. Confidence is not, assurance of success. Confidence has more to do with like, am I ready to do the thing? Have I done enough? Am I ready? Like, I don't want to get too sports ballish here, Asit, but it is kind of like what pro athletes, men and women pro athletes, what they talk about isn't, I know I'm going out there to win. It's like, I know that I've done enough. I know that I can win. I believe in myself. I know that I can do this. I'm going out there. I trained the way I needed to do. I'm ready. Like I'm ready. That's the confidence. It is not the, I'm going to stomp the competition here. It's no, I'm ready for this. There's a big difference between those two. So I think Rebel is pointing that out.
Yeah, I like that. It's a sort of muscle memory. Confidence or long-term confidence is about just developing this habit of being able to adjust, being prepared, and being able to adjust to realities. Okay, so let's move on. For the bees, our friend Karen says 7 hours of sleep. Blue sky, windy NC mountains. Yes, we had lots of stormy weather yesterday. It sounds like it's even prettier in the mountains today, but it's clear here in the Piedmont. Back from physical therapy. So grateful for Motley Fool Mindset and the discussion of doubt. Lovely Lily says,
glad you're here, Karen.
Yeah, same. Lovely Lily says, Asit, when you said pause, I just wanted to share what I just said as my motto yesterday. Pause, see, and return. I'm applying this to some doubt and difficulties. I really like that, lovely Lily.
too.
So pause, take that break, see, you figure out what you're looking at, and then return, maybe to take action or not take action. I can see applying that to a lot of things, investing and otherwise. And Rebel says 6 hours back to normality. That's great. I know Rebels, your sleep numbers like mine and Tim's have been all over the map for the last week. So good to hear you're back to normal. Our friend Mike D has gotten 8 hours of solid sleep. That's great to hear, Mike. Great that you're back with us this morning.
Yeah.
Hey,
you're well,
you're recovering and dealing with some stuff, and I appreciate this. I know that Tim does too. I could have slept more, but I didn't want to miss Motley Mindset. We really appreciate that, and we won't be we won't mind if you do sleep in some weeks to get that rest that you need. But we're thinking about you in our prayers, and glad you're here this morning.
Yeah.
Curly Q says, "Good morning, Mindsetters. My sleep number was very close to 8 hours last night."
Nice.
I think that's spectacular. Tim, what's your optimal sleep number, just out of curiosity?
I think it's reset to like 6. I wish it was 7.
Okay.
7, I think, is probably my best. So I'm hoping at some point I'll get back to 7.
I think somewhere between 7 and 8 is about optimal for me. After 8 hours, it's hard for me unless I've done some very physical work or exercise to be able to just sleep longer. And that, of course, is a chemical function as you age. But somewhere in that hour, between 7 and 8 hours, I usually feel pretty well rested and ready to go. And yeah, I'll send this back to you to read some more, Tim.
Yeah. Let's see some more in here. Zach's a fool. Top of the morning to you, gents. My sleep number was around 6.5 hours. Second night in a new place, and I'm still adjusting. Congratulations on the new place, Zach.
Yep.
Hopefully that serves you well. And lovely Lily saying good morning. Sleep number 8 to 9 hours. Man, that's really good. Slept hard for most of the hours. Off of work for over 3 weeks and started to go back to work a couple of days ago, and I'm tired. Yeah, I get that. That can be rough. Random Lake, cheers, fools. Let's call the sleep 8 hours. And Rose saying 8 hours enjoying my morning cup of green matcha in a room with 180-degree view of greenery. That sounds really nice.
Don't make us jealous on a Monday morning, Rose.
Yeah, seriously, that's great.
Actually, I'm blessed. I've got some greenery. It's brownery right now because it's early spring. It's brownery with some green shoots. But do you drink matcha ever, Tim? Are you a matcha drinker?
I do not. I mean,
Yeah.
I've got my morning hot chocolate on days that I do not have my caffeine. Today is one of those days. Otherwise, I'm a coffee guy. I want to address this one from. We'll get to Fulio has a couple in a second, but this one's from MH, which does have a bit more mindset oriented question in it. From MH, what effect will tariffs really have on auto prices? I have gotten stuck more in paralysis because of tariff questions. I do understand that. This gets to the loop we were talking about, Asit, which is I'm not going to make a political statement around this, but what I will say is tariffs have introduced uncertainty. I don't think that's unfair to say. Tariffs have introduced a high degree of uncertainty on the U.S. economy, and you have new surveys, like economic surveys. It's like consumer confidence has just fallen through the floor. And what consumer confidence means is like that's a measure of doubt. It is what we're talking about. And when consumers are doubtful, it tends to be bad for the economy because you're like, I don't know if I should spend money. I don't know. This is a good thing. I'm nervous right now. I don't know that I should be making actions that invest in the U.S. economy because things could get a lot worse. And so you end up in this doom spiral of of paralysis. So MH's question is super interesting to me in that sense. It's an example of how the doubt doom loop can manifest. Tariffs are giving me a lot of heartburn here. There's a lot of uncertainty. What's really going to happen here? I don't know what's going to happen here. And I think, we don't know, MH, exactly what it will be. We know that it can possibly make parts of the auto building supply chain a lot more expensive. And so auto prices might spike, and that may have some downstream effects. And so that may lead you to have some doubts about whether or not you want to be investing in portions of the American market that have to do with automakers. You may not want to invest in automakers specifically. You may not want to be investing in supply chain, participants in the auto market. I don't know. I'm not giving you any advice on this in particular, but this is a question about doubt. So, MH, what is your process then of dealing with doubt? If you want to be invested in this sector of the economy, how would you resolve the doubt you have here? What would you do? I mean, your checklist might include, just by way of example, going to the earnings transcripts or calls of different automakers who've reported, and what do they say about supply chains? What do they say about tariffs? What do they say about prices? They may not be if they're not giving you any information that alleviates your doubt, you could say, I'm good with a pause here until I get further information. I mean, there's lots of different ways to deal with that. But it's a great question because it speaks to exactly the topic of this is how doubt sort of creeps in. Yeah, go ahead,
Tim.
Asit.
Yeah, Tim, I wonder if MH is asking about actually buying a vehicle.
And that is possible as well. Yeah.
It's funny because Tim and I are on different podcasts. So this was Motley Fool Money. Just a couple of weeks ago, we were talking about tariffs, and I was talking about the difficulty when you get to big picture ticket items, big ticket items. The big picture is big ticket items. Thinking of appliances or vehicles, then it becomes really hard if you're a consumer. So we can sort of deal with uncertainty. We know that household goods items will go up. Our grocery bills may go up because of tariffs, but those big purchases really create a lot of paralysis. Do I wait and see if tariffs will take effect and potentially risk having to buy the vehicle then? Do I buy it now before they go into effect, if they're going to go into effect? Because I'm not sure about that either. Even though I don't have as much at this point in time for the down payment as I wanted to, and that might cause me to have to take on a more of a loan and have a higher monthly payment. There's so many factors that go into that, but it ties into what Tim was saying. We've seen this happen in the Chinese economy over the past few years. They had some macro issues related to how the government built up that economy and is slowly trying to change how the Chinese economy functions, which has really like crimped consumer confidence there. So they have almost looks like a quasi deflationary cycle that could go into effect because people are scared to spend. So tariffs can have that effect too. So whether you're a buyer or someone who's investing in companies that could be affected, that signal is actually, it's positive. It's information. And yeah, it might lead to some paralysis, but at least you're taking that information and trying to make a decision on that. But we totally get it. I mean, paralysis is one thing. When Tim and I were prepping for this hour last week, we talked about this is just one of the outcomes that often goes hand in hand with doubt. You get into a doom loop or paralysis. But we're here in this hour to try to offer some alternative ways to look at it so that you don't get stuck. But that's a hard question. Go ahead, Tim.
Foolish investor has a healthy way to look at it. That this is what we were saying. Doubt is your friend. Doubt is your friend. It is not the enemy. It is not if you can get out of the binary thinking, doubt is your friend. It's an opportunity to see whether or not you are well enough prepared before you take an action. So foolish investor puts it this way: I've gone against my gut and bought to later realize my doubt was right. Verbalizing doubt helps. Too niche, don't like management, no long-term moat, etc. I think verbalizing is great, foolish investor. I would also say doubt, if you think of doubt only as questioning like, are you fully prepared? If you are, great, let's go. If not, let's pause and work the process. That's it. That's all it is. And I think that's what foolish investors pointing out here. But it is important. Fulio saying something that I think is, I'm flattered by this, Fulio. I'm working on building a solution to a migraine level problem and forming a business. Congratulations, Fulio. I want Tim to know his voice mantra helps drive my thinking about this. I'm glad, but don't give me credit I don't deserve. You're the one that's building the business. So congratulations. Dig in, enjoy it. Building a business is super hard. So give yourself as much grace as you as on a perpetual basis if you can, because it is really difficult. Asit, anything you want to add there?
Such an adventure, though, too.
Of course.
In this day and age, it's easier to start a business than it ever has been, just because there's so many tools available at a low cost. So tons of businesses that might have been difficult to start years ago are suddenly much easier. But that doesn't reduce the difficulty of being a business owner and creating a business from scratch. So yeah, it's difficult. We're rooting for you, and also just, excited that you're on to an adventure. That's the fun part of starting a business. Maybe, and hopefully you'll succeed. You'll be your own boss and get a lot of fulfillment out of the path you've chosen. So go for it. Keep us posted as you're going along.
Yeah, absolutely. I mean, starting a business is easy. Growing a business is incredibly difficult. So it's really hard. So yeah, enjoy the ride. Enjoy the process. Keep the questions coming in here. I'm going to address Bestie's question from a mindset perspective here, because it's the mindset hour. Should we expect slowing growth in sports radar on the Wednesday report? I don't know, because I don't follow that one. But I would, if I could, because this is the mindset hour and I want to reinforce something that really matters. What are you looking for in that Wednesday report that either confirms or contradicts a long-term thesis for that business? Because it may be that when you see that Wednesday report, the doubt will creep in. I'll tell you what happens all the time. When you want to know the most common instance when doubt creeps in on as an investor, all the time. Stop me if you've heard this one, because we've all dealt with it. We hold a company, we really believe in it, and then it reports earnings, and what happens, Asit? It's down 5%, 10%, 15%. And you're like, what happened? What's going on here? And what is the first thing that comes into your mind? Doubt. It's the first thing that comes into your mind. So in those instances, instead of getting on red alert about 15% down, 10% down, 5% down, then it's back to the process. Work the process again. You can, if this sounds like, hey, you know what? Just go back to just go back to the weights and go down to low weight and just do your curls. You warm down a little bit, then you build up again. You're fine. Just work the process, work the muscles. And that is really what we're talking about here. Those moments become emotional and doubt creeps in. So then you go back to your checklist to see, did what I think was true, is it still true? I have some doubt here. So let's go back to my process and my checklist and see whether or not, something has changed here that makes me want to pause and decide whether or not I actually am prepared because the information's changed. That's possible, but you want to deal in facts, not hyperbole. And the danger with your question, besties, it's not a lot of danger. It's just something that you want to make sure you're asking it in the right context. Is if the growth slows over the next quarter, is that something that corrupts your long-term thesis? Does it matter? If it does matter, why does it matter? Like that question in isolation, Asit, can be dangerous because it can lead to doubt that maybe is not so healthy.
Yeah,
It is.
Tim.
Yeah, go ahead.
No, I was going to add that I like the specificity of the question. It means from somewhere, whether besties arrived at this doubt and question by themselves, or maybe read somewhere and an analyst thinks that the growth may slow, or maybe someone here at the Motley Fool said, I think we're going to see some slowing growth this quarter. That's a perfectly good way to look at this whole hour we've spent together. So there's a piece of information.
Yep.
And you've got something that's pulling doubt up, but it's evidentiary. You'll have data when Sportradar reports, and I don't really follow it either. And you'll be able to deal with that doubt. Either it's, as Tim said, something near term, or perhaps it's more systemic. How does that affect the reason that you purchased a share of this business or shares of this business? How does that affect the thesis if you hold one? How does this affect what you're going to do going forward? I love Tim's idea that just let's go through the checklist. Let's just make this a rational exercise. And it is, just to return to the thought before that, it is certainly something that's emotional for all of us. I don't think you ever outgrow it. For me, the best antidote, and I'm referring to that feeling when you look at a company, let's say it's after hours and you're waiting on it for it to report, and you see the stock is down, whatever it is, 5, 10, 15%, as Tim said. There's a sort of visceral feeling that you never quite get over. And part of it is that just like past baggage, times you've been wrong because they sear themselves onto the brain. Part of it is like, I don't want to deal with this. But the antidote for me has been having many positions in many companies so that it's not a concentrated consequence for me where I've got all my eggs in just a few businesses. And the other is just the fun of it. After a while, there is a part of you that will embrace this from an intellectual level, from a learning perspective, from a desire to get better. And it won't, it's always there, I think, Tim, but it becomes less of a urgent act now type of stimulus and more of a, okay, the data's coming. I see that. I see the red. I'll take my time and read up on this week and see what actually happened and what it means for what I have as a thesis over here.
Yeah. We're about done here. I think there might be some tech stuff upcoming with possibly Seth and Danny. So we will hand you off to some more harder information, good stuff in the next hour. Enough of this, fuzzy, warm and fuzzy stuff. But I do want to, wish, Karen here, who says, happy St. Patrick's Day. Last mindset for a while. We'll miss taking a pause with the Motley Fool after 5 solid years of education. Will find my voice in peace, cash, grace, and chaos, and changes. And little turtle emoji here. So I'm going to take that for slow and steady wins the race, which is my fave. That's my Motley. So glad you've been here, Karen.
Same.
It's you have an important story And I know it's been hard for you, but I'm glad, I'm thankful that you're here, that you've been around. You do what you need to do. You do what you need to do. We'll be here. Thank you for participating and being around for as long as you have. But we've got 1 minute to go here. Asit, final thoughts before we start closing up shop here.
Yeah, I also want to say that I wish For the Bees well. For the Bees, Karen has been with us since we first started Mindset. Tim, I remember many reports from the garden back when we started. And good luck for the next adventures. Thank you so much for your contributions. And everyone, let's embrace that doubt, the good kind, and leave the kind that's not as constructive behind. And I hope everyone has a great week. We reached the 12 o'clock hour, and we will see you next week.
Yeah, absolutely. All right, fools. Remember, we love you, and we'll see you soon. Fool on, everyone. Danny, Seth, take it away.
Hey.
See you guys.
I was reading stuff when we got put in here. I hope I didn't look too goofy. Always checking on the news. Welcome, everybody. Boy, the pollen must be out. It's getting back to me quickly. Danny, how you doing?
I am doing well. Seth, how are you?
I'm all right. You've the Hawaiian shirt, but you're not in Hawaii, right?
I am not in Hawaii. I am in San Diego.
Too early. Well, that's almost Hawaii. That's about as close as you can get. Yeah. San Diego, where it's summer all year round. So welcome, everyone. Our usual theme, my usual theme at this time is chips, tech, and clouds and more, tending to answer those kinds of questions. But, we're always looking for whatever questions you have. Danny and I were batting around the possibility of discussing a little bit that rumor last week that Taiwan Semiconductor, perhaps in conjunction with, who was it, Qualcomm or Broadcom, I forget who, that they were talking about putting together or there was rumor they were talking about putting together a consortium to take fabs off of Intel's hands and try to run them. So if anybody's interested in talking about that, we may look at that a little bit. Danny and I had some back and forth about that. And one of the cautions I have on any of these kinds of reports is that this business is really super complex. I don't know that any outsider can understand just how hard it is to make chips. And so when I saw that headline, kind of one of the first things I thought was, like, Intel and Taiwan Semiconductor, they have like different processes for doing very similar things. So like, how would that work out if you were taking fabs like off Intel's hands? They use some of the same machinery. Obviously, everybody who's doing this kind of work, especially at the bleeding edge, is using machinery from ASML. Those are the kinds of questions that remain unanswered when these kind of rumors fly around.
Yeah, I went back and looked at that report, just as we started heading into the show, and essentially, the rumor has it that Taiwan Semiconductor Manufacturing had spoken to or had talks with NVIDIA, ticker NVDA, Advanced Micro Devices, AMD, and Broadcom, AVGO, about taking stakes in a joint venture, and they would operate Intel's foundries. Basically, the proposal was one that came about because President Donald Trump administration had talked to Taiwan Semiconductor, TSM, about assisting Intel to turn around its troubled chip making issues. And what basically the proposal was is that they would take a minority stake of less than 50%, and potentially have NVIDIA, AMD, and Broadcom, taking other stakes, so that they could potentially run Intel's foundries and keep it here in the United States. The administration didn't want TSMC, who is a foreign-owned company, to hold a majority stake in it. And so this was this was the solution they came up with. So I don't know much more about it than what the news reports say, but as Seth mentioned, this would be kind of a complicated undertaking, not only from a technological standpoint. But also when you start talking, 4 or 5 different companies in the tech sector, all with, different ideas of how things should be run, and different objectives, things can get dicey fast.
Yeah, and it's a lot of it just looks really wacky. Like, okay, so TMC, who really all they do is work with OEMs to make the chips the OEMs want, right? Or not the OEMs, but kind of the non-fab chip designers want. So AMD, Nvidia, and so forth. So here you would have, like, according to this, you would have Taiwan Semi taking over fabrication plants run by Intel, which are presumably at this point, if when producing anything, producing Intel architecture chips. And this would be run by a joint venture that includes NVIDIA and AMD and Broadcom, who all do very different things with their chip designs, right? I mean, NVIDIA even is spitting out CPUs these days. AMD is competing with NVIDIA's GPUs with its own GPUs. So this is the kind of thing that, yeah, you really wonder what in the heck could possibly be the advantage here, except for Taiwan Semiconductor, except for maybe getting a government off its back. And you wonder, like, I wonder, is this even a serious proposal, or is there just enough stuff in here to sort of make it look like you're making an attempt, so that you don't find yourself in the crosshairs of an angry presidential administration? I feel like it's probably the latter. I think everybody right now is scrambling for cover and trying to do various forms of what's the word I'm looking for here? Courtiering, so that they can get the best possible treatment from the current administration. And what they probably think that would just be being left alone and not attracting any attention to themselves. So this is one of those things that I just don't think is likely at all. I don't know how you'd get AMD and NVIDIA to agree on anything, let alone throwing in 3 or 4 other companies to run the outfit.
Yeah, I like you said, it's one of those things where, you see the rumor come up, and Intel was up on the news, and Taiwan Semiconductor and NVIDIA and Broadcom and AMD all bounced a little on the news. And you wonder, but, long-term ramifications, I don't really know that this is feasible in the long run. I don't know if it will ever come about, but certainly, even if it did, it would be so complicated as to, take a really long time to get off the ground. And in the meantime, I don't know. It's an interesting story. Let's put it that way.
Yeah. Yeah. So that one was one we wanted to talk about. I guess we could look at a few questions here. Thoughts on Transmedics and Archer Aviation. Ryan asks, I don't follow Transmedics. Archer Aviation is a company I've looked at several times. I won't have anything fun or happy to share about Archer Aviation. I think that every single one of these VTOL companies is a snake oil primarily. And when you look at Archer, they say, oh, we got these electric VTOLs, and they'll carry 4 people, and there'll be a pilot, and they'll replace 60 to 90 minute car trips with 20 to 30 minute, air taxi rides. I just don't believe that. I don't believe there's that big a market for that, even in crowded areas. I believe the prices would be prohibitive, except for, really, really wealthy people. I just don't think there's a market. And I also think that the regulatory difficulties would be really tough to get past. I mean, we just had a horrible accident where a helicopter, military helicopter, flew right in front of a passenger plane right over the Potomac, and everyone on that plane and in that helicopter ended up dead. And that is a kind of problem that happens in crowded airspace. We have problems having enough air traffic controllers to keep things safe already. So throwing in dozens of more essentially helicopter flights, let's just call them, to try to replace, short hop driving, or in the case of, a lot of the areas where this would presumably be attractive, there's probably already public transit. So the lower end of the market, like me, your poors like me, are going to just get on the train, or they're going to take a car, take an Uber. And then what are the numbers on the other side? I just don't believe any of these stories. And Archer is one of the ones I just don't think this is ever going to happen. In the meantime, it's a company with no revenue and burning lots of cash trying to get things done.
So we had a question in the queue, actually from a few days ago, asking whether or not there were any thoughts on DocuSign earnings, ticker DOCU. I took a quick look at DocuSign's results. They reported, I'm actually going to cover that later on today on the earnings show, but they reported after the market close on Thursday. And generally speaking, the results were actually better than Wall Street was expecting. They grew their revenue by about 9% year over year to $776 million. Expectations were $762 million. Billings grew by 11%. Generally, it's good when billings are growing faster than revenue. That means they're adding more. Their bookings are growing. Looks like I'm looking down here. So adjusted earnings per share was 86 cents, which was about in line with expectation. They continue to generate, solid free cash flow. Their subscription business is growing. This is all actually was a little bit better than what Wall Street was expecting. And I think one of the things that we've seen repeatedly over the past couple of months is that if a company does not exceed Wall Street's expectations, the stock tends to get bid down. Whether right or wrong, that is, what's happening, particularly if it's a company with a high, a company with a high valuation. DocuSign has been beaten down, ever since the pandemic. They haven't come anywhere near those highs. This is a company that I actually owned before the pandemic. And I too believed that, once folks saw how easy it was to consummate agreements and to, track your contracts and your agreements on DocuSign's cloud, that, the bump that I had seen during the pandemic would continue. That turned out not to be the case. It turned out that habit was much stronger than ease of use in this case. I think DocuSign still has a bright future. I haven't sold any of my shares, but there's just a lot more work that needs to be done.
Yeah, I was never in the DocuSign shareholder pool. I mean, that growth curve sure fell off after the pandemic down, to a much lighter slope. But they generally produce good free cash flow here the last few years, unless you look at what they're spending on stock buybacks, which I always do. I've got the spreadsheet sitting in front of me that I'm always staring at when I do these. And one of the free cash flow figures that pops up in bar form is there's just regular free cash flow, which would basically be operating cash flow minus CapEx. And then there's one that also gets rid of any money they spent on share buybacks that year. And so just in the trailing 12 months, which actually happens to be the fiscal year, at least according to what I'm seeing on my chart here, through January 2025, the free cash flow produced, I see here on my chart, was $920 million. Does that ring a bell? Does that sound about right, Danny? Anyhow, but the amount of money spent on share repurchases was $896 million. In other words, almost all of that free cash flow went into buying back shares. There's just a tiny little stub of free cash flow left. Now you can say, okay, that's fine, but that's good for shareholders. So I'm still going to count that as free cash flow. You might choose to do that, but in the case of DocuSign, like the share count is still clipping upwards at a pretty decent compound annual growth rate of like, what do I have here? Like 4%-ish or something. Share count, that's 3.5% over the past 5 years and 2.3% over the past couple of years. So share count just going up. So they're not even really soaking up dilution at this point. The question there is, is that free cash flow really your free cash flow? It depends on how you want to look at your company. For some growth companies, maybe you don't care about this. Some of that depends on, what the top line growth looks like. I just always like to have that particular very conservative measure in front of me when I'm judging these companies as to whether or not I'd be interested in them. And in addition to the habits that Danny talked about, one of the things I noticed that even towards the end of the pandemic is, I don't really have a dog in this fight, as they say, but I started to get, when I was, refining a mortgage or something, I started to get, or, putting a bid on a place. Like I was getting e-sign documents that were not coming from DocuSign, that there was competition out there. I don't know how well that competition has held up over the past couple of years, because I haven't been doing stuff like that over the past couple of years. But I remember at the time thinking that this can't be good for DocuSign. And I know Adobe and others have similar capabilities. So yeah, DocuSign is one of those ones that was super popular during the pandemic, and there are other stocks. I still own some of them, and if you look back at them now, they have what I like to call the middle finger chart, which is that they did one of these and then they were up like that in the middle of the pandemic, and then they've kind of done this ever since. Imagine the spike in the middle of that hand, and that's the middle finger chart. And we all own some of those probably. If you look from 2020, or if you look from 2018 to 2025, we probably all own far too many stocks that gave us the middle finger chart. And most of us didn't get out at the tip of the finger, did we?
No, I mean, DocuSign, Teladoc is another one that I wrongfully believed that, the spike would continue. And then, because, I personally, unless I have to, I would rather stay home and spend, 10 minutes on the phone on a video app with the doctor, rather than having to leave the house, navigate traffic, go to the office, hang around sick people, come back home, and I've wasted a couple hours of my day. But it's one of those things where people like the personal touch, and I think we saw that with a lot of companies coming out of the pandemic.
Yeah. And then there's just so many things with like common problems that you cannot do with a video call. My kid got flu A. Her symptoms weren't terrible, but I recognized them as about 2 weeks ago as really sounding like the flu. We had like sore throat, muscle aches. It was just, I said to the wife, I was like, she's got the flu, I'm bringing her in. Well, I took her into a CVS Minute Clinic. They swabbed her. They tested her for strep throat, COVID, and flu A and B. And in 5 minutes, we had our answer,
Nice.
And it was great. And we knew what was going on. They could prescribe antivirals, and they thought the timeline was okay. Something that just could not have happened, over a phone. And then, similarly, a follow-up, a week or so later to check and maybe is there a sinus infection going on here that's, subsequent to this, they can't look up your nose with that pointy scope thing with the flashlight on it when you're on the phone. And so as useful as some of those online services were, I never really thought that the visits to the doctor would go away completely. But then, there's a lot of other ones. Like I was just looking at Roku. A lot of us own Roku. A lot of us owned it before the pandemic, and then we watched it go way up. And Roku actually gives you the double middle finger chart and then comes back to where it is. And how many of us were smart enough to look at that, even if you knew that valuation just looked crazy? And I thought it looked crazy, but how many of us were brave enough to say, you know what, I'm going to step off the elevator here, even, on the way up or on the way down? Most of us didn't do that. And so, we started here, went up here, and now we're over here again. Or, it is really hard to sell a stock, especially when the company and the product seems to keep doing well. But there's a point at which valuation matters, and if we can reflect on our COVID market returns or lack thereof, maybe we'll do better on some of those sell decisions.
So I have a non-tech related question here from Matt from a few minutes ago. Danny, as a Hawaiian shirt enthusiast, do you like Tommy Bahama's brand of island theme attire? I do like, I do have a couple of Tommy Bahama shirts that were gifted to me by family members. Also a big fan of Hilo Hatties. Those of you who have ever been to Hawaii know that Hilo Hatties is the biggest and most popular brand in Hawaii. So I have plenty of those as well. But moving along from
there's a good question here from Ed about a firm down 10% because they lost the Walmart account to upcoming IPO company Klarna. This is the buy now pay later type stuff. Back in, Danny and I are old enough to remember when you had to go to the counter of shame to buy on layaway, right? And now you could do all this stuff just by poking buttons. This is essentially small consumer loans that are paid back in different ways. And it says, it seems like the fintechs are a dime a dozen, losing proposition. That from Ed. I kind of agree with Ed. I know I have colleagues who like fintech, and I find it a spot that I don't have any expertise or any informational or what's the word I'm looking for? Analytical edge for the most part. I could maybe recognize that a company like what's our friends down in Argentina? Why am I losing it? The biggest
Mercado Libre.
That Mercado Libre with its huge lead might be a better type of fintech because it's ubiquitous, right? However, I do agree that kind of like the buy now pay laters all seem to be a dime a dozen, and it's just not a place where I would try to make money. Personally, as an investor, I always tell people, like, I can lose plenty of money investing in good companies that have great margins and what looks like a pretty defensible, competitive advantage. So I don't need to lose my money in companies that are kind of a dime a dozen and that maybe have opaque financials that require me to sit around and read, like, are they taking in debt and are they reselling it to others? Do I need to sit around and examine how well their debt is aging and so forth? That's just beyond the work I want to do. And so I would say to Ed and others who are looking at a firm, I'm surprised the firm's only down 10%. I saw that headline this morning. You don't have to play in those spaces, right? It's up to you.
I tend to agree with most of what you said. I still own a position in PayPal that I've had for a long time ago, from when they split off with eBay. And it's one that I've hung on to partially for sentimental reasons, partially because I think there's potentially a world where PayPal could do well. They're branching out into, these white label financial services. And I think they could, continue to be PayPal that we know for, making your payments to online places where, you don't necessarily know or trust the website that you're doing business with. And I like the ease with which I can go to a website, go to a charitable website, and just click on Pay with PayPal. It fills in all my information. I choose the card and I'm done in under 2 minutes. Whereas otherwise, I'm sitting there typing in the credit card information and my address and all the other things. But when I think about how I pay for things, the vast majority of the time, if I'm not sitting at my computer and I'm out somewhere, I pay with Apple Pay because it's just so easy. They bring the payment device to the table. I tap my iPhone on there and I'm done.
Yeah, and I'm
So
the same way with Google Pay, even like inside the websites, it pops up over on the side. Google Pay pops up, it's funny, I have my Garmin here, and whenever I use it, people go, "Oh, you have Apple Pay on your Garmin?" I'm like, "No, first of all, it's just NFC. It's just a near field communications chip. Like anybody can do this. Apple didn't do anything special. They kind of pushed it out, right? It's also in your credit card. You tap your card, tap to pay. Although it's funny, sometimes the card works and the watch doesn't, or the phone works and the card doesn't. But again, Apple and Google, like big giant ecosystems, right? Maybe some easy tie-ins to web browsers potentially to make this happen. PayPal, I'm similar to you. I think I've got it as a recommendation in a service from a while ago. But the problem is sort of everybody is encroached on that turf, right? And so Klarna and Affirm and the rest are a little bit more about not being able to afford things up front, and then just paying. So they're slightly different, but again, I feel like there's not a huge barrier to entry given the number of apps that have moved into this space. And then you also wonder, we had some pretty crummy consumer confidence numbers come out. And folks on the lower end of the socioeconomic scale are pulling back. We've seen CEOs talking about this, while at the same time, the people with more money who right now, I think it's the top 10% of earners in the United States, do half of the spending, the consumer spending in the US. And this is where you have to watch out, because the stock market can become the economy. We always like to say stock market and the economy are different things. Well, if to the extent that there is a wealth effect for people who are in the top 10% of earners that is based in any way on how they perceive their financial well-being as defined by their brokerage balances, you could easily see a pullback given like the problems we've had the last week or so with stock market indices coming down. And if they start to lose interest in buying things like cars at the same time that folks further down are pulling back on staples, and we all already saw, we had a profit or a revenue warning from airlines last week that people were foregoing travel. All of this stuff mixed together tells you that you might want to watch out with fintechs, especially if they are kind of operating on debt or on volume, because the volumes might go down and the debt may go bad or may get worse.
Yeah, I think the one thing that stands out to me from what you said is the fact that, the consumer economy can quickly become a self-fulfilling prophecy in that if people start to believe that the economy is going bad and they pull back on spending, that in turn will, send the economy southward, because, pulling back on spending, consumers are the bedrock on which the economy is built. And without consumer spending, recessions can come rather quickly.
Yeah. And at the same time, we have really huge uncertainty in terms of capital expenditure on the part of larger businesses. They have no idea what their costs are going to look like going forward because of all these whipsaw tariff threats and then pullbacks and threats and pullbacks. So, if Danny and I are running a company that, I don't know, supposedly we think we're going to onshore t-shirts or something like that, how would we make any capital allocation decisions, based on not knowing what our raw materials might cost, or whether, if we're selling some of our product into Canada or something, whether it's going to be, blacklisted at the border or anything else. These are real issues that cause trouble for companies. And when they don't have answers, they tend to sit on their hands, right? Like the best you could hope for is that you don't make a bad investment. So you sit and wait to see how things shake out. If all that happens at the same time, then spending is going to be less than those of us who hold stocks would like it to be.
Indeed.
Daydreaming says, I still have PayPal talk about a middle finger chart. Yeah, I haven't pulled that one up yet, but I'm guessing that's also a pretty big middle finger chart.
I'm pretty sure it is. I haven't looked at it myself, but yeah, there was more of a spike in PayPal during the pandemic.
And of course, some of that was that also I'm trying to think of, no, maybe I'm thinking of thinking of others. During the pandemic or shortly before, a lot of the fintechs were also getting involved with crypto and tokens and so forth. So there was another confounding variable in there, right? There was a whole lot of enthusiasm for this, what people thought might be the next wave of assets and payments and so forth. And some of that, of course, didn't happen. Yeah, there's PayPal's middle finger chart. Not as bad as Roku's.
So there's a question from Besties from a couple of minutes ago. Is New Holdings, ticker NU, moving into Mercado Libre's fintech space or vice versa? For anyone who has questions about the Latin American fintech space, I would highly recommend you go back and look at the interview that I did with Mercado Libre's former head of investor relations, who also happened to be News' former investor relations head, Federico Sandler. We actually had a conversation last week. I believe it was on Wednesday, on the 13th, whatever day the 13th was, Thursday. So go back and check out that interview. But the short version is that New Holdings is more of a digital bank, and their primary competition is the legacy brick and mortar banks in Latin America, which have woefully underserved their markets for years, according to Federico. Mercado Libre, on the other hand, they built their own payment method, which has been called the PayPal of Latin America. They built that out of necessity because when they first started their e-commerce business, there was a lot of distrust with the existing payment methods. And what Mercado Libre did was they developed Mercado Pago, in which someone could say, I want to buy this, and they would pay the money. And then Mercado Libre would hold the money in escrow until the product was delivered. And once they got confirmation that the consumer had received the product, then they would release the money to the seller. And that generated not only a lot of goodwill with consumers, but also a lot of trust in the burgeoning e-commerce space. So, that payment method has now expanded and is actually as ubiquitous in Latin America as, say Google Pay or Apple Pay is here in the United States, whereas New Holdings is more of a digital bank. So there is a little overlap there, but not that much. So they're not really moving too much into each other's territory.
Yeah. And just in terms of again, getting back to like payment options in Latin America, like I've been bitten by a couple of those that I was involved with down there, StoneCo and others. And so it kind of goes back to the comment we had originally, like fintechs tend to be a dime a dozen. New Holdings a little bit different, being like more of a bank to go to start with, whereas a lot of the fintechs start with moving the money back and forth and then hope to start the bank part. And Mercado Libre is doing that. But, Mercado Libre is sort of a different beast altogether because it has got so much scale and it's so well known that it can do things that others can't, and it can afford to make, some pretty big mistakes. I forget Buck Hartzell, who's our fintech guy. He always retells the story, and we laugh about how they wrote off like this just entire early chunk of loans that they did because they were just so bad at figuring out who would pay them back. But they can afford to do that because they've got so much of the rest of the business to fall back on. I see a question here about Apple and Meta and defense contracts. I'll just push that. I'm not aware that those two companies do any defense contracting of any kind. I've never heard of that.
Not that I'm aware.
I doubt that they would, either one of them would move that in that direction. Or try to remember that the artificial intelligence that Apple was originally working on and continues to work on, tends to be very consumer facing, like Siri and early natural language processing type program to try and figure out what you were saying and answer questions. Image processing AI built into some of the chips and the software on the iPhones themselves. Meta is doing a ton with large language models right now, and then open sourcing most of them, but almost all that AI is very LLM. The AI they are hyping right now is very large language model or multimodal model related. And that is, in terms of like making, for instance, images. And that's all for the most part consumer facing, as well as trying to supercharge the ad platform on the back end. In other words, if you can tell people who used to come to you with an ad that they paid somebody $100 or $500 to make and then put online, you can say, hey, you can just use our AI tools and make 20 different iterations of an ad instead, and it won't cost you much. You're going to get more business selling ads. And at the same time, of course, Meta is prioritizing AI slop in all of its platforms. People's feeds are just being taken over with AI generated images and videos and all sorts of weird stuff. And Mark Zuckerberg has said, like, hey, we're going to do more of this, because as long as people keep doing this, you keep selling ads based on it, that's fine with them. And so that's what the AI, the kind of AI that we think of right now, generative AI, is based on. And of course, behind the scenes at Meta, there's been a lot of machine learning for years to try and optimize algorithms to, put content in front of people that they're either interested in or that will monetize well for the platform. I've never heard of anything that either of these companies has made, having a defense use. And why would you, when you can, be one of the biggest advertising companies in the world, if you're in the case of Meta?
So I have a question from Sadaf from about half hour ago. How much exposure does Mercado Libre have to crypto? That's an interesting question. I know that late last year, Mercado Libre divulged that it had about $40 million worth of cryptocurrency in terms of Bitcoin and Ethereum, BTC and ETH. And I think that was primarily because the company was offering through Mercado Pago, its payment method, it allowed users in Brazil to buy, sell, and hold cryptocurrencies. And it held, that $40 million is really kind of a drop in the bucket to, Mercado Libre's overall value. And I believe, and I can't say this categorically, but the reason why they held those cryptocurrencies was to give access to their customers. Now, an interesting development more recently is that Mercado Libre announced late last year that they were starting their own so-called stable coin that was tagged to the price of the US dollar for customers in Brazil, and they called this stable coin the Meli dollar. And it could be traded by all of Mercado Pago's users in Brazil, via its Fintech app. And this was just another way to offer, crypto access to its customers. I don't think it gives them a lot of exposure in terms of suffering through the volatility that can happen with cryptocurrency, other than the small amount that they hold in Bitcoin and Ethereum. So I'm assuming that's what you mean by exposure. So that's how I'm choosing to answer that question.
Interesting here. There's a question from Vihan, which I think is leftover or restated from the last hour, about Cintas, which is, can you please help with valuation for Cintas? How do projections look for the next 3 to 5 years? I haven't looked at this company for a long time, and everything I'm going to be talking about right here has nothing to do with the latest news, which I guess is the proposed acquisition of yet another company. So Cintas, I'll just read you from their business description. Engages in the provision of corporate identity uniforms in related business services, primarily in the U.S., Canada, and Latin America. Uniform rental, facility services, fire, first aid, and other stuff. This is like an old school company, bringing laundered uniforms around and so forth. If you look at the, long-term financials, just kind of a long, gentle, continual upward revenue growth rate of in the neighborhood of like 7 to 9%. Gross margins that have kind of gone from like the 44% range up to 50%, almost 50% most recently. Consistent operating margins in the 20% range, and consistent free cash flow generation margins in like the 18% range. How much are they spending on buybacks? Quite a bit, but how's the share count look? Share count is, coming down. Share count actually coming down and not going up. So that you might want to say that free cash flow is working for you. Not the kind of company I'm usually that excited about, trading, especially as it was recently, at a 2% free cash flow yield. Now, if I've got my news right, they recently proposed buying. To do this as of January 6th, proposes to purchase UniFirst Corporation, unless there's another piece of news after that. And so, in other words, in order to figure out the valuation here, you'd have to grab all of that information, see what they typically look like, decide what the synergies were going to be, how much they were going to save by putting these two together, decide, is this really going to happen? And so it's actually a lot more work than one can kind of look at first blush. You have to sit down basically at this point, analyze two companies and decide what they would look like if they came together. But just kind of taking a quick peek at Cintas by itself, I would not have been a buyer over any point in the past, decade or so. But on the other hand, it went from $100 to $200 a share over that same time period. One of the reasons for that is pretty much multiple expansion. While the margins have gotten slightly better over that time period, basically the average price to earnings ratio paid back like in the in 2018 or so was like 24 times earnings, and more recently trading for like double that. So that again, sometimes those valuations fly for a real reason. You see high growth or really impressive margin growth, and what I see here is okay, but I don't know that I ever would have said I'm willing to pay like 45 times earning for a company that's doing an okay job but growing at like 7% a year top line growth. What do you think, Danny?
It's not a company that I ever followed. I know that I looked at it briefly when one of the services recommended it, and I thought to myself, this is a company that launders uniforms, and I tend to look more at more technology, and so it was. I just decided it was out of my wheelhouse. Yeah, then and for a company to have a valuation that high and that is basically laundering uniforms for a living, I don't see the potential growth that would support something of that valuation. I just don't. Don't get me wrong. I mean, there are some companies that I don't have that have egregious valuations. And they've been bid up that way because, there's the potential for explosive growth in the future. But I don't get it.
Yeah. And if you believe that robots are going to be walking around factories doing things, this would also not be your thing. For the record, I don't believe the robot thing at all. I think that's entirely nonsense, especially the walking around part. It always, as an aside, it's always funny when people are like, "Oh, we'll have these humanoid robots, then they can do stuff for you in a factory." And my first thought is, if you have a factory that could benefit from a humanoid robot that can carry 40 pounds, walking around back and forth. I will show you a badly designed factory. Like my second response is like, even in the places where you could imagine this, like wheeled robots would be better. There's a home, if anyone out there shops at Menards, it's like Home Depot, but a lot better in the Midwest. The Menards where I go in summertime when I'm looking for stuff to fix my ruined old cabin, there's like a robot vacuum and floor cleaner that rolls around. It's got wheels. Why does it have wheels? Well, because the floor of this whole thing is like one level and it's smooth concrete, kind of like most factories. So you know how you make a robot that can do a lot of work and you don't have to sit around and teach it to like balance and not fall over and worry about that? You put wheels on it and you have it do stuff. And so, a lot of this stuff kind of exists already, but it's not in a form that looks cool to people. And it's really hard to kind of raise funds or get attention if you tell people we've got this super cool robot that can vacuum floors, but it goes around on wheels.
So
we have a question
you
here.
Don't see us headed towards the Jetsons?
Yeah, I just don't see that happening. Every time I see one of these, I saw Microsoft had one the other day, and it was supposedly a breakthrough. It was, you could speak to this Microsoft robot and it would process using LLMs the instruction and follow the instruction. It was literally an arm, and it reached down and it grabbed a plastic fake mushroom and put it like in another bowl, which is something a lot of these robot companies are eager to show you these days. And as a person who, fixes stuff around the house and who makes things in the garage, like I make carbon fiber bikes and I do a bunch of stuff like that, the amount of like feel that you have to have in your head just to like put a screw into an object without cross-threading it or ruining it and grab, like, it's incredible. Like I teach my daughter how to do some of this stuff now. The other day she put new fans in her laptop because her laptop was going badly, and I showed her how we do that. We watched some videos, and like just the finesse you need to do that and the problem solving skills you need to have in order to accomplish something that simple. It's like beyond the capacity of any of these things to do that. Something as simple as like, oh, when I'm pushing down with this screwdriver right now, the computer is sliding backwards. So like I need to reach over, or I need to put a book behind it against the wall so it no longer pushes backwards so that the screwdriver tip actually stays in the screw. And these are like the subtleties of actually doing stuff that would completely escape any of these systems right now. But I want to move on to Chipotle. We got a question. Is it time to buy Chipotle? Chipotle is a super hot stock that I made a lot of money on. And when I sold it, I was very convinced that I'd done a great job. And if I'd held it, I'd probably have almost $1 million in Chipotle stock alone. So watch out with your cleverness. Yeah, how's that for an L? Taking an L. I think I would. I think I'd have $1 million worth of Chipotle if I hadn't sold it so cleverly at some point in the past. But getting back to, is it time to buy? Never really got back into it either. And part of the reason was I just couldn't make the valuation work for a fast food restaurant. And, Chipotle does a fine job. They still, they've got they got 40% gross margins now, free cash flow margins in the low teens, but, trading at a free cash flow yield of 2%. While the top line grows, what do we got? Top line growth in the revenues still in the middle teens these days. Was a little slow, a little lower over the past 10 years, but kind of back up in the middle teens. So doing okay. It's just, yeah, I suppose if you love Chipotle and you think the free cash flow is good enough, why wouldn't you get some now? You'd probably rather be buying it now than, what do we have it at? $50 a share than, $65 a share a year or so ago, year and a half ago. How closely do you follow Chipotle these days, Danny?
Chipotle is a stock that I own. And when Chipotle announced that they were having a 50-for-1 stock split, first time ever, I think they got kind of caught up with the meme crowd. The stock got bid up to really high levels. I didn't see any reason to buy anymore, but I also didn't see any reason to sell. Now, what I will say is, looking at the valuation now, Chipotle has never been a cheap stock. I think the lowest that you could have gotten the valuation was probably back about a decade ago when it was trading for about 27 times earnings.
Yeah, I see it bottoming out like at 27 or so. Yeah.
Yeah. And at one point, not too long after that, it was, selling for 548 times earnings. But realistically, going back over the past 5 years or so, Chipotle has traded, its high valuation was around 170. Its low was around 38. And right now it's down to about 44. So it's getting near to it's, a 5-year low in its PE ratio. So for somebody who doesn't mind, owning a company that has a bit of a high valuation, and if, like I am, if you're a little bit bullish on Chipotle's future, it may be getting down to a level where it's worth looking at. But I would also say, keep in mind that the recent change in the CEO is also probably weighing on the stock a little bit, and it remains to be seen whether or not, he'll be able to keep the company's momentum going. So they're just things to think about going forward.
Yeah. You're talking about Nickel and his move to Starbucks. Although, when I see what he pronounced over at Starbucks, I'm like, maybe he wasn't responsible for what happened at Chipotle for the good things. When your move at Starbucks is, hey, everyone should write a nice note on all the cups every single time, when that became like, it is a much ridiculed management move. And it made me wonder, is Brian Nickel as amazing as everybody said? Or has he just been, has he been getting lucky? Chipotle, yeah, it's, I guess it looks better. The question I have from here, and anyone should have, is what do we have? 3,700 restaurants now total. What are they looking at as the number they think they can get to?
If memory serves, I think at one point they were saying that they could get to like 5,000 locations nationwide.
Yeah, I'm trying to think of what the pace of openings is these days. It looks like they opened about 300 restaurants, maybe 280 or something between the end of 2023 and the end of 2024. So I guess if you were opening 300 a year and you wanted to get to 5,000, you got 1,300 left. You got 4 or 5 years or so, because they'll probably obviously keep upping that number they think they want to do. So 3 to 4 years left at that pace, and you'd be at what your target was, unless you raise your targets or slow your pace.
Apparently they've upped that target since then. I just looked that up, and they have a long-term goal of 7,000 North American locations now. And they plan to open between 315 and 345 this year.
Yeah. 7,000. Yeah, so those are the kinds of questions where you gotta sit down and ask yourself if you believe it. It's more like it's less risky at this price point in time. But you say to yourself, geez, as many Chipotles as there are out there, can we have twice as many? What's the spread there between US and anything overseas? Is that pretty much all US for the most part?
I would say the vast majority of it. Let me up.
That's what I would have guessed too. Yeah. Yeah. So yeah, if you like Chipotle and you've been waiting for a chance, you're probably better off now than you would have been at certain times. But I have tended to not be investing lots of my own money into restaurant stocks lately. I got out of quite a few stocks, especially consumer facing ones. Like a couple of months ago, I just started selling things off, and was I lucky, or was I being smart? I don't know, but I got out of a few that are down like 25-30% in a short period of time. Even though I liked the companies and I thought they were doing good things, the valuations just looked nutty to me. And so, I think of those as wins, but there's plenty of other companies that I didn't sell that are down similarly. And so I'm still sitting on those wounds.
So to answer your question, as of late 2024, Chipotle had 68 internal national locations that were in Canada, the UK, France, Germany, and Kuwait.
Yeah. So that's a US story, which makes sense. Yeah. So I guess, ask yourself, can we have twice as many Chipotles in the US? Will that work out? Maybe.
Well, I remember when folks were asking whether or not that was the case with Starbucks, and it's kind of a different story, but it turned out we could have twice as many Starbucks.
Yeah. Although the last Starbucks I went to, all I wanted to do, Mike, I had to bring my car into a shop. There was a new Starbucks across the street. So I brought my work computer and I thought, I can sit here for 2 hours while they fix my my alignment. And I went in there, and this is one of those Starbucks that looks like it's a Starbucks and it has only 2 tables in it. And so there was nowhere for me to sit. And it was the first time I'd been in a Starbucks for a couple of years, except for the ones like you run into when you're on the road and you go to a rest stop. At least it was clean. I am not a Starbucks fan because as a very occasional Starbucks patron over the past few years, I can count on 0 fingers the number of good trips I've had to Starbucks. And so I think that they've got a lot of work to do to turn that around. I honestly just think McDonald's coffee is better and it's less work for me. And it's a lot cheaper.
A lot cheaper. So we have a question here that we will probably have different answers to. Let it ride from a while back, about 20 some minutes ago. Do you prefer looking at forward valuation metrics such as forward price to earnings and forward price to sales, or trailing? I'll give you my answer, and then maybe Seth can pipe in. Generally speaking, I think they inform us about 2 different things. When you're looking at the trailing PE, it tells you how the company has grown its earnings in the past 12 months. And of course, forward tells you how the company is poised to grow its earnings or sales in the coming 12 months. Now, the thing I generally tend to look at the forward facing metrics, but also, it's worth keeping in mind that these are based on analyst consensus estimates, and that's all they are, estimates. And at any time, as we've seen with some companies recently, analysts tend to get their answers wrong fairly often. So while I like to look at those in terms of, excuse me, how tempting it looks to get into a stock, going forward, you also need to keep in mind that there are no guarantees when it comes to expectations and analysts getting that number right. So I tend to look at both of them. I give a little bit more weight to forward price to earnings, price to sales ratios, but not much more. Seth?
Yeah, I don't think that I almost ever look at the forward ratios, and that's because I don't, in the analytical sheets I build, I've got the backward looking ratios, right? So I don't have a backward looking line, for instance, of like what the forward price to earnings to growth ratio looked like at a certain point of time back in the past. So it's essentially, it kind of comes out to the same thing. I look at these as very loose indicators of what the market has been willing to pay over the years for a company. And then generally I use this worksheet where I have all these charts so I can see what they were willing to pay, plotted right below what the growth ended up being. So in a sense, I guess I was looking at, I'm almost looking at the forward price to earnings ratio just in reverse because I could see what investors were willing to pay, but I could see, what the actual revenue and earnings growth turned out to be at the time. So for me, it's just easier to look and see what those expectations have always been, and then take a look at the upcoming predictions for growth and see, how those things shake out. It's just kind of a matter of, what's the word I'm looking for? Just getting your brain settled on one figure or another, so that you always have a kind of apples to oranges comparison. Like, I couldn't tell you offhand if you were like, oh, what's a good PEG ratio for Chipotle? Like, I couldn't pull that out of thin air, right? Whereas I could probably give you a pretty good guess, based on trailing earnings or something like that.
Looks like we have about a minute left. Ed asks, has Chipotle turned into another Starbucks, Nike, PayPal, and Zoom? Well, the first thing I would do is I'd have to segregate that out a little bit. I think PayPal and Zoom, tickers PYPL and ZM, are a totally different story. They got, they spiked because of the pandemic and increased use cases, and then fell off because of that. Nike and Starbucks, on the other hand, have hit road bumps in their growth. And I think Chipotle really just more than that got ahead of itself in terms of its valuation, and has since, the valuation is coming back down. I don't know if you had
Chipotle is
anything to
still
add
on a
to that.
decent upward growth trajectory. Starbucks, I think Starbucks hit the law of big numbers. I just think there's so many of them. Like, what growth can you expect from them? And how much can you charge people for a cup of coffee or for a caffeinated beverage? I think that's a different problem. And then Nike made some fundamental mistakes in how it operated its business, assuming that people wanted to buy more online, kind of getting away from some of the performance driven halo effect that started out, that kind of made the consumer business and the fashion business possible. So it's tough to just give a list of tickers and say, are these all similar? Because every one of these companies has different problems and opportunities. So even if the results of the stock price action look the same, what caused that to happen, the background story behind it is entirely different between all of them.
And with that, it looks like we're going to leave you in the very capable hands of Jayson Hall and Dan Caplinger. What's going on, guys?
I think the better way to say that is the very capable hands of Dan Caplinger, and Jayson Hall.
See ya.
Fool on, guys.
See you guys.
Danny. Thanks, Seth.
Hey, Dan.
Happy St. Patrick's Day to you.
Happy St. Patty to you too, my friend. I dressed the part.
As did I. This is darker green.
I see it now.
You got the lighter green, but
yeah, I see it now.
Yeah,
very good. Well done. Well done.
So, self-defense very important to me. So
yeah, it is, because people get a little handsy on days like this. So avoid the pinch. The market's not pinching us today. The market's actually up, but that's short-term stuff. We're going to talk long-term and like longest term. For each of us, we're going to talk about some holdings that we've had for a long time that have done well. And in my case, I'm going to talk about one that I've held for a very, very long time that has been a horrible investment, and the lesson that I've learned from there. But Dan, before we get to it, just want to remind everybody watching, if you're a Motley Fool member watching, or you were watching us on YouTube, just remember, we want to answer your questions. Go to slido.com, get those questions into us. The event code is Fool24. And remember, just because we answer your question doesn't mean we're giving you advice. This is not a forum where we provide individual or personalized investing or financial advice. So please keep that in mind. Okay, Dan, you want to kick things off here?
I will. So my first holding, my longest holding in my portfolio, never bought it, never touched it, never added to it. And in many ways was my first mistake in investing. But nevertheless, I've held on to it. It is a mutual fund. It is the Washington Mutual Investors Fund, ticker AWSHX, part of the American Funds Capital Group family. And I invested $250 in that fund. Or what I should say is that I purchased $250 worth of fund shares, but not all of that got invested. And the reason for that is that Washington Mutual Investors Fund was, and I believe still is, what's called a loaded mutual fund, a mutual fund that charges a sales load. And so when I purchased my shares, 5.5% of my $250, bear in mind, I was 17 years old at the time. And this is 1980s. This is the late 80s. So, $250 was, more money than, it was a lot of money for me.
Yeah.
So out, the broker takes his $15. I get about $235 invested in that fund. I leave it alone. Every year it pays dividends. Every year it distributes capital gains. It's in a taxable account. I pay that taxable account. That 250 or 235, however you want to think about it, has risen in value. It is a 38 bagger. It is worth about $9,500 at this point, which sounds pretty good, except that we're going on 40 years for a holding period. And so when you do the math, you come out, that ends up with a compound annual growth rate right around 9.5%, which is trailing the market. And so, a couple of things for that. One was that $15 that I paid in that sales load has made a big difference, because if I'd had that $15 back and that $15 had gotten that same 38 bagger, that would have been another almost $6,000, or no, almost $600 more. And that would have kicked me over the 10,000 mark, and it would have incrementally helped my return. But the other thing that I've learned is, I've paid expense ratio along the way. That fund has a below average expense ratio, in part because of the sales load, but it has at times approached 1% per year. And if I had that 1% back, if that had been invested, if I had just picked, in 1986, there wasn't a SPDR S&P 500 exchange traded fund yet, but there was an index fund that I could have bought that would have given me the same results. I would have been significantly better off doing that. So I kind of keep that money there. It's, part of it's a tax issue, but part of it is a lesson, to kind of remind me of my roots and tell me what, kind of remind me of the lessons that I learned from having done that.
I love it, Dan. It's the thing that I like about that a lot, and I'm going to go a little bit off of script here, but the thing that I like a lot about that is it highlights how things that seem like they're small over very long periods of time, they get compounded and they end up being bigger than you could have ever expected. And as foolish investors, we want to try to find the positive side of that, right? Where how even modest amounts of improved returns compounded over decades can be meaningful amounts of money that can truly change your life, right?
Yeah, exactly.
Little percentages, how little percentages can do that. And so I'm going to use, just because this is, I think it's just an easy, if you give me just a second, I'm going to build a chart here.
Yeah.
But this is an easy one to understand. So this is looking at two companies that people are very familiar with. One is associated with Warren Buffett. That's Coca-Cola. One is not. And in investor lingo, often when you say it's the Pepsi to so-and-so's Coke, it's a backhanded compliment, right? Because it's a good business, but maybe not as good. It kind of, like I said, backhanded compliment is the way to think about it. But I'm going to give you two numbers here. The first one is 8.7%. The other one is 9.1%. So round figures, what's that? 0.4% of a difference here. That's the annualized return.
Percentage points. Yeah.
0.4 percentage points. That's the CAGR, the annualized total return for those two businesses, those two stocks, since the beginning of 1994. I want to show you what that looks like. Natasha, I just sent over a screen share if you'll release that. So that doesn't sound like much, but again, back to your point, Dan, the difference is if you had first day of 1994, the first trading day, you had bought $1,000 worth of Pepsi, $1,000 worth of Coca-Cola. Pepsi has been the better investment, but not by much, 0.46%. So roughly a half a percentage point better. Over the past 31 years, that's a couple $1,000. And that's just starting with $1,000 investment, right?
Yeah.
That very small amount of money really, really starts to compound. So I think that's an important thing to remember, is that don't assume that just because it's a small number, it doesn't matter.
Agreed. Definitely.
All right. I'm going to share. We got some questions that are coming in. Folks, keep those questions coming in. Just anybody that didn't join right at the top of the hour, just remember, go to slido.com. The event code is Fool24. That's how you can get questions to us. Get those questions coming in. I want to talk about two stocks really quickly, Dan, that that are two that I've owned the very, very longest. One is Intuitive Surgical. I made my first investment in Intuitive Surgical, and one of only a couple investments I've ever made in the company, on November 6, 2012. And so we're going on, what is that now? It'll be 13 years. It'll be 13 years this year. It's done okay. It's up 702%. All right. So that's very, very good. I've sent another screen share over, Natasha. That's 18.35% per year on average, compared to the S&P 500, which has done just over 13.9%. So again, looking at what seems like small numbers and how, holy cow, small numbers get a lot bigger. Call that 14, call this 18, and it's more than that. It's more than 4. Call it 4.5 percentage points per year better. And again, we're talking less than 13 years, and it's 60 or 70% more money, like total gains, substantial outperformance. These small percentage points really, 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 really matter. Now, here's another one that I bought. Now, Clean Energy Fuels, ticker CLNE. I actually bought Clean Energy Fuels in March of 2012, so even sooner. But what this is this is not only the brutally painful side of investing, but it's also, I'm going to pull Intuitive off of here just because of the opportunity cost reminder, right? So over, a dozen years here, this has been a wonderful period for the market. So again, 13.88% average year for the market over that period. That's not 3.8% better. That's 38% better than the average long term, which is around 10%, right? It's been a wonderful, wonderful run. So not only has the stock largely lost money for me from that particular buy, but it's a massive amount of opportunity cost. And why does this matter? Because this is what gets us back around to the idea of diversification, or Warren Buffett's it's the hedge against ignorance, right? We don't know everything about every business. Concentration can have its rewards, but it can also have its downsides as well. So diversification, owning businesses that have different risk factors that they're exposed to, different economic factors that are different parts of their, the continuum of where they are as a business, maybe some cash burning, startup-y kind of businesses that are disruptive, but also owning some Berkshire Hathaway style, Coca-Cola, high quality businesses. You pay a good price and you have a higher likelihood of getting some sort of a positive return. Having that sort of diversification can really, really be useful too. Here's the big one though. Again, thinking about that same chart, Intuitive Surgical has done so well that it covered all of the losses for Clean Energy Fuels and still gave me a 6x return after covering for a stock that was essentially, down 85%. Dan, that's close enough to 100% loss over that period of time that you're just quibbling over pennies.
Yeah.
The power of the long-term compounder is it makes up for a lot of mistakes along the way too.
Yeah. And frankly, those mistakes are inevitable because
course.
in many ways diversification isn't just about protecting yourself from the unexpected. It's accepting the uncertainty of you have ideas that you're interested in investing in. And you don't know which is going to work. You don't know that Intuitive Surgical is going to be the winner and clean energy is going to be the loser, not up front. It might well have turned out exactly the opposite way, and your portfolio would have been exactly the same value as it is now, but those two companies might be in very different places relative to where they are now.
Yeah.
But the purpose of diversification is, at the end of the day, you don't necessarily care. You've gotten, as long as one does what it's supposed to do, then whatever the negative impact of that other one is not going to be all that big. And sure, you can say, oh, if only I'd put everything into the winner and not put anything into the loser. That's just results-oriented thinking. There was no way to know up front. And, I think there are ways perhaps to, maybe thumb the scale a little bit, put the odds more in your favor, but you're never going to get to 100%. You're never going to be batting 1,000 with that kind of thing. And so to berate yourself about, oh, I shouldn't have, what was I thinking with the clean energy? It's just like, well, what you were thinking was that it was a business and it had a good idea. And it turns out that idea hasn't panned out quite the way that you'd hoped or expected, but it could have. It just didn't.
Yeah. Well, here's the funny thing. Again, looking at the businesses, Clean Energy has about 3 times as many refueling stations operated today as they did a dozen years ago. The business is delivering a lot more fuel. The economic output of the business it didn't generate return for investors, right? So those are the things that we run into. And I would say that there's a case to be made. I don't think it was in 2012. If you went back a few years before, a business like Intuitive Surgical did one of the hardest things in the world to do, and that was to change behavior somewhere in the healthcare system. And in this case, we're talking about change the way that surgeons actually do surgery. And to be able to do that is remarkable. We can look at the road to healthcare investing success and failure is littered with companies that failed because they could not break the way that the incentives were structured and the way that physicians and other parts of the system operate. DermTech is a perfect example. A wonderful idea, but you were expecting an entire cohort of practitioners to essentially change their business model around your product. And to a certain extent, there's a little bit of a similar thing for Intuitive. And now you have an entire generation moving into a second generation of surgeons that from their first surgery are trained on this sort of system. This is how they perform the surgeries that they do. So, and now it looks like it's blindingly obvious, but it certainly wasn't, Dan, back then. So avoiding those hindsight bias mistakes when we're analyzing our winners versus our losers is part of the answer to Let It Ride's question from about 4 minutes ago. So that question, if the goal is to beat the market on a long-term holding, what are the most important features you look for in a company to accomplish this? Dan, you have some thoughts about that?
I do. I mean, one of the things that I look for is you have to have a business model that makes it makes sense either as a long-term business model now, or you see evidence that the business model has the opportunity to evolve and scale up and transform, adjust to changing conditions over time. Because if you have a buggy whip corporate strategy and all you've got is the ability to make buggy whips, then when horse-drawn carriages go away, you don't have a future. Whereas if you have identified that you want to be in the transportation business and you are open to the disruption of horse-drawn carriages that the internal combustion engine powered automobile at the beginning of the 20th century represented, then your business model can shift and you can adjust and the business can continue to make money even if the business ends up looking completely different from how it did 10 years ago, 20 years ago, 50 years ago, whatever it is. That's probably the most important thing to look for in what you expect to be a long-term holding is that ability to adjust. I mean, I give you two mega cap examples of that. They're both in the technology industry. Look at Microsoft, ticker MSFT. For a long time, Microsoft was the king of the software hill. Just about anybody who was not in the Apple ecosystem relied on Microsoft to provide, office-based software, operating system software, that kind of thing. They sold things on a license basis, which means they got a whole bunch of money up front from every user, every corporate user, every personal user. They wanted to use Microsoft software, paid a big upfront licensing fee, permanent license. And then it was up to Microsoft to say, every few years, yep, now it's time. We've got Microsoft Word 2010. And it's a whole lot better than what we released a few years ago. And that's why you should come back at us and spend another decent bundle of money to upgrade all of your systems. And that worked until the internet evolved enough that you started to see subscription-based software as a service companies come out and say, you know what, that licensing model, we don't like it very much. You have to convince everybody to upgrade. There's a whole bunch of distribution questions. The revenue's lumpy. We'd really like to change things. And so this idea of recurring revenue came out. And a lot of smaller companies and Microsoft were successful with it. One reason the smaller companies were successful with it was they hadn't really had time to build up a licensed model in the first place. And so there was no disruption to their business. But a company the size of Microsoft, there's a huge change, because if you're able consistently to sell a permanent license on software, the amount of revenue that you are getting in any one given period is a heck of a lot higher than what you're going to get on a subscription basis, where you're basically amortizing the value of that software across its useful life. And so Microsoft was looking at, potentially, if they had to make a shift towards more of a subscription-based model, short-term temporary revenue lost would be huge. But that didn't stop Satya Nadella from doing it, because Satya Nadella CEO of Microsoft saw that it was incredibly essential to be in that area, to be able to offer immediate new features, immediate upgrades, give everyone the latest version of software day in, day out, without having to have a big sales team reconvincing everybody that now is the time to upgrade. And so that Microsoft, you've got an example of a company that was able to adapt and transform its business and find and stay relevant, even though it doesn't look anything like what it did before, just because of that simple evolution from license-based software to software as a service. Now, the other side of the coin, Intel, ticker INTC, king of the hill when it came to microprocessors in the 1980s. Winner of the PC revolution. And yet you fast forward, you look at the business model, it stayed stuck in that PC-based model for so long. And at least to date, it's tried and it has tried and it is still trying. Maybe it'll succeed one of these days. But it has largely missed out on many of the trends that have helped its competitors, companies like, Advanced Micro Devices, ticker AMD, and of course, NVIDIA, ticker NVDA, really just take all of Intel's competitive advantage away from it. And so that, long-winded answer to what do you need to beat the market? You need a business model that'll be more like Microsoft's than like Intel's.
Well, I think there's a core thing there that's really, really important. I'm going to send another screen share up. And I'm going to share just a specific period of time for a business here. And that's Autodesk. Because Autodesk was one of the first big software companies to do what we saw Microsoft do. And that is take its legacy selling boxes of software, and every few years when it comes out with a new version, then have its resellers and all of its internal marketing and corporate sales teams go out and try to upgrade those customers. And a lot of those customers don't want to do it. So what we saw was in this period here, and it really carried forward a little bit. The timing looks like bad because this was also during the financial crisis, but Autodesk switched from a license model to a recurring revenue model. And it was brutal. It was a tough time to be able to do it. But the company did it exactly as Dan said, because it needed to do it. It was a necessary move to strengthen the business, realign the priorities of the business to better power their customers as well. So they always have the latest iteration of whatever the application is, and they're maximizing their productivity while it's also maximizing the cash flows for you as a business as well. So a little bit of kind of being willing to disrupt your own model is so important. I mean, I can't undersell how important that is if you're looking for businesses that can last for the very long term and thrive. A couple of other examples of businesses that have proven willing to do that in the past. Apple launching the iPhone was a big risk for more reasons than we might think. The reality that the BlackBerry was the dominant phone, so strong in the enterprise because of its security, and nobody's going to get past the CIOs that are making these decisions about what devices are getting allowed on the enterprise. But also the bigger thing was their core business. The thing that was making them tons of money at the time was the iPod. And the risk of disrupting that massive cash cow business was, there were a lot of internal conversations at Apple about that. And they made the decision to do it, and they went through with it because it was the right thing to do for the business. And healthy businesses are the ones that they're always willing to be their biggest competitor, is to let another part of that business disrupt itself. Because if you don't, somebody else is going to. In the case of Intel, right? This is a business that was not willing to ever disrupt itself, and now it's a shell of its legacy self. Another stock I can talk about briefly as one of my long-term investments is Meritage Homes. And there's a couple lessons for Meritage Homes that I can share. I'm going to bring this one up on the screen too, because it actually, in the longest, my initial investments back in 2013, those investments, let's see if this is going all the way back there. So 2012, 2013, those investments are not doing great against the S&P 500. They've done great at times against the S&P 500, but it's when, so this is a good example. I bought a lot of shares in 2013, but by making those initial investments, Dan, and getting exposure to the business, and starting to build my expertise and knowledge about home builders, learning more and more about the state of the housing market that was really playing out from really 2008 through like right here, with all the massive underbuilding that was happening, and how there was going to be a wonderful opportunity for a lot of these businesses to fill the need for the shortage of housing supply in the US. As we saw an entire generation, millennials, really a lot of their financial goals were pushed back years because they were coming of age in the middle of the global financial crisis, right? So, and now here we are today with this massive shortage still. That's the biggest thing, is there's massive pent-up demand. And companies like Meritage Homes in more recent years, from those kind of lull periods, have started to really shine in terms of profit and compounding machines. For Meritage Homes, it was started as a custom home builder. Steve Hilton, the founder of the business, they were building custom homes. Traditional model, you go out and you find land, you buy the land, you start developing it, you put up your sign, you have your salespeople, and you have your show unit that you show, and you have all these different things that the buyer can customize. The problem with that model is it's expensive. You need skilled labor. It slows the sales cycle down. You have a smaller pool of potential buyers. It cuts your margins. Steve Hilton realized in the early 20-teens that the real opportunity was going to be in starter homes, entry-level homes, first move-up homes, because of that massive amount of underbuilding that was done during the financial crisis and in the 4 or 5 years after it. And he took a big risk to turn away from a business that they were known for and that they were really good at, to move to selling homes on spec, building the homes, not have a contract in hand, not have that deposit. And they shifted from like 25% of their homes on spec to 75% of their homes on spec. And they haven't looked back. Their margins have been better. They're turned their inventory over quickly. They sell through their communities more quickly. They pay a dividend now. The business has just gotten so much stronger because Steve Hilton saw the opportunity and was willing to take the risk on. So having leadership that's willing to disrupt something inside their own business because it's better for the long term, that's definitely a characteristic that I look for.
And correct me if I'm wrong, Jayson, but I think that Meritage is one of the home builders that, you were talking about that long-term structural shortage of homes available. And I think companies that are able to identify these long-term trends that will help their business year in and year out, I think that's one secret to having a good long-term holding. But the other thing, again, correct me if I'm wrong, but I believe Meritage has a pretty big emphasis on the Sun Belt, on the southern part of it. Is that correct?
No, that's right. So the first law of real estate is location. The first 3 laws of real estate: location, location, location.
Yeah.
And then the three rules of home builders are also L's. It's land, labor, and lumber. So being really good at acquiring those things and lining those things up really, really well. And again, being in the Sun Belt, that's been their big focus. They're also in Colorado and a little bit in Southern California too, but their big focus over the past decade has definitely been being in the Sun Belt and all the Southeast.
Yeah. David Brooks, I think, an interesting question. How many years do you hold on to a stock if the price stays flat for a 3 to 5 year period? David, I can't say that I have a huge amount of experience with that, but I do think that when I've thought about this, and in the past, distant past, I did more individual stock investing, and I was very sensitive to this. I would be sort of like, well, the stock hadn't gone anywhere. What's going on? It seems like the business is doing what I expected it to do. It's just not getting any love. I'm not quite sure how to deal with it. To me, that's sort of a behavioral investing aspect because, there's some stocks that they build momentum. They get a lot of attention. That momentum begets more momentum. That's one of the rule breaker philosophy tenets that David Gardner has helped make famous here at the Motley Fool. The flip side of that being that, once your stock is kind of flat and it stays flat, then it's kind of like, well, it's not in the spotlight. So how's it going to get into the spotlight? Sometimes it never gets into the spotlight. Sometimes it's NVIDIA and it finds its way into the spotlight because, you go back and look at that chart. Go back and look at how NVIDIA did, next to nothing year after year after year for a long time before it did its just straight up into the stratosphere parabolic move that we've seen. And, and so, you can put your tongue in your cheek and basically say, what happens is I get rid of all the ones that eventually go up and I hang on to all the ones that stay in there flat for another 3 to 5 years. And I get that. But to be a little more serious, I think that the more important question isn't, well, how long do you give it? The more important question is, okay, yes, you have picked a stock. You thought it was going to do well. It's been flat. 3 to 5 years goes by. What's your next move? And what I think the next move is to take a serious look, a critical look at the company and make sure it's still the company that you invested in 3 or 5 years ago. And if it is still that company, ask yourself, is that still a competitive and compelling investment thesis to hang on to the stock if you were thinking about buying the stock today? Because there's nothing magical about the fact that the stock is already in your portfolio, especially if it's flat. If it's flat, there's not even any tax consequence to getting rid of it. And so you can just kind of look at it as, all right, brand new decision. Am I going to keep this stock in my portfolio or is it not going to be in my portfolio anymore? And, to me, I think it's important to be critical and to look at the assumptions that you made, the beliefs that you had for the business. If those are all still there and you still have the same conviction in the stock's future, then you can stick with it and feel good about it. And maybe the next 3 to 5 years is more to your liking than what the last 3 to 5 years has been. But if
So
you don't, go ahead. Yeah, please.
Yeah, I want to push back a little bit here. David, please don't take this as me pushing back on you, but
yeah, just take it as pushing back on me, because I'm totally fine with
I'm
it.
pushing back on everybody here and myself too, because if I had a nickel for every time I said this stock's been flat for X period of time, I'd have a bucket full of nickels. But stocks they're not flat. They're never flat. It may have gone up a lot and then fallen, or it may have fallen and then gone back up. And when we say they're flat, what we're saying is that it's gone on a round trip, right? It's gone on a roller coaster, and it is back to where it was when I bought it. Natasha, I've sent another screen share over for you. Sticking with the theme here with Meritage Homes. This is from May 14th, 2013, when I opened my first position, going through the beginning of 2018. So just to kind of give a period, it wasn't flat. I mean, the stock fell 50% at one point. Again, using that example of Nvidia, going back from the beginning of 2010 all the way to 2015, stock was up 7% at the end of that period. But there's a lot of noise along the way, and I think the answer to that question, the reason, again, I'm not trying to dunk on anybody or push back in any disrespectful way. I think there's a really important lesson, because there's where you started and there's where, let me show this again. So there's where you started, and then there's where you ended. And then there's what happened along the way, understanding it, and what did you do to build your knowledge along that way in that business, contextualize your ownership, and then reach a decision to inform the best thing to do. And for me, with Meritage, when I first invested, I bought a custom home builder. Okay. I didn't buy the same business as it's built today, focused on entry level and first move up homes. Those conversations with the market, they were having those conversations in 2015, 2016, when they were really talking about that shift that Steve Hilton wanted to take the business in. He was still the CEO at the time. I was somebody that was deeply interested in housing and understanding the housing market during that period. I bought our first house in California kind of right about the same time I bought the stock. I was really interested in the mechanics. I'd gone through a year of trying to find a house. And I was at the age where I knew there was an entire generation that was going through or getting ready to go through the same thing. And there was just no inventory. There was just a lack of inventory everywhere. So I was building up my subject matter knowledge all along this way. And what I started doing is acquiring. I was adding to and adding to and adding to. You hear people talking about buying in thirds or fifths or that kind of stuff all the time. We had somebody on Motley Fool Money recently. Oh goodness, I can't remember his name, but it's somebody that's really focused on investing in small cap and micro cap stocks. And this is one of the things that I've done with Meritage and with Trex and 4 or 5 other companies that have been big winners for me over the long time. I've made 10 or more investments in these companies over, a 10 or 15 year period, made a regular habit of adding a small amount to these businesses when the opportunity looked good, when I had invested a lot of money in other things, maybe reduce my exposure and wanted to increase my holding in these businesses. So that's the one thing that I've always tried to do, is focus on the winning business, right? And invest more in the winning business. And what happened with Meritage, if you look at its earnings over this period, it's pretty easy to say, well, I mean, enough kind of got a little worse there. But again, I understood what was going on with the business, and they were making some decisions that were going to affect their earnings in the short term, as they were flipping inventory, as they were realigning the land that they were acquiring in places where they could focus on the target to build entry-level housing, making sure they had the right land, that they had the right relationships with the right labor in the different markets they were moving into. They were shifting away from Southern California and moving more into the Sun Belt. So all of those things created pain. And if I wasn't studying the business, Dan, I wouldn't have known. I wouldn't have recognized an opportunity. I just would have seen a weak business that had underperformed.
I want to reframe this just a little bit, Jayson, because I think it's relevant here. Keep that chart up for me, if you would.
Yeah.
you started putting money into Meritage 2013, and
Right.
2.5 years in, you're in a much worse situation
Yeah.
than what that question was talking about. You were down almost 50%.
Right. Right.
And, a lot of people would have said, well, what do? You pick the loser, and, yeah, you've got some other winner somewhere in the portfolio, and that's great, but you got this company, and it's a loser right now. What are you going to do?
Yeah.
And so what did you
Yeah.
do? You took a look, you understood the business, you were accumulating knowledge. You had, if anything, more conviction in 2016 than you had in 2013.
Mhm.
You made the decision to hold on to what you had bought and continue your long-term strategy of making strategic ads, as the case may be. And what'd you get? You got a double, because you were down, this graph, it shows it is down 50% back up to break even. But essentially, if you'd taken that money and you'd done something else with it, you would have had to double your money to do as well as you did simply by keeping it right where it was.
Yeah.
And so,
that's right.
That's important.
Now, along that same time, I was also studying clean energy fuels. Clean energy fuels did not do well. But the key, again, stretching this out over the very long term, then you start to see where those winners shine. The winning businesses, they shine, and it makes up for the losing businesses, and it pays off.
Yeah.
Now, here's an interesting. I'm just going to throw this up on the screen real quick, and then we can move on, because we've spent a lot of time talking about this, but I think it's critically important to talk about these sorts of things. We'll use the NVIDIA example. NVIDIA doubled its earnings over that kind of round trip period. So this is clearly a business that's winning. So sometimes the takeaway, Dan, is maybe I paid a little too much. Maybe my
it refreshes. Exactly. Yeah.
Right. Yeah. So sometimes you have to reset your own brain. It's like, okay, maybe I started off too aggressively with the investment that I made, but the business is doing well.
Exactly.
Okay, let's move on.
All right. What's next?
Curly Q. Yes, I do. Jayson, do you still own Clean Energy Fuels, ticker CLNE, or have you sold it to use whatever money was left to buy something else? My first buy was in my Roth IRA. So talking about compounding the losses, that couldn't even benefit in any way from, tax loss, realizing the tax loss or anything like that. But I have kept a small portion of that initial buy in my Roth. So every time I look at my Roth portfolio, it stares me in the face and says, hey, you, be humble. You're going to screw up. And sometimes your highest conviction ideas are going to be completely wrong. So that's why I've kept that little tiny, that's the only loser that I've really ever held on to that I don't see the same long-term prospects at all. That's the only one that I've held on to, because it's to help keep me humble in moments where I'm not as humble as I need to be, Dan.
Yeah. Ed from 3 minutes ago is one of the keys to building a long-term portfolio to take advantage of buying good companies at company lows, such as Trax, ticker TREX, Truist Financial, ticker TFC, and then holding them for the long term. Ed, I'll tell you, I think that there's too much emphasis put, in my opinion, on trying to get in at short-term lows, because let's face it, it just does not happen. Think about it. You did the right thing. If you invested money, if you had the courage to invest money in 2008, in late 2008 and early 2009, you did well. If you held on to those investments, for the most part, you did well. And it doesn't really matter if you bought in September 2008 or October or November, or in January of 2009, or on, I think it was March 6th, 2009, something like that, or March 9th. I can't remember the exact date. Everybody focuses on, well, if you invested on March 9th, 2009, you'd have X return. And yeah, sure, that's great. But you don't have to have done that. Your return's just a little bit less. And so if you have
Dan, I've showed
really
one of the
good
things
companies, then it's going to work out, and you don't have to focus so much on, it's just kind of a bonus when you get like that little discount there.
Well, one of the I've shown the chart. I'm not going to show the chart now. I'm just going to describe it. I've shown I think it was October 7th, but that first week of October 2007 was inarguably the dumbest week to have bought stocks for the next 5.5 years, because it took the market 5.5 years to the S&P 500 to fully recover. And from there to that March, first week of March, the date you were talking about in 2009 with the bottom, you lost 56% of your, if you just bought an S&P 500 index fund. Yeah. Chances are, if you bought any of these winning businesses that we like so much, especially if you bought a bank, whoo, buddy, you were down even more, right? So, but if you bought that day, let's just say you were just, dollar cost averaging in your 401k into the S&P 500 fund, and the dollars that you bought that week would be up over 400% now. So that's a 5x, right? And it's about 10% average per year. So over the 17 years since then. So dumb buys short term usually still work out okay, as long as you're not buying clean energy fuels or a bad business. So,
and give yourself a break. I mean, you're not gonna be the worst either. I mean, if I'm saying that you can't expect to be buying the S&P at 666 on the worst day, and I just remember that number, but you're also not going to buy it at 1,500 right before it goes down to 666 on its way eventually back up to 5,600 or 5,700, wherever we are right now. But, it all kind of evens out a little bit. And it's more important, I think, the mistake so many people make is that they never make the investment in the first place. They're sitting there, they've got this cash on hand, and they're sort of like, oh, that next time that it goes down, I'm going to be ready and I'm going to get there. And a lot of the
next time it's down, next time it falls 10%, it's probably moved up 45%. Right?
Exactly. Right? How many people didn't invest in the S&P when it was at 4,000? And now then it went from 4,000 to 6,000. Now we've had a 10% correction and you're at 5,500. And, a lot of those people, they're sort of like, well, that's not good enough. But 2 years ago, you told me that when there was a 10% correction, you were going to buy it. Well, here it is. And they're like, well, but now it's at 5,500. I could have bought it at 4,000.
Right.
My answer to that is exactly.
Yeah. I want to give that a little bit of credit here, because there's a word in here that's doing a lot of heavy lifting that I want to be sure we don't ignore.
Yes.
Is one of the keys to building a long-term portfolio. Ben Carlson's somebody that I have a lot of respect for, and I read Ben's A Wealth of Common Sense blog. He posts multiple times a week, typically. One of my favorite things about Ben is a lot of times he does work looking at market history or macro things and track stuff, so I don't have to. So it's kind of cool. He just posted yesterday one looking back, going back to 1950, looking at double-digit downturns where the S&P's fallen 10% or more. And according to Ben, so go to awealthofcommonsense.com. You can sign up for his posts. He's really, really good. He says, by my count, this is the 39th double-digit downturn since 1950. So he's talking about through Thursday of last week. That works out to about one every other year. So the way that I think about it is, don't wait for them. This is how I actually act, how I choose to invest. I don't wait for them, but when we do see them, I do have a list of a watch list of stocks that when we do, because when we get those, there's a good chance there's something that I own or want to own more of, or don't own and want to own, that's probably going to have fallen more. And again, I try not to just to anchor on, well, how much is it down from the high? But like, is this sell-off an opportunity, right? Look at it holistically. Is it an opportunity? And trying to make that part of my playbook, right? To when I see those opportunities, to not mess them up, trying to wait for even more, right? Buy a little bit. And then if we do see a continued downturn, which they're extremely rare to get, 20 or 30% drawdown, but if we do get them, I'm ready to act on those as well, but not let these opportunities pass when I see them. Last week, I added to my home builders last Wednesday. So I saw an opportunity. So I do think it's a reasonable part of one of the keys, right? One of the keys. All right. What do we got here? Kava, here's a good one. I like this one. Kava PE is 70. PE's price to earnings ratio. Kava, the ticker is Kava. This is the restaurant business. Isn't that high for a restaurant stock? Yes, but. So there's a case to be made that it's high for any stock, But if there is a time to pay a high earnings multiple for a business, it is when it's a business that's proving that it has a winning strategy and an approach. And for restaurants, it has to start with the product. Is it compelling? Can they get really good leverage in the business? Is it efficient to serve? And can it scale up? Right. So when you find something like that, and again, Chipotle is kind of the gold standard of something that's obviously wildly popular. It scales up really well. You can get good margins, simple menu, simple ingredient buying, all of those sorts of things. And you can do it at volume. Right. So with Kava, I think it answers some of those things, maybe not all of them as much as we want to fully know in terms of how popular can this be? What is their real at scale? How big can this business be? But the point is that trading for 70 times earnings today, if Kava checks off those other boxes where every restaurant they open, the restaurant level operating margin is going to be much higher than the total business because, well, the restaurants are what pays for the home office. It's what pays for sales and marketing and pays for your accounting department and your payroll people and your CEO and all the other executives, right? So what happens is they open more restaurants, the margin from those restaurants each one absorbs a portion of those kind of fixed costs for kind of the core, what they call it, the SG&A, sales general administrative, right? So that's
Right,
like
yeah.
kind of that business. So you're spreading that over more and more pieces of the pizza, right? As the pizza gets bigger, or in this case, the Mediterranean salads, if you will, whatever you want to call it, right? So the idea is that PE might look higher today, but as they add more restaurants and those restaurants increase operating profit and you get operating leverage, which is the key to this, when you've got twice as many restaurants and maybe it's fallen to a 30 times price to earnings, it's possible that the stock may have doubled or tripled, right? Even as that earning multiple has become compressed because the business is at scale, right? So you can see the earnings rate, the PE multiple get compressed over time and it still be a winning stock. So paying 70 times earnings for a business that's already at scale and maybe they're only adding like 1 or 2% new restaurants a year and their growth is really mostly just going to be from comp sales growth, that's a different situation where getting the really good multiple is the most important thing to getting acceptable rate of return. But for a business like Kava, your margin of safety is how well are they going to execute, lever up get better operating leverage as they grow the business and hold it for long enough time for that to pay off, even as the multiple might get squeezed. Any important nuances I'm missing there, Dan?
No, but I mean, you're at a place in the continuum for the company. So,
right.
Take Sweetgreen, ticker SG, at least Kava's making money. Sweetgreen hasn't yet gotten to profitability.
Right.
Other side of the spectrum, Chipotle, ticker CMG, PE about 45.
Yeah.
Much more mature than Kava. Still well above, if you go down the chain, McDonald's, I looked up, had a PE around 25, earnings multiple about 25. Darden restaurants, right around 20. So yeah, I mean, these stocks that are still in growth phase are getting bigger PE, getting bigger earnings multiples than the stocks that have essentially reached network maximum. And if they're going to make more money, they gotta be innovative somehow with their existing operations. They're not going to just geographical footprint expansion is not going to get the job done.
Right. That's exactly right.
I want to address Bestie's comments. A series of questions from Bestie's are really interesting to me, and I haven't had haven't had time to verify this. So I'm going to take your word for it, Bestie's, who says the best single stock compound annual growth rate over the past 100 years is Altria. Used to be Philip Morris, probably used to be some tobacco some name with the word tobacco in it before becoming Philip Morris. 16% per year for 100 years. The question is that what you can expect at the very most for a very long-term hold? Besties, I mean, the real fact here is that most businesses don't last 100 years.
Yeah.
Most businesses, something happens to them. Either they go out of business, which is very bad for investors. They may cease operations, but do some sort of liquidating event that returns investments to shareholders, and you don't necessarily have a catastrophic loss like you do with an insolvency type situation. Or you get a buyout where some other company acquires it, and in that case, you may do very well. But the number of companies that still exist that are 100 years old today, I mean, it's a very short list, and I suspect that will continue to be the case, just because of innovation, the importance of innovation, and the importance, of kind of changing generational, I'll call it generational fashion. It's very difficult for a company to continue to appeal to a grandfather generation, a parent generation, a child generation, and a grandchild generation. It's just, consumer preference, especially in consumer goods, consumer preferences are geared to be rebellious, just like your teenage child. And, so finding the longevity, I think, is a really difficult thing. But if the point that you're making is that if you want, and this may be the follow-up question, may be what you're saying here, is if you want more than 16% per year, you have to be in a place where you sell, and that you have to be smart about the selling strategy. Because you've had, certainly when you have shorter time periods, there are plenty of stocks that you can point to that you would have picked up 20-30% average returns over a decade or longer. And the question just becomes, okay, how long will that last? Can that continue to last? And if it will not continue to last, then, as you point out, a timely sale can be what allows you to keep that return and then plow it into another company that may be at the beginning of what could be their big growth spurt.
I just sent a screen share over, Natasha, if you can release it. So just for context of how hard it is to get these levels of return, you have to buy at the scariest, hardest time to buy and get really lucky with what happens after it. So this is from that March 9, 2009, the bottom. S&P 500 is 11 bagger. It's up over 1,000%, 16.3% in returns. And that's coming up. We just passed the anniversary of 16 years. QQQ, that's the NASDAQ 100, 21% annualized, which over that period, again, over long term, you start stretching it out and you look at that and you're like, well, that's only, 4.6% a year better. Over 17 years, it's worth twice as much money, right? Because 4% return over that many years is about doubles your money. So it's again, this is a remarkable period of time. And I think the better question, the reason I bring that up, Dan, is I think the better question for investors to ask themselves is, what is a reasonable expectation that you should have for the kind of returns that you can get going forward? And I think if you're looking backwards and you're cherry picking the dates, because if you torture the numbers the right way, Dan, they'll tell you exactly what you want to hear. We could look at.
You don't even have to cherry pick anymore, though, buddy. I mean, it's I feel it's been long enough that it's hard to pick a period where stocks have done badly over 10-year period.
But I think that's dangerous. That's exactly my point.
It's incredibly dangerous, and it has built a generation of investors who expect 20% per year. And it's like, if they don't get 20%, they're sort of like, well, what am I thinking? And the long term, I just hope that for their sake, that we don't get a period like the 70s where you have outright flat performance for a decade.
Right.
And and it just it's like a dead money period for people who just had overly inflated expectations based on what has been a remarkable period in the stock market.
I think you and I and Besties just mind melded, because as we were saying, guys, what are you expecting? And let's be realistic about it. Bestie shared in here Jayson, you're not going to get the CAGR I cited. Those are extremely rare. Most should not expect. All should not expect those CAGRs, because I can promise you the best investors in the world that are investing in stocks are not trying to get a certain level of return. They are trying to get the best that they can or get an acceptable rate of return, right? I think
Warren
that's
Buffett, $300 billion, 4 to 5% in cash. Do
Right.
your math.
right.
And that's
think
where I want to end. I want to end with Smack Jack from 10 minutes ago. What about retirees? You need the money sooner
Yes.
than long term.
Yes.
You know, yeah, we've been long term, and there comes a time when you start liquidating these holdings where you start looking for the exit, where you have to reverse the process and say, hey, I need this money now. How do I preserve my capital in a way that, yes, I expect to live in retirement for 10, 20, 30 years. So I'm not going to sell everything right now, but what do I keep? What do I sell? That is something that's very important. And in many ways, it reverses kind of the process that we've been talking about, culling those companies that no longer, they may be fine companies, they may continue to go up, but at the same time, you're ready to cash in. And that's a perfectly acceptable thing to do and necessary, because you need to take those. Now suddenly it's a short-term financial need, and you need to get that done sooner than later. Make sure that you've got the cash. You're not exposed to market risk anymore with that portion of your cash.
Dan, it turns into triage when you're in the emergency room. You have to deal with the immediate need first. And as investors, we fall in love with our winners. We fall in love with them. And sometimes it pulls us away from remembering why we're doing it. And we're doing it to provide for ourselves in the real world. And sometimes that means when the real world need is now, then you have to sell your favorite business and turn it into money. So we just have to do that. Dan, I think we're
at
up
time.
against it. We are. Dan Orelli and Lou Whiteman. This was great, Dan. This was awesome.
Appreciate it, Jayson.
You got it. We're out of here, fools. We're gonna here's the keys. They're yours.
I don't want Brian, you take them. I don't trust myself. Hey, Brian.
Hey, how's it going?
I'm all right. Fools, hi. I'm Lou Whiteman. That's Brian Orelli. We are here. It is the Healthcare Power Hour because nobody changed it after Keith couldn't do it. But Brian, you can do the heavy lifting on that. I can try and help out with everything else.
Yeah.
Fools, as always, a reminder at the top of the hour, this is for educational purposes. We're here giving our own opinions, our thoughts on things. This does not constitute personalized financial advice. We are not here to give personal financial advice. We are not here to speak for the Motley Fool. It's a motley group. We will let everybody speak for themselves, but we are here to answer your questions. It's Slido, keyword Fool24. Brian, how you doing today?
Good.
All right. Well, I mean, it is the Healthcare Power Hour. I don't want to lean too heavily on you, but because that's what's in there, I know some are coming in, so you want to go ahead and start and see where this goes.
Yeah, we can start with one from when I left off last night and didn't get to. Jennifer asked about Alnylam, ticker is ALNY, and Immunocore, IMMUNOCORE. That's how you spell the name, and the ticker is IMCR. So let's start with Alnylam. So this is an RNAi company. They basically do the exact opposite of Moderna and BioNTech. So BioNTech and Moderna are putting mRNA into the cells and trying to get them to express a protein from the mRNA. So that would be like the outside of the COVID-19 virus, the virus that causes COVID-19. And so you would express that protein, and then it would expose the immune system to that protein. Alnylam is using RNAi, which is RNA interference. And so literally it's the exact opposite. They're putting in a drug that binds to the mRNA that's already expressed by the cell and causes the mRNA to be degraded, and then you don't have any mRNA. And so if you don't have any mRNA, then you don't have any protein. So they're trying to get rid of the protein. So they've got 2 drugs on the market, or they've got 4 drugs on the market, 2 for TTR amyloidosis, and then 2 for sort of rare diseases that generate some sales, but aren't big sellers for sure. They have a PDUFA date, so that's the Prescription Drug User Fee Act date. So that's the date at which the FDA says is their goal for deciding on approval of a TTR amyloidosis drug. So their drug, the TTR amyloidosis, is caused by the TTR protein becoming aggregating and ending up stuck in the nervous system or the heart. So their current drugs are approved for when it gets stuck in the nervous system, and they're trying to get one of them approved for it being stuck in the heart, and that's a much bigger market. More competition too, because they've got competition from Pfizer and from Bridge Bio that just got theirs approved in December, I think. So lots going on with Alnylam. I think the valuation might be. I think the valuation might be a little high because I think that the competition in the cardiomyopathy version of TTR amyloidosis is probably going to be more difficult than the neuropathy, and so I think that it's going to be difficult for them to create a blockbuster. And then on Immunocore, that this company already has one drug on the market. Its sales were $841 million in the fourth quarter and $310 for the whole year. So you can see that revenue is accelerating there, and they expect to continue growing sales in 2025. It's a $1.5 billion company, so that seems pretty reasonable valuation. Last year's sales were $310 million, and if you take the fourth quarter and multiply by 4, we're looking at more like 340 million. So they're trading at less than 5 times sales, which seems reasonable for a drug that's continuing to increase in the amount that they're selling, and they've got plenty of cash. They're not profitable yet, but they've got they had 820 million in cash. So if you subtract out the 820 million, they do have they have a loan that already got they had a loan that they paid off in November. So they have 820 million in cash, and so if you subtract that out from the 1.5 billion market cap that they have right now, it seems like a pretty good valuation at 700 million intrinsic value. So I think this, of the two, I think Immunocore looks like a more solid valuation than Alnylam personally.
So a question on mRNA, and this is more, not as a science question, but as an investor question. This has been kind of with the COVID vaccines, mRNA, some of the pushback has hit that. There was a story on NPR this morning about the NIH telling scientists to scrub mRNA.
I saw that.
Is there, and again, I don't want to get into the science of it here, because I do think I don't know. But is there an investor risk, or is this something that you need to calculate as you're considering it? Or is this sort of like just good, like a lot of the stuff, good companies can overcome this over time. It's more of a near term, if anything, than it is a long term. I'm just kind of curious how stories like that, if you saw that, like, does it play into your investor brain, or is it just noise that you try to ignore as you're analyzing a company?
Yeah, I mean, obviously there's a slight risk, but I don't know. I sort of hope science wins out.
Mm-hmm.
Maybe I'm being a naive, scientist here. But I feel like, eventually science is going to win out. And so, yes, there may be some people who don't take vaccines because, they become paranoid or have government, whatever the current thoughts on the government are. But I don't think that it's, I think it's more likely that I think the driving force of whether COVID-19 vaccines get used is going to be whether people get sick from COVID-19, right? So I don't know.
Right.
I just my wife's coworker just got COVID-19, and we were just discussing, like, we couldn't remember the last person before that had gotten COVID, that we'd heard gotten COVID-19. So it felt like it's kind of taken a back burner. And I think anytime it takes a back burner, it's probably less likely that people will end up getting the COVID-19 vaccine. Now, how that's going to affect, I mean, like if you have a cancer drug that's using mRNA that's working, I mean, I have a hard time believing people are going to be like, no, give me mRNA because, I mean, like if the doctor's saying this is going to help extend your life by multiple, by months or years, I think most people would end up taking that regardless of whether they were worried about an mRNA. And let's be real, our cells are making mRNA every second of every day. So I'm not exactly sure, you can worry about the products that are given along with the mRNA, and you can maybe worry about the expression of the proteins that are involved in it. But the mRNA itself is benign. It's what the mRNA does that could potentially be causing problems. And it's also they put it in a sort of fatty lipid so that it protects the mRNA and also allows it to fuse with the cell membrane and allow the mRNA to get into the cells. So, those two things you can be worried about, but the actual mRNA is not actually an issue in and of itself. It's a natural molecule that's in your body already.
I guess this is a great example why to be long-term focused investors, because let the noise happen and then let the science play out and see what happens there. Yeah, that's good. All right. Well, this isn't a healthcare stock, but it's a company that has been on the operating table in triage in the ER for a long time now. So, pick your metaphor. I think it counts. T-Stock 13 minutes ago asked, thoughts on Boeing? The ticker is BA. Price now is just a little higher than it was in 2015 and has been crashing and sputtering since 2020. Fasten the seatbelts or jump. Well, Boeing is down big from where it was. And I think as anybody who has read a newspaper or has looked at the news in the last 5 to 10 years knows there's pretty good reasons for that. There was the 737 MAX and the fallout from that being grounded 18 months. A lot of the fallout was just a deep dive into how the company has done business and its engineering, and it only got scarier as it went. We have since had problems with the 787 Dreamliner. We are way behind on the new version of 777X. The defense business is arguably more screwed up right now than commercial. The tanker program that is one of their main programs, a program that, by the way, Boeing executives a decade ago went to jail over the procurement of that. It came in basically double the budget, which Boeing had to swallow. And even when they delivered them, they had to be returned because they were spare parts that were just left in the hull rattling around that they forgot to take out. This is a business like GE in the last decade that every time you thought it was safe to go back into water, there's a Jaws sequel. Every quarter is a one more thing, but not in the way that Steve Jobs used to do it, which was a good thing. It was always a bad thing. So yes, on paper, Boeing is one half of a global duopoly selling into a market where demand is growing. It should work from here. The stock is undervalued relative to a well-performing Boeing. But this business will take quarters, if not years, to turn around. And we don't yet know if all of the demons have been expelled yet. We're still waiting for proof of concept that they can actually do this. To me, it's too hard. I don't want to be involved because even if this is the bottom and it's up from here, it is a multi-year process. And I don't think in year one, they're necessarily going to lap the S&P 500 until this company can prove that both on the commercial and the defense side, that it can fly straight. I don't think anyone should get involved. I just don't. I think on paper, it makes sense from here. There's a lot it has going for it, just its inherent advantages. But sometimes companies break. And when they break on an engineering level, on a fundamental level, it can take a lot longer than it seems like it should for it to recover. So I think we need to see signs that that turnaround has actually begun before I would even consider investing my money in. All right, what else you got, Brian?
Steve asked about Cigna, the ticker is CI, they're a health insurance company, my insurance company, in fact, but I'm not a shareholder. I tend to stay away from insurance companies mostly because, I don't know, I feel like it's a guessing game. in any given year, whether they're, whether we're going to have a good or bad flu season, whether there's going to be an outbreak of some other disease, whether, the math people are pretty good at mathing, and they're pretty good at figuring out, if we have X number of patients and they're X number of ages, we're expecting, Y, Z number of amounts of costs, and so we can set our premiums at this and pocket the difference between the premiums and the amount that their costs are. But there's some variability, like the flu season, where they can't exactly figure it out, right? And so that makes it difficult on a year-to-year basis. Last year was great. They increased revenue 27%, so they were doing well there, and they're expecting, they're expecting income from operations to be at least 7.9 billion, or 29.50 per share, and that's up from 2024, which was 7.7 billion. So they're not expecting, in 2025, they're not even expecting income from operations, adjusted income from operations, to grow by even 5%. It's going to go up 0.2 billion off of a $7.7 billion average. So, I think that it's, even though they grew revenues really fast in 2024, 2025, at least on the bottom line, is not going to be looking that great in growth. So I'm not super excited about insurance companies in general, just because it can be up and down and wavy. I mean, I guess if you're going to hold them for years, maybe you don't care. You just sort of invest in the best one. I sort of think that, that might be United over the long term, just because of how big they are. And I think there's a lot of advantages to being big, and they have a lot of other outside, beyond being just an insurance company. They have other options. And then, so I think maybe United Healthcare, the ticker is UNH, might be a better option than Cigna. But the other thing that you have to be concerned about if you're owning insurance companies is, do they have a pharmacy benefit manager, and is the government going to do something about that? So these pharmacy benefit managers are supposed to negotiate with the drug companies and get lower prices for the companies that they insure for, that a lot of the companies are like self-insured. So they don't actually, like United Health doesn't actually cover the insurance. They're literally just, processing the claims, and then whether, the money that that is cost, the medical costs are passed on to the company that's self-insured. And so they're supposed to be saving those companies money by negotiating with the drug companies. What they do in reality is they negotiate with the companies and then pocket a large portion of that savings, so that the self-insured companies don't actually end up saving that much. And that's become a contentious issue, and the government has threatened to take action. What that action might be, and if it might happen, and when it might happen, I think are all up in the air and beyond my knowledge base to be able to try to figure out. But if you are investing in health insurance companies, you need to make sure that you're okay with taking on that risk, because I think if the government does act, I think that the health insurance companies, if they lose their pharmacy benefit managers, could, that I think there's some synergies there that are benefiting the health insurers. And if they lose the pharmacy benefit managers, they're going to lose that income that they pocket for the negotiation, plus they're going to lose the synergies. And so I think that that's a big risk that is, in my mind, an unknown risk in terms of the likelihood that it'll come to fruition.
Yeah, health insurance is so interesting to me, because my background was in financials, and I spend a lot of time with financial services companies, and I like insurance companies. I've found good investments there, but health insurance, maybe I'm just showing myself as a simpleton, but the idea of insurance is that we all pool a little bit of money to protect against the unlikely. So like Brian and I both pay in for home insurance, knowing that most people, the house won't burn down, right? And that is how insurance works. Healthcare, everybody needs healthcare. Everybody gets sick. So the idea of it, like as an insurance model, kind of as you say, it's really hard to run it as a profitable business, even without the wild card of, as you say, if they actually do manage to be profitable, the government comes knocking at the door. So it's just it is such a, I think, a really hard thing from an investor perspective to get right. It scares me away. Other forms of insurance, I do think you can kind of model it out, but again, it's the model for insurance is that the payouts aren't likely, and in health insurance, the payoffs are inevitable. So yeah, it's a weird thing. And as you say, they kind of have tried to get into other markets to make it easier, but there's all sorts of issues there too, right? Yeah, I mean, they've just it's been a tough industry to love, and I think for pretty good fundamental reasons, it's not easily fixed.
Yeah, I was on with somebody the other day, and they said, like, if health insurance was like car insurance, if car insurance was like health insurance, then not only would you get paid, would you get payout when you had an accident, but you get a payout when you needed an oil change,
right? Right.
Like,
and in fact, the oil changes would be free to make it more likely less likely you end up crashing the car, right? I mean, you'd have preventative care for free, but then inevitably at some point the car breaks down, right? And if there has to be a payout when the car breaks down, well, I mean, I'm not the same fully functioning automobile I was 30 years ago, unfortunately. So, at some extent, my health insurance is going to pay out. It's not an if, it's a when, and that's just a whole different thing to model for a public for-profit entity to do. Yeah, it's tough. It's tough.
Yeah.
All right, we have two separate questions about one industry. So I was thinking maybe I could answer them together. Just 9-10 minutes ago, Sadaf asked, Lou, any thoughts on Joby's new announcement of a partnership with Virgin Atlantic? JOBY is the ticker there. And then about 2 hours ago, Besties, but I know Besties is still on here, says, does Archer go after military contracts? The thing may be more useful in a battlefield than transporting you to your job. So both Joby and Archer, which is ACHR is the ticker, they are in the flying taxi market. They are the eVTOLs is what they're called. They're electric vertical takeoff and landing things. Think kind of a hybrid small plane helicopter. It's got wings, but the rotors can go straight up, so you can take off vertically, zoom over traffic for a short distance with battery power and get to your destination. These are coming maybe as soon as this year. And these are the two companies that are among maybe almost a dozen SPACs that are trying this. And we have had some zeros. We will have some more zeros, but these are the two out in front. So the two questions, Joby, this is business as usual for them. They're already partnered with Delta and a few other airlines. Their model is more of the traditional aerospace model, where they don't necessarily want to be Uber, where they're running service and stuff. They want to sell these to operators. Delta, Virgin Atlantic, some of these, you're not going to fly these across the Atlantic. But if you are like in the way outer suburbs of San Diego and you need to get to San Diego airport, you may be willing to pay $100 to Delta to not have to drive in and park your car, or to go from a local terminal. There's a lot of potential applications. So as far as Joby goes, Joby is a quieter company than Archer, but this is just business as usual for them. They continue to line up partners ahead of what they hope to be a launch probably early next year with regulatory approval, but maybe as soon as the end of this year. Archer, on the other hand, was kind of on a similar trajectory. They wanted to be a little bit more of an operator, but in the last few months yes, they are going after military contracts. And in fact, they seem to have changed their focus. A couple of months ago, they announced a partnership with, I believe it was Anduril Industries, which is Palmer Luckey, the guy who thought up the Oculus and sold Oculus to to Facebook. This is a defense contractor that Palmer Luckey started that is focused on technology and AI. They are partnering and actively going after defense contracts. It's a weird pivot because they're pretty far down the line in one business model, but they haven't launched yet. And they are saying, wait a minute, we're going somewhere else. I don't know if you want to read between the lines about how the original business plan was going. Both Archer and Joby have sent demonstration aircraft to the Air Force. It's just a small deal for the Air Force wanting to play with them. There could be some military applications, but I'd warn you that these battery packs are very heavy. That limits your ability to armor such a thing the way you can with a helicopter or something with just more torque. So I don't know. I think it's almost more in the drone area than it is a real military use. So I'm not honestly sure how that plays out. The one thing I'd say on all of these is right now they are being valued based on their potential. And Brian, I think sometimes this happens in biotech too, where you have a promising technology people are excited about, but it's pre-revenue. And the valuation is set for basically the imaginations of what people think it might do. And then all of a sudden you get government approval, whether it's drugs or airplanes, and you start having to manufacture these and sell them, and you actually get to set a price and see a balance sheet. It tends sometimes to shift the investor base from the dreamers to the industry types, and it can affect valuation. Right now, I think the valuations in this sector are very much set for best case scenario daydream land versus the realities of having to build pretty expensive, complex machines and sell them at a margin. And so I wouldn't be surprised. These can be winners over the long term, but I wouldn't be surprised that even though the news is increasingly good as they come towards a rollout, I wouldn't be surprised if you see a lot of volatility in valuation as people start going from imagining what these things could be worth to actually seeing what the market price is in and the realities of the cost of having to build them. So that's a quick overview of those. Would be a lot of fun. I'm in Atlanta. You're in Southern California. We could both use a way to get through traffic. Yes.
Yeah, I mean, even going into like you wouldn't ever fly to Orange County from San Diego. It's like a 2-hour drive, but it could be it'd be a very short flight in one of these things. I think that's sort of that would be the sort of idea that I would think of more than trying to get yourself to a major airport would be just hopping from an area to an area, from one area to another area and avoiding, huge amounts of traffic and even to get all the way to LA, it's in theory with no traffic, it's a less than 2-hour drive, but it could easily be 4 if the traffic's bad, so a short flight would easily justify driving to an airport, going to another, flying to another airport, and then having to take an Uber to your actual final destination.
Yeah, it's not what we were promised in the Jetsons, but it's kind of cool.
Yeah,
it's something. Yeah. Yeah. All right. Well, what else we got?
Yeah. So Good Driver asks about comments on Organon. The ticker is OGN. So this is the spin out from Merck that they spun out a few years ago, and the company has made it very clear with their annual, their financials, the reason why Merck spun them out, because they've been growing very, very, very slowly. I mean, technically, they were positive. They had positive growth in 2025, but it was just 2% growth, if 3% if you exclude the changes in currencies. So very slow grower, and the biggest growth they're seeing is in biosimilars. So these are generic versions of biologic molecules, and they're called biosimilars because you can't really develop something that's exact same like you can for a small molecule that's synthesized chemically. These are synthesized in cells and then purified, and so because the synthesis in the cells and the purification are proprietary still, they can't actually make them exactly the same, but they can make them close enough that the FDA will approve them. And so the sales of that group were up 12% compared to just 4% growth in the women's health and flat in the established brands, and then they have a little bit of drugs that they categorize in the other category, and that was down 6%. But it's not that didn't hurt the company that much because it's just a small amount. So the problem there is that the biosimilars have a worse gross margin because they're competing against branded drugs, so they have to discount them, and they're competing against other biosimilars for the same branded drug, and so again have to discount them. So gross margins dropped from 59.8% to 58%. So that tells you that the moving in the wrong direction, and that resulted in adjusted earnings before interest, taxes, depreciation, and amortization only going up 1%. So even though revenue was up 2%, the bottom line growth was only up 1%, and next year isn't looking any better. So the revenue is expected to fall between 6.125 billion and 6.325 billion, and last year's revenue was 6.4 billion. So they're expecting to, even the top of the range is below the revenue for 2024. Now, some of that is due to 200 million in currency change headwinds. So in theory, if you add those back in, then you're at the bottom of the range is at 6.325, and they're at 6.4 billion. So they're sort of bracketing then the revenue. The revenue guidance for 2025 is bracketing the revenue actual for 2024. But in the end, I don't think this is a very exciting company. And again, I think that it was, clear the reason why Merck spun off all these products was because they weren't growing very fast. And so, even though the company is trading at like price to sales ratio of 0.637, which is, just crazy low for, a biotech company. Even the slowest growing biotech company grows at, it usually can have a 2 to 4 price to, somewhere in the 2 to 4 range for price to sales ratio. So 0.63 billion is pretty low, and I think it's due to the fact that they have more biosimilars and that established drugs, which is basically just drugs that are branded but have generic competition, and that is resulting in low gross margins. And so, lower gross margins than your average pharmaceutical company would have. And so while you would normally, expect the price to sales ratio to be higher, the reason why it's lower is because less of that sales is going to the bottom line. So, if you, while I normally like to look at companies on a price to sales ratio in the pharmaceutical industry, because there's a lot of variance in the earnings, because they a lot of times have one-time payments to their partners if they, for instance, get a drug approved or have a positive phase 3 clinical trial or meet a sales milestone. They'll end up, paying billions of dollars to the partner for those successes, and so that can wreak havoc on the bottom line. So it's usually easier to measure pharmaceutical valuations on price to sales ratios, but in this case it becomes pretty hard because of how crazy low the valuation is. But I think there's definitely reason to expect that to continue based on the growth rate of Organon, and then the fact that the gross margins are actually going down.
All right. This is a fun one from Cornelius about 10 minutes ago, citing, I guess, Goldman Sachs report. AI could replace the equivalent of 300 million full-time jobs, according to Goldman Sachs. Your thoughts on how this change will affect the stock market? Well, the stock market, Cornelius, I might argue that, look, the Wall Street stock market tries to be a forward-looking machine, and I'd note that NVIDIA is up, I think, 2,200% over the last 5 years. I would argue that a lot of what we've seen the Mag 7 and what we've seen is actually the stock market being affected by projections like this. And now, of course, we have to see that pay off and see that whatever come true. 300 million jobs is a scary thing. I mean, I'd note, though, that there were textile riots in the 1900s in the United Kingdom during the Industrial Revolution. There was talk of the automobile and all the jobs that it would destroy and all of that back in the day. Technology, new tech, whatever it is, tends to have a disruption on the way we do things today. And that tends to lead to jobs that were needed before to no longer be needed. The automobile comes along, we don't need as many stable hands because we don't have as many horses in cities. Those sorts of projections tend to underestimate the job creation that can come out of innovation and the way work can evolve. So I don't think it is, I think the optimism, arguably, at least some of it's already priced in. And I don't think the pessimism long-term has ever been proven out on technology as a destroyer of jobs. Yes, it can destroy categories of jobs. Yes, it can cause near-term disruption. And yes, it can cause a lot of societal chaos. But we have been through a lot of technological innovation over the years that seemingly wiped out certain types of jobs or certain industries. And we have always seemingly found new ways to grow into that innovation. So I can't tell you it keeps me up at night personally. Brian, I don't know if you have any thoughts there. That is the biggest of big picture questions, but I don't know. I don't know. Other than I'd say a lot of NVIDIA from the last few years is based on stuff just like this. So it already has impacted the stock market.
Okay, you want to hear my number one red flag for biotech companies?
Please.
That they issue their 10Q or 10K and they don't press release it. Like if your numbers are so bad that you don't want people to know that you issued your 10K, I feel like that's a huge red flag.
Now, do you mean companies that like don't do a press release for earnings, but then just file their 10Q and say, or do you mean like separate when the 10K, if it doesn't come out with earnings, if they don't do something separate?
No, that they just don't issue it at all. They don't even like point out the fact that their quarter has ended or whatever. So Vihan asks about a company called Lexaria, Lexaria. The ticker is LEXX. And so I went to go look at the first thing. So the first thing I did was looked at the size, and it's $25 million company. So that tells me investors think it's going broke, right? Because a $25 million biotech is a really low valuation. They're giving no value. So then I thought, okay, well, let's go see how much cash they have, because that would be clear. That's probably the reason why, is because they probably have very little cash. So I go to the press release, the area of their company, and there's no press release anywhere in the last, since December, that shows that, at least not one that I can find, that shows that they, released fourth quarter earnings. Turns out that they're a little bit off cycle than everybody else, and their quarter, which, let's see what fiscal, whatever their fiscal quarter, so it must have not been a year because it's not a 10K, ended on November 30th. So they're off a little bit, but it got issued on the 10th of January, and they didn't bother to press release it. And I think the reason why they didn't bother to press release it was because they only had $8 million in cash then. So this company, it looks like they have a GLP-1 drug, but with $8 million in cash and a $25 million market cap, I wouldn't touch. I mean, I wouldn't even go any further and look at any further at this company, because yes, maybe it can, double, triple, quadruple. I mean, it could 10x to a $250 million market cap, and that would still be a small biotech, that So there's clearly the market is either knows nothing about this company, which isn't true because there's a lot of people that are a lot smarter than me who would be investing in this company if it was worth a heck of a lot more than $25 million. And so that just right there tells me that it's probably going to go bankrupt before it can develop additional products. And if it has to raise additional capital to run a clinical trials run, 100 million or more. And even a small, phase 2 clinical trial is probably 25 to 50 million. So how are they going to run that sort of clinical trial on $9 million in capital? They have to do a secondary offering. And how are they going to do a secondary offering with $25 million market cap? If they raise 25 million, they've then their share price is going to get cut in half because they're going to have to double the number of shares to raise that $25 million. So and so it's actually going to be more than that because the people who are going to buy the shares in the secondary offering aren't going to be willing to pay the current valuation. They're going to pay less because they're going to know the shares are going to go down. So that means they're going to have to sell even more than $25 million worth of current share price to sell the shares. So I just think that you're looking for a dilution. This is dilution central here, and so I wouldn't. I don't know. I'm not going to tell you not to invest in it, but because we can't give in personal advice. But I wouldn't. I wouldn't even bother to look at this further, even though it's in the obesity space and obviously has plenty of potential to be a multi-billion-dollar company if they can develop a drug. But my guess is that they don't have the proceeds, and they probably don't have the proceeds because they don't have a good enough drug to justify having the proceeds, because investors will invest in good companies. And so this is telling me that there's a whole bunch of smart people that think this company isn't worth anything.
Yeah, one thing interesting with especially speculative biotech is what you just said, smart people, but so much of it is just kind of on hope or on like what it could become. So you do tend to have really, really smart people who understand the things, who are willing to be kind of more risk tolerant than in other sectors. And yeah, so it's interesting to me that in a world where risk is commonplace or is an accepted cost of doing business, if the smart money isn't willing to take a risk, draw your own conclusions, I guess, right?
Yeah. This is, it's very counterintuitive, but you almost want to invest in a company that has a higher valuation, because then they can raise capital and not dilute their shareholders that much, compared to a company like this where the valuation is very low. And so any capital raise that they do would be a very very speculative, they would end up diluting shareholders substantially. So
makes sense. Yeah. All right, besties, this was a couple of hours ago, but I feel like you're talking to me, besties, and I know you're on because you're asking me a lot of good questions. So I love these though. And sorry, as my dog gets involved, but besties asked a couple of hours ago, do Apple and Meta do defense contracts? What are they doing? Do they fall in the line of more is less in terms of defense purchases? Besties, let me tell you something about the JEDI contract. And, government, they love to name things. This was the Joint Enterprise Defense Infrastructure, which was basically the huge Pentagon secured cloud that they were going to put together. And yeah, I don't think Meta got involved, but Google, Amazon, Microsoft, all of these guys wanted a piece. They ended up just fighting with each other, and the whole thing got flushed. The Pentagon ended up awarding something else. They canceled JEDI. They came up with a much worse acronym. I think it was JWCC. But you couldn't call it the return of Jedi. But that ended up going to Oracle, Amazon, Google, and Microsoft. But one of the things that came out of this, and one of the real problems is that, and this is underappreciated with the defense sector, one of the core competencies of the defense contractor is their willingness and ability to engage with the government as a buyer. Government procurement is nothing like anything you see in the private sector. It is, famously weird, different, whatever. It takes a certain skill set to navigate that process without basically having your head explode. And in this contract, and there was a lot of great back and forth and fun lawsuits and all sorts of stuff you can read, but you can actually watch really smart people at Amazon, at Microsoft, at Google, watching their heads explode in court filings as they went through this, just because the real issue big tech has is just trying to deal with the Pentagon and understand the Pentagon. You mentioned the idea for consumer scalable products to be transformed into something for defense. I would point you to Microsoft. I think early part of this decade, they got a contract to use HoloLens technology for the new military visor. So the idea that this HoloLens that they were developing for Xbox and all that, soldiers wearing that into battle to be able to see around corners and night vision and all that, they abandoned that about a year ago just because it was too complex of requirements and stuff. It's just really, really, really hard for these companies to exist inside the government's world and to understand government requirements and act on it. It sounds simple. It sounds like I'm almost being condescending towards them, but we've seen the same thing. Like Lockheed Martin had a great IT business, great consulting business. They said, why don't we also use this capability to sell to the private sector? They ended up spinning that out as a loss just because they didn't know how to talk to corporate customers. There are opportunities there, and especially as defense, like every other industry, goes digital, and so much more of the value is cut in the brains behind something instead of just the metal of something, just like with all industries. But it is really, really a vexing problem for even these huge, diverse, deep-pocketed companies to try to penetrate the Pentagon and do business there, and most of them just decide to go elsewhere. So that's why you don't see companies like big tech often involved with the Pentagon, other than at the fringes.
Another question from Besties. They say healthcare again. How much do you and members have in your portfolio allocated to healthcare? It can't be a large portion of it, can it? How much you want to disclose, Lou? How much healthcare?
So due to my spouse's job, I am not allowed. Actually, this is a great story, Brian. I missed the top on Teladoc by like a day and a half because when the new rules they came out annually, they added Teladoc to the stocks she couldn't sell. So we went ahead and sold my Teladoc in whatever when I could in full rules. And whenever it was, and I remember I was really ticked off I had to do it at the time, we missed the all-time peak by about 24 hours there. So that's why it's better to be lucky so I have zero in my individual stock portfolio. But I gotta say, even if I didn't, healthcare scares me enough in terms of high risk, high reward that it wouldn't be a large percentage either way.
I'm probably pushing 20%, I think. I think just because healthcare is so cheap right now, I sort of go between 5 and 20%, depending on how cheap I think healthcare is. And it just keeps getting cheaper and cheaper over the last few years. And so I've been increasing my position. I probably won't go higher than the current 20% or so that it is right now. I think that maybe that's a little risky for some people, but I think that there's more upside. There's a lot more upside than downside in the healthcare sector, especially in small biotechs right now, because they're so low valuation. For the rates, interest rates going down in and of themselves should result in the biotech sector going higher, just because the cost of capital and the ability and the risk-free return will be so much lower that investors will be willing to take on additional risk by buying biotechs to increase their likelihood of outperforming. And so therefore the share prices should go up solely on that. So beyond that, I think there's just a lot of opportunities in the biotech sector. I think there's a lot of crap in the biotech sector too. But I think it's pretty easy to figure out the crap and avoid it. And so you should be able to outperform the biotech. As an individual investor, you should be able to outperform the indices for the biotech sector solely on the fact that you can avoid the crap, and the crap is still in the ETFs.
So let's peel back this onion a little bit, because I think it's interesting to me. I think it might be interesting to members. So 20% or so, you say. What do you like? I'm just curious, like how healthcare fits into just a broader portfolio. What would you say that other 80%? Are you a generalist? Do you prefer ballast stocks? Are you looking for big tech growth, or kind of how do you balance out that 20 that you say can be risky, but you see where you have advantages and you can find good companies? How do you balance that with the rest of your portfolio? What else goes in there?
The other 80% is in 2 ETFs. Like I don't invest in any other individual stocks, mostly just because it's outside of my area of expertise. And I figure if I just match the stock market, I should do just fine if I can get that other 5 to 20%, depending on the valuations of the biotech sector. And I invest in a lot of picks and shovels for the biotech industries as well. So the other 2 is 80% of the 80% is in the VTI, the total stock market index for Vanguard, and the other one's in the Vanguard that follows the Russell 2000, the other 20%, just because the VTI, the total stock market index is cap weighted. So that means you're buying a lot of large cap companies. The $1 trillion companies are going to make up a large percentage of that total stock market index.
Right.
And so I buy some additional small cap companies to balance that out, so that I can have a little bit more growth in terms of the smaller companies that could potentially become those next multi-billion-dollar.
Right. No, I love that because history shows and of course we don't know the future, but over time, owning the market, you will get rich slowly, but you will get rich just fine. So put most of the money there, and then just kind of an area where you have a competitive advantage, or where you have just kind of an understanding. That's where you kind of stick your neck out and have that security of the money. I think that's a great plan for a lot of people. Yeah, that's neat. Thanks for that. That's cool. All right, I'm going to take another besties real quick, just because we're going to have to pick on besties some other time. But these are good questions. Lou, I would love to invest in Anduril. Any companies like that or comparables we can invest in? Yeah, I mentioned it earlier. That's Palmer Luckey, the guy from Oculus. That's his defense company specializing in automation. It is very private. I think Palmer wants to keep it private, at least for now. So automation, drones, AeroVironment, AVAV, has been one that's gotten a lot of attention thanks to its tools being used in Ukraine to some success. Arguably, it is very highly valued. Another way to kind of play similar would be Kratos Defense and Security. I think in Brian's backyard in Southern California, they make bigger drones and some really cool science fiction sort of things, where, like, imagine a mini F-35 or a swarm of them that would go into battle along with an F-35, read what the piloted plane is doing, adjust to that. So you basically have the equivalent of 12 F-35s working in harmony with only one crew. It's great for, in terms of just, if nothing else, helping survival rates, because it just gives radar systems a lot more targets. That's much more experimental, but is there. KTOS is their ticker. It's another one. And then also, if you want something that's just a little more stable, but has some of it, the largest of the Beltway bandits, the government IT companies, a company called Leidos Holdings, LDOS, they have bought a couple of pretty high-tech kind of almost research departments that have really focused on bleeding edge space, bleeding edge defense tech. It's really neat. Whether or not it ever pays off, we'll ever see, but that could be said about Anduril too. But Leidos kind of gives you some exposure to that, along with a lot of other businesses that are more reliable. So just a few thoughts, but no, you can't replicate that. And I think that's by design with the Anduril. All right, what else you got, Brian?
I got a question that isn't from Besties.
All right, good. Let's do it.
John asks, are any thoughts on Dexcom, tickers DXCM, and Pfizer, tickers PFE at these valuations? These seem to be strong companies with fantastic tailwinds. So I'd say yes on the tailwinds for Dexcom, at least currently, and maybe not so much tailwinds for Pfizer. But I think both of them are good valuations at their current level. So Dexcom makes glucose monitors. They're up to the G7 version of it, and the growth in the fourth quarter was just 8%. But the full year was 11%, and more importantly, they're looking for revenue in 2025 because they're launching some new products. Including the G7 that can stay on the body for 15 days. They're looking for growth in 2025 to be at 14%. So the PE for the company is pretty high. It's at 50.4. So that's still, that's pretty high for something that's growing at 14%, but it's down from in the hundreds, just a few years ago. So it's a much better valuation now than than before. The price to free cash flows at 47. So again, pretty high, but used to be in the hundreds just a few years ago. So I think it's an okay valuation, based on history. I think the one issue that you have to worry about with Dexcom is what's happening with what's going to happen with glucose monitors as people continue to take obesity drugs. So, obesity can lead to type 2 diabetes. And so therefore, if patients are getting off the weight before they become type 2 diabetics, they may not end up needing a glucose monitor. And so there's risk there. I think that there's not really a big risk to the current population of patients that are using Dexcom's glucose monitors, because even if you lose the weight, you're probably still going to be monitoring your glucose because you're probably still going to have type 2 diabetes, even if you do lose the weight, although you may be in better shape and not taking insulin as much, but monitoring the glucose is still going to be a thing that patients will want to do. So there's probably no real threat to their current patients, but in terms of future growth, there could be an issue there. Pfizer is facing a patent cliff, so it looks really, really cheap right now, and trades it has a dividend yield of like 6% percent. And so I think that it looks very cheap, and you're getting paid to wait for growth. But I wouldn't expect the valuation to continue to look that cheap. There's going to be a slowing of the sales, and then therefore then the measurements on a price to sales ratio or a PE or price to free cash flow ratio is going to go down, the price is going to go up, or the amount is going to go up, and the price isn't going to go up that much. So the valuations are going to come up a little bit and look actually worse, but because the growth has slowed down. So overall, I think Pfizer is a good buy on a risk reward basis, right? So it's not as risky as Dexcom, but you're probably not going to get as big of a return. If you can get the 6% dividend, then you really only need 3-4% growth in the revenue, which should translate to 3 to 4% growth in the valuation, in the share price. And so then you're looking at an 8 to 10% return, which is not as good as you would hope for the S&P 500, but you have less risk, and it might grow. I think it's going to grow steadily versus dropping substantially, and if we end up in a recession, where Dexcom is a little more risky because it's growing at 14% revenue, or it's expected to grow at 14% revenue according to the management. there's more risk in terms of if they don't hit those numbers, the share price is going to fall substantially. So there's, more upside, and you're probably going to get a better return with Dexcom if everything goes well. If everything goes well with Dexcom and everything goes well with Pfizer, you're going to get a better return on your capital, your investment from Dexcom, I would think. But it's probably, there's more risk of you losing more money than investing in Pfizer, especially considering there's that 6% dividend yield that you're going to get. The 6% dividend yield also provides a lot of downside protection for the stock price, because if the stock drops even further, then the dividend yield goes up even further, assuming they don't cut the dividend, and that allows them to, then that would attract even more dividend seekers, and so that would cause them to buy and sort of creates a floor in the potential price of Pfizer. So I feel like there's very little downside risk to Pfizer compared to the downside risk to Dexcom.
Sounds good. All right, and besties, I love you. I'm going to go back to it one more time, but it's because we are going to do an official Motley Fool programming tease here, which, the bosses love that, right, Brian? So we got to do that. But Bestie said, Lou, appreciate the response about navigating Department of Defense. It basically says Palantir may be the best at navigating both defense and commercial. Palantir PLTR, as I'm sure everyone knows. All I'd say there, Besties, is maybe not so fast, my friend, because we will see about that. I would note that Palantir only went public in late 2021. At the time, if you read the S1, they were talking about 40% annualized commercial growth. They have delivered closer to 15%, which again is 15% growth. We're not going to sneeze at, but I do think that if you hooked up Palantir on their fancy software and actually got truth serum out of them, they would say that they have found the transition to commercial to be a lot tougher than they thought, as evidenced by they've been doing a lot of things. Like a lot of that commercial growth has come from me giving Brian money that Brian then agrees to use to buy my product. Palantir has done a lot of equity investments in companies that turn around and spend and really, really contribute to Palantir's commercial growth. So we'll see if that's sustainable, but definitely they are attempting it. The teases, though, Brian, are you aware we are doing a bold prediction show now, right?
Yeah, in the final hour of the day, each day.
Boldly predicting. I am going to boldly predict that Palantir will be a featured topic on that show tonight. So, besties,
I feel like
know
you have
you're
some
here
inside
right here.
knowledge here.
I do. Well, maybe, or maybe I'm just being bold about it because we're supposed to be bold in these predictions, right? So, yeah, I boldly challenge you, everybody, to tune in at 7:00. Actually, to remain tuned in, because as much fun as this has been, Brian, we're done. But we have Jayson and Rachel. They can tune in for that, and then they can tune in all the way to 7:00 and see what. Yes, Jayson, the bold predictions, the bald predictions, whatever you want.
Just remember who said that out loud, and it was not me, Lou.
Yeah, Jayson, this is why none of us like you, though.
It's true. I mean, I don't like myself, so the feeling is mutual. All right, Lou,
fair enough. Brian, thank you. It's been fun.
Guys, enjoy the rest of your day,
show, guys.
Oh my gosh.
I'm not trying to kill you, Rachel. I promise.
Are you trying to kill me over here, Jayson?
I saw you laughing and choking. Sorry about that.
Just choking on my lemon water. It's all good.
It's okay. All right. Well, my water doesn't even have lemons in it. So, all right. Well, let's roll into this 3 p.m. Eastern hour. I'm Jayson Hall. That is Rachel Warren. A couple of Motley Fool contributors here, and we're happy to be on. This is the valuation hour. So we're going to talk valuation if you have valuation questions, but there are a ton of questions in the queue. So we're going to try to spend some time going back and answering questions people have asked over the past few hours as much as we can as well. So we're going to do that as much as we can. And Rachel, there's a few stocks that we wanted to highlight, in particular companies that have earnings coming up. So it's kind of a good time to be thinking about those companies in terms of valuation if they're on your watch list and the price looks compelling. But in this case, especially for, I think, Nike and FedEx, investors want to learn more about what's going on with the turnarounds with their business and things they're trying to do to get the ship turned in the right direction. And now, of course, I'm using the metaphor about Carnival Cruise Lines, talking about the other two companies, but Carnival is one that reports this week too that you highlighted.
Yeah, looking at Nike, Carnival, FedEx, obviously these are companies in widely different industries. Nike and FedEx especially have really seen their valuations come down over the last few years, and part of that's been a function of downward pressure, obviously on share prices, and for good reason. I've talked about Nike a lot. This is a business that I follow. I find them interesting. And I think one of the biggest issues that they've had is they are dealing with an increasingly competitive landscape where there are so many of these smaller, up and coming Gen Z, younger millennial focused brands. And as much of sort of this, flagship mainstay status that Nike has, they have been struggling to keep up, and they really haven't had any major, product innovations through the years. I mean, they're obviously known for their athletic footwear, apparel, equipment, accessories. They are, well known for Jordan and all of these other types of brands, but they've been very reliant on these kind of core brands for many years. The market has shifted, consumer appetites have shifted. Even, brands like Dunk and Air Jordan that are classic do not have the same draw that they did maybe 10, 20 years ago. And there's been a real shift there that I think that they have been struggling to figure out exactly how to, realign to. I mean, obviously they're in the midst of this turnaround. They're under the helm of the new CEO, Elliott Hill, is really working on implementing this turnaround plan to revitalize the company's sports roots and really emphasize, athlete-centric product development, and also reviving some of these core running franchises is another thing Hill's talked about, like Pegasus, Structure, Vomero, shifting into sports-led teams that are segmented by men's, women's, and kids. And there's this goal of empowering the nimble, cross-functional teams to assess the needs of sports-specific athletes. I think Nike even announced that they were going to be entering into a partnership with Skims, which was kind of the first major, brand partnership innovation we've seen from them in years, Nike Skims. And obviously Skims has, cult-like status among a wide range of shoppers and consumers. Right now, Nike is also dealing with an issue where they're working to clear out older inventory to make way for newer premium priced products. They're trying to clean up their marketplace, slash back some of this promotional environment that they've been operating in. And I think analysts, broadly are expecting short-term margin pressure as Nike implements its turnaround plan. And by short-term, I mean, that could be numerous quarters or a couple years at least. I think that is probably a pretty reasonable, estimate to be looking at. The other thing I would say is that despite their challenges, Nike has had a pretty good track record of increasing their returns to shareholders. They've been paying a dividend that they've, I think, increased pretty regularly for over 20 years at this point. They have a lot of debt they need to be working down as well. I think they had a debt to equity ratio of somewhere around 85% last I checked. So there's a lot for them to implement and prove. I think they report earnings on Thursday of this week. So I'm sure I'll be talking about this company again, but those are kind of some of my thoughts on the business. I think that there's a real opportunity for them if they can affect a turnaround. But with the likes of, On Holdings and Deckers and some of these other businesses that are, I think, continuing to seize market share, they have a bit of an uphill battle at this point, in my opinion.
Yeah, I think that's right. And I'll share a little bit just to actually get into some of the with the theme of valuation. Some things with Nike that I think will be useful for kind of how I've informed my thoughts about the company as well. But before I do that, just a reminder, those of you watching on YouTube, our Motley Fool members who are watching behind the paywall, we use Slido. We have one channel for everybody to submit questions to. So go to slido.com. The event code is Fool24. Get us your questions. Again, whether they're about valuation, or more broadly, we'll do what we can. Rachel knows a lot about a lot of healthcare businesses. In addition to the consumer goods company she follows, I cover a lot of energy things. I cover a lot of companies. I've got a pretty broad knowledge of businesses in general. So we'll be happy to try to answer your question. But just a reminder, too, we're not providing individual investing advice or personalized financial advice. For a million reasons, you don't want just a couple of people on the internet doing that. So remember that when we're answering your question, we're not telling you what to do. So we're happy to share our insights and expertise as much as we can, though. Okay, so I'm going to bring up on the screen here, Michael, we got producing right now gonna send over a screen share if you can release it. This is, and I've gone back. I'm cherry picking a little bit, but I'm doing this just to kind of keep the data clean. This is going back to the beginning of 2022. We've seen Nike's price to earnings multiple fall from over 40 times to just a little below 23 times at recent pricing. And again, Nike, long-term business that's made investors money over the long term. And a lot of folks, you look at that and your immediate thought is, okay, this is a bargain. It's time to buy Nike. But here's a little bit of the reality of what's going on. Over that same period, we've seen Nike's net income has come down. We've seen its revenue. I'm going to do this on a percentage basis just to make it easier to see. We've seen its revenue kind of stagnate, right?
Yeah.
And here over the past year or so, it's actually revenues come down a little bit because competition, the company, it's omni-channel strategy that it took. It like always, and we saw Under Armour did the same thing earlier in its growth phase. On is trying to do the same thing, but starting from a much smaller base, trying to prioritize its direct-to-consumer sales business. Nike did this, and it worked to some degree, but it also maybe affected its wholesale channel business. So wholesale is where it's selling into distributors or to large retailers like Dick's that might not use wholesalers that are big enough to buy directly. That business is still really, really important, I think, is the big takeaway. And Nike's go-to-market strategy, in addition to its branding, both are things that the company is trying to work on. And what that means and why it's important is to not just blindly go into buying it because the PE ratios come down by 40 and 40, almost 49% over the past few years and say, oh, Nike's cheap, I should buy it while it's cheap. It's having the context to understand the things that are going on with the business, the real world pressures, new leadership in place, relatively new. What are the things that they're looking to do? Rachel described a lot of them, and looking for an inflection point and evidence that those things are actually starting to create value for customers, first of all, for buyers, that they're getting more leverage with buyers to pick up some of those marginal buyers, reestablish relationships with buyers that they may have lost it with. And then from there, create economic value for shareholders, drive earnings growth back up, increase free cash flow per share, get the turnaround going. We could have the same conversation about Starbucks, right? New CEOs come in, I think is the best operator in the restaurant business. Somebody that turned Chipotle around before they turned Chipotle around, somebody that turned the Taco Bell business around. So somebody that has a legacy of taking these kind of beaten up brands when they're weak and leveraging them and taking them on to further greatness. I think we're going to see the same thing happen with Starbucks. But again, you still have to see evidence for it. So Nike's in that same situation. So don't buy just on the valuation. Think about what's going on with the business and let that inform the decision that you choose to make.
Yeah, I think that's a really important point, because something I've talked about a lot as well, and especially as a newer investor, over the last 5 years or so, is just like a low valuation isn't in and of itself, a reason to put money into a stock. A high valuation, you
fall into a value trap, right? When you
right,
do that.
Right. A high valuation, it doesn't necessarily scare me off either if I think the business has tremendous potential over the long run. And it's, one that aligns with my interests and my portfolio goals and risk tolerance.
You're just warming the cockles of my capitalist heart right now.
Oh, I'm so glad.
It's great because, you're talking about, the businesses that are trading for premium prices that have earned it and then still have a lot of potential to continue generating great returns.
Yeah. Well, I've learned at the feet of the master, Jayson. We've been doing this for a while.
I appreciate that. But no, it's awesome. Okay, keep going here. Keep going.
All right. Well, FedEx, this is another one I'll talk through a little bit. So this is a business, totally different sector, obviously. They generate revenue through their broad portfolio of transportation, e-commerce, and business services. There's FedEx Express, FedEx Ground, FedEx Freight. FedEx Express focuses on essentially what is the world's largest express transportation company. They offer delivery to over 220 countries. FedEx Ground is the leading provider of small package ground delivery services. And then there's FedEx Freight, which is a leading provider of less than truckload or LTL freight services. And then they offer a variety of other business solutions, including logistics and transportation. They've been facing some challenges the last few years, although I still kind of like this business as a very, very like value oriented. This is not anywhere close to being, a growth business, which is what I usually gravitate towards. But, they've been dealing with some different factors, right? You see a drop in e-commerce activity post-pandemic, right? That was really, really driving this really robust, probably short-term, short-lived to be expected trajectory of growth during the pandemic. And then there's been, general economic unrest since that time. So there has been a reduced demand for shipping services, particularly for time-sensitive deliveries. Then you have the reality of inflationary pressures, right? That's higher fuel costs, higher labor costs. That has increased their operating expenses, which has put pressure on their margins as well as their profitability. We've seen changes in terms of demand for international shipping that's contributed to some lower revenues and profits, particularly for FedEx Express, which was focused, more on air and international deliveries. There's also been some data that has shown that some customers are shifting to cheaper ground shipping options or even using USPS, which has diverted packages from some of these higher margin air services. Now, FedEx has implemented a bunch of cost-cutting measures in the last few years. This includes, slashing some of their flight hours, reducing headcount, and with an ongoing, freight recession, oversupply of trucks, not enough goods to ship, that's impacted their freight trucking business. So competition as well from lower priced operators and the rise of e-commerce logistics providers that are, well integrated into their own businesses are also putting pressure on their pricing and market share. So in addition to measures like cost cutting and working to slash some of that, operational weight. They've also been working on integrating express and ground segments into one segment through their Network 2.0 initiative. And that's essentially them looking to improve their efficiency and reduce their overall costs. But the transition has been challenging. Another major announcement from the company that we've seen in the last couple of years is that FedEx announced that they want to spin off their freight trucking business, FedEx Freight, into a separate publicly traded company. And they said, we want to focus on our core business, reduce capital intensity. So for a perhaps less than exciting business, there's a lot going on here. I believe that they also report earnings on Thursday, if I'm remembering that correctly, the same day as Nike, either that or one of the prior days. This is also a business that has been a kind of a long-term value-oriented business. They are a long-standing dividend payer as well. Their yield is around 2.3%, which is a bit higher than that.
A little over 2%. Yeah.
Yeah, which is the average S&P 500 dividend stocks around 1.3%. Part of that yield uptick has been a function of the not so well-performing stock price
going the wrong way. Yeah. Yep.
But those are some of the things that are going on right now. I don't know if you have a chart, Jayson. If not, I have a chart, so we can do dueling charts if you want.
Yeah, no, go ahead. But I think the interesting thing is if you look at FedEx and UPS too. I'll talk a little bit about UPS after we finish up with FedEx. But the interesting thing is if you look at the earnings multiple, if you look at the earnings multiple for these, it's actually up over the last few years. That's because as much as the stock price has fallen.
Oh yeah, that's the point I was going to make. Yeah.
Yeah, earnings, right? That's been the challenge as we went from this very, very good period for these companies where basically anybody that was doing e-commerce had to pay, right? You didn't have the infrastructure in place. You went to the guys that had the infrastructure in place. And I mean, it was absolutely salad days for FedEx. You see right there on that chart, that purple chart.
Yep.
Pandemic. Who buddy was that good for their business?
Right. Right over here.
So, and that sent the P ratios way down from there. But if you restart that chart, like if you make it just like a 3-year chart, pull
that in a bit.
The earnings are down. Earnings are down. And the earnings have fallen down more than the stock price, right? The stocks, because this is not a super popular stock, right?
Right.
And a lot of the investors that own a FedEx, the bulk, like the number of like if you think about the percentage of shares that are held, they know the mechanic. They understand it's cyclical, and they're looking forward to when the cycle gets a little better and FedEx kind of pulls the levers that they're trying to prove to strengthen, improve. They're trying to pull to strengthen their business, but it makes the stock look more expensive than maybe it is because, and it's common with these cyclical businesses, Rachel, where right now is a little bit of a weak point in their business. We could say the same thing about UPS, but it makes them look expensive because their earnings have fallen and the stocks have held up a little bit better. But often when these look maybe a little expensive, they're cheap. And when they look cheap is when they're expensive. You could go back to that peak earnings period. The stock had done really well, but the PE ratio looked good because it was looking backwards. And the stock didn't do as good as you thought because a lot of smart investors understand the business and know that it's cyclical. We're not holding it. They'd already moved on, right? A lot of people that were buying it were not looking forward at the reality that its earnings would be affected in the near term.
Yeah, this is an interesting one. And it's funny because I cover so many stocks that I don't even own, but that I cover just for work here at the Fool. And FedEx has been one of the ones I have found interesting because it is kind of a boring business. It doesn't seem like one that a lot of investors are as intrigued by. But I do think that this is, a business that does have value to provide over the long run. And, there's a lot of these different elements I mentioned that they're working to turn around, but they have still been a solid, business in terms of earnings, in terms of growing their dividend as well. So there's a lot to see there. And I think it provides an interesting contrast when you're looking at a business, like Nike, looking beyond that valuation and seeing what are the numbers behind it is so much more telling. Because as you said, sometimes you can get caught in a bit of a trap when you're just looking at the frontline numbers.
Yeah, that's exactly right. And the thing, so I'll bring UPS into this just for 30 seconds. The thing about UPS that compels me is that it's one thing I've bought it, and part of it, I'm going to be honest, is the dividend yield is higher, but I understand what management is trying to do with UPS. They're actually trying to shrink the business. Like their plan to divorce away from Amazon. They finally announced something earlier this year. It's kind of been known that eventually it was going to happen because that's a really, really low margin business. And they're looking at a low margin business that Amazon is literally trying to build inside, right? Why would you want to basically subsidize their ability to take that business away from you anyway? So UPS management's made the hard decision to kind of rip off the Band-Aid and really focus internally and move away from some of the commodity last mile things that don't drive value and move into things that do drive value. So one thing, kind of getting back to your core professional focus area in healthcare is they have a testing facility, a medical testing facility that's where their largest hub is for air transport. And that's massively valuable for the healthcare industry, for testing, to be able to turn those things around quickly and potentially at lower cost, things that you want to do quickly, while it's a value add for UPS. So it's the kind of thing where they can grow margin, where they can create more value. So they're really focusing on places where they can leverage their network in areas that are driving more margin versus just taking a larger share of things that are more of a commodity. So I appreciate that they're doing that and realize that in the near term, there's going to be some pain as they go through the transition of the business, but it looks like they're pulling the levers the correct way so far. And again, it can make the stock maybe look a little pricey when earnings start to fall as they're going through these periods of adjustment. But you have to look forward again and think about the price of the stock today. I'm not buying this stock today based on how much money the company earned over the past 4 quarters. I'm buying based on what its earnings trajectory will be over the next 5+ years. And you start listening to the calls, going through the presentations, reading the filings, especially the annual report, to really make sure you understand the risks. Also know what their balance sheet are. How are they going to pay for this stuff, right? Cash flow statement, look at the balance sheet. How are they going to pay for it? Are they going to have to issue shares or debt? That's going to weigh on the returns, and try to arrive at a future earnings number and value the business based on that, right? So like a discounted cash flow, right? Where you're thinking about future cash flows, you're trying to estimate it to arrive at whether or not this price makes sense based on what the company can earn in the future. So that's one of the more challenging things to do as an investor is look at companies going through some sort of a turnaround and try to come up with some sort of a spitball number, because you're going to be wrong, but directionally you want to be right with it. That's the key. And acknowledging that for these businesses, the thing that's going to matter the most is how well are they going to be able to execute on this shift in strategy to get to that point in the future.
Yeah, I think that's right. Real quick, we can look at Carnival, totally different industry again, switching gears, also reporting earnings this week. It's interesting as well when you look, and I'll pull up the chart as well, when you're looking at how their PE ratio has moved around, because, after the, doldrums of the pandemic and the impact that had on the cruise industry, Carnival was deeply unprofitable for quite a while. And they actually only returned to profitability, I believe, in their Q3 of their fiscal 2023. So, fast forward to 2024, they had record-breaking revenue of $25 billion. They reported about $2 billion in net income last year. So it was a really, really solid year. But they're really still, newly profitable in their post-pandemic journey, right? So I think that's something that's important to note. This is very different, obviously, from a company like Viking Holdings, which we were talking about a lot the other day. This is much more of your, fun, lively, affordable type of cruise company. They have a range of, activities, entertainment options, widely, accessible fares from a financial perspective. They are known for having, casinos on board, lots of, salon services. They make a huge part of their money, obviously, through ticket sales. And then there's their cruise line. They have onboard spending, which is a major revenue source for them, with all their different specialty restaurant meals, shore excursions. And then they've got other revenue streams from tour and other, activities like hotels, lodges, and rail cars. Something about the cruise industry just generally is they have very high fixed costs, including the cost of powering the ships and the ships themselves. So it makes it really crucial to fill these ships to maximize revenue and profitability. Well over 60% of Carnival's revenue comes from selling cruise tickets, and then the smaller remainder is from onboard revenue. And as I mentioned, I'll share this really quick. They are somewhat more newly profitable in terms of their post-pandemic journey. Last year was their first full year of profitability post-pandemic. So you can kind of see how some of these metrics have been a little wonky, although obviously net income has come up significantly as they've turned from loss after loss and turned that around in their Q3 2023 and have reported successive net income since that time. And even so, their PE ratio has come down quite a bit in that period of time, and revenue has certainly the growth there has underpaced the recovery of their bottom line. I don't know if you have any thoughts to add there, Jayson.
Yeah, just one thing, and I'm going to share a screen here too. It's the thing that
stop my share.
When we start talking about the airlines and we start talking about the cruise lines, this is so important to remember this. These companies added massive amounts of debt and massive amounts of shares outstanding to get through the pandemic. Yep. So again, this goes back to the beginning of 2020. So this is before they had to start pulling these levers to raise capital. And so what that means is looking at metrics like net income, comparing it to the past, it's easy to miss, and like free cash flow. It's easy to miss the fact that, again, the share count in the case of Carnival is doubled,
right?
From where it was before the pandemic happened, and the debt loads have more than doubled. I wanted to highlight this, something that Lou Whiteman and myself and some other folks that have been followed like this whole run up through the pandemic when we're talking about it said is, look, the reality is that a lot of that first profit that's going to be coming in is going to have to be addressing balance sheets. So what has Carnival done? They've paid down their debt 22% from the peak. So that's the promise that they made is we've got to start reducing our share count, or excuse me, we've got to start reducing our debt. We've got to start addressing our balance sheet. they're doing that. So it's just important to remember. And this is why things like earnings per share, free cash flow per share are critical metrics to use, because it doesn't matter if a company doubles their earnings. If they double their earnings and also double their share count, they haven't
Right.
increased earnings per share, right? So it's just really important to remember those things. I got a question here that I'd like to make a run at too. I believe this was Ed asked this not too long ago. Ed, what is a home builder you like at today's valuation that will be great for portfolio diversification? So Ed, I want to be clear here. Ed, you know this. You've heard us say this enough. So I'm speaking to you by proxy to everybody else. When we get a question like this, it can sound really easy. It can be easy for it to sound like we're making a recommendation for somebody to buy that stock. And Ed, you know, I'm not telling you to buy any stock individually. I just think it's important to remember that. And what I want to do is I'm going to highlight the 5 home builders that I have bought as recently as last Wednesday. A few of these, and some I bought in the past, call it 2 months. And this chart's going to look really, really busy. I apologize for that. Let's see if I can make it just a little bit less busy and put each of these on their own ticker. So there's one on this list. There's one exception. I don't own NVR, but I put it on here because this is kind of it gets held up as the standard, the gold standard in home builders. Just since going back to the 90s when the company came out of bankruptcy and really focused on their strategy today of asset light, not carrying a bunch of debt to buy land. They use land options, bolting on a mortgage business as well to help buyers finance homes. They make good money from that. This is a forward PE multiple, 14.3 times. It's a little bit below its long-term average. And you can see it's substantially more expensive for the most part than most of these other home builders. Again, because it's the gold standard. This is the only home builder that made money during the global financial crisis. A lot of home builders went out of business. These guys actually managed to stay profitable. It says so much about the quality of their business and their strategy. I don't own NVR, which says a lot about me. But Meritage Homes, ticker MTH, LGI Homes, ticker LGIH, Lennar, ticker LEN, Green Brick Partners, ticker GRBK. Those are the 4 that I have recently added to or rebought. LGI Homes I'd owned for a long time. I sold because they were going through a period where they sold out their inventory and their balance sheet got ugly because they were trying to rebuild their land assets and get them prepped and ready to actually start building. So their home sales fell and they just were kind of in a mess. But they've really hit 2025 with good momentum. And a lot of their land is they're going to end the year with more active communities than they began it with. So that's a real positive. Lennar is one of the biggest home builders and definitely the most asset light of the biggest home builders. And then Green Brick Partners is one of the smaller home builders. They're based in Texas. They operate mainly in the Sun Belt. They're just really, really smart buyers of land, builders of houses, and sellers. They know how to get a house built at a price that they can sell quickly, that they're going to make really good margins. They have some of the best gross margins in the business. And you look at the valuations. So the average is, that's the average. This goes back, how far we go back here? 3 years or 10 years? No, this isn't going back 10 years. This is going back to when LGI Homes went public. It's the newest of these. And you can see, by and large, most of them are trading for around or maybe a little below their long-term PE multiples. I'm going to take LGI off of here so we can go a little bit farther back. And you'll see now, which is it, Green Brick? You know, maybe it's Green Brick. I think Green Brick and LGI both are more recent public offerings. I don't know what's going on here. Why is this not letting me go further back? Oh, I can tell you why, because I'm using the forward PE ratio versus so let me fix that real quick. I apologize, folks. So let me pull that off. And then we're going to see a little bit longer term look. And then they should generally, I don't have the average on here, but if you look, if I put it on one chart, see the problems, I have to go on every single one at a time and add that annotation. But you can just look at the chart and you can see that by and large, these are all trading for a discount to their long-term PE multiples. Now, where this can be dangerous, because this is a cyclical business, is when periods when earnings are up a lot. So again, we have companies like Lennar that are kind of blowing the curve on this because it's so much bigger. So we'll pull it off and we'll see all of these. We're in a period where earnings have come up, but in the past few years, they've stabilized and flatlined. Again, we come through the pandemic period where these guys sold through all their inventory and only a few were able to aggressively get enough land prepped and developed so they could just continue building. That earnings have actually started to fall a little bit from some of those peaks. So as a result, some of these I think that actually are cheap. Like they're really, really cheap. But I think by and large, every single one of these is a reasonable valuation for a 5+ year investment. I would not necessarily, I wouldn't be willing to go on our predictions hour at the end of the day and feel comfortable making a prediction on any of these where they're going to be at the end of the year. There's just so many pressures on housing right now. Housing supply, lumber costs, labor supply, that it would be a foolhardy prediction to say what's going to happen in the near term. But these prices just look really good. If we take that same idea of looking forward 3-5+ years, and is today's price likely to be owning a company that's earning a lot more money in the future? I think that's the case for this entire basket of home builders.
There were a couple healthcare related questions I wanted to hit. One came in from Matt about 27 minutes ago saying, Rachel, going back to my question yesterday about ZBH, do you see there being consistent and steady growth in the markets for both hip and knee replacements? So ZBH, Zimmer Biomet Holdings, they're a global medical technology, medical device company. Their primary focus is on the orthopedic field, developing and selling products to support joint replacement, trauma, and sports medicine procedures. So their product portfolio includes a wide array of implants, instruments, and related technologies for various orthopedic procedures, including hip, knee, shoulder, and foot and ankle surgeries. They operate globally. They have a very diverse customer base, including hospitals, clinics, and surgeons. And something as well for this business, I'll note before kind of getting into the latter part of the question, is they're really working on investing in higher growth segments and markets as well, such as the foot and ankle segment of the orthopedics market. And this is something that has been highlighted in their acquisition of a company called Paragon 28 that they are in the process of, or I think maybe recently closed. I don't think that transaction has fully concluded yet, but Paragon 28, they're a medical device company that specializes in foot and ankle orthopedic solutions. So it's a deal that's really going to bolster Zimmer Biomet's offerings in that area, really bolster their fracture, trauma, and joint replacement businesses. But there is absolutely a kind of vast and growing addressable market opportunity for them. Hip and knee replacements, for example, are on the rise. There's a lot of different data projections out there that are indicating that there's going to be a significant increase in the number of these procedures performed in the years. You've got factors like an aging population that are a huge element here, as well as increased life expectancy. There's some reports I've seen that would estimate that total knee replacements, for example, may between going back to 2005 to 2030 will have increased by over 600%. Total hip replacements are another huge area of growth as well. And obviously Zimmer is not the only company that's focusing on orthopedic solutions, right? As well as other musculoskeletal solutions. Another company that's asked about a lot on this show is Globus Medical. They are industry competitors. They're both major players in the medical device industry, particularly in the fields of orthopedic and spinal implants. Both companies really compete in the broader medical device market. I will say Zimmer is a somewhat larger company in terms of they have a broader portfolio Globus Medical is more focused on specific areas within the musculoskeletal space, particularly spinal implants. Then you've got other players like Stryker, Medtronic is another one. But there's absolutely a vast and growing addressable market here. And these are areas that both of these companies tap into. Zimmer Biomet's one I learned about just more recently, but it's an interesting business. They've done a really good job of, successively growing their revenue over time. They've been consistently profitable. I like Globus Medical as well. I find that to be an interesting business. That also kind of ties into another question that had come in from Jolly J asking, what are your thoughts on McKesson and GMed, valuation and long-term hold prospects? So Globus Medical, as I mentioned, they're somewhat of a competitor to the likes of ZBH, Zimmer Biomet Solutions. They do offer solutions for hip and knee replacements, including implants, instruments, and different enabling technologies for joint reconstruction procedures. For example, in 2019, I believe it was, Globus Medical acquired a company called Stelcast, which is a manufacturer of implants and instruments for hip and knee replacement. So they now have a really comprehensive portfolio of hip and knee reconstruction solutions, including implants and instruments. But they still focus a lot on orthopedic implants for, spine, trauma, artificial joints. They also have what's called the Excelsius GPS system, which is a smaller part of their platform. They added a company called Nuvasive to their business as well more recently, but the core of their business is these orthopedic implants for spine, trauma, and artificial joints. This is a business that I find ironically a little bit more compelling than ZBH. They are at a different stage in their growth story. They're a smaller business in some ways. They're obviously a bit less diversified than the likes of Zimmer Biomet, but I think these are both businesses that have growth opportunity over the long run. Just to give an idea of scale, Globus Medical grew their top line by about 61% year over year to about $2.6 billion in the recent quarter. I think that if you're looking at this space, whether it pertains to spinal solutions, musculoskeletal solutions, hip and knee replacement, medical device companies, those are both businesses that I think are compelling plays within this space. It's a fragmented market, and there's multiple players, quite a few of which I've mentioned, but there's definitely opportunities, for more than one winner. The thing I'll note with McKesson is they are a totally different type of business. They are in the business of pharmaceutical wholesaling. So they buy branded and generic drugs from manufacturers. They deliver them to pharmacies, hospitals, and other healthcare providers. They also earn revenue by handling logistics, inventory, compliance, and credit risk for manufacturers, as well as marking up generic drugs. So they're the ones that will manage the complex logistics of moving medications and supplies from manufacturers to healthcare providers. And they also distribute specialty medications. One thing that has been a bit of a nice tailwind for McKesson's business over the last couple of years has been the uptick in distribution and adoption of GLP-1 medications. Because they play such a key role in the pharmaceutical supply chain, distributing medications, including GLP-1 drugs to these pharmacies, hospitals, and clinics. This has been a real, boom for their business. So that's been evident in their prescription technology solutions segment. That's where they report all that type of growth, and that's where you've seen a real nice uptick from a variety of sources, but particularly, the growth and broader adoption of GLP-1 drugs. And they're also working to expand their presence in the specialty medicines market. These are all businesses, as I'm talking about, the healthcare is such a broad space. There's so many ways to play it. And that's actually one of the reasons I love it so much and why I so enjoy studying it, for my profession. These might not be the businesses that seem the most exciting at first glance, but these are businesses that are providing the, mission critical infrastructure, products, services, medicines, therapies, medical devices that patients around the world rely on today. And there are so many different segments and market opportunities within these broader spaces. I've talked about a few of them. But that, I think, is what is most exciting to me when I look at these companies within their respective markets. These are high revenue growth companies. These are companies with a really solid history of producing cash growth and cash flows. And also ones like McKesson are pretty, faithful dividend payers. So, healthcare may not be a space that everyone is as intrigued in at first glance. For me, I think that there's so much opportunity there in so many different types of economic cycles. I always find it intriguing, but even more so in this particular period of time that we're in.
All right, I got a question I want to grab here. And I've been scrolling through looking for other questions too. I think it was BG. Thoughts on Trex. So ticker Trex, TREX. One of my favorite stocks and one that has been a very big long-term winner for me, which you might not always be able to say that about stocks that if you look at their performance over a shorter period of time and they're down as much as Trex is. I'm going to share that on the screen. Here, I'm sending the screen share over. So Trex stock is down 24% over the past 3 years. You look at it from its recent high, it's down even more. If you don't mind releasing that screen share, Mike, it's down 42% from the high. So you don't think about long-term winning stocks as doing that well. I bought my first position back in 2013. We look at it since then, and this is a 12 bagger. It's up over 1,100%, down brutally, painfully a lot for anybody that bought in late 2021 or even in early 2024. It's down. So what's going on with Trex and what is the business? As a starting point, what Trex is a useful thing to know. And Trex is a manufacturer. It manufactures composite decking. So I know when I said manufacturer, 10% of people watching tuned out. And then I said composite decking manufacturer, another 10% of people fell asleep. So what Trex's core business is manufacturing, and it's the brand. It is the brand that is known for the entire industry. It's replacement decking for wood decks. And it's made out of 95% recycled material, mostly polyethylene film. So it's the shrink wrap, like pallet wrap, like you see in big box stores and stuff they make grocery store plastic bags out of. That's polyethylene film. So this stuff is really, really difficult to recycle because there's no value to it. It's such a cheap, like the when they make it from the virgin resin, it's super duper cheap. So it's hard to make a recycled version of this that's there's value there. So it's a lot of it ends up in landfills. That's great for Trex because they can get it really, really cheap. They also source basically wood scraps from lumber mills and wood yards and timber producers. And those are the two primary feedstocks, those two materials. And then there's another 5% of things that's fillers and binders and things that give the colorants, that give the different decking that they make, composite decking they make. It's color and finish. It's the best product in the industry by large. The real secret to their business is they've built deep relationships with the with the industry, with the decking contractors, people that build decks for people that don't want to do it themselves. And they have deep distribution channels for the distributors that sell to commercial customers versus the DIY customer, as well as also having primary real estate in Home Depot and in Lowe's, the big national chains as well. So they have by far the best distribution and they get incredible operating leverage on their product. The stock is down because the catalyst that drives their business is turnover of existing homes. If you buy a new home, you're very unlikely to go out the next year and spend $10,000 on a new deck, right? You're going to get it with the house that you get, right? And very rarely are they going to do something like a composite deck. They're just going to build a wood deck. It's what builders typically are going to do. So the catalyst for homes right now, home builders, they're doing the best. Existing inventory is very, very weak. Inventory for sale, right? It's it's about half of what it should be. It's a little over 1 million, like 1.1 million. We should be closer to 2.5 million existing homes for sale to be at a healthy amount of real estate. So because that real estate isn't turning over, it's affecting Trex's demand. There's just not as much demand, especially when you combine that with interest rates. Interest rates are so much higher right now because decks are, a 4-digit spend or more. They can be a 5-digit spend for some of these large, 5,000 square foot decks you see out there, these just incredible luxury decks. But the average deck, if it's, 500 square feet, you're going to spend a few thousand dollars just to have it refinished with composite decking. So a lot of people, that means you're whipping out the credit card, or you're going to, do the store financing or something like that. And the interest rates are very high. So that's pressured its business a lot. But while those pressures are coming on, Trex has continued to be profitable. They've dealt with some declines in revenue, but they see the long-term opportunity. And in this period of weakness where the cycle has turned, most manufacturers, Rachel, that are in that boat, they're just doing everything they can to keep the lights on. They're cutting costs. They're cutting back on staff. Trex is expanding. They're adding a new manufacturing facility, and they're expanding into Arkansas. And that geographic expansion for their manufacturing is going to help drive their margins even higher on the other side of when that facility is fully online in roughly a year from now, because it's closer to the Sun Belt where a lot of demand is. And that's just getting that much closer to where the end customer is going to help improve profitability, on top of the fact that it's expanding their manufacturing capacity. So just like those home builder stocks that I talked about, I think the price is compelling today, not for what the business is necessarily going to do in 2025. I'm thinking what it's going to do in 2030 and beyond. That's why I continue to own Trex, and why I've added to it multiple times over the years. And I wouldn't be shy about buying Trex at these prices. I'd be completely cognizant of the fact that this could be a really, really challenging year. But again, looking out 5+ years, I think Trex looks really compelling.
Ed was asking, when you talk about healthcare stocks, why does Abbott take a back seat? Well, I don't think we've gotten as many questions on Abbott, but I do know this one a bit, so I'm happy to talk about it. I have been probably a bit more interested in AbbVie, which was a spinoff of Abbott. And I believe that's also a stock that I still hold in my portfolio. But Abbott, that's a company that's actually done pretty well in terms of share price performance over the last year. This is another one of these global healthcare companies, but their business is divided into numerous lines. So they have a medical device segment that they're really well known for, which is medical devices for heart disease, stroke, carotid artery disease, and other vascular conditions. They also make diabetes care products like the Freestyle Libre continuous glucose monitoring system. For anyone that has heard me talk about Dexcom, which is a longtime position of mine, this segment is a direct competitor to Dexcom's CGM business. But Abbott Laboratories also has a diverse portfolio of nutritional products, including those for adults and pediatrics, brands like Similac and Ensure. Anyone that's followed this business for a while might remember that Abbott, along with another company, has been dealing with ongoing litigation for the last year or two related to allegations regarding their infant formula. There was a jury in October that found Abbott and another company called Reckitt not liable in a case alleging that their infant formula products caused a condition called necrotizing enterocolitis. And then just on Friday, and this for anyone who follows the stock would have seen shares take a little bit of a downward bump. A judge actually ruled that plaintiffs could pursue a new trial against the companies. Abbott, as well as Reckitt, have said they intend to appeal that ruling. Obviously, in this space, we see a lot of litigation. So I'm not saying that in terms of sentiment on the stock. I'm just noting that that's something, to be aware of with this business. So they have their medical device business, their diabetes care business. They are also known for some of their diagnostics, so testing equipment, consumables, reagents for various diagnostic applications. Actually, that testing business was one that saw a real uptick during the pandemic for COVID-19 tests. And obviously that is a revenue driver that has declined significantly the last few years. Medical devices is really the biggest revenue driver for Abbott at this point. So minimally invasive devices for those various heart disease and vascular conditions I mentioned, as well as their diabetes care products, like the Freestyle Libre CGM. This is a business that in 2024 delivered about $42 billion in sales. That was a 5% year-over-year increase. If you exclude COVID-19 testing sales, which have obviously been on a steep decline in recent years, their revenue actually grew 10% year-over-year. They also improved their gross margin as a percentage of sales by 60 basis points, which was also notable. I believe this is a business that also is a long-standing dividend payer. It's not one that I follow as closely as some of the other healthcare companies in the Fool universe, but it's worth noting this is a very long-standing dividend payer. They've increased their payout for 53 consecutive years at this point. And they have been a faithful.
It's on that royalty. It's on that royalty list of dividend growth.
I was going to say the Dividend Aristocrats Index. Yeah, this is one of those companies. That's the thing I've always found a bit more interesting about this particular one. Like I said, I hold shares of AbbVie. That's an interesting business. That's their spinoff from several years back. So that's been more where my area of focus has been. But yeah, it's a good question. I mean, I think it's an interesting business. It's, again, one of these classic healthcare stocks. The medical device business is the lifeblood of the business. And again, their Freestyle Libre has been a real growth driver for them the last few years. So I think, value-oriented dividend investors, that's an interesting one, perhaps to consider. So many stocks across this universe.
So one of these crazy trivia things, and you mentioned it there, I'm going to build on it. So Mike Lauren, I'm not sure who's running the screen right now, but if you can send up that slide, thank you very much. There's this weird history of companies, like good companies, doing spinoffs, and then the spinoffs going on to be the better investment. And in this case, AbbVie, since it was spun off, I think in late 2012, maybe early 2013. So it's it's about 12 years now at this point. Is up 907%. It's a 10-bagger, right?
Yeah.
And it makes Abbott look like a bad investment, but no, Abbott's been that's good. 14% a year roughly is really, really good. But it's interesting making the decision to spin off its pharma business. And AbbVie's, I think the idea at the time was, let's spin it off. We're not sure, if you've got Humira, because Humira was its biggest drug back then. I think that came off patent a couple of years ago.
Right.
But since then, we've seen Skyrizi that's come. Rinvoq has been pretty successful as well. So it's a lot more than just like, Botox and Humira. It's managed to be a pretty big business on its own, and maybe spinning it out and letting management of this separate company, like, dedicate and allocate resources focused on its priorities versus as a subsidiary of a much more diversified business when it was part of Abbott, clearly has made that a win for investors. And also, it, like I said, it makes Abbott look like an also ran, which is unfair because it is a wonderful, really high quality business.
Oh yeah, no, definitely. I agree that it is. And it's interesting as well because you do see this a lot in the healthcare space specifically, right? For example, Pfizer, if I'm remembering this right, they spun off Upjohn, which combined with Mylan, and I believe that formed Viatris. And then there was also the Zoetis segment. And you don't always see the end result being that spin-off is the stronger, maybe even more high growth business. But that's, at least in my opinion, been the case here. But I do agree, Abbott is a high quality business. I think I bought shares of AbbVie about 5 years ago at this point. So it's been an interesting business to hold. I also report on it a lot. And yeah, they've been dealing with some sort of moderation of growth as they're dealing with loss of patent exclusivity on Humira, but they have quite a couple of which you mentioned, other blockbuster drugs in their portfolio, and other notable ones in the pipeline. And I think it's also a really solid business over the long term.
So we've got a couple of kind of question comments going back a few hours ago from Besties and David Brooks talking about Cintas. So ticker is CTAS. And so the first comment was Cintas has been a great performer for a long term, beating the market by quite a lot. Isn't that what you want? And then David Brooks points out that David's Cintas position is up 680%. Not sure what that time frame is, but I wanted to share. So Cintas is easy to mix. And a lot of people, you might have seen a Cintas truck drive by, but they do like uniforms and that sort of thing. So like the service where they they deliver them and then they pick up the dirty ones and they clean them and they deliver them again. So it's very much like a dirty job sort of business. But what I'm showing here, and this is going back to the IPO, is what you've seen is a business that for the long term has been able to generate a pretty solid operating margin, but then convert that operating margin into exceptionally high profits. If you're getting a net margin of 17% off of 22% operating margin, you are an exceptionally well-run business. And a lot of times where a Cintas fits in is it's in those niches where it does something that a business just is not going to do itself. It doesn't make sense for the business to do itself. It's relatively inexpensive. It would be far more time consuming and resource consuming for the business to try to figure out how to do it themselves. But it's not a very super expensive thing to do, but it's really important to the business. Like, uniforms are pretty important for a business's employees. So being in a position to serve those sorts of markets, I think is really underappreciated. Finding businesses like that is really, really, really useful. Now, Cintas does a lot more. They provide a lot of other services too. Like it's not just uniforms. So like floor mats, right? Like replacing the floor mats and doormats in front of a store, picking those up and putting a clean one down and taking the old ones off to be cleaned. Again, it's just kind of like the like little esoteric things that are easy to overlook that businesses have to do. And sometimes paying somebody else to do them and letting you just focus on your business, and you get what's a good price, but the company that's doing it is doing it at scale for a lot of businesses and is generating a lot of profit from doing it. So I love businesses like that. Absolutely love them.
Yeah.
All right. We got a couple of minutes here. We can hit a few more questions.
This was nice from John saying, Rachel, thanks for providing some great insight about Dexcom over the weekend, Fool24. Yeah, I'm enthusiastic about that stock. I don't see a lot of enthusiasm in the Fool universe, so I appreciate that. There was actually a question that had come in that I could briefly hit. It was directed at Lou actually earlier, but it was about Joby Aviation. I followed this one, so I figured I'd hit this really quick. Sadaf was asking thoughts on their new announcement of a partnership with Virgin Atlantic. This is an interesting business, right? They're planning to generate revenue by operating a vertically integrated air taxi service. They want to control that, whole customer experience from aircraft production to flight operations. They plan to operate an air taxi service similar to Uber, but with electrical vertical takeoff and landing aircraft. And they're planning to launch their air taxi service in high density markets like LA, New York City, potentially expanding to other, international locations like Dubai. This partnership with Virgin Atlantic made sense to me. I mean, they already have existing partnerships with companies like Delta and Uber to expand their reach and market access. They're making really strong progress towards getting to commercial operations. They are already on the 4th of 5 stages required to certify their aircraft for commercial passenger use in the US. They're expanding their pilot production line in Marina, California. They're building their first vertiport, and they're also working with the US Air Force as well. They've been delivering aircraft as part of a long-term contract with them. Another partner for them is Toyota. This is obviously a pre-revenue business. This is a very risky type of endeavor and investment, but it is one that I follow a bit because I find the potential of this business fascinating. They say that they want to begin market testing in Dubai late this year or early next year. This partnership with Virgin Atlantic would include the UK as a potential future market for their electric air taxis. And that would also be the 7th country in which they hope to one day commercialize. So at this point, it's a lot of planning, a lot of hopes pinned on the business. It's certainly what I'm following. And I think it's an interesting partnership for them that follows on a score of really robust partnerships with well-known transportation companies.
Rachel, as we bring Danny Vena and Jeremy Bowman onto the stage, I just want to answer one more question here. And I'm not answering it as much as I'm using it to promote another show. Ed asked earlier, the Fed meets this week. Do you believe they talk about lowering rates? Of course they're going to talk about lowering rates. Doesn't mean they're going to do it. They talk about it every time they meet. They talk about raising rates. They talk about leaving them the same. That's the whole point of the FOMC meeting, right? I tease you, Ed. So the reason I wanted to bring it up is that during that same, I think it's Wednesday or Thursday, the FOMC announcement comes out. We're going to be Andy Cross and I, Motley Fool's Chief Investment Officer, Andy Cross and I are going to be on here during that same 2 to 3 p.m. hour talking about the relationship between stocks and interest rates. So we'll see the release at some point when it comes up, and we'll probably see some headlines that we'll talk about. But I just want fools that are interested in that to tune in when we do that. Now that I've taken up 1 minute of your hour, Jeremy and Danny, we'll pay you for the full hour, but you can have 59 minutes.
Very generous of you, Jayson.
By we, you mean you and the French mouse in your pocket, right?
There you go. Exactly. Exactly.
Oh my
All right,
gosh.
fools. Have a great day. See you next time.
Hold on, guys.
All right. Danny Vena, how you doing today?
I am doing just ducky. How are you, Jeremy?
Pretty good. It's 4 o'clock on the East Coast here. Markets are closed. Happy St. Patrick's Day to those of you who are celebrating. I know neither of us are wearing green, but I'm having some very Irish weather over here today. It's been drizzly all day, so I guess that's how I'm
may
celebrating.
not translate well, but this is actually green. It actually looks a little gray on the monitor, but this is green.
All right. Well, there you go. Well, for those of you who are regular viewers, you know, 4 o'clock is our regular earnings hour. We're kind of in a dry spot in earnings season here. Not too much on the calendar today, but we do have a few stocks loaded to talk about from last week. And if you have any other questions on any stocks really, any earnings reports that have come out recently, we got some big names due up this week as well. Nike and Micron among some others. So any reports you're looking forward to, please let us know in the Slido, code Fool24. We got a few questions recently as well. So Danny, do you see any questions you want to take, I think you had a...
there was one question that I saw. I'll hit this, and then after I answer this question, I'll go ahead and work on pulling in my my slideshow. But this question came from Kirk Lamberti about 3 hours ago. NVIDIA, buy, sell, or hold? I see this question a lot, and I see it over and over and over again. It kind of surprises me every time I do it. But then I think back, and I think about the fact that, when I was a novice investor, I equated a lower stock price with a business that wasn't doing well. In the case of NVIDIA, this is, just the opposite of that. This is a company that, it may have a stock price that is down. The business is booming. If you look at the most recent quarter, their revenue was up 78% year over year and 12% quarter over quarter. This is not the numbers of a business that is, having a hard time. They had record full year revenue for their fiscal 2025. The revenue was $130 billion, and it was up 114%. Gosh, I wish all of my companies, would be able to put up numbers like that. When you're talking about their earnings per share on a GAAP basis, up 82%, on an adjusted basis, up 71%. Even quarter over quarter, earnings per share was up 14% under GAAP, 10% on adjusted basis. I can't think of a company that put up stronger numbers that people are asking whether or not this stock is a sell. So let me just be categorical. I do not, under any circumstances, think that NVIDIA stock is a sell. In fact, just recently I was looking, and the price to earnings ratio is getting down near a multi-year low. And it's actually on a forward basis, it's actually selling for cheaper than the S&P 500, which is crazy in my mind for a company that is putting up, 70+% growth. So for me, NVIDIA is by no means a sell. It is definitely a hold. And if I was an investor looking to build out my position, and mind you, NVIDIA is already my second largest holding at more than 10% of my portfolio. If that wasn't the case, I would be tempted to buy at this level. But that's just me. I don't know if you wanted to add anything, Jeremy.
No, I mean, yeah, I agree with everything you said. I think, yeah, I mean, it's pretty extraordinary to see a company, right? They just reported 78% revenue growth trading at this kind of valuation, and I mean, it seems like a lot of the skepticism or pessimism is, related to some of the recent macroeconomic news or maybe general fears about a slowdown in AI. But I think the company's in a very strong competitive position, and the long term sort of investment cycle in AI and technology more broadly, I think is going to continue. I mean, the pace could change, but I think it's still a very strong company 5 or 10 years out. I'll take another a recent question here. Besties just asked, well, Tim, I don't know. I don't think we had a Tim on the last hour, but I don't know. Maybe that was referring to another question or another commenter. Tim, what do you make of Toast in these times? Would you buy now? Why not? Toast, for those of you who don't follow the stock, is they're kind of like the Shopify of restaurants. They do point of sale system, inventory tracking, ordering, kind of your the brains of the restaurant operation, making it easier for restaurant operators to make that kind of stuff work. And it's a software company. We get a lot of questions about I think these kind of software stocks, and I think Toast is better positioned than a lot of them. I think a lot of the valuations in the sector can look a bit stretched. And we've seen a lot of these stocks. Toast has started, they did well during the pandemic, then kind of fell off a cliff. They started to come back, but I mean, the recent numbers I think is still very strong. They've kind of cornered what's been historically, I think, a pretty fragmented market in restaurants, and we haven't really seen a pure play company, I think, go after it the way they have. Their various, Aloha or Micros, I think, were owned by some other, larger tech companies. But just to throw out a few numbers, fourth quarter, their annual recurring revenue, which is sort of a smoothed out measurement of software revenue, up 34% to 1.6 billion. Gross payment volume, which is, the number, the size of the business that the restaurants, the restaurant customers are doing, up 25% to 42.2 billion. So certainly a very big business when you think of the the customers they're serving. They're at about 160 billion over the year. But I think growth numbers like that around 30%, pretty strong to me. I mean, I think they're like a lot of the companies in the sector, their valuation is not cheap, but I mean, it's actually pretty reasonable. Let me pull that up here. Yeah, I mean, actually, just price of sales of about 4, which is actually very good, I'd say, for a software company growing like that. And just turned profitable on a GAAP basis, which I think is a good sign. So I think overall pretty good outlook for them going forward. I don't know if that's one you follow at all, Danny.
It is actually one I follow, and it's a company that I have been adding to on and off over the past couple of years. I bought into it shortly after the company went public. I generally tend to wait 3 to 6 months. And I waited a little bit before I decided to buy into Toast. But since I have, it's one I'm pretty happy to be a shareholder of. I think one of the things that stands out to me is, they have a really large addressable market. And the fact that Toast has a software system that, they tout it as the operating system for restaurants. So it can handle, a whole variety of software systems within the restaurant. So it can handle scheduling employees. It can handle, the front end where the host knows, which customers are sitting at which tables. It can handle inventory for the restaurant. It can handle deliveries from places like Grubhub and Postmates. So this is, I like that, they get a foot in the door by, maybe one module, and then they expand over time. They have that land and expand strategy. And I'm really kind of bullish on the fact that they've been doing really well at that. And the fact that they, have been able to gradually expand with their current customer base, expanding into new customers. It just seems like there's a long runway ahead, if you'll, excuse me for using a somewhat labored metaphor. But really, this is a company that I'm pretty happy with. Thus far, let's see. I wanted to take a quick look here and see. Yeah, so I bought 2 different tranches of the stock. Right now, it's only about 0.25% of my portfolio. But those 2 positions together are up about 68%. And one that I've been looking to add to, I haven't really had the opportunity lately. So yeah, I think this is one that I've been talking about too much, which is why I haven't been able to add to it. But yeah, I think that they are, in my mind, they're a solid buy right now.
Yeah, that's a good point. They've been able to gain market share pretty fast, so I think it's a sign they're doing something right.
And just so that you know, Jeremy, I'm having some technical difficulties here with the system not wanting to let me upload my slides at the moment. I may have to try to create a login or something. It's the system is causing me issues.
All right. No problem. We got a couple other comments here. See this one. I think they talked about Carnival in the last episode, but this one from Don W is still hanging out here, so I'll grab that. He says Carnival tech charts rising back above rising daily 200-day standard moving average. Discretionary spending includes travel, 50% of January highs. But poli-sci now I'm not in. I don't know if you're still with us, Don W. I don't know if I quite understand all that. We don't tend to do technical investing as far as moving averages and stuff right now. But as far as Carnival's current position, I mean, I can speak to that. Carnival is the world's largest cruise operator. We did see the travel sector get hit kind of broadly last week. Delta and a few other airlines and cut their guidance for the first quarter due to some seems like weakening consumer sentiment and that sort of thing. Carnival is actually I think they're due to report this earnings this week or maybe next week as well. But they're I know in their last report that they're in a very strong booked position heading into the summer. So I mean, a lot of these cruise lines, they sell sell rooms or spaces, several months ahead of time. So it's a bit different than something like the airline. So I mean, I think the sell-off, could be a favorable opportunity for them. I mean, they're still recovering from the pandemic as well, but I mean, the cruise demand has been very strong in recent years, and I think travel is one of those industries where we see a lot of macro trends as far as youth spending on activities as opposed to goods and that sort of thing as continuing to be very strong. I mean, we're seeing a lot of headlines about concerns about over tourism, which I mean, that could even favor an industry like cruise lines in some ways. So I think long term still pretty good setup for Carnival. And I think
All right,
Danny,
it looks like I have resolved the technical issue with my slideshow. So what I'd like to do is share my screen here with my DocuSign slides. Now, DocuSign reported after the market closed on Thursday, I believe it was, and they reported results that were better than what folks were expecting. Yeah, I think it's going to take just a minute to get these slides up. But in the meantime, DocuSign is one of those cases where this is a company that, did really well during the pandemic. They were actually doing well before that. The stock price shot through the roof during the pandemic because everybody thought, oh, DocuSign is going to be the only way to get documents done, get, contracts signed. And then, shortly after the pandemic was over, the stock fell off a cliff. After they reported earnings last week, the stock went up 18% in one day, primarily because they had done so much better than what Wall Street was expecting. So revenue grew about 9% year over year to $776 million. Subscription revenue made up the bulk of that, also up 9%. Consensus estimates were only for $762 million. So that was the first part of investor enthusiasm for the stock. Now their GAAP earnings per share increased 200% year over year. Backing out one-time issues, their adjusted earnings per share was 86 cents, up 13%. I like it when their earnings per share is growing faster than revenue. That means they're leveraging the expenses that they're already having. Consensus estimates were only 85 cents, so they also beat on the bottom line, if maybe just slightly. Billings were $923 million, up 11%. Now, for those who may not be familiar with the term billings, this is one that you see a lot in businesses that have subscriptions. Under generally accepted accounting principles, the rules that govern accounting, if you have a contract that is 12 months long, you're only allowed to recognize that revenue 1 month at a time. And the rest of that has to go somewhere. And in this case, it's into billings. So their billings was actually up 11%, which I like to see because it's growing faster, again, than revenue. And the reason it's growing faster is because, this change in their contractual obligations mean they are basically backloading more of that. Another term that you might hear used in a similar context is backlog. I'm going to go to my next slide here. Overall, the results look good. Their international revenue was up 12% year over year and now makes up 28% of revenue. This is something that DocuSign has been working on for the past couple of years. Their total customer numbers grew to 1.6 million, which was up about 11%. The average contract length was about 19 months, which is why you see, so much of the company's sales end up in their backlog. Now, one thing that has me pretty excited as a shareholder is their intelligent agreement management platform. Now, what this is they have taken regular AI and they have infused it into their basically contract lifecycle management. Basically, you can load all of your contracts from multiple years into this platform. And going through this, the software will create lists for you, and it'll tell you this is when your next contract is due. This is when your deadlines for getting this to your sales department. This is the deadline for getting it to your marketing department. Legal needs it by a certain date. And it can go through and even make suggestions for language that might be more beneficial to you than the language that's in your current slate of contracts. And what management said was this is the fastest growing new product in DocuSign's history, was a quote from the CEO on the conference call. So there's a lot going on here with DocuSign. They have, depending on who you listen to, they have somewhere between 50 and 61% of the electronic signature market. But the big opportunity is in DocuSign Cloud and in their contract lifecycle management, because they have shown time and again that they're able to save businesses time and money by adopting these. So it's got a really good return on investment. And this is one that I continue to hold, even though, some of the other pandemic era stocks have gone by the wayside. Teladoc is one that I've lost faith in, as is Zoom Video Communications. But DocuSign is one that I believe still has a good opportunity ahead, and one that I am happy to be a shareholder in.
Yeah, 50 to 61% market share sounds pretty good. That's actually something I've been wondering about DocuSign.
It's certainly not bad.
Well, yeah. Well, it looks like I'll go ahead and talk earnings report as well. Still waiting for some questions to come in. So if you're out in the audience, have anything on your mind, please share it with us at Slido Fool24 again. I don't have a slideshow prepared, so Danny, you got me beat there. But one company I did want to talk about that reported earnings last week was Oracle. And I think Oracle's sort of overlooked by in the tech sector and by tech investors, even though it has I think it's a market cap of around 400 or 500 billion now. But it's not in that Magnificent Seven group of stocks. It's not it hasn't historically last 5 or 10 years. I think it's performed pretty well, but not so great that it's gotten a lot of attention. But I think this is one that deserves a closer look. It's a company, legacy tech, mostly known for database software, but they're really seeing a lot of strong AI driven growth from their in their cloud infrastructure business, outgrowing all those big cloud companies, Microsoft, Amazon, and Alphabet are the big three there. So they have a sort of funny reporting calendar, but in their fiscal third quarter, cloud infrastructure revenue was up 49% to 2.7 billion. Overall revenue growth was much slower due to they're seeing declines in their smaller on-premise license and legacy businesses like hardware. So overall revenue up 6% to 14.1 billion. But in addition to that cloud infrastructure figure I mentioned, remaining performance obligations, which is a forward-looking metric in software. Basically, it's a proxy for backlog, contractual obligations that the company has to fulfill. So that was up 62% to 130 billion. So, and Oracle has teamed up with those other, cloud hyperscalers I mentioned, particularly Microsoft, and everything the company mentions, on their earnings calls, demand around that is just exploding. So they see revenue growth accelerating next year or in fiscal 26, which I think begins in April for them, to around 15%. Profit margin, operating margins are very strong. Their adjusted operating margin in the recent quarter was 44%. I think they doubled their data centers, or they're planning to. And the stock is trading, pretty fair valuation. Less than 30 right now on a trailing adjusted PE basis. So, pretty similar to the S&P 500. So I think it's a bit of a, I don't know if you can quite call it a dark horse, but maybe compared to, NVIDIA or some of the other names that we hear a lot about. I think it's a good bet for a market beater.
Yeah, I was actually just pulling up some information here so we could kind of give your comments context. So I wanted to look and see what the other big three cloud providers grew. So in the fourth quarter, Amazon Web Services, AWS grew at 19% year over year. Let's see, Microsoft, let's see. I'm hoping they were just going to give it to me, in one place, but I've got to go through this.
Oh, yeah.
Amazon grew 19% year over year. Microsoft Azure grew 31% year over year. And Google Cloud grew 32% year over year. So to give that context, if you go back and look at Oracle, and Oracle grew their cloud revenue by 51%. In the fourth quarter. So yeah, that's quite a bit higher than the big three. So, if it keeps growing at that pace, I think eventually, who knows, we might get to see the big four.
Yeah, and they're also, and I forgot to mention, they're involved in that, Stargate project that was announced a few weeks ago with, Microsoft and OpenAI and some NVIDIA as well. Some of those other big tech companies. So, that's supposed to be the biggest AI infrastructure project in the world. So, good thing to be a part of for them as well.
Yeah, there was another thing that I was looking at. CEO Safra Catz during Oracle's earnings call said that they have a growing trend of customers and longer contracts. And noted that the record demand for AI drove its cloud revenue up 52% year over year. I knew it was over 50, but it was 52%. So that's pretty impressive growth for a company that is not even spoken of in the same breath as Amazon, Microsoft, and Alphabet.
Yeah, and they are smaller than them, so as we mentioned. But yeah, I think that growth in the remaining performance obligations too, I think is really evidence of confidence from their customers, and they've tried it out and they like what they've seen so far. So they're like you said, larger and longer contracts. So that's certainly a good sign.
So, fellow fools, if you don't have any questions in yet, feel free to get them in. Jeremy and I are looking for your questions. In the meantime, there were a couple other things that I noticed during Oracle's conference call. Jeremy was talking about their remaining performance obligation, which is, contractual obligations that have not yet been included in revenue. That was up 50% year over year. And what's interesting about that is, that is on pace with their cloud growth, which essentially means that not over are they growing at 50% now, but the likelihood that they're going to maintain that growth going into the future. Every time they add to that backlog, every time they add to that, to their remaining performance obligation, the likelihood that they will continue to grow at that pace kind of increases a little bit. So that's pretty impressive remaining performance obligation growth that they have. And at this point, that's worth about $97 billion, which is interesting. If you go back and you look at the company's, more recent performance, their total cloud revenue, which was software as a service, infrastructure as a service, was at 6.2 billion. That means they've got several years worth of remaining performance obligation. Looks like actually that's 130 billion, up from 97 billion last quarter and 80 billion last year. That's up 63%, and it doesn't include any of the contracts that Jeremy was talking about from Project Stargate. So this is one that I have written about, and perhaps pointed out that it's one investors should be paying a little bit more attention to, because the company is performing well. It's getting the tailwind of AI, but thus far anyway, it hasn't gotten as much press as the bigger names in the AI space.
Yeah, definitely. Well said. I'm going to go ahead and take a question from the queue. Bessie's asked a few hours ago, what is your view of the new Intel CEO? Hopefully you can turn it around. Big news out of Intel for those of you who might have missed it. Last week named Lip-Bu Tan as their new CEO. So the company had basically pushed former CEO Pat Gelsinger out the door in December. Gelsinger had really tried to overhaul the company and create this new foundry model where Intel is opening itself up to outside foundry customers in the model of Taiwan Semiconductor. New business for them. So far, the results hadn't. He gave these very bullish forecasts, for 2030, but so far the results hadn't really kicked in. I sort of thought that decision was maybe a bit premature, or wrongheaded, but I think given the circumstances the company is in, Lip-Bu Tan, who had served on the board previously, he actually left the board in August, and basically, threw the company under the bus at the time, or said, like a lot of critics of Intel, basically the company's been risk averse and sort of has failed to keep up with the times. And I believe at the time he was only one of two people on the board with semiconductor experience. So Intel's brought in a couple of semiconductor executives onto the board since then. So that's a good move. He was the leader of or CEO of Cadence Design Systems, a semiconductor company, for 12 years, and led it to very strong stock performance. So I think under the circumstances the company is in, and they had this dual interim co-CEO structure for the last few months or so, I think he's the best choice. He knows the company, from being on the board. I don't know. I'm still skeptical of Intel's competitive position, and I don't think there's really a silver bullet kind of thing that's going to turn it around quickly for the company. There's been talk about maybe spinning off the foundry business, or prior to him being named as CEO, this maybe joint venture model with Taiwan Semi and some other of the big semiconductor companies. So hard to say what's going to happen with that. That's one thing to watch with the company. But I think any meaningful turnaround in the business could take a year or so. But definitely interested to see what he does.
It's interesting that you mentioned this Intel news. I remember reading late last week about there was a report that Taiwan Semiconductor had held talks with, let's see, I think it was NVIDIA, AMD, and Broadcom to create a joint venture to operate Intel's foundry business. And it got a lot of press at the time. It kind of shook up the tech sector a little bit. A lot of stocks, particularly in the chip sector, climbed on that news. And what's interesting is that now that Wall Street has had a little bit of time to, basically digest that news, some folks are saying it's not ever going to happen. I was having a conversation with Seth Jayson earlier today, where he said, that they use vastly different processes. And so, not really sure how that would shake out. And one analyst came out and said, a joint venture like that is a pipe dream. So not sure if that's actually going to happen.
Yeah, it does seem like it would take a lot for every major
for the stars to align.
Know if it would. Yeah, I don't even know if that would be legal either. But sort of every big company and industry to team up on something like that. But the chatter definitely will drive the news cycle.
So we've got a question from Sergey. It actually came in about 8 hours ago, but I thought maybe I would take a crack at it. In your respective portfolios, is there a stock that you love at this time, not so much liked by the market? I started thinking, this made me think of Rodney Dangerfield, the comedian who was famous for his saying, "I can't get no respect." And that's kind of how I feel about Disney stock right now. This is a company that has probably the largest portfolio of intellectual property in the world. They're producing new movies all the time. That they are the owners of Pixar, Marvel, Disney Animation Studios, and Star Wars. They keep churning out movies that, if are not all, generate $1 billion or more in box office, they cater to fans across the spectrum. They can take this IP then and use it to create, the rides at their theme parks and shows on their cruise lines. So, there's a lot of areas that are covered by Disney. You've got your, theatrical releases, and you've got your streaming video. And if you want a plush toy, Disney's got one for every taste. So I think that, it wasn't too long ago that Disney stock was flat over something like the past decade. And I think what happened was folks put a little bit too much emphasis on streaming. And Disney said, we're going to be profitable in our streaming business by the end of 2024. And they were. And now folks don't really know what to make of it. So this is a stock that I think has a lot of potential that's baked into it. But because, there's been so much will it or won't it over the past few years, Disney's stock is kind of stuck in neutral. I'm not selling my shares of Disney. This is a company that I like. I have a lot of respect for. I see plenty of opportunity. I just don't think that investors in general in the market specifically are really all that enthused by Disney. I don't know if you've got one you wanted to share, Jeremy.
Yeah, I think those are definitely good points about Disney. Yeah, there's definitely feels like a disconnect there between the strength of the company and its performance. You know what? I'm going to stick in the same industry, and I think this question made me think of Roku.
Oh yeah,
which has actually the stock jumped about a month ago. They had a pretty strong earnings report. The company said they were going to be profitable or report a positive operating income in 2026. which I mean, still another year, but I think good to see them finally getting to profitability. And the stock is down 40% now, with this recent market sell-off we've had. And I think sort of like you said about Disney. I mean, of course, Roku's a different company. And they're focused on streaming distribution. But they're the industry leader there. I mean, I think they have a strong competitive position. You look at the companies they've kind of fended it off to control or lead that space as far as Amazon and Google. I think they've done a pretty good job there, and they're, I mean, maybe most people associate them with their devices or maybe, smart TV platform, but they make a lot of money from advertising. They get a cut of some subscriptions. So I think they have a good business model. Consumption, consumption of streaming and on Roku continues to grow. So I think there's a lot of growth left for them. They're leader in I think Mexico and some other company. It's in Latin America. I mean, it's an international company as well. So I especially considering that last report. I mean, I think the sell-off seems a little brutal. Yeah, I mean, they're sort of, I mean, Disney's obviously profitable, but at least as far as the streaming thing, Roku's another one of those that, did very well during the pandemic and then really kind of struggled with that, the kind of dislocation in especially in the streaming industry that came after that. But it seems like given their leadership and the growth of the market, they should figure it out eventually. So I still maybe still optimistic about that one over the long term, despite the struggles.
So I got another one that maybe we could both address. I'll go ahead and take first crack at it. But this is from young Tom Morris a few days ago. What's your pick for a stock that can 10x over the next 5 years? Seems more likely at these levels given how most stocks have fallen on broader market concerns. This is a really tough question to answer. So what I look at for a stock that I think can 10x is I'm looking for a company that has a large addressable market, a company that is growing quickly, that they generally have broad consumer appeal. And one of the ones that I've seen that kind of intrigues me is Dutch Brothers, ticker BROS. They have widely been reported as the next Starbucks. Now, obviously, there's only one Starbucks, and that's Starbucks. However, the thing I like about Dutch Brothers is that they are a regional coffee chain. They are growing at a relatively rapid pace. And they've carved out a niche for themselves that has been, doing remarkably well, rather than just focusing on, the Starbucks and the, premium coffee. What they're focusing on is fun. So if you go to a Dutch Brothers, they have a variety of flavors that you're not going to find at Starbucks. They have a secret menu that they tout where folks can, order something that if you're in the know, and by the way, if you want to be in the know, just Google it, you'll find it. They have this secret menu. They have their own line of energy drinks. So, you can go in the afternoon and get a little afternoon pick me up if you're not interested in having coffee. They have these cold beverages. They have, special drinks that they only roll out for a short time. Kind of like, I don't know if you remember the Starbucks, unicorn frappe or whatever that made a big splash when it first came out and then disappeared. So this is the kind of thing that Dutch Brothers is embracing. Now, this is a stock that, they only went public not too long ago. They have a market cap right now of just under 10 billion. Let's see, when did they go? Dutch Brothers, when did they go public? Looks like, yeah, it looks like they went public in September of 2021. So the company's been public for less than 4 years. So again, this is a company that, because they have such a small size, and because it's one that, is kind of, they have a focus on their niche, smaller company. I think this is one that has the potential that it could 10x over 5 years. But again, a lot of the stars would have to align, and everything would have to go right in order for it to 10x over 5 years. I don't know if you've got one in mind, Jeremy.
Yeah, 5 years is I mean, it certainly happens, but that, fairly short time frame to 10x. But yeah, I think a lot of, there are a few other restaurant stocks that I think are good candidates for that. Kava and Sweetgreen are two that come to mind. But one I was going to share, and it's a very volatile stock, so I think could go up or down, but is down in the recent sell-off, which is Upstart. Market cap is I think between 4 and 5 billion right now. Another stock, people might remember it did do very well during the pandemic, and then came down a lot. But I what I like about them a lot is that, and they do consumer loans. They have AI technology that they say is much better at than traditional FICO scores at determining credit worthiness, and you get a lower default rate and that sort of thing. And it's been, the macroeconomic climate has not been great for them with high interest rates. But the company released updated its model a few months ago, and really their growth soared in the fourth quarter. Revenue was up 56%. Their conversion rate improved a lot, going from 11.6% to 19.3%. So I think I think there's been some doubts about this company, about whether the technology, sort of works, and if it can deliver that kind of results. And I think that gives me confidence. I mean, I think they'll continue to improve their algorithms. And I like your points too, Danny, about large addressable market and steady growth and that sort of thing. I mean, they've started, they've gone from consumer loans to auto loans. They're offering home equity line of credit in some states now, or maybe most states. The mortgage market is massive for them, and they license their technology as well. So I think, and it is a company that I expect to do well if who knows if interest rates will ever come down at this point, I guess. But, I think it would happen eventually, right? So, if the macroeconomic tailwinds cooperate, and we continue to see this sort of technology improvement from the company, and some of that recent momentum I just mentioned continue. I mean, I think they could certainly be a multi-bagger over the 5-year time frame, and possibly a 10x.
So did you have one?
Oh, no, sorry, I didn't.
Oh, okay. So I do have one in here from Kelly from several hours ago. What are your thoughts on Arista Networks, ticker ANET? This is a company that I follow, and this is one where that the valuation had gotten a little ahead of itself, and when the company didn't do as well as Wall Street thought it should do, the stock basically came down a bit. But this is one where this is a company that they developed these kind of groundbreaking network switches that allowed high-speed servers and other devices to connect on a network. and it reduced the lag so that, they were nearly instantaneous response times. And since then, they have developed a whole suite of offerings, switches, routers, other network equipment, basically that's used to speed data about the ether. They've developed custom Ethernet systems designed just to handle the rigors required by large language models, which form the foundation of AI. In the company's most recent quarter, they grew their revenue by only about 7%, which was lower than what it had been. Over the full year, it was like 20%. So it was definitely a decline. No, I'm sorry, I take that back. 25% year over year, 6.6% sequentially. So, the 25% growth, Wall Street was looking for something a bit higher than that. And, whenever you don't meet Wall Street's expectations and, you have kind of a frothy valuation, things tend to get bid down a little bit. I don't see any issues with Arista Network. I think they are positioning themselves well for the AI revolution. And so I think this is a case where there has been, the broader macroeconomic and geopolitical issues that have been weighing on the broader market. And as a result of that, any company that has too high of a valuation and doesn't beat is taking it on the chin. I think that's what happened with Arista Networks. And I think also their guidance was not as robust as analysts had hoped. So this is a company that has a bright future ahead. They're positioned well for AI. And I think for investors that are looking to maybe establish a position, it's a little more affordable now than it was recently, but certainly one that I think is worth looking at.
Yeah, that's not one I've followed too closely, but I know it has been a long time outperformer and considered a leader in AI. But yeah, that was definitely a good rundown there. So it's apologize on behalf of a technical glitch, or blame it on Slido. We did have a few questions that just came in, so looks like there was a delay in the queue or something like that. But I guess we'll try to tackle a few of these in the few minutes we have left. But I like this one from Ed. C3 AI, still waiting for this one to get on track. Do you think this is one of the losers in AI? Yeah, C3 AI is an interesting company. They do AI software, a lot of different applications. Inventory management, supply chain. I think cybersecurity. They sort of feel like a bit of a wannabe Palantir to me. The company got a lot of attention. Shortly after ChatGPT came out, and this sort of AI craze began. I'll give them some credit. Their growth has improved. Revenue growth has improved in recent quarters. Up to they're about up to 25% revenue growth in their last report. Still very unprofitable. They spend a lot on share-based compensation. Their GAAP loss is still pretty close to the amount of revenue they're taking in. So I think it seems like they're still years away from profitability if they can get there. So I don't want to call them a loser. I mean, I think the jury's still out on them, but I personally think they're better AI stocks to own. I don't know if you have an opinion on them, Danny.
I do, and it's not quite as nice as yours. I remember when C3 was going public, and I went back and did some research on the company. Back in 2016, their name was C3 IoT for Internet of Things.
Right. Yeah.
Then shortly after that, they changed their name to C3 Energy. Then they changed their name to C3 AI. And their CEO, founder, I can't remember his first name, but Sciple is his last name. And he liquidated hundreds of millions of shares of the company shortly after the IPO. And I don't know, that to me, there were just too many red flags on this one. Just because you say you're an AI company, don't make it so. And yes, they do peddle AI models. Basically, they're turnkey models that companies can do. But if you don't fit in that little niche, it's probably not going to be that useful for you. So I would say, yeah, I wouldn't touch this one with Jeremy's money.
Yeah, the name change is a good point. Yeah, that does. Yeah, I remember learning that, and it does certainly raises that skeptical eyebrow.
Yeah. So we've got a question in the queue that came in not too long ago from John Gallegos, who said, Danny and Jeremy, any thoughts on some of the mid-cap software stocks such as DocuSign, Twilio, Roku, and Zoom? Tickers DOCU, TWLO, ROKU, and ZM. Well, we've actually just talked about DocuSign and my feelings on them. And actually, Jeremy and I both just talked about Roku. Basically, I think they got I gave a thumbs up to DocuSign and said I think that they have a pretty solid path ahead, although, there's still some work to do. Jeremy talked about Roku. We both think that the company, even as an industry leader, doesn't get a lot of respect. I also said, kind of in passing, but that I had lost faith in Zoom video communications, primarily because Zoom was one of those companies that I believed that would continue to grow at a healthy clip after the pandemic was over. And that prediction ended up being wrong, which was not surprising to me. I get stuff wrong all the time, but I was certainly wrong about Zoom. Now, Twilio is an interesting one. Twilio is a company that they provide basically the pre-built software architecture to other companies that allows them to integrate communications capabilities within their apps and their websites easily to have their customers, reach out to them. So, for instance, if you've ever been on Netflix's website and you clicked on the link for customer service, Twilio was probably behind that. If you get updates on your deliveries for your food delivery service in real time, that's probably a function of something that Twilio put together. So there's a lot of utility there. There's a lot of opportunity there. And they were growing very quickly for a while. But then when the economic downturn happened, Twilio kind of, their business and their stock both fell off a cliff. I still own the shares. But this is one that I have been watching, and basically I am cautiously optimistic that Twilio can, resume at a little bit higher growth rate than what we're seeing now. So I'm still moderately bullish on DocuSign, on Twilio, on Roku, not so much on Zoom. And I'll let Jeremy speak for himself.
Yeah, Twilio is one. Yeah, I did own it. I sort of gave up on it. I haven't followed it too closely since then. Fun fact about them: their former CEO and founder Jeff Lawson now owns The Onion, the satirical newspaper. So odd career twist there. Roku. I just spoke bullishly about. I mean, it's been a frustrating one to own, but I think there's still a pretty good opportunity for them long term. I agree with your thoughts on Zoom there, Danny. It feels like the company just had the misfortune of reaching that sort of terminal value during the pandemic, and everybody who was ever gonna need Zoom used it then, and they've. I think what's been disappointing about them since then is that the lack of growth maybe doesn't seem that's so surprising now. But they've been unable to pivot either they had that failed acquisition of Five9, and maybe you would have liked to see a new product launch or something like that from them. I mean, they're still very profitable, but it's hard for a software stock like them to do well in the market without really much growth. And DocuSign is not one I know super well, so I think I'll yield to your commentary there. But with that said, it is about 5 o'clock, 5:01 here, so I think we got a new batch of hosts coming on.
I think we're going to be joined by Rachel and Will.
And we're back.
And there are Rachel and Will.
Hey guys, Danny, I think I'll be seeing you in about an hour.
You will be seeing me in about an hour, and we get to talk. Mag 7 and FAANG, right?
Yes, looking forward to it.
All right, Fool on, guys.
Thanks, Danny. Thanks, Jeremy. All right, Fools. Welcome to another hour of Fool24. Will and I, we were on earlier today doing our deep dive into DoorDash, and we are back as your co-host for this hour. But this hour, we're going to be talking about cyclical versus defensive stocks, which I think is a particularly interesting topic as we are looking at the current environment. There's a lot of news and volatility that we've been seeing moving the markets recently. We obviously, as long-term investors, we don't invest based on short-term movements, but there's a lot of fascinating stocks in both the cyclical and defensive spaces that investors might be looking at a bit closer these days. And I do think it's something, that's worth considering as well. Something we note a lot here on the show, and I'll highlight again, is, we are not here to give personal financial advice. That's not something we are able to do. We don't know your financial situation, the composition of your portfolio. We are not able to tell you what stocks to buy or to sell. That is beyond our purview. But we are able to talk about companies that we're interested in. We can answer your questions. We can give our opinions. And we have a very motley group of opinions here at the Motley Fool, which honestly just makes it so much better. But how's it going, Will? It's good to see you.
It's good to see you. It's like I just saw you a few hours ago.
I know. I'm getting a weird sense of deja vu.
Yeah.
I know we both have a few companies we want to talk about, but maybe to start things off, I'll briefly just talk about this idea of cyclical versus defensive stocks. And what does this actually mean, right? So when we talk about cyclical stocks, we're talking about shares of companies whose performance is closely tied to the ups and downs of the overall economy. So these types of businesses tend to thrive during economic expansions and maybe struggle during downturns. Cyclical stocks can be stocks of companies that produce or sell goods and services that are considered discretionary, meaning that consumers are more likely to buy these items when they have more money, and they might be less likely to put that money to work in those items when the economy is struggling. Something that is often a characteristic of cyclical stocks is these companies' earnings and stock prices can be highly sensitive to changes in economic conditions or sentiment. So changes in GDP growth, consumer spending, and interest rates can put downward pressure on share prices as well as those businesses. Examples of cyclical industries, there's, stocks we talk about a lot in places like the automobile industry, airlines, travel stocks, restaurants, hotels, high-end retailers. We also see that true in other areas as well. There's a lot of tech stocks that have cyclical orientation within their business. I personally invest in a wide variety of cyclical and less cyclical stocks. I think that there's a lot of great opportunities in these spaces, but it's kind of important, I think, to understand what the characteristics of these companies can be like. Cyclical stocks do tend to outperform the market during times of economic boom, and they often underperform during recessions. So sometimes we will see this pattern where investors who believe the economy might be on the cusp of a downturn or a recessionary period, we might see a sell-off in cyclical stocks. That's something we've seen recently, where pretty solid, fundamentally great businesses are seeing downward pressure on share prices as sentiment and volatility afflicts the markets. Non-cyclical stocks, or more defensive stocks, tend to go back to companies that produce or sell goods and services that are considered essential, which means consumers are more likely to buy these items regardless of what is happening with the economy or the broader world. These can be companies in the food and beverage space, healthcare, which is obviously a huge area of focus for me. Healthcare and all of its various sectors are broadly considered to be far less cyclical than some of these other industries. Utilities can also be very defensive. And defensive stocks are often ones that also tend to grow at a slower rate during times of economic boom, and where those growth-oriented cyclical stocks tend to outpace their performance. But at the same time, sometimes during economic downturns, you see that these stocks might remain more relatively stable. Investors sometimes see them as a safe haven. These are often companies operating in sectors like consumer staples, as I mentioned, healthcare, areas where demand is consistent even during recessions. And again, these could be slower growth businesses. A lot of defensive companies also have a lower beta, which means just their price volatility is less than the overall market. But they might also be much slower compounders over time. A lot of defensive businesses, I will also note, have a history of paying consistent dividends. And that can provide a steady income stream for investors. As I mentioned, I like investing in a combination of both of these types of businesses. I have definitely favored that mixture through the years. But some investors prefer to invest heavily in one area versus the other. It's a very personalized thing. But looking at the differences between cyclical stocks, defensive stocks, there's so many companies we can think of in this space. Well, as you sort of think about this theme, are there any companies that really stick out to you?
Well, there are companies that stick out to me, but I do want to emphasize that just because cyclical stocks grow faster, that doesn't mean they're appropriate for everybody.
Right.
There are times that an all defensive portfolio can be appropriate for you. It really just depends on your investing goals. Now, if you're younger, just starting out investing, you're going to be in the market for a few decades, you probably do want to lean more towards those cyclical stocks. However, if you're near retirement or retired, depending on income, that's where maybe the defensive stocks might serve you better, especially because there's so many that increase their dividends every year. So, I think it's important to understand both. In terms of companies, when it comes to cyclical, I wanted to highlight AMD. AMD is one I own. It is very cyclical. And as are really all semiconductor stocks, the semiconductor industry is almost famous or notorious, depending on your point of view, for its cyclicality. What happens during a boom time is demand for chips will rise. The companies will henceforth raise their prices, and that will go on until the economy turns or the prices become too high. Then demand falls and they're cutting their prices. And when they're raising their prices, the stocks typically go up. Generally, when they're cutting prices in a recession, not surprisingly, they'll fall. AMD has been falling over the last year. It's down about 54% from its high just over 12 months ago. And you also have to kind of realize that AMD it's in 4 different segments. Data centers is approximately half of its revenue. That's the AI accelerators. That's where it's competing with NVIDIA. And as you can see here, it grew 94% over the last year. So that's a very, very fast growing segment. Clients, a lot of people don't get confused by that term, but client basically means the PC business, which I think everyone's familiar with that. But that's been kind of in an uptrend. That's up 51% over the last year. That's about 28% of its revenue. Its smallest segments now, and this is because the revenue has been falling so much lately, at least a lot of the reason why. Gaming, which is now 10% of revenue. AMD is probably better known for making the gaming console chips for the Sony PlayStation and Microsoft Xbox. So those consoles have not been updated in a number of years. That's why that segment is being hammered so hard. And I think that's why the stock is down so much. Investors don't like to see that, see it in a downward cycle. So, and then embedded has been down to a lesser extent. That's more the business to business side. Chips that are embedded into products. That's as the name implies. So, but I do like the stock. Like I said, I think the data center segment and the client segment, that's almost it looks like 77% of revenue right now. That part of the business is very much in an upcycle. So it's kind of weird to me the stock's down so much, but because the stock is down so much, it's trading at a forward PE ratio of 22, which that's more appropriate for a defensive stock, which I'll talk about in a minute. A higher growth stock like AMD should not be selling it at 22 times forward earnings. So I think this is one that's fascinating because it's part of the business is an upcycle, the other part's in a down cycle, but it's being treated like a down cycle stock, even though most of the revenue is actually upcycle. So it's in a very interesting position right now, but it's what I think investors should watch.
Yeah, maybe real quick, I'll touch on a couple and then we can kind of switch over to more defensive businesses. One that I own is Shopify. I could definitely see that being I think we've seen that already in the last several years, a business that is prone to cyclicality. I'm a long-term investor in this business, and it's one I still, really like. You think about, what their revenue breakdown looks like. They primarily earn revenue from their merchant solutions segment. That generates over 70% of the total revenue for the business. And merchant solutions is a revenue source that is comprised of several different areas, right? So payment processing fees is a big driver of their merchant solutions revenue. So fees that Shopify charges for processing payments made on its platform. If transaction volume declines on the merchant platforms, the merchants that are using Shopify's software, that's obviously something that impacts revenue and trickles down as well to profitability. Another element of their merchant solutions revenue is referral fees. So revenue from referring merchants to other services or products. Obviously, advertising is a notable source of revenue for them as well. And then they sell point of sale hardware to merchants. And all of that is encompassed within their merchant solutions revenue segment. Then more like 30% or so of their revenue comes from subscription solutions. Those are the monthly subscription fees for using the Shopify platform. That contributes a smaller share of their revenue. And obviously that is that critical infrastructure that merchants need to keep their businesses running. So even in a period of economic difficulty, it's hard to imagine that merchants would do away with those subscriptions, but you would probably inevitably see a hit in terms of payment processing fees if transaction volume declines. But, looking over the long term, this is a stock that I have held for almost 5 years at this point, and it has been a volatile time to be a shareholder in Shopify. They have gone through a significant period of transformation the last few years. They saw a huge run up in growth during the pandemic. That was a period of growth which probably, like some of these other companies we've seen that saw just outsized performance during the pandemic, might have been realized in a much longer period of time if the pandemic had not occurred. And a period of growth normalization that followed that. Investing more heavily in logistics and then quickly pivoting away from that, which was also a costly, but I think over the long term, a good choice for the business. Scaling their headcount at one point, they had 1 or 2 different rounds of layoffs. It was a bumpy few years for the business. And I think it's realistic to expect that, if, recessionary headwinds were to prevail, which I am not saying they will, and I hope they do not, this is a situation where a business like this could absolutely see a short-term impact. But over the lifespan of a long-term investment in this business, I think this is still a really exciting company to buy and hold for the long run, at least for my personal portfolio. Their most recent quarter was their 7th consecutive quarter of 25% or greater revenue growth. They grew their free cash flow margin sequentially each quarter of 2024. They've been successively growing their profitability as well as their operating income and getting back into a solid track record of GAAP profits. Their margins are looking really good. This is a really interesting business and one that, despite its cyclicality, for me and where I'm at in my investing journey and my interests and the types of stocks I gravitate towards, is one that I find really fascinating. Real quick, another one as well that I do not currently own that has seen a real pressure on its shares the last few years is Airbnb. This is obviously a business that is going to be prone to cyclicality, right? If consumer spending slows, people are going to be spending less money on travel. That is sort of a reality. But at the same time, we've also seen the last few years, this is a business that has done an exceptional job of growing profitability, cash flow, and recording really strong revenue growth figures, even as consumers have been curtailing spending a bit. And some of that is probably a function of, pent-up pandemic demand. But I also think that that period of, cash that was held back during the pandemic, a lot of that has probably been expended at this point. And I think that you're also seeing a place where consumers are still prioritizing some of the travel spending on, experiences rather than things in a way we were seeing, during the pandemic several years back. So I think that's another good example of a cyclical business, but one that I still find really intriguing and one that I've been watching really closely over the last few years, particularly as the landscape in which it is operating has continued to evolve.
Yeah, and I should say that I own Shopify also, as well as AMD. With Shopify, it is a cyclical stock, but it's kind of in a weird place. You did feel the cycle, post pandemic when all that front loaded growth for pandemic related companies suddenly reversed, and you felt it then. I don't know that you're feeling it quite so much now because. Even though it still is cyclical, the industry is now growing so fast that's going to minimize the cyclical effect of it. So when you're dealing with growth stocks, you're not only dealing with the cycle of the overall business, but you might be dealing with the cycle of the stock as well. So you have to keep the two separated when you're dealing with a faster growth stock like Shopify. So that's one thing to keep in mind. In terms of defensive stocks, I was going to highlight Kroger, which I do not own. But Rachel just mentioned that grocery stores or anything food related, or most things food related, except for maybe high end restaurants, that's going to be very defensive. We all have to eat, so that's no matter what the economy is doing, that's not going to change. So even if times get bad and people can't afford to go to restaurants, or at least high-end ones, they're always going to be buying groceries. So Kroger's been a fairly stable business. The stock is actually trading at an all-time high right now, if you can believe that. The revenue was down 2% last year, but they did divest their specialty pharmacy business. So that I think that was the reason for the revenue decline. You're really not going to see revenue declines very often with a business like this, unless there's some one-time event like that. So, but EPS was up 23%. And a lot of times investors are happy when they get a 1% net margins in the grocery business, but this one is looking towards 2% net margins. So it's you have 147 billion in revenue, 2.7 billion. That should be income, not earnings per share. I apologize, but that's almost 2%. So that's what is actually for a grocery business. That's actually pretty strong. Now I know the growth is not going to blow your socks off. Revenue outlook for 2025 is only 2 to 3%, and that's going to be typical for a stock like this. But it's Kroger's now the biggest nationwide grocery chain. They tried to merge with Albertsons, but that was blocked by the government. Now they still, that was somewhat controversial because they would still have competition from places like Costco or specialty groceries like Trader Joe's or regional grocery stores like Publix in Florida or HEB in Texas. But I think the government was still a little bit uncomfortable with that. With that, despite that, so now we again have, we still have, I should say, 2 nationwide grocery chains, with Albertsons being the somewhat smaller. But it is growing by it's going into digital sales and growing that by double digits. Strong free cash flows. With the dividend, it now pays $1.28 per share yearly. It's a yield of about 2%. The S&P 500 is yielding between 1.3 and 1.4% nowadays. So that's a relatively strong dividend. It's also it increased its dividend for 19 straight years. So you're getting to where investors start expecting dividends. I think if they were to cut their dividend or not increase it for a year, that might put a lot of investors off, and that could hurt the stock. I don't think they're going to do that, and unless they're absolutely desperate. But I don't see any scenario where they're going to get into that desperate situation. Like I said, it's nationwide. They operate under multiple names. It could be King Soopers in Colorado, Fred Meyer in the Pacific Northwest. It is based in Cincinnati, so a lot of places will use Kroger, but they bought up so many grocery chains over the years that they have several names, but that are under the Kroger umbrella with those roughly 2,700 stores. They've had a little turmoil with the recent resignation of their CEO, Rodney McMullen. That's going to bring a little bit of uncertainty, but because this is a stable business, I don't see that disrupting things too much. But no, again, it's not going to be runaway growth. But if you're looking for an income stock, I think this is a good one to consider, in my opinion.
Awesome. One I could highlight that I own as well, speaking of defensive stocks, is Johnson & Johnson. I've owned that stock quite a few years. This is one of the most sort of classic pharmaceutical healthcare businesses you could think of. And ironically, this is a company that has not been a very high portfolio performer. This is a company that has a pretty long-term trajectory of growing very slowly over the period of years in terms of share price increases, although they've been a really faithful dividend payer through the years. And that's really why I invested in the stock. And also it was one of the first healthcare stocks that I ever bought. Their yield is about 3% at this point, partly as a function of the kind of sluggish, if you will, share price performance. But that is still quite a bit higher than the average 1.3% for the typical S&P 500 stock. They've been paying dividends for 62 consecutive years at this point, and they have regularly increased their dividend payout, I should say, for 62 consecutive years. And that's been something that has been a hallmark of the business, is continuing to pay and increase their dividend through a variety of economic landscapes. Johnson & Johnson has gone through, a number of changes over the recent years. They back in 2023, they spun off their consumer health business, which had been a much slower growing area for the company. That's a business that was known for names like Band-Aid, Listerine, some of the other flagship, household items, but was a very low margin, slow growth business. They spun that off into Kenvue. That company started trading on the New York Stock Exchange in May 2023. And since that time, they've continued to really focus on their faster growing pharmaceutical business, as well as their medical device business, which they have continued to bolster through a series of acquisitions. And that's something that they have also really been focusing on, acquisitions, since they spun off their consumer unit in 2023. For example, they announced that they were acquiring a company called Intracellular earlier this year. It's its biggest deal in the last few years, and this is designed to boost its portfolio of psychiatric drugs. It acquired, I believe it's called Abiomed, a company a few years back, which is the maker of the Impella heart pump. They've been focusing heavily as well on growing their heart device business within their broader medical device business. They also last year bought a heart device maker called Shockwave Medical for $13 billion. And that's been another notable part of the business's pivot towards focusing on growing their medical device business, growing their flagship pharmaceutical business. How they reported is they put all of their pharmaceutical products under the segment called Innovative Medicine. A huge focus for that segment is oncology drugs, which is something that they've been known for a long time. But they also focus on immunology drugs, drugs targeting various neurological disorders, cardiopulmonary disorders, as well as specialty ophthalmology. Darzalex, which is a monoclonal antibody for multiple myeloma, is one of their top-selling drugs. Another top-selling drug of theirs is Stelara, which is used for the treatment of psoriasis and other inflammatory conditions. A newer addition to their portfolio that is expected to be a big growth driver for the business in the coming years is called Carvecti, and it's belongs to a class of drugs known as BCMA CAR T therapies, and it is also approved for multiple myeloma. This has been a new addition and growth driver for their innovative pharmaceuticals business. That drug achieved $963 million in sales last year, which nearly doubled from the prior year, which is, I believe, the year when it was first approved. So just shy of blockbuster status, which is required when you deliver $1 billion in annual sales. They're also known for their androgen receptor inhibitor, Orelli, which treats prostate cancer, Tremfya, which is another psoriasis drug, Spravato, which is an antidepressive. So a really wide-ranging portfolio. They also have a really extensive product pipeline. Again, this is not a company that is known for super high periods of growth. Share price performance is usually quite moderate. This is really a business that is known for a robust balance sheet, a really impressive medical device and pharma business. And that has really translated to exceptional profits and revenue through the years. Single-digit revenue growth is common for a business of this maturity and level of growth in its business. So that's something I think to be aware of as well. But it's been a great dividend stock for me through the years. It's one that I have continued to be intrigued in as they have really evolved over the last several years, and I think are working to enter into their next phase of growth, particularly with the acquisitive streak they've been on since they spun off their consumer health business. So that's one example of a company I own. There's so many others in this space, classic consumer staple stocks like Coca-Cola, PepsiCo, Philip Morris, other healthcare businesses like United Health, Pfizer, AbbVie, which is one I own. I would even argue that Dexcom, which is a company I talk about a lot, it's a pretty defensive business with their focus on continuous glucose monitoring devices. McKesson is another one. There's just a lot of really interesting ways to play this space. And as I said, for me, based on my stage that I'm at in my investing journey, I have favored investing in a combination of cyclical and defensive stocks. But it's a very personal journey for every investor.
Yeah, so digging into the questions, there's one about a very cyclical stock I wanted to address. Well, it's actually to Lou, but I'll take it anyway. About 3 hours ago, Bessie's asked Lou, or Will in this case, what are your views on GRMN, which is Garmin? I saw the radar and sonars they have on boats at the marina. How big is that part of the business and growth? Well, I looked that up. I haven't followed Garmin in a while. I was in it, back in like 2006, 2007. No, at the time it led the GPS business, but then the iPhone came along, wiped that completely out. I thought Garmin was going to be dead in the water after that. No pun intended. But however, they did pivot to where the smartphone apps were not pivoting. So they went into, well, I guess fitness they're into now, but they went to outdoor, aviation, marina, like Bestie's mentioned, and auto OEM. So this stock has really revived itself. It finally got back to its 2007 high earlier in this decade. And I think it trades near. Well, let's see, I need to check it lately, but I haven't checked it lately. Let's see where it is now. Yeah, it just recently hit an all-time high before pulling back significantly very recently. But I'm looking at the marine business. That's it earned about $251 million. It looks like in the fourth quarter of 2024. It's not really that big a growth business. It's about 23% of Garmin's business right now. It really grew at about 5%. The really fast-growing parts of Garmin are fitness is fast growing, as is outdoor and the auto OEM. Those are growing at around 30% a year. So at least in the fourth quarter, they grew that fast. So I think this is a great business. Looking at the valuation, it trades at a PE of about 29. So given how fast some of that revenue is growing, the revenue overall grew. Looks like 23% for the fourth quarter, about 20% for the year. So this is a fairly fast-growing company. I think that's a good price. So I think this is one you want to put on your radar.
There were a couple questions that had come in a while ago that I wanted to hit. And Fools, if you have any questions about our theme or related to what we're talking about, feel free to go ahead and get those in the Slido. Let It Ride had asked a few hours ago, and this is probably related to when I was talking with Jayson Hall about valuation. This is a good question. How do you value a biotech stock? Because obviously there's different valuation metrics that we all talk about. We talk about price to sales, price to earnings, price to book, free cash flow. There are a lot of different valuable metrics that we use when we look at companies, and it's also important to look at those metrics in light of the specific industries in which those businesses are operating. So for biotech companies, it can be a little bit different sometimes. One of the things to look at besides these key metrics that we talk about are also evaluating biotech businesses at their face based on how these work, understanding that we do see some of these bigger, more profitable biotechs. A lot of the biotechs that are trading today are businesses in the much earlier stages of their growth. They may or may not have more than one or two products commercialized. A lot of the hype you might see around their stocks, which often feeds into sky high valuations in some cases, is really all about excitement for the business's potential. I may not necessarily go back to actual sustained profitability that the company has reported so far. So there are some, I think, major things to consider when you're looking at these businesses. From just looking at the business as a whole, in addition to some of these metrics I mentioned before, you want to think about the stage of clinical trials or development of the drug candidates or key candidates that company has in their portfolio. Early stage companies tend to be valued based on the potential of their pipeline. Companies with products in later stages of development or on the market are valued based on their actual or projected revenues. There's a lot of factors to consider as well, including the likelihood of a drug candidate succeeding in clinical trials, receiving regulatory approval, the size and growth potential of the target market for the drug or technology. Are also really key indicators of potential revenue and profitability to consider. The ability of that company to gain access to the market and rate of adoption by healthcare providers and patients are important factors to consider too. Looking at the competitive landscape for the business, including existing treatments, potential competitors, is also really essential. Now, when you have companies with products that are actually on the market, obviously metrics like revenue, sales growth, profitability metrics, if indeed those exist for these businesses, are really important indicators of performance. But beyond that, you also want to be looking at things like their research and development costs. What are their cost-saving initiatives? What are their profit margins looking like? Some of the factors that can also impact that are funding status, financial resources that are crucial for supporting research and development and commercialization of their products. These are things that I also look at very closely when I'm evaluating biotech companies beyond just these, initial valuation metrics that we talk about a lot. In addition to R&D costs, research and development costs, you really want to consider these businesses' debt loads as well. High debt can negatively impact a company's financial stability, of course, its ability to invest in future research and development. A lot of these early stage biotech companies are laden with debt. There's a lot of operational costs into getting these businesses, off the ground, commercializing your first product or products. A lot of them are really reliant on funding from the government or other larger research institutions. Something as well to consider when you're looking at these businesses. And that's why I wanted to talk about it beyond just the, traditional metrics we talk about, like price to sales or price to book or, free cash flow, price to free cash flow, is also thinking about the company's pipeline. What is the stage of development of their drug pipeline? Are there drugs that are in later stages of development, like phase 3 clinical trials? Are a lot of them in earlier stage clinical trials? What is the state of their pipeline looking like? And then what is the size of their market for those potential drug candidates? Those are some other things to consider. One other thing I would note as well when you're looking at biotech businesses is you want to have some understanding of, the strength and breadth of the patents that they hold. And a really robust patent portfolio is crucial for biotech companies. It really provides a competitive edge. It protects their proprietary technology. those are some things to consider beyond just, the traditional financial and valuation metrics. Obviously, cash flow analysis is really important. A lot of biotech valuations rely on discounted cash flow analysis, which projects future cash flows and discounts them to their present value. That's something as well to think about. Revenue multiples, of course, like price to sales. But those are some additional factors to consider if you're looking at biotech businesses. Beyond just the face value financial metrics that can help you get a much more comprehensive and holistic view of the health of that business.
Yeah, so I wanted to tackle this question this really comment from Bessie's 4 hours ago, because it really talks about the limits of growth stocks, of these cyclical stocks when they're growing over a long time period. Bessie said we should temper our expectations and start with the possible. Apple did 25% compound annual growth rate since the 1980s, and Microsoft since 1986. Berkshire 20% since 1965. Coke since 1900. I think those, 15% or 20%. I think those are over the long term. I think those are very good companies can maintain those kind of growth rates over the long term. Once you start getting past that, I'm not going to say it's impossible to maintain, but it's going to be at least over, if you're going 10, 20, 30 years, multiple decades, it's going to be hard to really go too far beyond that. Bessie's pointed out that Apple's 25% CAGR since the 1980s. That also includes a period, between the two times that Steve Jobs served in the company, where it went down and, frankly, nearly went bankrupt. And then Microsoft, it's up a lot since 1986. However, between 2000 and 2014, the stock actually fell. I'm not quite as familiar with the history of Berkshire or Coke going back decades. They all had their, they've been through the cycle several times at this point. But I think you really have to temper your expectations with long-term growth. You have NVIDIA, which was growing at triple digits until recently. That's kind of coming to a natural slowdown. I think they were predicting, I'm going off memory, but I think it was 58% revenue growth in the upcoming quarter. And that's still a very impressive revenue growth rate, but because it's a little slower, that might, disappoint investors slightly. But I think you really have to temper your expectations on growth when you're looking at cyclical stocks, especially ones that grow over the decades. You're not going to get these massive growth rates forever. And, since it's cyclical, you're going to deal with sometimes very, very long times when the stock either does nothing or actually goes down in value. So, it's a lot of investors, frankly, don't have the stomach for that. So they might, and some of those might turn to defensive stocks, or they might turn to index funds. Investing is a personal experience. Some investors are going to have a greater comfort level than others in dealing with the cyclicality. I'm fairly comfortable with it, but I have a lot of friends who used to be stock investors and went to the indexes too. So, it's not for everybody, but if you're going to be a cyclical investor, I think that's one thing you're going to have to keep in mind.
There was a question I wanted to answer that also came in about McKesson, which is a company I talked about a little bit earlier today that I wanted to hit really quick. Besties was asking, what are the expectations for McKesson over the next 5 years? So anyone that doesn't know this business, this is a very diversified healthcare services company. They make money primarily through pharmaceutical distribution. They also have a health IT segment, medical supplies, care management tools, or other sources of revenue. But their biggest and most high growth business is in the area of pharmaceutical distribution. They are a major pharmaceutical wholesaler. They buy branded and generic drugs from manufacturers. They deliver them to pharmacies, hospitals, and other healthcare providers. They earn revenue by handling logistics, inventory, compliance, and credit risk for manufacturers, as well as markups on generic drugs. Their health information technology segment includes technology solutions that they provide to healthcare providers that include practice management software, electronic health records, and other IT services. Another maybe smaller part of their business as well as medical supplies. So they supply a wide range of medical and surgical supplies to various clients in healthcare settings. They offer tools and services that help these providers manage patient care. That includes specialty pharmacy services and oncology services. They also generate revenue from logistics and supply chain management. So they manage the really complex logistics of moving medications and supplies from manufacturers to healthcare providers. They distribute specialty medications as well, which often have higher product margins. So what are some of the growth catalysts for this business over the long run? Well, one is its biologics business. We're also seeing a really strong and robust and rising demand for specialty pharmaceuticals. GLP weight loss drugs, that's been an area where McKesson has really risen to meet the occasion in the last couple of years as a key distributor of healthcare pharmaceutical products. They are also working to expand into ophthalmology and retinal care, which is sort of mirroring their strategy when they first expanded into oncology. And that, again, I think kind of underscores their commitment to these high value specialty care markets. But as we're seeing a rising demand for specialty pharmaceuticals, that's really contributed to their revenue expansion. Their biologics business is really expected to contribute as well to future growth. They acquired a company called Prism Vision, which again kind of highlights their focus on expanding into ophthalmology and retina care. And they have a really extensive history of growing through acquisitions. And that's allowed them to really expand their service range, become a leader in specialty care distribution, while offering a wide range of clinical, financial, and technological solutions. They've also been working in investing in expanding their distribution centers, integrating AI into their services, and that has also bolstered their revenue. But their prescription technology solutions segment has really been a key growth catalyst for the business through the years. They're also working on really establishing themselves, and have done so through the years, as a leader in the healthcare supply chain, ensuring products reach care settings across the country. So they work with a wide range of companies and organizations across the healthcare spectrum. These include biopharma companies, care providers like hospitals, pharmacies, manufacturers, governments. So they will supply, for example, pharmaceuticals and medical surgical supplies to hospitals and health systems. They are the company that helps actually distribute pharmaceuticals from the manufacturer and get them to the independent pharmacies that distribute them and prescribe them. They help provide long-term care facilities with pharmaceuticals and medical supplies. They also provide supplies and equipment to clinics and surgery centers. And then they work with specialty providers, including those in oncology, to deliver these types of solutions. Something I mentioned as well is they've been heavily involved in the distribution and related services for GLP-1 medications, and including those used, for diabetes, as well as weight loss applications. They have been one of the key providers involved in the pharmaceutical supply chain, distributing specialty medications like GLP-1 drugs to pharmacies, hospitals, and clinics. The high demand and the growing demand for specialty drugs like these has created some supply chain issues. Now, McKesson has really worked to fill that gap. This is what their business is all about. But some of that has also impacted, their sales and margins. This is a pretty solid business. They haven't reported for their full fiscal 2025 yet. They report their year a little differently, so they are well underway into their fiscal 2025. But in the first 3 quarters of their fiscal 2025, they reported revenue of about $268 billion. That was a 15% year-over-year increase, while their net income was down slightly year-over-year. That was about $2 billion. They're also a consistent dividend payer. So they returned $3 billion of cash to shareholders in the first 9 months of the fiscal year. And that included $2.8 billion of common stock repurchases and $254 million of dividend payments. Now, their real driver of their top line growth continues to be their U.S. pharmaceutical segment. And that's due to increased prescription volumes, including higher volumes that they've been seeing from their retail national account customers. Now, they had been a major supplier to Rite Aid, which had previously filed for bankruptcy. So some of the impact that we've been seeing on their earnings recently has been correlated to bad debts related to that Rite Aid bankruptcy. So that would be more short-term pressure on their growth and margins there. But these are kind of the tailwinds for the business over the long term as they continue to expand into these different areas and really fine tune their supply chain systems. Again, that U.S. pharmaceutical segment is a huge driver for them. Revenues in that segment alone were up 19% year over year. Their prescription technology solutions segment is another area where they're seeing really solid growth. That segment delivered growth of about 14% year over year. They're also really focusing on their international expansion. They've been driving growth in their international segment up sequentially. Revenue there is smaller part of their business, but it increased 6% year over year in the recent quarter. And part of that was higher pharmaceutical distribution volumes in their Canadian business that we're seeing as well. So it's interesting to see how the rise of specialty pharmaceuticals is something that can really impact the business over the long run, and where they are really well positioned to fill a gap in the market. And then again, as they've expanded more into oncology, ophthalmology, some of these other areas, that's been something as well that has been a real tailwind for the business, and I think will continue to be so over the next 5 to 10 years.
Yeah, so Steve Mitchell asked about 4 hours ago, or really he commented, I prefer Wingstop, symbol WING, to Kava, symbol CAVA. Kava is great, but it is not coffee, melted cheese on meat, or chicken, which is all true. These account for virtually all of U.S. QSRs. I have to agree with you there. Maybe not because of the preferences, so that probably is a melted cheese on meat is probably a preference to Mediterranean food, quite frankly. I happen to like both, but Mediterranean is more an up and coming cuisine, whereas wings, or if you look at Mexican Chipotle, it's a little bit more established. So I think Kava maybe has a disadvantage there. Also, Kava has been run up over the last year, and it's fallen back some. Looking at the PE ratio on each, Wingstop's PE is about 58, which is high, but it's not as high as 71 for Kava. Looking at the price to sales ratio, actually the price to sales ratio, they are about the same, but it's, I think looking at the forward PE, I'd have to give the edge to Wingstop on which is cheaper. Looks like Kava may take a hit on profits because their forward PE is higher than their trailing price to earnings ratio. I think also Wingstop is a little bit more established. They have more than 2,000 locations. That's I can't remember how many locations Kava has right off the bat because I don't have the information in front of me. But they're like, I want to say they're in like the 300s or 400s in terms of locations. They are growing at a rapid clip. But just because I think Wingstop is a bit more established, and they have more stores, that their cuisine I think is a little bit more popular overall, I would probably give the edge to Wingstop as well. So I agree here.
I like Kava. That's one I've been following a bit more recently because I think we get a lot of questions about that in the Fool universe. But I also really like Wingstop's business model. I do think both of these businesses would be prone to some changes, if consumer spending is curtailed a bit. But, when you think about this, these types of businesses have pretty, accessible meals from a price point perspective. And I think that people are going to maybe be more prone to, go spend, say, $20 on a meal than say they might be putting towards things like plane tickets or other areas where we've been seeing some of these companies that have been, kind of dragged down by the sentiment of the broader market. But yeah, over the long term, I like both these businesses. I did a deep dive on Wingstop some months ago, and it was really interesting to me the way in which they maintain like a really controlled, the way they maintain control over their supply chain, the way they vet their suppliers, and how, the very unique ways they've structured their franchise agreements, both domestically and abroad. And I think it's led to a lot of success for the business over the long run. So yeah, even though there's been some volatility with share prices there, I have found that to be a pretty interesting business.
Yeah, I think with the restaurant industry too, you have both cyclical and defensive. If you're looking at the higher end restaurants, that's definitely going to be more cyclical. I think in a down economy, people still need an escape. I don't think they typically don't stop eating out completely, but they're going to go for the $20 Wingstop meal instead of the $75 meal at the steak or sushi house. So I think both Kava and Wingstop, I think I would call them defensive stocks in my opinion.
Yeah, I mean, I think in my opinion, they probably fall somewhere in the middle. I definitely don't think that they're as cyclical as some of these other businesses we've talked about. I do think there's an element of, defensiveness there, because I do think that they are able to retain consumer dollars, even if spending, slows overall. But yeah, Kava is also a really interesting one. They've been expanding at a really steady rate, but very intentionally and strategically. They've been growing their profitability, which has been really interesting to watch. And they're doing really well, especially when you pair them up against some other company like Sweetgreen, which is also kind of an interesting business in that space, but not profitable, dealing with a lot of capital intensive maneuvers as they're trying to expand their business. So yeah, it's an interesting space. I find following restaurant stocks broadly very interesting.
Yeah.
This actually relates to what we were talking about earlier with DoorDash. There was a question from Ed that had come in 7 hours ago. This might be interesting to weigh on. Will DoorDash's gross margin get squeezed if they try to increase their market share? I think that came in right after we exited or wrapped up the deep dive earlier. Yeah, we've been talking a lot about how we were talking earlier today quite a bit about how that is a company that has expanded quite a bit internationally through acquisitions. Really one of the most prime examples of that is that acquisition of the Finnish company Walt that they made a few years back. And now they're present in something like 30 countries or more. But their most mature market is in the US. That's where they have the most extensive market share. That's where they continue to be the key and dominant player. And even though they have a presence in these other international locations, those are highly fragmented. There's a lot of local competitors that also continue to really fragment and disrupt that market. But there's also a real opportunity for them. I think that anytime you see a company that might be continuing to expand and enter into a time of expansion, that's inevitably going to weigh on the margins. I think we've seen this is a company that has been investing heavily in their growth the last few years. I mean, they really only had their first full year of GAAP profitability last year, and that was just about 120 million, somewhere in that ballpark. So I think we've seen that be the case where their push for growth, and that's something they've been investing in heavily, which can obviously pay off over the long run, has weighed on profitability and has weighed on margin growth. But I do think that if they continue to expand internationally, if they really work to leverage those acquisitions that they've made into meaningful market share expansions, I honestly think that that's how they win over the long run. So it's somewhat of a pay now, pay later sort of paradigm, because I think that unless they are able to really successfully expand internationally, I think at some point growth will slow significantly. But, I could be wrong. They've done really well with their focus in North America and specifically in the US. That's been obviously a huge area for them, and one where they continue to be, major key players, where despite these other players like Uber, they're still the market share leader. But I do think it's realistic to expect gross margin could get squeezed a bit if they continue to try to expand internationally.
Yeah, that's usually the way it works. I mean, there's going to be an outlay if they do that, so it only makes sense that there's going to be some challenges at first, and they're going to have to get established before they can get those margins back up. Daydreaming about 5 hours ago was talking about PayPal. I guess again another comment. I too still have PayPal. Talk about a middle finger chart. PayPal's been a tough one. I think in terms of cyclical and defensive, I kind of think that stock is in between. Obviously when the economy is booming, there's more economic activity, which means more payments. Of course, I don't think payments quite disappear when the economy turns negative, but there are reduced. So that one's probably in between. As for PayPal, their growth. Their growth is kind of slowed into the single digits. I think this is kind of becoming a more mature business. So I think we're going to be having slower growth on that going forward. I mean, like I said, I don't think it's fully defensive, but it's not exact. The cyclicality, I don't think is going to be there as much in the future, in my opinion.
Yeah, I think that's right. Looking through here, there was a question I saw and I lost it briefly. Any thoughts on VRT or VST over the next 5 years? So Vertiv and Vistra Corp. I don't actually know Vistra Corp very well at all. I've gotten to know Vertiv a bit more recently because we've gotten quite a few questions on that company. And I've had to look into it a bit more, and I find it really interesting, particularly as we're looking at a time where AI is, driving growth in data center and the need for power production. So Vertiv, for anyone that's not familiar, they are a company that provides critical digital infrastructure solutions, focusing on power, cooling, IT infrastructure management for data centers, communication networks, and other critical applications. So they offer critical power solutions like uninterruptible power supplies, DC power systems, power distribution, battery energy storage systems. A huge part of their business is also thermal management, so solutions for managing heat in critical spaces. They sell what's called modular data center racks, cabinets, and closure solutions. This is a business that I find really interesting as we're seeing the growth of AI and the need for high power in data centers. So because they're focused on providing these critical infrastructure solutions, including power and cooling to support, the growing demands of AI and also high performance computing workloads, their end-to-end solutions from rack level to modular data centers are really key. So we know that AI workloads require massive computational power. They generate significant heat. They demand robust power and cooling infrastructure, which is exactly what the Vertiv provides. It's sort of like somewhat of a pick and shovels play on the growth of AI and the need for data centers and how that's correlated with the expansion of AI infrastructure. Obviously AI data centers also need to be energy efficient to minimize operational costs, as well as environmental impact. And Vertiv's range of power solutions, high voltage and high density solutions, and then their AI specific power management solutions are really helping support new energy sources, but also to enable data centers for AI and other similar applications. So this is kind of an interesting business. I think that there's a really significant place for companies like this over the next 5 years. I think that where they are well positioned in the market is ideal as we're seeing the evolution of AI. We're seeing CapEx on different AI applications from some of these big tech companies. That all trickles down to the need for high computing performance, exceptional AI infrastructure, and all of that has serious power and cooling needs, which is exactly what Vertiv provides. So kind of an interesting business. Like I said, it's one I got to know more recently because we had some questions on it. Vertiv's also been collaborating with companies like NVIDIA to advance data center innovation. So that's been really interesting to watch as well. So this is one I'm fascinated by and watching a bit more closely.
Yes, we have about 2 minutes left, and we were talking about Kava and Wingstop just now. And I just can't notice this question from Bessie's or comment. Seth, you made a lot with CMG Chipotle. Do you think you can make a lot of money with Kava? You get another chance with valuation. I probably should have known this when you were talking about Kava. The stock is down hugely. Just in the last few weeks. Just since the beginning of the year, it's down by more than a quarter. If we take that out to the beginning of February, that rate falls to sorry. This. Bear with me just a second. So yeah, it's down more than 40% just since the beginning of February. So I think that's kind of changing the valuation dynamics of it a little bit. If you're looking to buy it, I think it's a little bit more risky than Wingstop, like I said. But at these levels, it's starting to look more attractive. Now it has been run up too, so that I think that's a big reason why it's now coming down a bit. But at these lower levels, it looks a lot more interesting. Going back to the PS ratio, the PS ratio is about it's now it's about 10 now, which it was flirting with almost 18 just a couple months ago. So, or not even 2 months ago. So that it has become cheaper. That's kind of changed the dynamics of it. So it might be worth taking a closer look at for that reason. If you believe in the Mediterranean segment and see a future, and there definitely could be. It's just slightly more risky because it's not quite as established as Chipotle or as Wingstop.
Well, and with that, it looks like we are to the end of our hour. Time has flown. It's a really interesting, it's been an interesting hour. I enjoy talking about these different types of businesses. Lots of intriguing ones covered, including some of these maybe slower growth, value-oriented businesses, as well as higher growth ones. A lot of interesting companies that fit into both of these categories. Looks like Danny is getting ready to be ushered into the room here. He's going to be joining me here for the next hour before I sign off for the night. Will, it was great doing the show with you. Good to see you as always.
Yes, we'll see you tomorrow.
Thanks.
Bye.
All right, fools. Welcome to another hour of Fool24. I'm sticking around for one more hour. It is, yes, it's 6 p.m. on the East Coast, right? It's 11 p.m. where I am here in Italy, so I am fully infused with caffeine at this point. Danny, I see you have yet another cool Hawaiian shirt for us today.
I do indeed. What's interesting is when I look down, the color that I see is green. But when I look at the screen, the color that I see is gray. What say you?
Yeah, it looks a bit gray from where I'm sitting. But, it looks good either way.
I wore green because it was St. Patrick's Day. And yet it looks gray.
You're right. I, as per usual, am wearing black. I should have worn green. Actually, you know what? No one can tell on camera, but I am wearing green eyeliner, so I officially follow the theme. Well,
spurred it.
I tried. This hour, we're going to be talking about Magnificent Seven versus FAANG stocks. And obviously, there's a lot of overlap between these different categories of stocks. We've seen the term FAANG be phased out a little bit more in recent years. It's an acronym that has shifted a bit through the years, but it essentially refers to publicly traded shares of these 5 prominent American tech companies: Meta, formerly Facebook, Amazon, Apple, Netflix, and Alphabet, formerly Google. And then you've got the Magnificent Seven, which includes a lot of these businesses as well, right? You've got Apple, Microsoft, NVIDIA, Amazon, Alphabet, any of these names sounding familiar, Meta, and then Tesla. So several companies on both of these lists. These are companies that are some of the largest and most prominent businesses in the world. There's certainly ones that tend to lead the direction of the stock market, particularly the tech-heavy NASDAQ, as well as the S&P 500 in times of market volatility. These are also some of the most, fundamentally successful dynamic businesses of our age that are moving the industries in which they operate and have been leaders in their respective spaces, for many, many years. A few of them I own. Several of them I do not. But it's interesting because we often see a dynamic in periods of market volatility where some of these, FAANG, Magnificent Seven stocks see a real pullback. We've seen that a lot in recent weeks. And there's often often that goes back to, shifting consumer sentiment, often in periods of economic unrest or uncertainty about the economy, something we've seen broadly reflected in the markets recently. Investors sometimes shy away from these very tech-heavy, growth-oriented businesses, kind of going back to the discussion that Will and I had in the last hour about cyclical versus defensive stocks. Now, that doesn't mean these businesses, aren't great investments over the long term. As I mentioned, there's a few of these that I hold in my portfolio that even in the 5 or so years I've held them have been multi-baggers for me. But I'm curious, Danny, which of these businesses do you hold in your portfolio or maybe want to hold in your portfolio in the future?
So just so that we're clear, whether you're talking about the FAANG stocks or the Magnificent Seven stocks, I own every single one.
Ah, there you go.
So let's just make it easy that way. But I have a question that I wanted to kick off the festivities with. So here's my question to you, Rachel, and my question to our viewers. Please avoid looking up the answer because I know it's easy to find, but see if you know what the answer is right off. So back in early 2023, an analyst from Bank of America actually coined the term Magnificent Seven. And the Magnificent Seven did away with one of the stocks of the FAANG stocks, and it added 3 other stocks. Now, the stock that was kicked off from FAANG was Netflix, and the 3 that were added were NVIDIA, Microsoft, and Tesla. Now, here's my question. Of the 4 stocks that moved either off of FAANG or onto Magnificent Seven, 2 of them have been significant outperformers, and 2 of them have actually been kind of disappointing since that time. So which 2 do you think were the 2 best performers?
Oh, I feel like NVIDIA has to be one of the companies from, you're talking about both of these categories, right? Okay. I feel like NVIDIA. I am not a shareholder in NVIDIA, actually. This is not a company, ironically, I know that well, as many of my fellow fools do. So I'd have to say NVIDIA, and I'm just going to throw out a wild guess. Netflix?
Actually, Netflix, of the 4 stocks, NVIDIA was the top performer. Netflix is the second best performer. Between the 2, from early April 2023 through today. Now, what's interesting about this is Netflix was kind of, kicked to the curb because of its, thoughts that, oh, well, Netflix is old hat. Its growth days are over. And yet, since early April of 2023, over this 2-year period, Netflix stock is up 175%. Compared to the 2 stocks that were added, 2 of the stocks that were added to the Magnificent Seven to take its place, Microsoft stock is up 35% and Tesla stock is up 15%, according to White Charts. So I thought,
so I did guess right. There we go.
Yeah, you did.
And of course, those are 2 companies I don't own.
Wow.
I own Alphabet, Amazon, and Apple.
Alphabet, Amazon, and Apple. There you go.
Yeah.
So yeah, and I bring that up because Netflix is one of those companies that I have been encouraging investors to watch over the past couple of years because sentiment had turned against them. The company was continuing to, gradually increase its revenue, increase its subscribers. It was working its way through the advertising tier that had instituted a couple of years back. And so what's really cool about that is that here, just a couple of years later, Netflix announced back in November that it had surpassed 70 million users in its ad-supported tier. Now, that is more than Hulu, Peacock, and Apple TV. And yet, what's interesting too is that if you listen to the conference call, Netflix executives have said that audience on the ad-supported tier is more profitable for them than those on their regular tier. So I went back and looked. So their ad-supported tier has a price of $7.99. Their regular standard tier is $17.99. That means that for every viewer on their ad-supported tier, Netflix makes more than $10 per person on advertising. And they are focused on growing that ad-supported tier. And it seems like that the ad-supported tier is actually outpacing the growth of its standard tier. So I think there are even more, there's even more runway ahead than many investors realize for Netflix. And I wanted to kind of highlight Netflix because, you know, they've become the stepchild, you know, the forgotten of the FAANG stocks that was kicked to the curb, and yet one of the best performers over the past few years.
Yeah, well, you know, one company I'll talk about for a few minutes. I mean, it's one we all know, Alphabet, obviously parent company of Google. This is a long-term position for me. And this has been a really interesting company that, while this is still a very, very small part of their business, I've been really kind of fascinated by what they're trying to do with AI-driven drug discovery and development. That's something that really intrigues me as a healthcare investor, and where I wonder how that could be, you know, a long-term element of their business, say 10 years, you know, down the line. I mean, this is obviously a business that continues to do exceptionally well. In their Q4 2024, their consolidated revenues were up 12% year over year to $96.5 billion. Total operating income increased 31%. Net income increased 28%. They expanded their operating margin by about 5% to 32%. And then cloud and YouTube exited 2024 with an annual revenue run rate of $110 billion. Alphabet's core advertising business continues to generate, you know, the lion's share of revenue. That generated about 76% of its revenue in 2024. But it's been a really, you know, great decade for investors who have stayed with the stock through the long term, despite the ups and downs as its digital advertising and cloud businesses have expanded. You know, you look at between 2014 and 2024, Alphabet's revenue grew at a compound annual growth rate, or CAGR, of about 18%. Earnings per share increased at a CAGR of about 23%. And then again, you know, they're venturing into more emerging technologies and industries through new business acquisitions, ongoing research development. Their core advertising business, obviously, you know, one of the biggest things you could think of, playing devil's advocate, there's, you know, challenges from generative AI platforms. You think of these, you know, short video platforms like TikTok, Meta platforms, Reels. But Alphabet has continued to be a incredibly successful advertising giant. They're investing obviously heavily in cloud computing infrastructure. They're already guiding for a CapEx of about $75 billion for 2025, a huge part of that being AI driven. But it's been interesting to think about how they're focusing on different AI powered solutions that are perhaps, you know, less thought about when investors look at this business. You know, this includes things like wearables and precision health. So Alphabet's Google Cloud provides healthcare organizations with scalable AI solutions, helping them access and analyze patient data more effectively. Then you've got DeepMind's AI systems like AlphaFold. Those are used by pharmaceutical companies right now for applications like drug discovery, which helps to accelerate medical research. Google, under the umbrella of Alphabet, has been working on AI-powered screenings for diseases like tuberculosis, lung cancer, and breast cancer in India, and some of these early studies they've done. It's very, very interesting for me to see how could healthcare factor into this business over the long run. Maybe it remains a tiny, tiny part of the business, but it's still really interesting for me as a healthcare and tech investor to look at. You know, another Alphabet subsidiary, Verily, I believe it's called, they focus on precision health, which is all about tailoring treatments based on genetic and lifestyle data. I think that it's interesting to see how this could be an area of growth, you know, for the business over the long run. There was an announcement in early January of this year that Alphabet's subsidiary Isomorphic Labs is going to begin clinical trials for AI-designed drugs soon. Obviously, the potential and abilities of artificial intelligence are rapidly advancing. There is already many examples within the broader healthcare space of how AI is being used to disrupt as well as aid in effective, faster, and more accurate drug, discovery, development, all of these different aspects, as well as helping to construct and optimize clinical trials. There was an interview with CNBC where the co-founder and CEO of Anthropic was talking about the ongoing developments in AI, talking about the progress in creating AI that can autonomously operate, computers. There's so many different areas where this can also be beneficial within the healthcare space. Back in 2021 was really when Alphabet dived into the drug discovery game with the acquisition of this, artificial intelligence company, which was built on the protein folding simulation successes achieved at DeepMind. And this is this new isomorphic laboratories, which, as they've said, has aimed to deliver an AI-first approach for tackling biopharma research. The long-term goal of this unit, which they launched a few years back, is to serve as a commercial partner to drug makers to figure out how medicines will react within the body. For example, researchers at DeepMind back in 2020 showed that they were able to solve a riddle that had been a mystery to scientists for decades, which was, how do proteins correctly fold into the proper shape and they form the building blocks for life itself? Well, DeepMind's generative AI model was able to predict how a string of amino acids would translate into a three-dimensional structure with atomic precision. And this was sort of the beginning of what became, this new division, isomorphic. And back in 2021, it was reported that they were working on hiring computational and medicinal chemists. And then we have, news that came out earlier this year that they are starting to begin, reportedly, clinical trials for AI designed drugs. And Isomorphic Labs was essentially spun off from DeepMind. It's focused on using AI to tackle biopharma research and drug discovery. And of course, the idea is to reduce the time and cost associated with that, and using AI to predict how drugs will interact with the body, which molecules are likely to be effective. They're beginning to, again, plan these clinical trials. They've entered already into strategic research collaboration agreements with the likes of Novartis and Eli Lilly. So talk about Alphabet a lot in the Fool universe. Lots of focus on their work in AI, their cloud business, YouTube, their advertising business, all of these areas, which I love and am a long-term shareholder in the business for. But I think it's less talked about how their AI spending relates to healthcare and actually how much they have focused some of their CapEx into growing this wing of their business. So I thought that would be a little interesting to talk about as well.
Fair enough. And just for the record, I would say that, I have some pretty positive views of most of the Magnificent Seven and FAANG stocks over the coming few years. In fact, if you just add Netflix in, we could just call them the Magnificent Eight and make my life easier. So I think there's probably only one stock out of that group of eight that I have concerns about. And I'll get to that in a minute because we actually have a question about that. But first, Jenny asked a question about an hour ago. Danny, can you discuss Global E? I haven't added in some time. How are they doing? I just went and took a quick look at Global E Online's fourth quarter results. For investors who may not be familiar with the company, Global E, ticker GLBE, is a platform that provides services to merchants who want to sell their goods across borders. Now, as you know, selling goods across borders can be a complicated mess. There are You have to deal with the regulations of 2 different countries or multiple countries, depending on how many countries you're selling in. You have to deal with import and export fees and duties. You have to deal with monetary issues, exchange rates, local regulations. There's just a lot of ways that you can trip yourself up if you're trying to sell goods and services across borders. Globally Online handles much of that, so that as a merchant, someone can just handle selling their widgets, and let Global E handle the regulatory nightmare that is cross-border selling. On their fourth quarter results, revenue was about $263 million, which was up 42% year over year. So to me, that's a pretty impressive growth rate. Now their net profit for the fourth quarter was $1.5 million. Now that marked the first quarter that they have been profitable in some time. This is a company that Shopify chose as its strategic partner for the merchants that use Shopify, and Global E Online handles their cross-border transactions for them. Let's see. It looks like they generated free cash flow of about $129 million. They expanded their gross margin from let's see here. It looks like their adjusted gross margin to 46% from 43% year over year. Their GAAP gross margin grew. Let's see. Yeah, GAAP gross margin grew to 53%. There's a lot to like about Global E Online. They handle an area where there's not a lot of competition. There are not a lot of companies out there that handle this. I would consider this to be an area where there's high barriers to entry in terms of navigating the nuances and the myriad regulations involved with cross-border transactions. So it's not an area that a lot of potential rivals are going to jump into. So their growth rate is still impressive. Now the stock has taken a beating. I want to take a quick look here because at one point Global E Online stock was pretty overvalued in terms of let's see here. Yeah, well, and the fact that they weren't profitable yet has been weighing on the stock as well. They had a price to sales ratio going back that was, let's see here. Yeah, their price to sales ratio right now is about 8. It was a bit higher than that. It was above 12 or 13 at one point. They have a forward PE ratio of about 45. Again, they don't have a trailing 12-month PE ratio yet because they've only just turned profitable. But still, even on a forward basis, 45 is a little bit on the high side. So I think that one of the things that has weighed on the stock is the fact that while its growth was impressive, its valuation was more impressive. And so, the stock has taken a little bit of a beating. From an operational standpoint, I think Global E Online is doing just fine. It's a company that I own in my portfolio, and I continue to have a fair degree of confidence in.
Yeah, I think several years back, I remember speaking with the CEO of Global E, and I thought that was a really interesting business at the time. We had a question that came in from MH that I wanted to hit real quick. Is Fold, F-O-L-D, a standalone stock or somehow part of the Alphabet family? If not, what drug stock is related to Alphabet? So Fold is the ticker for Amicus Therapeutics. As far as I'm aware, and this is like a $2.7 billion market cap company, they are not affiliated with Alphabet in any way. I'm not aware of any active partnerships with them, and they are indeed a standalone stock. They are not under the umbrella of Alphabet. There are other companies that have been collaborating with different subsidiaries of Alphabet when it comes to drug development and delivery. There is Alphabet's Verily, which is their precision health subsidiary. Now, it's worth noting that is a subsidiary. I touched on it earlier a little bit, but they're leveraging tech, data science, and AI to personalize healthcare and improve outcomes. This was initially sort of a moonshot project within Google X, later became an independent subsidiary of Alphabet in 2015. And Verily's work is all about conducting clinical trials and research to develop new treatments and technologies. Their precision care platform, operating as a standalone company under Alphabet, that's a segment that has been struggling a bit. I know that there were reports that they were cutting some jobs as part of a strategic restructuring quite a few years back. I think back in 2019 as well as 2021, there might have been some announcements about this. But in 2019, there was news that Verily Life Sciences had inked some strategic alliances with pharmaceutical companies like Novartis, which is publicly traded, Sanofi, Otsuka, and Pfizer. And then since that time, there's also been some partnerships inked between Isomorphic Labs, which again is that DeepMind spinout that I was talking about that's focused on AI-driven drug discovery. And I believe that they have entered into some partnerships with pharmaceutical giants like Eli Lilly, like Novartis. And they've also been working on developing AI models like the AlphaFold 3, which is designed to accelerate the drug discovery process. So there are some companies that are working with Isomorphic Labs, which again, spin off of Google DeepMind under the umbrella of Alphabet. They had more recently expanded, I believe, their strategic collaboration with Novartis. They added several research programs as well. Again, that Isomorphic Labs division was spun off just in 2021. So it's a newer entity for investors to watch. But yeah, you do have some of these bigger companies that are publicly traded that are having some early partnerships. Not a ton of information about those partnerships at this point. These are businesses with their very own unique models and market footprints to look into if you're evaluating this space. But those are a few that are worthy of note that I wanted to mention as well. And then one other question that I wanted to hit that was a little bit further down in the queue. Jimmy G had asked about 8 hours ago, thoughts on Simply Good, ticker SMPL. This is not one that I knew very well, but sometimes when we're on the show, we'll get questions about stocks we're not as familiar with, and I always find it fun to kind of look them up and learn a little bit in real time. While I was not familiar with Simply Good Foods trading on the NASDAQ under ticker SMPL, they are the parent company that owns Atkins, Quest, and OWYN brands. So they develop, market, and sell branded nutritional foods and snacking products. I am familiar with their Atkins division, obviously. OWYN was a more recent acquisition of theirs. And this is a business that has a market cap of about 3.5 billion at this point. Shares are up about 131% over the last 5 years, although the stock trades right around $34 a share. So their product portfolio and their core business revolves around a diverse range of nutritional food and snacking products. So they all have all these different types of protein bars under the Atkins and Quest brands. I'm very familiar with those. I had no idea that there was a publicly traded parent company that owned those brands. So that's kind of interesting. They also sell ready-to-drink shakes under the Atkins and OWYN brands. And again, OWYN is a recent acquisition of theirs. That's a brand that's specifically focused on plant-based protein products and clean ingredients. Quest is known more for their protein crisps and other snacks. And then Atkins has been around forever and is known more for their low-carb, high-protein products, bars, and snacks. So they distribute these products through channels including traditional grocery stores, natural food stores, online retailers. as I was looking at this business, because again, I was familiar with their products, but was not aware that they were under the umbrella of a bigger publicly traded company. This is a business that has been pretty consistent in terms of sales and earnings growth through the years. They did acquire last year, as I mentioned, this company, OWYM, which is the acronym for the protein shake brand Only What You Need. That was a $280 million acquisition. And that really strengthened their presence within the growing ready-to-drink shake market. In terms of how they're doing, from a financial perspective, the most recent results we have for them was for the first quarter of their fiscal 2025. So they reported net sales of about $341 million, which was a roughly 11% year-over-year increase. They reported a gross profit of $131 million. That was an increase of about $15 million from 1 year ago. They also reported net income of $38 million compared to about $36 million 1 year ago. There were some one-time costs related to that OWYN acquisition that had some impact on the business as well. They also delivered cash flow from operations of about $32 million. That was down year over year, but again, mostly related to that OWYN acquisition. They also had cash of about $122 million on their balance sheet when they finished out the quarter. In terms of the type of growth you see from a business like this, they're expecting net sales to increase anywhere from 8.5% to 10.5% in their fiscal 2025 in its entirety. This is a fairly mature business. And again, there's somewhat low margins on the products that they sell. But yeah, they did report net income of about $38 million in their recent quarter compared to about $36 million a year ago. So kind of an interesting business. Again, this isn't one I knew very well before answering this question, even though I was familiar with their brands. Just kind of taking a quick look in terms of the financial history and performance of the business. They have been a pretty solid grower of earnings as well as their revenue through the years. Something we've seen is that sometimes these types of businesses can also be prone to cyclicality, particularly as different trends and fads within their target market specifically tend to evolve. Now, the company as it is now looks like it was formed in 2017 due to a business combination of NCP ATK Holdings, which is what is essentially the Atkins business, and another company called Conyers Park Acquisition Corp. So kind of interesting, not one I follow very closely. I don't know that this is a business that would interest me in particular, just given sort of the margins and the focus of the business. But I do think that there's certainly a place for this company's products in a wide range of economic environments. And obviously they own a range of flagship brands that have been around for a very long time. So something interesting to look at a bit further. Those are just some of my thoughts as I was looking briefly at the company.
So we have a question from Let Your Winners Win from 12 minutes ago. Would you say Tesla only appeals to 50% of the population due to anti-Musk sentiment? Will that affect future growth? I have talked about this a little bit before. I have been clear about my concerns as a Tesla shareholder that Elon Musk is becoming increasingly distracted, not only by his other companies that he runs, but also by his work within the federal government as a special employee for the Department of Government Efficiency, aka DOGE. Now, my fear is that as Elon Musk is doing all these other things, he's taken his eye off the ball with Tesla. And it turns out that I am not the only shareholder who thinks that. There was a recent survey, and this was only reported last week, that 85% of respondents deemed Elon Musk's political involvement as a negative or extremely negative for Tesla, according to a survey that was performed by Morgan Stanley. I would prefer if Elon Musk got out of the business of politics and got back into the business of trying to create a robocar. That's my opinion. I do think there are other people who have negative opinions, and I think it could weigh on the stock price. Will it affect future growth of the vehicle? That remains to be seen. However, if you look at what's happening right now, growth in the U.S. is slowing, growth in China is slowing, growth in Europe is slowing, and so I think Mr. Musk, with all due respect, should pay more attention to Tesla, which is his publicly traded company, where he has a responsibility to shareholders. And I'll leave it at that. The other,
I think that's very fair. Well said.
Indeed. There was another question from Let Your Winners Win. Have you heard about a potential security fraud case against the trade desk, ticker TTD? Would that be depressing the stock price? I just want to be clear what we're talking about here. Anytime that you see a publicly traded company that has its stock price fall by, I'm going to use a random number, 20% or more, you have the potential to see a security fraud case brought. Now, with all respect to the attorneys, perhaps in our audience, I think this is a case of attorneys that are looking for an opportunity to do something. You see these cases fairly frequently. Sometimes something comes of them, sometimes it does not. But essentially, I did see a headline that said there was a law firm and they were in search of a lead plaintiff for a securities lawsuit against the trade desk. This is fairly common. Fairly often they come to nothing. Sometimes there's a settlement involved. Sometimes they are thrown out of court. I don't know what's going to happen with this one, but I sincerely doubt that this will have any long-term impact on the trade desk's stock price. I think what will have a long-term impact on the trade desk stock price is whether or not the company turns around the issues that they had in the fourth quarter. They were moving customers from their existing Solimar platform onto their Kokai platform, which rather than just being a platform that uses AI, their new platform infuses AI at every level of the process. They had a little bit of an issue moving people from one platform to the other. It slowed down their revenue growth a little bit, but certainly not, in my opinion, certainly not to the tune of losing half the company's market value. So I think once investors see that the trade desk will right the ship, I think that the stock price will resume its upward trajectory. My opinion on the matter, but nobody knows for sure. Rachel?
So, well, a couple things. One, there was a question from Let It Ride. Alphabet is in talks again to buy Wiz. Any thoughts? This is interesting. And there's actually a little bit of breaking news around this. So for anyone who was following this story, last summer, there was all of this talk that Alphabet or Google was close to making its biggest acquisition ever, that Alphabet was in advanced discussions to buy this fast-growing cybersecurity startup, Wiz, for roughly $23 billion, according to a person familiar with the matter. And a takeover of Wiz, which makes cybersecurity software for cloud computing, would be not only a huge bet for Alphabet on cybersecurity, but again would be the tech giant's biggest ever acquisition. There were reports at the time last summer that Alphabet and Wiz began talking after Wiz raised $1 billion from venture capital investors earlier last year. At the time, in terms of a potential deal, it was said had not been finalized. Talks could still collapse. news initially of that was first reported by the Wall Street Journal. Well, that deal did not pan out at the time, but fast forward to today, just a couple hours ago, and there is new reporting that Alphabet is again in advanced talks to acquire Wiz for, at this point, around $30 billion, which is a bit of a premium compared to, I think, the $23 billion that was reported that they were, reportedly talking about with the company to acquire them for, at this point, close to a year ago. Again, a person familiar with the matter was saying this. They say the deal hasn't been signed. It could still change. At this point, Alphabet and Wiz have not responded to requests for comment. This was again first reported by the Wall Street Journal on news of talks with the two companies. Now, Wiz had called off the previously reported $23 billion deal with Alphabet last year, reportedly to focus on its own initial public offering. A buyout of this size, obviously, this is one of the most, notable things that I think a lot of people are talking about, could face a lot of regulatory scrutiny. There's been a lot of discussion about companies like Alphabet having monopolistic tendencies through the years. So that is something that remains to be seen. We know that Alphabet was reportedly in talks to acquire HubSpot last year. That is a deal that they also walked away from. Now, there's been an increased interest in the cybersecurity industry for a business like Alphabet. This is obviously a huge addressable market opportunity for Alphabet. It could also be a major opportunity for them to expand their cloud infrastructure segment, which is a huge growth driver for the business. Wiz was valued at approximately $12 billion, according to the reports I'm seeing, based on the private funding round that they had in 2024. So they were last valued at around $12 billion. This reporting is saying that Alphabet could be acquiring Wiz for as much as $30 billion, so a significant premium to its last reported valuation. Wiz's core business revolves around providing a platform that helps organizations secure their cloud environments by identifying and mitigating risks. Wiz works with a lot of large enterprises and Fortune 500 companies. They've also had a real strategy that has worked through the years of acquiring other cybersecurity startups to expand their product suite and engineering talent. They, as I have noted, have raised significant amounts of venture capital. They've acquired other startups to bolster their engineering talent and product suite. And they provide really comprehensive coverage of cloud environments, including virtual machines, containers, serverless resources. Their customer base includes everyone from Colgate Palmolive to LVMH to Costco to Chipotle to Salesforce. So interesting business. I'm curious if this is actually going to go through, if second time is the charm, if indeed this reporting is true to what is actually happening in the background machinations between Alphabet and Wiz. I don't know if you have any thoughts about this, Danny. Be curious to hear.
Whenever you're talking cybersecurity, and if you think about Google's place in the big three cloud providers, you've got Amazon Web Services in first place. You have Microsoft's Azure Cloud in second place, and you have Google Cloud in third place among the big three. And whenever you have that much data in the cloud, it's not necessarily a bad idea to beef up your cybersecurity offerings. Whether or not Google needs to buy a $30 billion company, I don't know enough about the intricacies of cybersecurity to know whether or not this would be a good deal for Alphabet. But apparently, they've come back to it. And if it was worth $23 billion last summer, it's potentially worth $30 billion this year. One of the things that I look at, they talk about Wiz's valuation, since it was founded in 2020, has considered to be one of the fastest growing startups of all time. And during an employee tender offer late last year, it was valued at $16 billion. So yeah, this would be a significant premium. I don't know if the value that Alphabet would get or that Google would get would be worth what they're going to pay for that company if they indeed are able to acquire it. And even if they make the offer, they come to an agreement, there's still going to be the question of whether or not the Justice Department under the Trump administration would allow the deal to go through. There's been a lot of discussion among the, talking heads about whether or not the Trump administration would allow a big tech deal to go through. And we don't know. It's too early yet to tell what the Trump administration antitrust stance is going to be. So I think that remains to be seen.
Yeah, I'm intrigued. I could see how this could make sense. I'm a little worried about that premium based on the last valuation metrics that we have for Wiz. I very much see how this integrates into their business, but that is a steep valuation. And my biggest sort of thing that gives me pause is, would regulators actually approve this? I'm intrigued as an Alphabet shareholder, somewhat put off by that valuation, but we'll see. This didn't go through last year. Will it happen now, particularly in the environment they're operating in? Hard to see, but I'm curious, and I love it when we get these breaking news stories during the hour. Kind of fun.
And this would be a good excuse to see whether or not that deal can ease on down the road.
There you go, Danny.
From the Wiz.
I like it. I
had to throw that out there. So Sadaf mentioned about 19 minutes ago. What about Batman? For those of you who are not familiar, Batman is an amalgamation of the Magnificent Seven stocks and the addition of Broadcom. So yeah, there's a Batman. There's one for everything. Of all of those, of the 8 stocks in that acronym, I am still pretty bullish on all of the Mag 7 stocks, save Tesla. And I think Broadcom has been doing particularly well. And what many of these companies have in common is that AI wildcard. If the AI revolution continues on schedule, and if it continues to drive growth among the big the cloud providers, which were the early adopters of AI, then I think we could potentially see more room to grow for all of these companies. And Tesla, if Elon comes back and decides to focus on the robo-taxi, maybe we'll get some growth there too. I simply don't know.
We had a question that I thought was interesting, directed towards both of us. Rachel, have you considered investing in Mercado Libre? And if so, what price would be attractive? Oh, could they please do a stock split? That would be so nice. Danny,
come on.
I know. Would you add Tabelli here to your current holdings? I actually, it's funny. I've followed Mercado Libre for a long time. I'm not currently a shareholder in the business. I obviously am a long-term shareholder in Amazon. I really like Mercado Libre. And I've talked a lot about how valuation is not something that keeps me away from great stocks. Mercado Libre has been kind of an exception to that rule. It is a very steep, also just price per share toll to pay. Now, I will say one thing I have considered as well, if I did not want to necessarily buy, individual shares, and I think this has been such a fantastic business over the long run. This is one of those businesses where I wish I had started investing when I was really, really young, out of high school young, because I would love to have been holding this business all these years. This is obviously a company, they've never split their stock. This as in 17 years as a public company. Danny, I'm sure, is very, very happy.
I'm okay with that.
As a long-term shareholder, this is one I have sort of gone back and forth on internally in my own dialogue. Okay, do I maybe start out with some, dollar cost averaging into fractional shares? Do I maybe just buy a couple shares of the business and hold on to it over the long run? There's obviously quite a few exchange traded funds that hold shares of Mercado Libre, like the Invesco QQQ Trust is one that I have followed a bit. So yeah, this is a company I really love. I think it's fantastic. And I've just been a little put off by the premium for shares. It's certainly one that I could buy into if I wanted to, but it's been one that just given sort of its steep valuation has even kept me, who is not put off by such things, a little bit on the sidelines. But I would consider investing in it. I would love it if they did a stock split. I'm sure Danny wouldn't. But who knows? Maybe I'm just going to go for it one of these days and say, why not? If I hold this stock for 20 years, I still think it would probably significantly outpace its current growth position. So yeah, maybe I need to look into this one again. It's been a little time since I did that.
Have you watched the interview with Federico Sandler from last week?
I have not yet. I have not had a chance to yet.
That would probably help inform your decision.
I only caught the tail end of it. It looked fantastic, but I hadn't had a chance to watch it all the way through yet.
I'll give you the Danny's condensed version.
Yeah, don't bury the lead, Danny.
According to Federico Sandler, who is the former head of investor relations at Mercado Libre, he said that as people who live in North America, we don't appreciate the opportunity that they have in the credit market there. Because, when we think about credit, we can just go to the bank, and if you have a good business plan or you have collateral, you get credit, and that's it. That's not the way it is in Latin America. In Latin America, there is a large portion of mid-market businesses that have been underserved or unserved by the banking industry there. And so because Mercado Libre has all of this information about the merchants that they serve, and there are a lot of them, they are able to very accurately determine whether or not they have the ability and the potential to pay back these loans. And so there's a huge opportunity there. The other thing is, when we think in terms of credit, we think about the credit spread here in the United States. If you've got an account with Ally Bank, you're probably getting somewhere in the neighborhood of like 4.5% interest on your savings. And if you want a loan, you're probably going to have to pay 7 or 8%. And that's a very small spread. The spread in Latin America is much bigger because they're, I think one of the interest rates I saw was somewhere in the neighborhood of 17%. And so in order to get credit in Latin America, you need to have a really good relationship with your bank, or you need to be a merchant who has business with Mercado Libre. So there's a really huge market there. They are well positioned to tap that market, and because they use so much AI in order to inform their decisions, they have a very good rate of return from the folks who they lend money to. So it's a really good opportunity. To answer the second half of that question, Mercado Libre is my third largest holding. It represents about 11% of my personal wealth, period. So I would not add Mercado Libre to my current holdings simply because it's so much already. And I don't feel like me adding to it would move the needle that much. That said, as Rachel pointed out, this is a company that I believe if you look back 20 years from now and say, gosh, I wish I invested in Mercado Libre 20 years ago, or you can say, wow, I'm really glad I invested in Mercado Libre 20 years ago. It just depends on your thoughts on the business going forward. Me personally, I have 11% of my personal wealth in Mercado Libre. That should give you some indication as to how well I think the business will be doing over the next couple of decades.
Okay, Danny, I think you've convinced me. I need to take a second look at this company again.
Take a look.
I do really like this business. And I think for whatever reason, I've just focused on other companies, some of which I have paid a steep valuation for through the years. So, and maybe it's time to dig back into that. So that's a great question.
Rachel, didn't I recommend Mercado Libre to you when we were first on the air several years ago?
I think you might have. And honestly, and when I was just starting out, when I was just starting my investing journey, I think you absolutely did. And gotta say, I'm wishing I had done it then. So no time like the present, it would seem.
At least to look into it.
Absolutely. Yeah, no, it's a great question. I love getting ones like that. There was an interesting one from John Bystroff was asking, why has Microsoft lagged behind all the other Mag 7s? And what would motivate the market to give it the love showered on the rest of the Mag 7 the last year? That's a good question. I mean, let's see. How has the stock performed? Yeah, shares are down about single digits over the last year. It's just, I still think I love this business. There's been, I think, a few factors there. I think there's been some, I hate to say it, but I think there's been a little bit of AI fatigue. I mean, we've been seeing a lot of kind of reporting about this, but I think that there's a lot of excitement around the space over the long term that I think there's probably been so much hype that's built into that with some of these businesses that's been weighing down a little bit on the stock recently. They've been seeing some deceleration in their cloud segment. Their intelligent cloud segment has been growing steadily. I think some investors were less than enthused about some of the slower than expected growth in their Azure segment. I think that prompted some analysts to lower their price targets. I also do think, and again, I think that Microsoft's investments in AI are key. I think it's going to be really integral to the business over the long term and provide really notable tailwinds. But I do think that you also saw a ton of excitement and hype surrounding Microsoft's investment in OpenAI really baked into the stock for a period of time. And I think as some of that has settled down and even waned a bit, that has, led to some, come down in shares there that I think has had an impact probably on its performance this year and in recent months. There's also the fact that more recently they issued some weak current quarter guidance. We obviously saw the announcements about Deepseek a few months ago, and how China's Deepseek trained its AI model on systems that use less power and cost less than leading AI chips. Those are all, I think, elements that have been incorporated into Microsoft's performance in recent months. It's also fair that I think shares were trading at a pretty high multiple. And so I think it's made it a bit difficult for the stock to rebound even on positive news. I still think this is, a winner over the long run. They also had some impacts from the botched CrowdStrike software update in July, which crashed global IT systems and weighed on the stock. This is still a company that's up almost 200% over the trailing 5-year period. So, breaking down some of the impacts on the stock over the last few years, I think those are some big factors we've been seeing there. But this has still been a winner over the long run, and I still think it will continue to be.
So this is actually a holdover question from when I was last on the air. And Bestie's pushing back saying, I don't agree with the notion that Arista Networks, ticker ANET, is overvalued. Granted, its customer concentration is a risk. Arista Networks is still going to grow in the mid to low something. I'm guessing that's supposed to be teens. I wanted to point out that it's not that I am saying that Arista Networks is overvalued. That is what the market is saying when it bid the shares down. And in order to make a point here, what I want to do is I want to share my screen for just a moment because I think it helps illustrate the point that I was trying to make. And if you look at this screen and you look at Arista Networks price, you look at its PE ratio, and you look at its forward PE ratio, Right now, the company's PE ratio, and I think we might be having some technical difficulties getting this screen share up here. But the point that this chart makes is that if you go back to earlier this year, Arista Networks was trading for 135 times earnings, and it was trading for about 52 times forward earnings. Now, it has come down a bit since then, but I would argue that anytime, if you can see that peak right there, that's when it was, 100 and, what did I say it was, 130? Yeah, about 135, 136 times earnings. I'm sorry. I'm a guy who is okay with buying highly valued stocks, but saying that Arista Networks was not a high valuation for 130 times earnings, yeah, I disagree. And that's okay, because the market is made up of people who are buyers and sellers, and who agree and disagree all the time. Now, the good news is that if you were looking to buy shares of Arista Networks, its forward PE ratio is now 34, and it's selling for 38 times earnings, which is much more reasonable than the 135 times earnings it was selling for just 2 months ago. So having said that, certainly don't want to disagree too much. We all have our opinions, and that's fine. And thank you for sharing your thoughts with us, because we value them even if we don't necessarily agree with them.
Awesome. Well, with that, Danny, we are at the end of our hour together. It's been a fun time. Up next, I know we've got Lou and Jose coming in for the newly launched predictions hour. So that should be awesome, fools. Stay tuned for that. Hey guys, how's it going?
Hey, it's time to get bold.
And I just want you to know, Lou, you stole one of my ideas, and I think great minds think alike.
Danny, no cheating. You're not supposed to look.
I will say this. He's going to say something about Palantir. You heard it from me first.
Thanks, you guys.
Well,
all right. Thanks, Rachel. Thanks, Danny. Jose, how you doing tonight?
Pretty good. Ready to take out my crystal ball and see if it's still working.
Very
never
good.
worked, but see if it worked this time.
Very good. I'm excited about this. I know you are too. All right, fools, good evening. This is, as mentioned, the Bold Prediction Show. First off, we say this every hour, but now more than ever, we need to say it here. This discussion is for educational purposes. We are not providing financial advice. We are making predictions. It is hard to predict the future. So this is not financial advice. We are trying to be bold here, trying to think things through. You shouldn't take these as gospel. This is just I think we both believe all these things, but this is just us making predictions. So here's how it works. One of us is going to make a prediction. We're going to spend a couple seconds defending it, and then field some questions from the other host to kind of, to figure out if it's worth its salt or not. Meanwhile, you can go to Slido, Fool24 is the code word, and vote on whether you agree with the predictions and make any comments you want about our brilliance, about our stupidity, or about anything else you want. All right? Sound good?
Perfect.
All right, Jose, why don't you give us the first prediction?
So the first prediction I'm going to say here, Lou, is I predict that the overall basket of quantum computing stocks will hit their 2-year peak within the next 2 months. And the main reason, I'm going to share my screen really, really quick just to make some quick 2 points on why I believe this prediction will happen pretty closely is, I took some of the popular names out right now, Lou, and if I'm pretty sure it's pretty small here. Nope, that didn't help. But quantum computing stocks, most of them are trading north to 100 forward 1 year, not forward this year, not forward the next 12 months, it's next fiscal year.
price to sales ratio of nearly 100. And kind of just looking through these lists, some of these companies like QBTS have a market cap of nearly $3 billion and revenue of not even $10 million and burning more free cash flow at the moment. So I do believe a lot of growth is expected for these quantum computings, even if they do kind of start to improve revenue growth. I think the market is too ahead of itself. So again, the basket of quantum computing stocks will hit their 2-year peak in the next 2 months.
Very good. Okay, Dan, I'm curious here, Jose, because this is tough for me. You say even if revenue comes, but everything I've heard is every time there's been a big announcement about quantum, and then there's that little asterisk about how, but we're still decades away. And then I'll get a press release or see something else with usually one of these companies saying, actually, we're doing it already. So what is the truth here? Like forget the stocks for a second. When is quantum computing going to be here? Is it here now? Is it coming? What's going on?
I think one of the main things, Lou, is quantum computing is seen as just like one thing. But just like any other market within quantum computing, there's like different ways to go about it. There's different solutions. And I'm not going to get too technical here because it's way above.
Because I'm here.
It's way above my own brain count. One of the companies that has talked that, hey, look, quantum computing is here is D-Wave, but their CEO has mentioned that the way they do quantum computing is completely different to the majority. So there might be some players that are already producing some solutions right now, but for the vast majority, they are kind of following this approach, which will kind of most likely happen in the next decade or so. The great thing, Lou, is this upcoming Thursday, there is going to be this huge quantum keynote with NVIDIA. So I think we're going to get a lot of answers on Thursday.
So that's my next question. So we asked the science thing, but there's also the hope, the expectations. And as you said, these things have been jumping, maybe not on fundamentals, right? My question about this prediction is that it seems like there's decent odds that between NVIDIA, Google, Alphabet, Microsoft, somebody is going to have a big news about quantum computing sometime in the next 6-12 months. Is this going to just be a up and down? Why wouldn't these just jump again to new greater heights when Microsoft says, hey, we did it too, or something?
Yeah, so I think we're going to continue to see this massive volatility, but I think my prediction is the market is going to get used to those. It's going to be like, hey, look, we heard this big thing. 2 months later, 2 weeks later, we heard the next big thing, but we're not really seeing the results. So I think eventually the market, and within these next 2 months, the market is going to understand that we're going to keep hearing about these research breakthroughs. And that's the important thing, Lou. Most of these are research breakthroughs. It's not like a market breakthrough that can kind of expand to the whole industry. They're research breakthroughs, and they're going to start seeing, this is another research breakthrough. It's still years ahead, especially for a lot of these players.
So this is the weighing machine, voting machine, that over time, the science is going to matter more than the hype. That makes sense.
Exactly.
All right. We have to vote, but fools, you need to vote too. Slido, Fool24. You can go in there. You can vote right now on whether or not we're right. We're also going to hold Jose accountable for this. We are already booked for March 17th, 2027. We're going to be on right now, and we're going to be talking about this. So get your votes in. Any final argument to make, Jose?
Nope. I think the most important thing we're gonna hear is, like you mentioned, Lou, volatility is gonna stay here, but I think the market is gonna start weighing these research more as research opposed to market adoption.
All right. Get your vote in, fools. 1 more minute. And yet, this is fascinating to me because it feels like science fiction still, but yet, all these things, it's not real until it is. And it's really cool when it's here. And so it's kind of really, it's fun, even if it is early days, it's fun to kind of think about the progress that has been made.
Yeah. And I think for investors, I think quantum is a cool technology that will eventually lead to some form of future. So I'm not knocking the science, right, Lou? I do believe this is going to be something that investors will eventually, especially myself, I will most likely in the next decade or so be invested in some quantum stocks. I just don't believe for me that time is right now.
All right, and Pro Shop guy, I missed the I missed the final as it went off. I think the binary answer had won though. I don't know. We can get that in, but I don't know. Jose, did you see? I will say I voted for. I think you make a decent argument. I think that the hype is going to fade as each one of these goes, and eventually we're going to say, all right, well, what are you actually doing, right? Yeah.
Yep. And I think one of the biggest hypes is going to happen this Thursday when we're going to have a lot of quantum CEOs.
Mm-hmm. Mm-hmm. I don't know. I love the name. I think I'm just a sucker for the name. All right. Should we move on?
So we do have, it seems one quick question here that came in.
Sure.
Topic.
Yeah. Okay.
So Seth, I've heard that quantum computing shall break all security algorithms. Do you think companies like Okta can benefit from this? So yeah, this is one of the things that quantum computing will be able to break, a lot of kind of like the digital lock per se. And I think once we start to get closer, another bold prediction within here is a lot of cybersecurity companies will be already working with this type of technology to be ahead of the game, right? Because if not, that's going to be a market destroyer for them. So if a great cybersecurity company, if they see this coming in, they're most likely going to follow suit as well.
Good deal. All right, and I can confirm that the overwhelming majority, 75% agreed with you. So there you go. Jose is off to a good start here. All right, moving on.
Yeah, Lou, so it's going to be your turn and for your wild prediction here.
Yeah, well, and Danny teased this one, so I should have to do this. Palantir, PLTR. I think we all know the ticker. I think Palantir will experience a 50% drop from its current price at some point in the next 18 months. So let's put some meat on this. I think it closed at 87.35 today. So I'm saying it will hit 43.68. All right. Now, Palantir, I think we all know, really, really cool algorithms. They found Osama bin Laden, very good technology, now applying it with artificial intelligence into the corporate customer. But let's be honest here. The stock currently trades at 121 times projected EBITDA. All right, that's including debt. By comparison, the Mag 7, this stocks that everyone say is overpriced. The Mag 7 trade between 11 times projected EBITDA forward, which is Alphabet, and 43 times Tesla. So we're talking they are 3x the most highly valued Mag 7 stock. All right, this is a high beta stock, 2.6 beta. That means, it is more volatile than the market in general. That beta is higher than any of the Mag 7 except for one, NVIDIA, and NVIDIA is mostly just because it has outperformed so much. So this is a stock that is overvalued or highly valued. I shouldn't say overvalued, even versus the Mag 7. It is more volatile historically than the Mag 7. With such volatility, we tend to see dramatic moves up and down. So despite being public for just less than 5 years here, the stock has already done this move twice, okay, in less than 5 years. Early 2021 and then into 2022, twice, we've seen Palantir drop more than 50%. Not making a statement about the business. I still believe this company can be a winner. You can look at NVIDIA, you can look at Netflix, you can look at Amazon, a lot of companies that did this along the way. But I think it's going to happen, whatever happens with this company.
So definitely, Lou, this is one of those, like you mentioned, highly valued stock. Just going to, if you were to guess within this already prediction, Lou, what would be some of the events that would cause this drop? Is it just the company maybe not missing expectations in upcoming earnings, or is it something else? Because the stock is down already, I would say 30% from its maybe even a little bit more.
I wish I would have gotten a chance to make this prediction a month ago, right? So it's a good question, and a couple of things. For one, even after that drop, I would say again, look at the valuation, and that just startled me, even versus the Mag 7. But what I would wager will happen is it's a combination of some of maybe the AI fairy dust comes out of the market, which is what we've seen, which not that AI won't continue to grow, but there will be questions about how quickly we get there, because valuation at the end of the day is just a matter of how long it will take to get to some place. And right now, it's got to go a long way in a short amount of time. I also do, though, remember, this is a company that promised 40% growth rates at its S1, which, again, only a couple of years ago. They have been growing commercial quite impressively, but commercial growth has been closer to 15, 20%. I think even that might be hard to sustain in this environment from what we're just seeing from other players. So I do think that, when you're priced at these valuations, you can still have a really good quarter, but it might not be quite as good as people wanted. And that's when you see with these high beta stocks, a really, really steep dive, even if it's still a good company.
And one of the things that we are seeing right now is kind of AI getting cheaper and cheaper. And I think Palantir CEO has mentioned that, yes, their software is pretty, or their applications that they design is pretty expensive just because they're one of the best in the business. Do you believe maybe if AI gets cheaper and cheaper, it can maybe help accelerate the growth for Palantir here? Or how do you think that dynamic of AI price changing can either benefit or hurt Palantir?
I think it could work either way, because yes, their reputation back when they were a defense contractor primarily is that it is great software, but it's software you only use when you have to because of its complexity and cost. So, it is the only one that can get certain jobs done, but it's not going to just be taking over everything. I think they've worked on both the accessibility and the cost over time, but I do think that in a way, what you're going to see, there's the potential that it opens up new doors, or the potential is that as other tools get smarter, there's less of a differentiation, easy for me to say. But so there might be just more competition as other tools get more sophisticated, which could work against them in these growth rates as well.
Thank you for that, Lou. And I'm gonna make, I think
we are under 2 minutes, Fools. So get your get your votes in now. Jose, make sure you vote. I think I voted. Yeah.
Yep. I agree with you here, Lou. I voted. I agree. The stock price grew too fast, and I mean, especially with AI right now, Lou. I think AI is definitely going to be the future. But there are some stocks that this product is more of a net new solution, and expectations sometimes get way ahead of what we can really see coming in their pipeline.
So 82% agreed here. That's interesting, because this is one, this is what I wasn't sure about, because look, it is still a great company, right? It is still a company that makes a product that can do impressive things. It's interesting. I don't know if that speaks to sentiment right now or not, or just speaks to, I'll be honest, Jose, when I was looking this up, I kind of thought it a prediction. And then when I actually compared it to the Mag 7 in terms of valuation, I was pretty amazed just even compared to that, because that's not comparing it to, I don't know, an industrial coal company or something. These are supposedly the stocks that we keep hearing about as being fully valued, and they are fully valued 3x. Yeah.
I wonder, Lou, if we would have this show running live on like X or something, how different, because this is such a popular stock, right? And I feel like I'm surprised that, again, many people feel the same way for Palantir right now.
The big takeaway here, as always, I think with Motley Fool always saying it, is this is why we hold for the long term, because some of these stocks are volatile. And like I said, maybe it won't go like Amazon. Maybe it won't go. I mean, who knows how it was? But there are so many examples of companies that survived this and moved on. So if you believe in the stock, focus on the long term, not the next 18 months, right?
Yes. So I think we can move on to the next one. It seems like we are doing great in time so far. And Lou, I'll throw in my next prediction here. So I believe we will have another Deepseek moment for AI in the next 12 months. And Lou, what I mean by Deepseek moment is, I believe it was mid-January of this year, we saw AI innovation that brought the cost of AI dramatically cheaper. As a result, we saw various AI companies from NVIDIA drop multiple double-digit percentage in one day. And in the AI market, there's more than just semiconductor players, and there's multiple semiconductor players. You have your NVIDIA, you had your Broadcom, which kind of provide AI chips for the for a lot of these big tech players as well. And a lot of companies have kind of seen a nice pull up with AI computing. Some of those are like the nuclear power stocks, some energy infrastructure stocks, stocks that deal with the data center infrastructure as well. So a lot of those stocks, not just semiconductors, saw double-digit percentage in one day. And the reason I believe we're going to get another moment like this within the next 12 months is AI is innovating at rapid levels. And one of the biggest bottlenecks for AI is still pretty expensive. So the only way we can really move on into having mass adoption of this application is for us to make AI, or for scientists to make AI cheaper. I think the market will still perceive any news like that as negative for the overall industry. But in the last earnings season, Lou, we've heard from a lot of big tech players that this kind of AI getting cheaper is actually very bullish for the developing the overall ecosystem of AI, and is going to drive further growth.
Okay, so I'm curious a little about this, like a DeepSeek moment, as far as, you know, like we'll have just another innovative, like, wow, this is possible, or the stocks will react the same?
Both, Lou. So I believe we will have another, wow, AI is getting cheaper.
Yeah.
And the market
and
is
the
going
stocks
to
will just,
forget. Yep.
yeah.
The market's going to forget that we went through something like this and be like, nope, maybe last one wasn't the real DeepSeek, but this is the real DeepSeek issue. And we're going to price it as scary as it was last time, even though we didn't learn our lessons that it can actually accelerate AI adoption.
Okay, so I'm curious, like, because the cost was such a big one. Do you think it's going to be another just like order of magnitude down on costs, or do you think? I mean, I know now I'm really asking you to be bold, but like, what's the next big thing? But like, what is? Because I sort of feel like, kind of back to our first discussion, that, you know, like once we get by the initial hype, that maybe a more cooler heads will prevail. But like, would it be just another like, oh, this is cheaper, this changes our costs, or is it going to be something totally different that like, oh, this changes the script completely? Or, I mean, what do you think?
I think it can go maybe two different ways, Lou. The first way I would say is just a huge reduction in price, 10x on some of the prices that we're paying. And some of the things, Lou, is one of the big stories was that the prices were being reduced in training and in the cost of training. But another thing that was happening is the reduction of price in inference. And I think that's now becoming the bigger issue for AI, because inference is kind of the thinking process that goes on with AI. So the more software you have, the more apps that you have, and the more users that you have, if inference is pretty expensive, these kind of software companies are going to be losing a lot of money. But I think what we're going to see is cost reduction dramatically. The other DeepSeek moment is kind of something that it's one of those that I have no predictions, but it will be like one of those things that no one saw coming, where it's not price, but it's just some whole different innovation happening in the AI space, where it's like, okay, this is it. This time it's time to sell for real.
Yeah. All right, fools. Well, you can get your vote in now. I think you have a few more minutes. You can change your vote if it has changed along with you. You know, I was just going to try. And I couldn't get it in quite in time. I just asked Gemini I could get up quicker, but Gemini can't tell us if we're going to have another DeepSeek moment. Interesting. All right, I'm kind of disappointed like that. All right. Yeah, I just figured I would go to it and ask, but no, that didn't work. It just kind of explained what the DeepSeek moment is. It says, in essence, while the DeepSeek moment has drawn attention for a specific set of advancements, the underlying forces driving AI innovation are ongoing. Therefore, it is reasonable to expect further transformative moments in the future. So I guess Gemini is going with you. Is that right, Jose?
Yeah, it seems like we need to add an extra vote, and I agree that Gemini has decided to partake in this poll.
Okay, so you voted, I voted. We'll get Gemini to vote, but there you go. I'm curious if that like is a last minute moving of the thing. I think it's interesting because I think it's funny that I love the question, and I love the point of it because almost inevitably, if we believe in this innovation and we believe in AI and we are buying all these stocks in anticipation, we are saying we believe there's going to be a lot more innovation and a lot more wow. And so as investors, we really ought to be pricing that into our mental model and just not be shocked by it if it happens again, because why else would we be so excited about this if we're not saying it's just going to stand still from here, right?
Yeah, and Lou, and this is one of the reasons. I mean, if you hear a few players starting to talk now of something called like AI factories, at first I was like, what the heck is an AI factory? Why is this very crucial in the AI space? And AI factories is a factory generates something, it produces something, right? Lou, in real life, outside of AI, a real factory produces a product. With AI, Lou, for AI to work, you need to produce a token. The token is kind of like the word behind it. And one of the future hopes is AI becomes so cheap that you're going to have various AI factories, which would be data centers, that they're not going to be doing any other type of cloud solution. The only thing they're going to be doing is running 24/7, creating tokens for these large language models. And the only way we would be able to have a 24/7 AI factory is if the price of AI is becoming so cheap that everyone is using some form of AI in some regards.
Makes sense. Okay. Well, I agreed with you. I think you probably agreed with yourself, right? And obviously Google Gemini agreed. So, and 44% agree. So we got another win here. 33% disagreed. Say I disagree, and 22% need more information. I don't know. I thought getting Gemini involved, maybe we'd switch some of those off of the more information, because they all agree we will see innovation here. And as I said, it does make sense. If we are saying this is we are buying these stocks for innovation, then it should go without saying that there will be innovation, right? All right.
Yep.
Should we move on?
Yes, we should.
All right. So this one, I am going to, instead of try and get inside the market's mind, I'm going to try and get inside an individual's mind, which what could go wrong with that, right, Jose? But this one is kind of fun, but I do think I do mean it, that I believe this. And I do think that it's something that investors in this stock should at least, again, be mentally prepared for. Jose, I think that Warren Buffett is going to step down as Berkshire Hathaway CEO on May 3rd when they do the annual meeting. And yeah, I know, Lou. How do you know? Warren and I don't talk a lot, so I need to disclose that this is not inside information. But look, I mean, I don't want to just say he's 94, because Charlie Munger stayed till 99, and Buffett is doing great. So I don't think age should disqualify him. But his good friend Charlie Munger has passed. I do think that there was just some of the mojo gone last year, and I do think Buffett, even more than Munger, is probably ready. Munger just really felt like he wanted to be on that stage as long as he could. Buffett, I just sense that maybe not so much. And as far as like actual evidence to this, we all know, like, one of the big questions with Berkshire Hathaway for how long now has been, what are they doing with all of this cash? They have doubled the amount of cash that they have in the last year, Jose. They're up to $334 billion in cash. He's sold down blue blood positions like Apple, Bank of America, and was like, oh, maybe he's timing the market, but he hasn't done anything with it. He hasn't even added to stocks. Now, reportedly, they're in talks to sell the real estate brokerage unit, which, that's like a core business. So there's something going on here. I do, in my mind, what's going on here is Buffett is sort of reshaping the portfolio ahead of time for his successors to come in and run it, probably in consultation with them. I also sort of think that because inevitably, look, he's Warren Buffett, right? There has got to be a reaction when Berkshire Hathaway announces they have a new CEO. I also think, kind of the side prediction here, the second prediction is they're going to use some of that money to announce a dividend. something that Buffett never wanted to do. But wouldn't that ease the blow of losing the Oracle of Omaha? It's just like kind of having the dividend there. So I've sort of just looked at all this and tried to say, what are you doing? What's going on? And this is the stock I own. And in my head, I've just convinced myself, this is what's going on. Uncle Warren is going to, what better place than with all of his friends and family and loved ones and all the investors who are kind of his family, what better place to do it than at the annual meeting on May 3rd?
Lou, I want to say this is probably the true definition of bold prediction, because I would say if it was me coming in here with that, I would say within the next 2 annual meetings, I would expect this. But you're saying that with this meeting coming up on May 3rd.
I'll book myself for May 5th, Jose. You can come on.
And Lou, you brought up a few great points here where I was going to ask, how do you think the stock price would react to something like this? But you also mentioned the market is always questioning this, right? You gave the age of Warren, 94, and that's pretty amazing to still be doing this at that age. I have never gone to a meeting or even listened to one, Lou. But in the past few meetings, has there been any like introduction of maybe more of a different phase to talk a lot about maybe what's going on within Berkshire to kind of at least slowly show some form of transition? I know online you hear that, hey, look, there's when we see a lot of these big tech purchasing or this abnormality purchases outside of Warren Buffett style, we kind of get a few names of certain individuals. But do we actually have they shown face in kind of like these meetings to kind of help maybe with that transition?
Definitely. I think over the last few years, Greg Abel in particular, who will take over, has become more in the spotlight. And part of that is like, look, these were 2 guys in their 90s running a huge company. So I think there was just kind of a need to show that even if they intended to be there for a while, that there are competent people here. It's hard to say, because last year with Munger gone, it like kind of necessitated that was enough to, they had to do something different. And so maybe it's kind of easy to dismiss that like, well, they had to do something different then. But I do think that whether or not he's going this year or whenever, they have made an effort to kind of ease the markets the best they can by saying, like, look, Warren Buffett's smart. He's picking smart people to keep the company going. I can't imagine, though, how this could happen and it wouldn't have at least a near-term reaction to the stock market. I mean, I'm sitting here predicting it, and it would make me very sad and a little nervous about my investment if it does happen. So, yeah, I mean, I don't know if a dividend is enough to reverse that, but it would make sense to me. If you got $300 billion in cash, you can afford to give a little bit of it away, right?
And just to remind the fools, the poll is up and running. Make sure to get your vote in. I will be getting my vote in after a few more questions here. Look, you mentioned, and if I was doing something and that was in my 90s, I would enjoy doing it with my best friend. And that would make me feel younger and younger and younger and just make me really enjoy it more. Do you think if, obviously it's, I don't want to be disrespectful in any way, but if Charlie was still alive, do you think maybe this prediction would not be here right now, Lou? Would you believe he would go a little bit longer if his best friend was still there with him?
I do. I mean, that's part of this for me is I do think, I mean, I'm not, despite Jayson Hall saying it I'm not in my 90s yet, but I will say I do think that things like that do sort of put things in perspective. And again, Buffett definitely enjoys these meetings. There's no doubt about it. He's not forcing his way through. But Charlie always seemed like the one who, you're going to have to pry him away there. I actually think Buffett would enjoy kind of stepping back. I don't know. I mean, this is, again, trying to get inside someone's head. But I do feel like it just feels like now could be the time. And if nothing else, it just would explain some of the things that's been going on there.
And Lou, with technology now and kind of like, the only thing is I feel like sometimes the market knows something beforehand and we kind of, there's like whistleblowers and just rumors going around. Again, I'm not within this Berkshire community. has there been any increasement of leaks, meetings, of anything like this that can also be used for more of evidence to this bold prediction?
I mean, and that's a great point. It's a great kind of pushback on it because look, Berkshire has always been very good at keeping things in-house, and I think it's helpful to be in Omaha there versus being in, based in downtown New York. But it does feel like something like this that we would be hearing something. I mean, I think there's been a lot of speculation. I don't think I'm alone in kind of asking this question, but yeah, I don't think it's leaked, and it probably, you're right, that something at this level we would hear something.
All right, Lou, I think we
right,
only have a few more seconds here for
get your votes in. Vote early, vote often.
And Lou, I think this is going to be the first time in the show I'm gonna disagree.
Okay.
And Warren will continue. The only reason, Lou, is I feel like nothing is a secret anymore, and I think we would have heard maybe a little bit more rumors here if something like this was going to be announced. But yeah, I'll be on March 5th as well with you, Lou, so we can see who ended up right here. But this one was a nice. It was the percentage was pretty close. It was 56. Agree that Father Time win, and 44 disagree and believe Warren will continue. Luckily, though, Lou, this was 0%. No one needed more information. Everybody decided pick the side.
This is what I figured people would have, and I've shared the screen real quick, and I know we have to move on, but Lauren, if you can, because we did get a 10th vote in, okay, and I think it might have tied it. Yeah, so Gemini says there is, based on available information, it appears that Warren Buffett has no plans to retire. So there you go. I sort of like this. I know we shouldn't do it, but I think we should start asking. I should get Jester up instead, because Jester's probably much more accurate here. It was just Gemini was easier to click on, but there you go. So I don't know. I don't know, but
That's a great idea. And Motley Fools beat the AI in these bold predictions.
Yeah. All right, we have a couple more to get to. Jose, are you ready?
Yeah, so I'm going to jump into my next prediction here, Lou, and it's going to focus on a very popular semiconductor stock, not NVIDIA. This time is Intel. And Intel, just quick background, they recently introduced their a new CEO. Intel has kind of been in a crazy turnaround story right now where they're trying to advance, their chip design and their manufacturing design. The manufacturing is where you kind of build these chips. And Intel normally used to produce all their chips in-house. But as them lagging in the manufacturing space, Lou, they've actually been they've been sending their designs to TSMC, which is a competitor in their manufacturing side. And right now, they've mentioned in a recent presentation that about 30% of their wafers are outsourced for Intel at the moment. So now, and in again, just quick pre-log here, the company believes that it will eventually hit about 15 to 20% instead of 30%. But my prediction is Intel will continue to use TSMC for these manufacturing needs at these high levels for the next 2 years, and that 30%. So I might have worded it a little bit wrong in the kind of document that we have, but overall is that they will continue to use TSMC at this kind of 30% outsourcing versus kind of what they're looking for 15 to 20%. And the main reason I'm going to go with this prediction, Lou, is Intel is designing new chips, and the new chips that they're going to continue to design in the upcoming years, in the upcoming quarters, are going to be using the most advanced manufacturing process. And if they want to continue to compete against the likes of AMD and other players in this space, they can no longer be held back by saying, hey, look, even though we want to design the best, we need to design what's the best we can produce. And that is what has created kind of this lag between their competitors and them. I think now with the new CEO is like, I don't care if we're not going to be using our manufacturing. What we want to do is be able to design the best chips And if that means we have to go give TSMC more money, then we're gonna go do that. So I believe Intel is gonna continue to use a nice amount of TSMC for their wafer manufacturing.
So when you were thinking about this, there's been all sorts of rumors around Intel as far as a breakup, acquisitions, all that. Maybe it's sort of quieted with them actually naming a CEO, but I still think there's a lot of, talk about that, maybe at least. How much does that factor into this? Because obviously, I mean, if the foundry business is suddenly elsewhere, kind of, that throws everything, but they still have a lot of in-house capability there, right?
Yeah, so I think the new CEO for me, Lou, made this prediction more a higher chance of happening, because in the semiconductor world, Lou, like we saw, Intel focuses on two products. It focuses on manufacturing and it focuses on design. And when the new CEO came out or was going to be announced, I was curious if that CEO would have more specialization in manufacturing or more focus in design. If that new CEO that would have came in would have had more focus on manufacturing, I don't think I would have made this prediction. But the new CEO is one that really just wants to be the best at everything. And I think because he has prior experience in a lot of semiconductor companies, he was the CEO of Cadence, because he had this perfect I think he's one that has a nice understanding of both the manufacturing and design side, that he will make sure that Intel will design the best chips, even if it means that they don't have to use their own manufacturing capabilities. So this new CEO is someone that wants to make sure the best. In the long term, Intel's going to win, even though in the short term, it might not look like that's the move he's going with.
Yeah, that's interesting. And of course, the obvious thing here too is that, and I know it's sort of apples to oranges, but anyone, Intel included right now, the goal is to